It's Stamper over in Italy saying that UniCredit may consider BPER as a potential target, and that is having an impact on how it's trading ahead of the open, so we'll watch that. And AB InBev in the drink space, Wall Street Journal has a story about the potential for this business to do a $700 million deal for the Party Punch maker Beatbox, so we'll watch consolidation in a couple of different parts of the market this morning then, Chrissy.
Who knew Party Punch could be such a stock-moving event? Nevertheless, let's get these markets open because, of course, there's plenty of sectors that we're keeping an eye on. We mentioned the tech sector, defense in there as well. Lots of geopolitics as well, walking in through from Zelensky to the comments we heard from MBS in Washington. Right out of the gates, we're seeing FTSE 100 kind of not giving us much action, very, very flat. But again, keep an eye on the DAX, keep an eye on the CAC 40, keep an eye on the IBEX because these are the places that where you have seen the most volatility. The CAC 40 getting their cue from the weakness they're seeing in China. The DAX, of course, very exposed to that defense story. And, of course, even the IBEX and the FTSE MIB, that banking story is going to permeate through. Lots of individual stock stories, Val. How do the sectors look?
Well, look, it is looking pretty mixed when it comes to the sectors. We do have around 12 in the green, the remaining 8 in the red. So pretty split as versus to yesterday's session where all sectors closed in the red. At the top of the basket is energy. We're seeing the likes of Shell, Total Energies, and BP, some of the biggest points gainers in the Eurostoxx 600 just in the first few moments of trade. At the bottom of the basket, maybe not surprisingly, is technology. It was a soft close for the NASDAQ late last night on Wall Street, and NVIDIA being the main points loser to the downsides. That does point us a bit softer when it comes to European tech shares this morning. But broadly, we have 333 shares in the green, only 216 in the red. So more up than down so far this morning.
Yes, more up than down, which tells you something, doesn't it? And technology was by far and away the biggest loser straight out of the gates, but has pared some of those losses just a little bit, Valerie, and now it's just down 0.2% as a sector. And the worst performing sector is utilities, which, you know, that's linked, I guess, but also tells you something about where the market's thinking is. At the top of the market then, Valerie, you flagged energies. I mean, all of these technology, utilities, energy, they're all part of a similar theme sometimes. Today's market is looking at things differently, and it's not part of the same theme. Energy is higher by around 1%. It was interesting yesterday that tech was weaker in Europe, but actually it was things that were just cyclicals like autos, banks, basic resources. They were the weakest performing sectors. Today looks a little bit different, and we do have that slight balance to the upside as the Stoxx 600 tries its hardest, Critty, to go higher.
It is shocking to me that we're seeing energy in the green right now and driving the markets higher, to your point, because we're looking at Brent crude prices that are actually pairing those initial gains from the session. 64.452 is where we are on that. And this is coming in the background, by the way, of some of the geopolitics that we've seen, the background of the conversation between MBS and Donald Trump in Washington yesterday. So interesting to see how much of that shakes out. And, of course, the sanctions conversation, which is kind of lingering in the background. I should also mention that Roche is having a second positive day. Yesterday, we saw it was moving the market quite a bit and leading the healthcare sector to the upside. It feels like it's a similar story, I should say, today. Let's talk a little bit about some of the other commentary we're hearing as we're talking about valuations or we're talking about a potential slowdown. Well, Goldman Sachs president and COO John Waldron spoke about those very topics at the Bloomberg's New Economy Forum in Singapore earlier. Take a listen to what he had to say.
There's been, equity markets, IPO markets much stronger. So we've seen a lot of deployment of capital this year, and I would expect that to continue in 26 if we have that underlying economic backdrop that we're expecting. It may move around the world in various ways. I think the notion of all this money running out of the United States was declared much too early.
Joining us now is Patrick Brenner, multi-asset CIO over at Schroders. Patrick, welcome to the program. Thank you for joining us this morning. I'm going to ask you maybe a little bit of a strange question. What are you worried about the most? What keeps you up at night when it comes to these markets? I could give you a laundry list, but I'm curious about what's top of your worry list.
Well, I think probably the biggest worry is that our baseline scenario of a very low probability of a recession in the U.S. Could be wrong. I mean, that's probably the biggest risk from a fundamental perspective, because when we look at the fundamentals, the situation is still pretty good. We think the labor market is in this low hiring environment, which is not a bad place to be. Real wage growth continue to be supportive for the consumer, which is the backbone of the U.S. economy. So I think that's probably what keeps us awake, if we were to be wrong on that side. The other side, obviously, I'm sure we might touch on that, is AI. If we were to see some bubbles around, some waves around AI, that will obviously has the potential to distort markets going forward.
Well, to your point, it's very timely to have that conversation, given we have those NVIDIA earnings after the bell. Walk us through, though, the outperformance of tech or underperformance of tech that could be emanating out of the United States. What is the read-through into European stocks?
Yeah, I mean, it looks right now, to be honest, that everything seems kind of correlated, right? I mean, our sense is that the recent corrections we're having right now is actually more driven by liquidity than by anything else. And I think, if you look at the internal market dynamics, it's interesting, actually, you will see that those U.S. large cap, high quality tech names actually have been holding up pretty well. And for us, this is kind of indicating that this is probably more liquidity driven than fundamentally driven. And what we are seeing on the crypto side is probably going in the same direction. But when we look at the fundamentals, actually, we think that the picture is not too bad.
A question, though, you're tying this recent struggles in the equity market to the liquidity picture. It's tied to the Federal Reserve, the recent hawkish comments we've gotten out. That does seem to be there is some sort of issues going on at the Fed in terms of what to do with this December decision. How are you viewing the fact that at least we've not gotten a clear update from the Bureau of Labor Statistics? It doesn't seem like they're going to clear this backlog before the Fed convenes again. They're still going to be in a data fog when it comes to that December decision. Do you think that means they're going to be on hold?
Look, I think clearly we've been flying a bit in the dark recently with the U.S. shutdown, and it clearly increased uncertainty around macro data. And I think to some extent this probably explains why some of the pricing around the December cut have been repriced. And to us, it does explain why, to some extent, this is kind of tightened the liquidity condition recently in the market, and probably explain the recent correction. Going forward, we still believe the Fed is going to cut in December.
Yeah.
So we think that with having more clarity going forwards, both around the labor market but inflation, there is more space for the Fed to cut.
So if you're assuming that the Fed is going to flip to maybe a more dovish stance, are you buying the dip here? Is that one reason why you think this equity market could rally and you see value in this drawdown? So
we're staying positive risk. We've been positive equity for most of the year, and again, we don't see that further than just a correction, so we're happy to stay long equity at this level.
Patrick, talk to me about the link. You started this conversation saying to Chrissy, one of your biggest, well, the thing that you would worry about is if the economy in the United States didn't turn out as you expected, and your low probability of a US recession turned out to be worse. What's the link between that and the job story right now? I mean, because it seems as if we could get some negativity around jobs, but certainly big tech names could be doing just fine and could be telling us a different story about America's prospects. I mean, where are you focused? Are the cracks that we always look for, are they the same?
I think you need to look really at both. I mean, it's with no doubt, what's happening on the AI story is driving markets. I think no one is going to deny that. But equally, it is important to look at what's happening in the underlying economy in the US, and we believe that the labor market is still critical, right? So having the right call on the labor market, we believe, is still something that we should look. I mean, right now we are in a position we believe fundamentally where the labor market is all right. We think that the AI cycle is not over, so there is probably more room to go there. So again, this is all supportive for a long equity position.
And I guess you'll be looking for the sort of cyclical and the structural when it comes to that labor story. What about gold then? Because you're still pretty positive on gold, even though you don't want to turn fully defensive on your portfolio, and you're hopeful about the US economy and AI, but you are also buying gold, I understand. So what's the story there?
Yeah, I mean, despite the recent volatility that we've seen in gold, we still believe that gold has a role to play in the portfolio as a diversifier. especially in an environment where there is growing concern from investors around the role of the US dollar and US Treasury in the portfolio to kind of diversify the long equity risk. And with that perspective, we still believe that it does make sense to continue to hold gold in the portfolios.
Do the lack of correlations right now matter? And I know you kind of said everything is a little bit correlated from the equity perspective, but it doesn't feel like this bond market is responding to the dollar or vice versa. It doesn't feel like the equity market is watching what's happening with the bond market. Are you seeing that? Is that a problem?
I think it's really tough right now to find uncorrelated negative correlation in the markets. It clearly seems that there is one big trade. And I think I'm going back to my point around the liquidity. It does really feel that the market is very much liquidity driven. We mentioned about the repricing on the front end of the curve, which probably, has tightened financial condition in the US. Maybe we should talk about also, the tightening in liquidity that we've seen from the rebuilding in the TGA, in the Treasury General accounts. Clearly, this has been a drain on liquidity. But now with the US administration reopening, that should resolve it by itself. So hopefully those liquidity drains should continue to slow down, and we should hopefully come back in a market which could be more fundamentally driven, and then going back into those more interesting correlation features.
Patrick, given a lot of your thesis is about the liquidity issues or maybe lack of issues that the Fed is responding, we have seen that tri-party repo rate move above the Fed's upper bound of 4%, and the Fed has mostly been on the sidelines. Now, some are viewing this as a big departure because the Fed, since 2008, the 2019 repo blow-up, has always responded aggressively to hiccups in repo rates, but they've not done so this time around. Does that tell anything to you?
Well, I don't think the Fed is in a situation where they want to tighten liquidity conditions. So I think, when they feel that there is a risk around, a systematic risk around the financial system, I'm pretty sure they will do whatever is necessary to keep sufficient liquidity in the market. So that's not a big worry to us right now.
Okay, Patrick, thanks for putting that back on our radar. Thank you very much for joining us. Patrick Brenner, multi-asset CIO over at Schroders. Let's have a look at some of the core six and how they are performing. It is a day to think about technology, so we do that this morning in the shape of ASML here in Europe. One of the weaker parts of the market yesterday was anything to do with the semiconductor space. ASML is down by 0.5% this morning. Schneider Electric also down 0.6% with its links to big tech. That is of interest. Elsewhere, though, there are areas of green we see from pharma to defence to consumer goods. Let's get an update on some of the individual stocks in focus. Chloe Melly has a briefing. Chloe.
Good morning, Anna. Let's start with that utilities space. And we are down across Enel and Endesa this morning after both of those companies were RBC, with analysts saying that the expectations were maybe a little bit too high for those companies and valuations were also a little stretched. So we are down 1.5% for Enel and 1.8% for Endesa this morning on the back of those downgrades. Moving on to WH Smith, which is also in the red today. We're down 1.5% after the CEO resigned, and that follows an investigation into an accounting error which forced the company to earlier this year slash its profit outlook in North America. The discovery of the accounting error led the shares plunging earlier this year over the summer, and now the resignation of the CEO following that investigation is also sending the shares down this morning. Moving on to SMA Solar, and this company, which is a provider of solar energy equipment, was raised to a buy rating at Jefferies, with analysts saying that the company had weathered the worst and was now set for an improvement in profitability going forward, and that is really driving the shares higher this morning, and we are up 6.7% for that company. And finally, let's end on another positive move, and Sage, which is a provider of a payroll software, is up after announcing a new buyback and also a very positive outlook, and that is despite the fact that profit missed expectations for the latest period, and we are up 1.25% this morning after this outlook and this buyback really reassured investors.
Chloe Melly from our equities team, thank you for running us through the stocks on the move this morning. Coming up on the show, we'll get into the details of the UK inflation print after we receive the first fall in the figures for 7 months. More on that next. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. November 26th, Chancellor of the Exchequer, Rachel Reeves, delivers the UK's autumn budget. Can she boost growth and productivity by unlocking investment? How will the Treasury raise revenue without breaking tax promises? And will the budget prove that a fairer economy can reward working people? Bloomberg Television brings you special coverage starting with the Chancellor's statement to Parliament at 12:30 p.m. UK time. And tune in Thursday for the opening trade budget special at 7 a.m. Bloomberg, context changes everything.
Welcome back to the opening trade. We're near 17 minutes into today's cash equity session here in Europe, and we have broadly flipped into the red across all major indices. Euro Stoxx 600 down 0.2%. The CAC 40 is underperforming this morning, down near 0.4%. And S&P futures over on Wall Street have now flipped into the red after briefly trading in the green in the last hour and a half. Well, now let's turn to the UK. UK inflation fell for the first time in 7 months this morning, with price pressures easing as traders add to bets that the Bank of England will cut rates in December. That odds have risen from around 80% to around 87% so far this morning. We are seeing a rally in front-end gilts. Those 2-year yields are down around 2 basis points. Well, joining us now to discuss this and more is Kit Rees from our Bloomberg team. What's your read on the inflation print this morning?
Yes, so the big trend is that it's going downwards, which is probably going to be very welcome for the Bank of England and also for the Chancellor of the Exchequer. So there were a couple of positives, mainly the energy prices were the big downward contributor, which has been a big pain point for households, as well as household costs and rents. Yet there's still a couple of areas of concern. Food bills unexpectedly rose, which is a little bit of a negative. But we saw services inflation moderate a bit, and the UK is a big services economy, so this is really key, and this is something that's watched very closely by the Bank of England. But overall, even though inflation came in a little bit hotter than economists expected at 3.6% for October, it was in line with Bank of England forecasts. So overall, the trend is downwards, and this is seen as a positive.
Kit, I want to get your take on the budget in just a moment, but before I do, I want to just flag to our global audience that the London Stock Exchange Group CEO David Schwimmer spoke on this very topic exclusively from the Bloomberg New Economy Forum. He was talking about the UK budget. Before I come to you, I just want to flag what he had to say.
I think the important thing for the UK from an economic perspective
is to make sure that its fiscal house is in order, to have the breathing room for investment, both public sector and private sector investment. I think there are clearly some fiscal challenges. There's some political challenges. And I hope that the government can put a budget in place that addresses those kinds of needs.
David Schwimmer there, the CEO of the London Stock Exchange Group, otherwise known as LSEG. And we should mention the parent company of Bloomberg News competes with LSEG to provide news, trading services, and data to the financial industry. But you can hear him talking there about some of the fiscal challenges in the UK. We are T-minus 1 week away from it. Kit, I want to bring you back in here. T-minus 1 week. Is anything, like, how much is going to change here? It feels like the plans are still waffling. Does today's print change the course that we're already on?
It's hard to say, really, because inflation is still higher in the UK than in other European countries. So it's still a very big and a very salient issue, especially for voters. So it's probably unlikely to move the needle very much in terms of impacting Reeves's thinking. She has pledged measures to bring down the cost of living. So this is probably still very much going to be a focus. We're probably likely to see some kinds of tax hikes. But overall, it shows that, inflation is still high. It's coming down, so the trend is positive, but we're still not quite there yet.
And we've had some comments coming through from Hugh Pill around inflation. I mean, this was yesterday before this data hit, but he was saying that the level of inflation is sort of, the headline number overstates. You're right to point out that it's high compared to other countries, comparable economies. But he's sort of suggesting that actually there are, beneath the hood, there are lower pressures. There's a lot of regulated stuff in that headline inflation, isn't there?
Yes, definitely. And, if you're looking at services, that is coming down. So I guess there could be made a case that perhaps its headline inflation isn't as bad as, what's going on in the underlying economy. But we still see things like food prices, which consumers, that's very salient for consumers. Households obviously keep an eye on grocery bills. And overall, in terms of what it means for the Bank of England, the last vote was very close to call. Hugh Pill still said that, cautioned against lowering interest rates. So we'll have to see, this changes the Bank of England's thinking. Markets are pricing in a rate cut for December, so it could be likely, but still there's a lot of moving parts, and we'll probably have to wait for the next inflation print to see, to really confirm this downward trend.
Yes, and of course there's the budget in a week. Thank you very much, Kit. Thanks for joining us. Bloomberg's Kit Rees with the latest on the UK, and with the UK in mind, we want your questions. Join Kit Rees and the Bloomberg Markets Today blog for a special UK budget Q&A. That's 11 a.m. London time. It's taking place today, so a week before the budget. They'll be discussing what could be in store and what it means for those in the UK for their money. Send your questions to marketstoday@bloomberg.net. And the UK Chancellor Rachel Reeves is expected to deliver her budget at 12:30 p.m. London time next Wednesday. Viewers in the UK and Europe can join us for a full coverage and analysis leading up to the budget statement, and of course, some response from the opposition and indeed some analysis off the back. So, Chrissy, lots of ways to get involved in our budget coverage.
Absolutely. Let's go to another part of the world that we're keeping a very, very close eye on. That, of course, is what's going on in Asia. China escalated its retaliation against Japan, suspending imports of Japanese seafood and halting approvals for new films. More signs that the diplomatic spat is far from over, despite efforts from the Japanese. Bloomberg's Winnie Su joins us from Hong Kong. Winnie, just walk us through the developments of the day. It feels like this is becoming a more volatile situation than a lot of people would like.
Yeah, exactly. We are really feeling tensions escalating pretty quickly here, and that is also felt in the markets. As you can see, over just the past 3 days, the TOPIX is already down about 4% so far, and that's the broader implication. And now, especially with China saying that they might going to act if Takaichi does, or if Japan does not walk back these comments, and Japan saying that they are willing to have more conversations with China. And in these specific sectors, you can also see that, for example, in the seafood sector, we were seeing the Chinese seafood names rising while the Japanese ones were down after Japanese local media said that they are hearing Chinese officials saying that they were going to ban seafood import from Japan. So that kind of escalation is really being felt in different sectors today, and we are very closely monitoring what's going on between the two countries here.
Winnie, how are investors hedging against a possible further escalation of these tensions between China and Japan?
Yeah, exactly. They are really looking for the pockets of opportunities and, more importantly, which sectors to avoid at this point. So we are seeing that people are walking away from these sectors with very high exposure to China, and that includes retail, includes department stores, cosmetics, for example. We're talking about, for example, Shiseido having about 30% of their revenue from China, and hence it's going to see very big impact if this tension continue to escalate. And China actually, the tourists from China, they account for pretty much the biggest portion of spending when we compare that with other foreign travelers to Japan. So big impact on the travel industry. And now we're also shifting attention to the trading firms, because so far the restrictions, like you mentioned, has been on food, seafood, beef, some of the filmmakers, but also if we're going to expect some more further escalation when it comes to rare earth, that might potentially impact the auto industry for Japan and also the trading firms.
And Winnie, what's the latest thinking around the sell Japan trade? There's this geopolitics in play. There's a focus on big tech, of course. There's also concern around the fiscal story in Japan and what that's really going to deliver. How does all that add up to positioning around Japanese assets?
Yeah, that seems to be the mainstream thinking right now, unfortunately, because we are seeing what we call right now a triple dip. It is the sell-off in stocks after that Takaichi trade, and also now the yen as weak as 155 level against the dollar, and some further sell-off when it comes to the JGBs. So we had that 20-year auction for the JGBs today, and the demand wasn't particularly strong, and hence we're still seeing yields remain quite elevated. And really, this goes to show how investors are still concerned about Takaichi's fiscal expansion policy. And we're also very closely watching what her first economic plan is going to be expected later this week.
All right, Bloomberg's Winnie Sue walking us through the developments there. We thank you so much. Really boiling down some of the details that we're hearing from both the Chinese and the Japanese side. We thank you so much. In the meantime, I want to bring you a quick stock check because, of course, there is some deal news here, some potential deal news that is moving the markets. Very volatile here. You are seeing Unicredit, at least according to an Italian newspaper, Stampa, saying that it may consider BPER Banca, which I guess I'm hoping I'm pronouncing this right, as a potential target. We know Andrea Orcel is, of course, on a little bit of a shopping spree when it comes to the domestic Italian banking unit. He hasn't been able to get the stamp of approval from a series of some of his other bids. Nevertheless, it is moving the market. You did see Unicredit shares down about 1.4%, and BPER, wherever the bank Banca was higher at 1.4% at one point in the session. It's now only higher by 0.2%.
Andrea Orcel seemed to doing all that is possible for one person to do to create capital markets union and banking union. But we will wait to see how that one develops. Coming up on the program, we'll get back to the big tech focus of the day. Investors look ahead to NVIDIA numbers. Q3 earnings will test sentiment at the heart of the AI boom. We'll talk to Richard Windsor next. This is Bloomberg.
The key issue right now for us in the diamond space is the declared divestment of Anglo from DBS. And as you know, Anglo holds 85% stake in DBS. And Botswana, the government of the Republic of Botswana holds 15%. We are resolute now, and we've communicated a firm intention to increase our stake in DBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
This is the opening trade. We're 30 minutes into today's cash equity session here in Europe, and it is looking like a pretty mixed picture, and obviously we're not going anywhere fast. Euro Stoxx 600 is flat to the downside. Some underperformance in the CAC 40, but really not a lot of read-through here. We are pretty mixed when it comes to S&P futures as well. The market is really struggling for direction on risk sentiment after a few pretty deep days in the red for the S&P 500. Critty?
Yeah, it's fascinating. It feels like everyone's just kind of in wait-and-see mode until we get those NVIDIA earnings. You kind of see that with the volume that we're seeing right now. On 20-day average, down about 27%, just rounding up there when it comes to the volume picture. People waiting on the sidelines, waiting for some direction. That being said, from a member breakdown, we're seeing more members in the green than in the red right now. That's kind of interesting. 310 versus 265. Let's go through some of the names that we are seeing. Roche continues to be one of the leaders. We saw this in yesterday's session. We are seeing it again today. Yesterday, the talk was all about a new drug that they had launched that would reach an endpoint, really getting rewarded by the market. Feels like a little bit of a carry-on trade into today. Siemens Energy also moving, but I think the one that we were all trying to do a little bit of detective work on this morning was Shell. The idea of the energy complex as a whole higher by quite a bit. What are they responding to, though, as you start to see the commodity space as a whole drop in today's session? Those shares higher by 0.8%. Let's talk about the decliners, though, because this is where the heavyweights really matter, Anna. ASML is the key one here. The tech story, if we're waiting for the NVIDIA read-through, even the panic of the last couple of days, ASML is where it's going to show up. Already some nerves there, down about 0.6%. One eye firmly on the banking sector. Of course, we have some M&A news, but right now HSBC seems to be one of your biggest laggards, down by about 0.6%. LVMH, if you're worried about China, if you're worried about the consumer read-through, even if you're worried about the geopolitics, it's going to be a read-through into the luxury giant. Those shares, Anna, down by about 0.7%.
Let's get an update, Chrissy, on some of the other stories that we need to keep across this morning. UK inflation fell for the first time in 7 months. The latest print comes as a sign that price pressures are past their peak, ahead of crucial decisions by the Bank of England and the budgets released by the Chancellor of the Exchequer, Rachel Reeves. The US Senate is moving to clear a House-passed bill forcing the Justice Department to release its Jeffrey Epstein files. The House approved the measure 427-1, signaling strong bipartisan support despite President Trump's earlier opposition. Trump, though, has since relented. He could still delay the release of some documents as he orders new investigations into Epstein's ties to Democrats. And the world's most valuable company, NVIDIA, is set to deliver a quarterly report later today. The results could assure Wall Street that the AI computing boom continues or fuel fears that the tech industry is in a bubble which is about to burst. Val, which way will it fall?
Which way will we fall? And perhaps will it set the tone for how the equity market broadly trades into year end? For more, we're now joined by Richard Windsor, the founder of research firm Radio Free Mobile, for some thoughts on the wider tech trade. Just 13 hours to go until this NVIDIA release. Are you thinking that they could raise the bar further for what is this AI trade into year end?
I don't think they're going to raise the bar, but I think most importantly of all, they're not going to lower it either. And the reason for that is actually very simple, is NVIDIA still has more demand than it can handle, which basically means that its revenues are determined by how much capacity is reserved at its manufacturing partner, TSMC. And as a result of that, I think that's given it very, very good visibility. So what I would expect is they'll very slightly beat the guidance they gave. They will guide very little bit more, just a little bit more in terms of what the expectations are, and that will basically set the tone. So I think the tone basically is going to be, it's not booming further, but we haven't seen a collapse yet.
Well, there's been a lot of discussion on what's driven this recent drawdown in the NASDAQ. We had yesterday NVIDIA again for a second day in a row being the worst drag on the index. It was down near 3%. We were just speaking to the Schroeder CIO, Patrick Brenner, and he was really tying this to more of a liquidity story. The fact that we've had a hawkish Federal Reserve, hawkish Fed members really putting that December rate cut in doubt. How are you explaining the recent weakness in tech, and maybe that can inform what you think the market needs for it to bounce from here?
Well, I think there's an element of doubt over a rate cut in December that obviously affects the higher beta end of the market. But I think what is key here is look at what's been going on in the debt market. Now, a lot of these technology companies have raised a lot of debt against the AI build-out, and we've seen a lot of pressure on those bonds in the last couple of weeks. And that nervousness really is around, is the business model of spending billions and billions of money on compute, is it a viable model? And so consequently, how viable is it? And that affects the risk attached to the bonds, and also, of course, the risk attached to the equities that are selling these services in the market.
Richard, talk to us a little bit about, I mean, you kind of hit it there briefly in the bond story. I want to take a little bit of a zoom out away from NVIDIA and just talk about the tech sector broadly. As we do see this weakness in the NASDAQ, there's also plenty of announcements about lending, innovation, the circular theme that you're seeing from some of the hyperscalers into the innovators, into the AI kind of creators as well. And then throw in there the banks that are, of course, lending billions of dollars to everybody. Is that circularity the new norm when it comes to the tech sector? Is this something that should be raising some eyebrows?
It should raise eyebrows, yes, but it is not the same type of circularity that we saw in the internet bubble that caused the communications equipment sector to collapse when the traffic didn't materialize. At that time, it was much simpler, which was the equipment companies borrowed money, lent it to the operators who spent it back on equipment. And then consequently, when demand fell off a cliff, they couldn't pay back the debt, and you know the rest. This time, it is circular, but it's not circular. It's circular in a more complicated way. What I think that does is it doesn't set up the kind of same potential for a collapse, but what it does do is, if there is a perturbation in demand, what happens is these companies are all now linked to each other, and it will set off a round of sort of dominoes all hitting each other, which will cause, I don't think it's a collapse. I've described it in my research as an orderly reallocation of capital. And I think that is what is on the cards, not really the kind of panic, head for the exits, massive collapse that we saw perhaps when we saw the internet bubble 25 years ago.
Okay, so we'll watch that. Yeah, circularity has certainly been one area of concern for the broader market around tech, Richard. Another has been the rate at which you depreciate some of the key technology that's being installed right now, and NVIDIA chips are part of that. Are we expecting, can we get some more detail on the useful life of NVIDIA chips today that could help us understand over what period it is right to depreciate this technology?
This is a great question. And to be honest with you, you can play, as a company, you can play all sorts of tricks in terms of what rate do I decide to depreciate my assets. There's a simple fix for this as an investor, which is forget about depreciation, forget about profit, just look at the cash flow. And that will fix all of these, basically all of this issue. Now, on the negative side, people say, oh, they're pushing out the depreciation schedule to flatter the profitability. On the other side of it is Google rightly says, hey, we've had some TPUs that are 7 years old that are sitting in our data centers and they're still running flat out because we're so short on capacity. So there is no good answer to that question. From an investor point of view, I would say forget about it, just look at the cash flow.
Okay, so cash flow remains the focus then, certainly when we get to the hyperscalers and hearing more from them. Richard, in related tech news, and I wonder how your thoughts develop on this, and it's linked to NVIDIA because it's all about where data centers are geographically, within which national boundaries. We had an interesting story yesterday about SAP keeping Microsoft's EU cloud running if President Trump orders some kind of shutdown, tries to cut Europe off from some of its tech provision. I wonder, software nationalism, is this a theme for 2026? We're going to have to watch this further.
I think there's an element of that, of course. To be honest with you, I haven't looked at that story in much detail, but I think by far the most important story to look at in that area is going to be software and technology nationalism as it relates to China and the United States, because basically what is happening is there is an ideological struggle going on between these two parts of the world, and it's being played out in the technology sector. And so consequently, you know, from my perspective, this is a much, much more important place to look, because that is a real struggle rather than perhaps, you know, what might be seen a bit of tit for tat and arguments going on between what are supposed to be allies.
Richard, in the last 24 hours, among the fears and the backdrop of kind of these jitters that you're seeing in the tech space, we also got news of a minor outage when it came to Cloudflare and some of its partners. You had ChatGPT, you had X, you had a series of other platforms that were affected by the outage. And it feels like we've seen several of those incidents throughout the year from Cloudflare and some of its peers as well, including one from Microsoft. It feels like it's pushing this extra tailwind into investing in things like infrastructure. But if you do that, if the hyperscalers that are viewed as growth companies invest in infrastructure, data centers in their CapEx, shouldn't that show up in their valuations? Shouldn't they be trading more like, or at least closer to the Chevrons and Exxons and BPs of the world that are also investing in CapEx and industrialization? I know that's a little bit of a stretch, but Richard, I hope you understand my point. What do you think?
I understand your point completely, which is, you know, if you're one of these neo clouds and you build a ton of data centers, and then you then sell the compute almost as if it's like basically like a commodity, and you are going to see that happen. Now, the thing to bear in mind is that, taking your analogy to its logical conclusion, if you look at OpenAI, if you look at Google, as two examples of this, they're much more vertically integrated. So in your analogy, yes, they would be selling the energy, but they would also be selling the vehicles and the services that are based on that energy. They're much more vertically integrated. So you have to look at it with a little bit more nuance than that, because they are much more integrated across the whole of the AI supply chain.
Richard, thank you very much. Thank you for your time. Richard Windsor, founder and owner of Radio Free Mobile. A busy day for tech ahead, for sure. Let's pivot to other news flow this morning. The US plans to greenlight the first sales of advanced artificial intelligence chips to the Saudi Arabian AI firm Humane. This amid a landmark meeting between the Saudi Crown Prince Mohammed bin Salman and the US President Donald Trump in Washington. Joining us now, Bloomberg's Stuart Livingston-Wallace with some takeaways from this meeting and the developments in this relationship. Stuart, great to see you. So talk us through this broad AI agreement between Riyadh and Washington. What does it entail?
Yeah, good morning, Anna. So, I mean, look, the short of it is we don't know exactly yet. It hasn't been announced, and we don't quite know what the contours are. But what you can say is that this is a big win for MBS and for Saudi Arabia more generally. You've seen this huge push into AI, a sort of a pivot away from some of these so-called giga projects that they've been doing across the country, and really a huge focus and a huge amount of money going into this new company, Humane. And really their idea or their ambition is to be sort of the number 3 power in AI and compute in the world within several years. But of course they can't do that without access to these high-end chips. So the fact that we're even at this stage where it looks like we're going to get some sort of at least preliminary agreement suggests that that will definitely allow them to go forward on that grand plan.
Stuart, there were previously some fears that these chips could get into the hands of China via the Middle East. Have those kind of fears been abated?
Yeah, I mean, I think to some extent we probably wouldn't be at this sort of preliminary stage. So Humane itself has said quite explicitly that it will not be using any Chinese equipment equipment, within the company. And then presumably we'll have to offer some other reassurances as well, because that, like a lot of its neighbours, it has to come up with some sort of evidence that that's not going to happen. At the same time, the Gulf nations do maintain, and I suspect want to continue to maintain, strong ties with China. But on the other hand, they realise that the tech coming out of the US is probably at the top of the food chain, and that's ultimately what they're going to need if they're going to fulfil these ambitions.
Stuart, I'm so glad you referenced that relationship between the Middle East and China, because part of the conversations happening between the White House and Saudi Crown Prince is around defense and the F-35 jets that have become a very contentious issue. I want to get your take on it, but before, I just want to play you some sound that we heard from the former Vice President of the United States, Donald Trump's first running mate, Mike Pence, yesterday, commenting on the risk of the sales of the F-35 jets to Saudi Arabia. Take a listen.
I have concerns about the sale of F-35s to Saudi Arabia or any nation that could not assure the United States that technology and the great advancements that we've made with the F-35 don't fall into the hands of nations that are hostile to our interests.
Mike Pence, the former Vice President of the United States. Stuart, he went on to very specifically say that the risk you run is those technologies ending up in the hands of Russians, of the Chinese. What did the president have to say when the jet sale to Saudi Arabia came up?
I mean, I think there's basically lots of issues here. I mean, again, we do need to caveat this. We are at a very preliminary stage, and I think, the good example here is at the end of Trump's first term, he agreed to something similar with the UAE, and what are we now, 5-6 years later, we're still waiting for that to get completed. So we're many, many years off this getting done. However, it's not just concerns about the technology potentially falling into other people's hands, particularly, as Mike Pence said, hostile nations, but I think it's also, here about the balance of power in the region. So, these are very serious bits of military kit. They're about $100 million a pop. And the only country in the region that has them at the moment is Israel. And Israel is supposed to have this supremacy in terms of its military abilities. So there will be some concern there about changing the balance of power too much. On the other hand, you've also seen Trump declare Saudi Arabia last night, or at least my last night, as a major non-NATO ally, which again is a sort of it's signaling this attempt to get this rapprochement, at least on the defense and the military side, and bring Saudi Arabia into the fold, with ultimately the goal of Saudi Arabia joining the Abraham Accords and a normalization with Israel. So again, it's part of a much grander strategy. The F-35s will take several years, if they happen at all, but it's all pointing in the same direction.
Yes, and President Trump said he got some positive response from Mohammed bin Salman around the Abraham Accords, so we'll watch for any news there. Stuart, thank you very much. Bloomberg Stuart Livingston Wallace with the details of that relationship as it develops. Let's pivot back to what's going on markets right now, and specifically the banking sector within Italy. Chrissy, you were talking earlier on about this story. We'd seen some reporting elsewhere in Spanish media about the possibility of UniCredit buying BPER. Well, we've had a pretty clear denial of that by UniCredit, saying there's no active talks regarding M&A on BPER. Rumours on BPER, a deal there, are entirely unsubstantiated.
We'll keep monitoring those shares, of course, and the share price reaction. Both stocks now in the red. Coming up on the program, we'll get the latest on the B20 Business Summit. That is underway in South Africa. Bloomberg's Jennifer Sabasaja joins the program next. This is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back. This is the opening trade. Now, the B20 meetings are kicking off today in Johannesburg. That's a business engagement group that runs ahead of South Africa's G20 summit of leaders. Not all the leaders, though, and that's part of the story. Joining us now from the event is Bloomberg's Jennifer Sambasaja. Good morning to you, Jennifer. Good to see you. So top South African bankers, they were pretty bullish at the Bloomberg Africa Business Summit yesterday. So what are we expecting from the B20 today? A similar bullish mood?
That's right, Anna. And it wasn't just South African bankers. I mean, it was really Pan-African financial experts, analysts, bankers, CEOs that were quite bullish on the growth trajectory of a lot of emerging markets, and in particular, a number of African markets, in particular South Africa, which we're standing here in today. And as you were just mentioning, yes, today is the first day of the B20, which runs ahead of the G20, and it's really the culmination of a year of engagement and dialogue on some of the issues that have been carried on prior to South Africa taking over the presidency and seeing ways in which they can push it forward. And a lot of the business engagement, they try to hone in on the fact that they are not trying to rewrite the rules here. They're trying to come together and find some consensus in pushing forward some of the narratives and some of the ways in which they can help strengthen the financial architecture for the global south, but also for a number of the countries that make up the G20. And so we are waiting to hear some of these business leaders continue to speak throughout the day here. Of course, the elephant in the room is that the U.S. president will not be in attendance, but still, many people are encouraged by the engagement that they've seen over the past year with business leaders and with also some of the other delegates that have been a part of the negotiation. So whether or not we actually get a communique, a declaration at the end of this summit, for some people, it doesn't necessarily matter. The fact that they're all speaking to a certain extent, at least on a business and private sector level, is a win for many of the people we've spoken with.
Jen, you mentioned the U.S. president is one of those notable names missing from the G20 later this week. But what are the views of the ground about the upcoming summit?
Right. Well, the big question leading into this is really, will this summit still be of significance without President Trump being in attendance? Of course, we know there are a few other heads of state that won't be here, but there are still a number of leaders that are planning to come. A lot of, quite a few European leaders who plan to also be here. And the question will be whether or not we actually see a declaration at the end of the summit. We haven't yet had a G20 where there hasn't been a consensus this, and the U.S. has said they may veto any sort of declaration, potentially only seeing a chairman's statement or agreeing to a chairman's statement at the end of this. They, of course, take over the G20 next year. And so we're really trying to see where some of these leaders that will be in attendance do find consensus. And for South Africa, which is the host of the G20, for the most part, they're dismissing the fact that President Trump is not here and just hoping that they can walk away with some of the priorities that they took over this presidency with and continue to push them forward moving ahead.
All right, Bloomberg's Jennifer Sabasaja at the B20 Summit in Johannesburg. We thank you so much. Let's go from Johannesburg to Singapore, where Bloomberg's New Economy Forum has also kicked off, bringing together key players from government and private enterprise from across the globe. Our very own Francine Lacqua is there on the ground. Fran, we were just speaking to Jen about the highlights in Johannesburg. Give us the highlights in Singapore.
Thank you so much, Crudy. Look, there's quite a lot going on here in Singapore when you have ministers, heads of states, and of course, some of the biggest names in business. What do they talk about? What they worry for 2026? That's AI, that's of course geopolitics and fragmentation. And then there was a lot of talk about de-dollarization, what it means for investments in the future. And we had some pretty heavy hitters talking about how they see the future. Now, I would pick out 3 to 4 big business leaders that we spoke to. Mark Rowan of Apollo actually saying that he does not agree with Jamie Dimon's concerns about hidden cockroaches in credit markets. He basically said that, look, there's a very confusing landscape for investing right now, given interest rates, geopolitical uncertainties, and given prices in general, i.e. inflation, but then he still sees quite a lot of opportunities and he doesn't see anything systemic. Then there was, again, a bit of pushback for Jenny Johnson when it came to the de-dollarization trade. And then I had a great conversation with the president of Goldman Sachs. Of course, he is John Waldron. Now, what he talked about was, look, inflation will stay sticky. U.S. companies are likely to see layoffs in 2026. And then we talked about the more immediate concern of a market correction. And again, he says it's not too bad to let a bit of steam off, but nothing too worried. Here he is.
I think that the dynamic between the U.S. and China, which we call increasing strategic interdependence, so the countries are interdependent, but there are going to be areas where they're going to be more focused on national security. And because that relationship is getting much more complicated, you're seeing more fragmentation around the world. And so a lot of the conversation here in Singapore this week has been about fragmentation, new regional alliances, redesigning supply chains. You know, I worry about that because it's a new world order. And we don't really know what to expect in that new world order. And I think that will create disruption and pressure in the system, which is, you know, kind of unprecedented for the system that we've operated under for quite a long time.
So, Anna, we discussed, of course, this new world order, what it means for cross-border mergers. So lays into more opportunities.
Francine, thank you. Bloomberg's Francine Lacqua from the New Economy Forum in Singapore. Of course, she'll be back in the next hour with more interviews from that event in Singapore. You can see all of those on your screen there. The Swiss Economic Secretary, the PwC Global Chair, amongst them. We've just got a red headline around the Dutch and the status of Nexperia. Handing back control to the Chinese is the latest there. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, global stocks stabilize after a $1.6 trillion wipeout as investors brace for earnings from NVIDIA to gauge whether the AI rally still has momentum. UK inflation eases for the first time in 7 months, lifting hopes that price pressures have peaked just a week before the Chancellor unveils the budget. Plus, Beijing escalates its feud with Tokyo, suspending imports of Japanese seafood and halting approvals for new films in the latest signs their diplomatic spat is actually far from over. So good morning, everyone. Good afternoon. If you're watching us from Asia, I'm here in Singapore at the New Economy Forum. First thing is first, you know the drill. We get straight to the markets. Look, stocks pretty much steady after a pretty bruising couple of days. Traders now, I guess, refraining from taking big bets ahead of NVIDIA's earnings later today in what will, I know, be a potential pivotal test for the big tech-fueled rally. The other thing we're watching, of course, is the release from the Fed of the minutes for last month. Traders now seeing less than a 50% chance of a quarter-point interest rate reduction. So you're looking at gold, 4,084, and then the U.S. 10-year yield at 4.1212. We're also looking at European markets. Again, they kind of follow, just given all of the tech and NVIDIA news, what we're seeing in the U.S. Now, I am here in Singapore. Of course, this is where the latest edition of Bloomberg's New Economy Forum is happening. The event established in 2018 to embrace the historic shift in economic power from west to east, from north to south, by bringing together the best of government and private enterprise from across the globe. So this is the latest, of course, from Singapore, and fears of an AI bubble and market correction have now dominated much of the discussion here in Singapore, with many chief executives and business leaders telling us that valuations had become too high in the sector.
I would say you're seeing in the markets right now a pullback, which I think is healthy. Markets have run quite a bit this year, U.S. equity markets in particular.
If we're not going to find $2 trillion of revenue to justify the AI revolution, which I think is impossible by 2030, given the level of public debt around the world and where taxes need to go to pay for this debt, the likelihood is we're going to have a significant correction.
I tend to agree that if you look at the public markets, there are risks there for sure. You know, we can call it valuation bubble, etc. For sure.
We've seen risk assets be repriced. In my sense, this is a healthy correction, not something that's turning into a bear market.
Markets heavily focused on this AI dynamic. You know, are we going to get the returns on capital invested that the market expects and is priced in? It's a big debate. We're going to see the NVIDIA earnings later today. That'll be a very important moment for the markets.
Well, let's bring in Ven Ram, our currency and rates strategist from Bloomberg M Live. Ven, such a big day, much talked about here in Singapore, of course, this AI correction. Are equities now stuck in a loop of negative feedback?
Good evening to you in Singapore, Francine. I think that, NVIDIA results are going to be the key for the market reaction, as the speakers earlier were saying, because, there's a lot of froth built into the markets. Even despite the past week correction, we are nowhere near reasonable levels on valuations. If you look at the NASDAQ 100 valuations, the mean PE is 30 plus times, so which is not sustainable. The historical sustainable PE for the NASDAQ 100 has been about 24. So there's plenty of froth built into the markets and plenty of expectations built into AI. But we need to remember, if you think about, when mankind first started flying, there was a lot of expectations about surrounding airlines. But, 1 century down, we know that, capital-intensive businesses don't necessarily pay off at the very start. And billions of dollars have been sunk into AI, and we need to know what the concrete payout is going to be for investors, and which is why NVIDIA's earnings today will be crucial in that context. But this is a market that has plenty of froth, there's no question. And going into the year end and Thanksgiving next week, I think liquidity is thinning, which is a big warning sign for the markets.
Ven, I know you're one of my favorite BOE watchers, so UK inflation dropping for the first time in 7 months pre-budget, but you actually think that a December cut by the BOE is far from a certainty. Why?
Well, what we have seen is, as you mentioned, 1 month of disinflation for the first time since May. And that's not, as Bailey told you earlier this month, Francine, the BOE is not looking for a lone data point, they're looking for a trend. We don't have a trend with 1 month's data of disinflation. We need to see more of it. And we've also got the autumn budget next week. The uncertainty that'll bring, we don't know yet what it'll bring. And the BOE has one more inflation print that comes out before they meet next month. So I think there's plenty of uncertainty going into that meeting. So I don't think that the BOE is going to be in any hurry to cut interest rates, simply because services inflation is holding at 4.5%. So with the BOE's benchmark at 4%, if you cut rates now, your real policy rate is going to be negative. And they're already 4 years of chasing 2% inflation hasn't yielded any fruit. And if they cut into a regime where inflation hasn't subsided as much, particularly services inflation, you don't run a real negative policy rate when inflation is running amok. That would be a policy error, and I don't think that the BOE wants to walk into one.
They certainly don't. Ven, as always, thank you so much. Ven Ram from Bloomberg MLive. Now, the world's most valuable company, NVIDIA, due to report earnings later today. And of course, a quarterly report could assure Wall Street that the AI computing boom has room to run or fuel fears that the tech industry is in a bubble. Let's bring in our very own Tom McKenzie. Tom, it's actually crazy how much is riding on these earnings. What will you look out for?
Yeah, well, it's a company obviously with a market cap of $4.4 trillion US dollars, and combined, of course, a larger market cap than the market caps combined of, for example, the FTSE 100, the entire UK and French markets combined, and by some stretch. What are we going to be looking for? The top line is really the number of chips that they're shipping. So it's the data center part of the business. That is the AI accelerators. Expectations that they could come in top line with revenues of about $55 billion across the entire business in the third quarter. We're looking at margins, Fran, of 72 to 73%. Really significant margins being estimated. Earnings per share about $1.26. Those are some of the key metrics. By the way, the growth that's being estimated in the quarter that's going to be reporting, you're looking at about a 60% increase year on year. Always, as is always with NVIDIA, at least in recent history, it's all about whether or not the earnings can match those sky-high expectations. This is a stock that's trading at about 40 times forward earnings. So can Jensen Huang and the team just assuage those concerns amongst those investors that this is still sustainable, that demand for their chips, for their Blackwell chips, is there now and will continue to be there into 2026?
Tom, thank you so much. Tom McKenzie there with the very latest on what we can expect from NVIDIA. So how do you advise clients on how to create growing, stable businesses during times of geopolitical uncertainty, market volatility, and the dawn of a new tech era? Well, my next guest company is in the business of doing exactly that. Well, joining us now is Mohamed Kandeh, Global Chairman of PwC. Mohamed, thank you so much for joining us. I mean, your job must be thrilling, but also a nightmare, because these big companies have to deal with disruption, AI, stop and start. 1 minute they're optimistic, the other it's like the end of the world. Like, how do you advise them?
First of all, thank you for having me, Francine. And no, it's like a nightmare, but it is actually a good nightmare.
A good nightmare.
It's a good nightmare.
So a dream.
It's like, we could call it a dream. But you know, the very interesting time that we're living today, I think the last time we experienced such a thing was 25 years ago, during the ramp up to the mobile internet. And today, the level of uncertainty is unprecedented, as you can understand, for many companies around the world. And the way we advise them is, first, agility. Learning a lot about being very clear on what is happening in the market, understanding the real signals that will drive what they have to do for their business, and to do a lot of scenario planning. The worst thing to do for any company out there is to stop executing their strategy.
But, Mohamed, I mean, I guess the worry is that there's a bit of a stop and start situation, is that 1 minute there's optimism and the other there's not. So how do you advise them on spending? And, you know, I hear you, and it sounds so much like common sense, but actually, how do you cut away the noise from everything else?
The way you cut away the noise from everything else is to have different plans and to keep experimenting. Many companies about a year ago were waiting to see what was going to happen with the AI bubble, but now no company will have the stomach today to wait for what might happen. The question that companies are asking themselves today is, are they moving fast enough? It's a completely different question, actually.
Yeah, but fast enough into what? Because fast again, there's so much money into AI, but what does it become, and how do you see the returns on that?
Fast enough into first adopting AI in how they're running the businesses today. You know, the original trend for artificial intelligence, for the users of AI, not the NVIDIAs of the world, or the companies providing all the computing power or all the large language models. For the users of AI, the first play was around efficiency, productivity improvement. That's a no-regret move for most of the companies. They might not have had all of the benefit from using artificial intelligence, going on the efficiency game, but they're all trying this. Now, many companies today are looking for AI to understand how can they use AI to reinvent their business. They might not have the answer, but they are going to experiment.
Is there a lot of anxious CEOs out there that you have to advise because they're pouring millions, if not billions, into AI, and they're not quite sure how they make a return on that investment?
Absolutely,
it's like a race to be a race.
It is a race that everybody is embarking on, but today it's a very uncomfortable place for many of the CEOs out there, the fact that we don't know what the answer is going to be. It is very different from what we were experiencing 3 years ago, but we know that we don't have the luxury of time, therefore we have to experiment, make mistakes, and learn from the mistakes, but continue to make the investments. That's what we're seeing a lot with the different CEOs. The question is, what experiments, what investment they need to make, and how do they learn from them as they keep moving? And nobody's waiting now.
And how much does that mistake cost? If you put 20 billion to AI and it doesn't give you the returns that you're expecting, you'd be in trouble with your shareholders.
That's the nightmare part.
But I mean, it's a serious question, right? How do you advise? Do you tell them this is where AI ends up in 3, 4, 5 years? Or do you just try and say, look, whatever your R&D or your spending is, just cap it so that you don't take the whole house down?
Depends on the company, but most of the CEOs that we are dealing with today are making very informed bets when it comes to artificial intelligence. And when you go into the productivity improvement that can be gained by artificial intelligence, there are really no regrets moves that I mentioned, because we know what the efficiencies are going to be. Where the bets are going to be about is how do they reinvent their businesses to run the businesses differently, or how do they incorporate artificial intelligence in the next generation products and services? And they will be part of their R&D budget that you just mentioned, but it is a calculated bet that many companies will have to make.
How do you see the trade-off between resilience or agility and growth?
The trade-off has to be made because growth is necessary, but resilience is even more important than before. And you become resilient and resilience costs money. That's where the level of investment that need to be made by companies today, as far as what bets that they're willing to make today in artificial intelligence to build that resilience. The only way not to be resilient is to wait.
But if you wait too long, then is there a worry that actually you miss out? What's the biggest challenge? Is it actually going fast for these chief executives, or is it betting on the right horse?
It is a race. It is a race to going fast compared to their competition, but also, as you mentioned, Are they betting on the right horse? Are they betting on the right technologies? You have so many players in the AI ecosystem today that depending on where you find yourself in the world, whether you find yourself in the East and the West, you have different choices to make. And that is what we are seeing for a lot of CEOs and the leadership team that we work with. Which players do they need to select? But also, how many bets are they willing to make at the same time? And the future will tell us what the real answer is.
Do you see AI being in a bubble? I know it's more of a market question, but it was explained to me, which I thought was really funny. Like a bubble, if you think about it, is really the thing that you get fired for not owning until it explodes.
You know, it depends where. I know that we have an AI race. I don't know if we will have an AI bubble or not, but it's sure that the valuation that we have today seems to be very inflated.
Yeah.
But the AI race that we have today, to really understand that race, is only on the supply side of AI, not on the adoption, on the diffusion of AI in the rest of the different economies. That is where we're going to see most of the opportunities when AI is being adopted at scale in the different geographies around the world. That's the future of AI. And I'm an optimist. It happened 25 years ago with the mobile internet. I truly believe that we are now at the cusp of a new industrial age, which we call the intelligence age, where new innovation will play out by using AI, not just by providing AI.
So underlaying all of this is, of course, the nice little hiccup of trade and tariffs. Are we there yet? How much, if you look at the global supply chain, so this could be blocks because of allyships or more thought leadership with aligned interests. Are we 60% of this new world, or does it change all the time?
Unfortunately, Francine, it changes all the time. And that is why CEOs today have to understand what do they have to do, not only to understand what's happening within the confines of the business and outside of the businesses, and be very agile to react to what they run every day. Unfortunately, the world is changing pretty much on a daily basis, and we just have to adapt to it.
How depressed are your big clients? Or if you look at your big clients, who's the most depressed bunch? Is there an industry that are finding it tough to navigate this industry?
Most of the industries are finding their own way into this. Some of them is by the use of generative AI. Some others is about industrial AI, especially the big manufacturing companies, etc. But every company, depending on the industry, have a different play. But I would tell you that pretty much all industries that we support today are looking to adopt AI. Nobody is waiting. The question is not what to do, it's how to do it.
And what region clients spend most? It's very different, actually, sitting in London, where I'm usually in the studio, sitting to Singapore, here in Singapore, and then being in the US. Is there a region that's a little bit more optimistic about their future?
I think Asia is very optimistic. And I'm also very optimistic for Asia when it comes to the adoption of AI. Again, it's not just providing the computing power and the language models. It's about the adoption of AI at scale.
But you also have Chinese manufacturing that's coming in. So again, you kind of have a fire that's slowly burning. So there's maybe a bit more optimism, but they're also not overjoyed about these changing dynamics.
The change of dynamics are going to give more choices to the users, though, if you have multiple technologies coming in. And depending on where you find yourself in the world, choices might be a good thing for the different companies.
Okay, an interesting conversation. Thank you so much, Mohamed Condé, there, the global chairman of PwC. Now, coming up, a pivotal test for big tech with NVIDIA earnings set to land tonight. More on what the make-or-break moment could mean for the AI boom. That's coming up next, and this is Bloomberg.
bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
November 26th, Chancellor of the Exchequer, Rachel Reeves, delivers the UK's autumn budget. Can she boost growth and productivity by unlocking investment? How will the Treasury raise revenue without breaking tax promises? And will the budget prove that a fairer economy can reward working people? Bloomberg Television brings you special coverage starting with the Chancellor's statement to Parliament at 12:30 p.m. UK time. And tune in Thursday for the opening trade budget special at 7 a.m. Bloomberg, context changes everything.
The conversations that matter and the insights you need. This is the pulse. I'm Francine Lacqua at the Bloomberg New Economy Forum here in Singapore. So with NVIDIA's results expect to land after the closing bell tonight, investors bracing for the clearest read yet on the strength of the AI boom and whether the rally still has the firepower to drive markets higher. Now, the chip maker is expected to post more than 50% growth powered by surging AI spend from Microsoft, Amazon, Alphabet, and Meta. Now, for more on the AI rally, I'm joined by Jack Selby, Managing Director of AZVC, or AZVC, if you're US-based. Jack, so good to speak to you. AI, I mean, it's the big stress, right? Everyone's focused on NVIDIA. I know you can't talk too much about NVIDIA, but it's like, it's kind of crazy that it makes or breaks the market as a whole, full stop.
Yes, yes.
Are we in a bubble?
I very much think we're in a bubble. I think this may be the mother of all bubbles, dating back to our time when we started PayPal many moons ago. We've seen some cycles over that period, and this one seems like it's by far the largest bubble of that period.
And this is what, just because it's difficult to get a return on all the investment going in. I mean, it's difficult to define a bubble, and two, the secret is to know when it bursts.
Sure. I mean, it's one thing to call the bubble itself, because that seems like a consensus opinion at this point. I think it's much more interesting to talk about what those possible catalysts are. But to go back to your earlier point, what I think is different about kind of this AI innovation is that it's very, very, very CapEx intensive.
Right.
Unlike other innovations in the past. And so it's still an amazing innovation, but the inputs that it requires are very, very expensive. And they scale in a linear way. So even with ChatGPT-5 today, it still takes as much power and energy and chips and cooling as it did with ChatGPT-4 and 3 and 2. And so it's a one-for-one linear scale. And so it's very, very expensive.
So, Jack, I mean, what does that mean? That CEOs will just have to get used to the idea that they won't necessarily get a return on their investments? Or at some point, is it really going to be able to be monetized?
Well, it's a difficult question because the valuations are so price forward. Yeah. So not to pick on any specific companies, but these valuations are such that they're almost 5, 10, 20 years forward. And to pull them back today and try to justify them with today's allocated dollars, I think is just getting harder and harder. And that's a very difficult question for CEOs and the like to make.
But why? Because it's difficult to value, or people get caught up, it's misunderstood? I mean, again, it's really difficult to talk about, valuations that are priced to perfection. But what do you think the underlying cause of it is?
Well, everyone likes to cite the MIT study about how AI is supposedly not having the miraculous impact on productivity that we all thought we were getting. So I think there's maybe an open question about what that productivity gain really is. And if you compare that with very rich valuations, that's a difficult pairing. And so as we get forward into this bubble-like period, it becomes an even more difficult question as a capital allocator in terms of whether you continue to shovel cash into this potential inferno.
Where are you, this potential inferno? This is like, we're not mincing words. Where are you putting your money?
Well, so I run a venture capital firm in Arizona, and so it's kind of the opposite side of this bubble, if you will. And so if you get outside of the 3 states in the U.S., so that's Massachusetts, New York, California, those 3 states last year took down 75% of all venture capital spending. And so this year, obviously the year's not over, but that number will probably be north of 80%, may even be as high as 90%. And so the glass half full, though, on the other side of that phenomena is if you get outside of those 3 states. So if you go to those other 47 states, which, by the way, is where 80+% of the U.S. population lives. So 250 million plus people live in these states. The valuations are relatively cheap. And so the entry point from a valuation perspective is quite good. You can coach those companies up like you do in any sort of normal venture capital context. And then you can take them by the hand to all the friends you may know on Sand Hill Road or the equivalent in these coastal states. So I think in the backdrop of this AI bubble, trying to play directly is very difficult, especially at these valuations. And then getting on the other side of it in these geographies that are not quite so inflated, I think is a potential strategy.
So what are you excited about? Is it AI adjacent? Is it payment? You know, like what kind of industry are you looking at? Or specific companies?
So actually, I think it's different. So I think one thing that's remarkable about AI, again, trying to be glass half full, and I don't want to sound like a Luddite, is that AI has, sitting here in November of 2025, become a ubiquitous, pervasive ingredient that you see in almost every single startup company as a recipe. And you see that not just in Palo Alto, but you see that in Fort Worth or Wichita, Kansas, or Phoenix, Arizona, where I live. And so the fact that AI has become so ubiquitous so quickly is really remarkable. And I would say if you had to assign a force multiplier number to what AI helps you achieve, it's probably somewhat on the order of 10x. Yep. So in other words, you can achieve 10x more revenue than you could otherwise, all things being equal. And then also you can do that in terms of overhead and cost being 10x lower. So that's a huge, huge improvement. So going back to what we said a moment ago, that's probably the biggest force multiplier we've ever seen in terms of its technology innovation in the last 30 years. Now, is that worth $500 billion in some contexts? I don't know.
What happened? You called it an inferno, which I imagine is when the bubble bursts, right? If there's a huge market correction.
Yes.
What does it mean for your investments? At that point, you deploy more cash to support some of, the companies that may struggle but that have good value? Is it a buying opportunity?
So I think pure play AI, that is the domain of the coasts. So private tech, pure play AI, I would argue is uninvestable. So if you want to have that exposure.
Now and forever or just now?
Now, I don't know, I can't predict the future, but sitting here today, I think it's uninvestable. And if you really have to scratch that itch, you should just go buy Alphabet or buy Meta or buy Microsoft. Again, not investment advice, but if you really have to feel like you have to participate, why wouldn't you invest there? Because you have instantaneous liquidity. It's not a pure play, it's more of a blunt instrument. But in terms of evaluation, I think it's much more reasonable.
Okay, and what? I mean, is there something that you would be selling off?
No, I think it just in terms of if you feel like you're compelled to participate, which no one is, because again, I think it's ubiquitous. It's a force multiplier for all these different companies, not just in Silicon Valley, not just in the coast. So it's good for all of us. It's just a question of whether the valuation is justified.
Jack, thank you so much for coming on. Jack Selby there, AZVC Managing Director. Coming up, we speak to Barclays' Brad Rogoff on stress in the credit markets. That's next, and this is Bloomberg.
I just wondered if any of you had a perspective of the reason to, put some of that capital into women's sports.
It's going to create you the fastest return. You will have so much success. If you look at the growth metrics of women's football, selfishly, in this country at the moment, it's phenomenal. We are the fastest growing sport on the planet. Our participation is up in this country. The interest that is around women's football is at a real, to your point, we're at a real moment in time to be able to capitalise on it. And if I was an investor looking to come into football in this country at the moment, I'd certainly be considering women's, because I don't have to invest an astronomical amount to become the best in the world, to really be put on the global stage, to be winning Champions League. Whereas if I wanted to do that in men's football in Europe, that's going to cost me a lot of money.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The conversations that matter, the insights you need. This is the pulse, and I'm Francine Lacroix at the Bloomberg New Economy Forum here in Singapore. Now, global stocks stabilize after a $1.6 trillion wipeout as investors brace for earnings from NVIDIA to gauge whether the AI rally still has momentum. UK inflation eases for the first time in 7 months, lifting hopes that price pressures have peaked just a week before the Chancellor unveils the budget. Plus, Beijing escalates its feud with Tokyo, suspending imports of Japanese seafood and halting approvals of new films. In the latest signs, their diplomatic spat is far from over. So President Donald Trump said he would formally designate Saudi Arabia as a major non-NATO ally. Now, this comes as the kingdom made a vague pledge to increase investment in the U.S. from $600 billion to around $1 trillion.
$1 trillion will be the amount invested in the United States or committed to invest in 1 year. So I'm here 9 months. We're up to almost $18 trillion.
The agreement that we are signing today in many areas, in technology, in AI, in rare earth materials, magnet, etc., that will create a lot of investment opportunities.
So you are doing that now. You're saying to me now that the $600 billion will be $1 trillion.
Definitely, because what we are signing, it will facilitate that, and we
I like
will
that
build
very
on
much.
it.
Well, let's bring in Honor Aunt, Bloomberg's managing editor for the Middle East and Africa and North Africa. Honor, look, there was a lot in the press conference. There was a lot in that meeting. What was actually announced during the Trump MBS get-together?
Francine, they finalized a range of agreements that they said will strengthen or deepen the U.S.-Saudi strategic partnership. The first and foremost, they signed a U.S.-Saudi strategic defense agreement under which President Trump approved sale of F-35 fighter jets to Saudi Arabia. And also that includes an agreement that will allow Saudi Arabia to buy around 300 military tanks from the U.S. In addition, and equally notably, the two sides signed a memorandum of understanding on AI. This was very scarce in details, but we believe this memo will soon be followed by a firm agreement that will allow Saudi companies, including state-backed Humane, to access and purchase U.S.-made chips that will be used in AI facilities and data centers in Saudi Arabia. And possibly most notably that we've just seen, we have seen that MBS, Mohammed bin Salman, the Saudi Crown Prince, pledged to invest around $1 trillion into U.S. infrastructure, technology, and industries. That's up from a pledge of $600 billion that President Trump had secured during his earlier trip to Saudi Arabia this year in May. So these were the highlights of the agreements signed between the two countries during Tuesday's visit to the White House.
I mean, you could see that there was quite a lot of joking around from the two leaders. What do these deals also say about the changing relationship between Saudi and the U.S., which is not uncontroversial?
Well, this trip by the Saudi de facto leader, Crown Prince MBS, to the White House allows both sides to claim major victories, wins, I think, after the trip. For MBS, obviously, it caps a years-long process whereby he went from, in Joe Biden's own words, from being a pariah to a key U.S. ally. And all the deals that he signed with President Trump sort of cements that position in the eyes of the public. For President Trump, I think, which was very clear from the White House statement overnight on what's been accomplished during this trip, the major takeaway, the major win is that these deals will allow him to show to the American public that whatever dealings he is in with foreign leaders, he is putting America first, and all these pledges, investment pledges that he received or secured from MBS will directly it will result in spending by Saudi government, and the money to be spent will flow directly into American communities, into his own words, supporting American jobs and American industries. So that's the key takeaway for both leaders from this trip, and it obviously, the end result is that it results in this visibly stronger relationship that also allowed President Trump to deliver on his election promises for lower energy prices, because Saudi Arabia, the single largest oil exporter in the world, did play a major role in driving down oil prices. Brent is down about 14% this year, and that's the agreements definitely cements that relationship that helped President Trump so far in his second term.
Yeah. Honor, thanks so much. Honor Onther, Bloomberg's managing editor for the Middle East and North Africa. Now, the U.S. Senate is moving to clear a House-passed bill forcing the Justice Department to release its Jeffrey Epstein files. The House approved the measure 427-1, signaling strong bipartisan support despite President Trump's earlier opposition. Now, President Trump has since relented, though he could still delay the release of some documents as he orders new investigations into Epstein's ties to the Democrats. Now, the Apollo Global Management Chief Executive, Mark Rowan, has downplayed Jamie Dimon's concerns that there are cockroaches in credit markets. On a panel discussion here at the Bloomberg New Economy Forum in Singapore, Mark Rowan said he did not see anything that is, quote, systemic.
The size of the private credit market, as I see it, is some $41 trillion. Most of the market is investment grade. A fraction of it, some $2 trillion, is below investment grade levered lending. And so much of the focus is on this notion of levered lending and the tricolors and the first brands. And if you think about what's happened, the shock from tariffs has now adjusted into the economy. The shock from high rates has now adjusted into the economy. Credit stats are actually improving rather than declining. That does not mean we will not have late cycle banking behavior, because there are good banks and bad banks, and good insurance companies and bad insurance companies, and good asset managers and bad asset managers. But there's nothing that I see that is systemic.
Well, we're now joined by Brad Rogoff, Global Head of Research at Barclays. Brad, thank you so much for joining us. Look, credit has been like the boogeyman, the spooky thing that's been, going on in the markets. As Head of Research, how much should we worry about something fundamentally wrong, maybe systemic in the markets?
Yeah, so look, everyone's focusing on that, yet if you look at where credit spreads are today, they're still in the bottom quintile of where we see credit spreads. So, I mean, I guess the market overall isn't maybe as focused as we would see just from reading news stories, et cetera. Now, all of that said, there are areas of the credit market that are under more stress today than they have been over the last few years. You guys just played some quotes leading into it. And while we can find some of those, and I do think there are areas that are concerned, and we can talk a little bit more about, if I take credit markets as a whole, overall, we feel pretty good about the fundamentals of the underlying companies.
Brad, when you look at some of the worries about underwriting, for example, the debt and things like that, what changes? Again, where would you see some of the nasties?
Yeah, and so private credit markets are something we certainly need to pay attention to because that is very different. The makeup of those private credit markets, as well as the size, are very different than we've seen in any other cycle. So where there are examples of leveraged lending, and it used to be a loan that was done in public markets, and now it's a loan that's done in private markets, is there a bit more leverage? Is it something to be a little bit concerned about? Sure, but that is quantifiable. We can understand it. We can understand the downsides potentially from that if the economy moves lower. I think where some of the concerns are, and especially some of the issues that have come up recently, is when there's different type of lending, right? When there's certain types of asset-backed lending where these are not ways that we've lent before. There's not a history of defaults and recoveries. We can't model things out the same exact way. And that is late cycle behavior, right? We find more different creative ways to lend. And why is it attractive? Because we lend at spreads that aren't quite as high as you can do in other markets. So I think that's the area, and those are sort of the rocks you want to uncover right now.
Where do you see more distress?
Yeah, I think if we look for more distress, you're going to look at maybe some of the consumer finance type businesses, right? Those are businesses that there's a lot more of the asset-backed type lending and less of a, hey, I'm just assessing one corporate. I can really dig on the balance sheet. I can really look at that type of loan, right? So I think that's an area, and then there'll be sectoral issues, right? And so there are certain sectors that are coming under pressure. Obviously, right now, chemicals is a great example of that. But I think if I had to look for an area, I would probably focus a bit more on some of the consumer asset-backed areas.
Brad, overall, as global head of research, how does your research change into 2026? So, it's very clear that some of the anxiousness that we've seen in the markets is AI, whether it's price to perfection. There's a lot of talk on geopolitics, and then inflation that could be much less predictable than in the past. Is it still the same themes for 2026, or do we enter a new phase?
Well, I actually think, let's hit on that AI one for a second, right? Because if we think about what AI has been, for most of this year, it's really been an equity story. If you think about the biggest hyperscalers, it's really didn't matter to credit markets, for example, right? And so when we're spending time on AI, I'm spending time with my equity analysts thinking about it, whether strategists, analysts, whoever. Now, what we've seen in recent weeks is we've seen a backup, especially in the U.S. investment-grade credit markets, and that backup has come because of some huge issuance coming from AI-related, from hyperscalers hitting the market, right? And so what we really have to do as we think forward into 2026 is thinking about all these markets and the interplay, right? Because the cost of financing this is going to be much higher than maybe originally thought. And so far, it's not much higher. It's a bit higher. Then, that does change things a little bit. Now, where I feel a little bit better is if we go back in time, and our equity analysts have spent and strategists have spent a lot of time on this, if you look at the companies that are funding the AI revolution, so to speak, versus if you go back to the turn of the century and look at the dot-com boom and who was funding that, the amount of free cash flow these companies have, it's not even close, right? So the ability to fund it is much higher, but they're still going to debt markets to do it. And that's where we're starting to see a little bit of stress. So yeah, from a research side, we're looking at that interplay and trying to use all our resources.
So is it more through the market side, so through the credit side, but also just the business model for it? Or is it a little bit too soon to see the longer term impact it has on the economy, productivity, and job losses?
Yeah, and that's obviously been topical recently. We don't have a lot of jobs data, right? But what we've got, we are seeing a little bit of that. And I think what we'll see in 2026 is really, yeah, soon, exactly, very, very, very soon. So we'll see some of that. We also don't want to do too many conclusions, certainly from 1 month of delayed data, or then we'll get 2 months of data. But all of that being said, I think what you are going to see, yes, there are going to be some isolated job losses, but at the same time, the productivity enhancement, and we see it in how we're able to do our research, right? We're able to have the same amount of people. We're able to cover more companies as a result of the increased productivity from AI. So that's probably the first phase, but then there's a question of how quickly we transition to the second phase.
Yeah, so on the release of the data, and again, there's a lot of excitement, I'm sure, on trading floors just because we haven't had U.S. data for a while because of the U.S. government shutdown. We get that employment data, which of course is backward-looking, but it's the first set of data that we have on Thursday. What will you read into it?
Yeah, I think it's important to remind ourselves that what we're looking for in jobs data, for example, has changed a lot over the course of this year, right? People weren't satisfied unless you were adding 100,000 jobs a month if we go back to the beginning of this year. But with everything that's changed in the U.S., especially with respect to immigration, the break-even number for jobs data is sort of barely a positive number at this point. It might be 15,000 jobs. And so what we're looking for is going to be a difference between private and public, certainly in overall payrolls, right? Because you're going to see some of the government stuff play out, right? Some of those packages that people took where people were only rolling off now. And so we're going to try and look at those differences and see if, when you kind of look at the private number, if that's dipping into negative territory, I think that would be another signal as to why the Fed might move in December.
Brad, thanks so much. Brad Rogoff there, Global Head of Research at Barclays. Now, coming up, tariffs slashed, investments pledged, the U.S.-Swiss trade deal breaks cover. More on that with Switzerland's State Secretary for Economic Affairs. That's next, and this is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
I think the important thing for the UK from an economic perspective is to make sure that its fiscal house is in order, to have the breathing room for investment, both public sector and private sector investment. I think there are clearly some fiscal challenges. There's some political challenges. And I hope that the government can put a budget in place that addresses those kinds of needs.
Well, that was David Schwimmer, the London Stock Exchange Group Chief Executive, speaking here at the Bloomberg New Economy Forum. Now, UK inflation fell for the first time in 7 months, ahead of crucial decisions by the Bank of England and the Chancellor of the Exchequer, Rachel Reeves. Now, we're joined by Anna Andrade from Bloomberg Economics. Anna, thank you for joining us. So first of all, inflation dipping for the first time in 7 months. Does this meaningfully change what the BOE does in December?
Hi, good morning. So obviously, an environment of falling inflation is a better environment for the Bank of England, and inflation did fall to 3.6% in October, which is what the BOE was forecasting. So it's good on the surface, and I do think it keeps December rate cut on the table. It will be a close call, but actually, when we looked at the details this morning, and if you compare at least with the September CPI, which was such a game changer, I would say the details were not as benign in the sense that energy was what drove the fall in inflation, and even within services that fell, services inflation fell. It were components like airfares and accommodation, which have been items that the Bank of England in the past has tended to overlook, that sort of drove that fall. So you really didn't see that progress on underlying inflation that we've seen in September. And I think whether it leads to a December rate cut or not will depend on the interpretation of Andrew Bailey's wording in the November meeting. He said he needed to see more progress on underlying, more progress on disinflation, and it's a bit unclear whether that means, inflation is coming in line with the forecast, in which case December rate cut is game, but it can also mean more progress on underlying price pressure, and we just haven't seen that yet in this print.
And I mean, how much of a difference does it make on the upcoming budget? I have to say, this autumn statement on November 26th, and people are even talking about it in Singapore because there's so much anxiousness about where this puts the UK.
I mean, I think this DCPI print won't meaningfully impact the scale of fiscal tightening that Rachel Reeves needs to deliver. Obviously, politically, is a much more favorable backdrop to announce tax rises. But I think what we'll need to watch, at least on the interaction between fiscal policy and monetary policy, is what Rachel Reeves does that can influence inflation. So essentially, she has said that she wanted to sort of tackle and ease the cost of living. And there's been rumors that she could reduce the VAT on energy bills. If she does that, that could mean sort of a drop on headline inflation of 0.3 percentage points, and that would be obviously very welcome for the BOE. I mean, if she does that, then we think a December rate cut is sort of more or less like a done deal. But obviously, we'll need to wait for the details to see what happens.
Anna, thanks so much. Anna Andrade there from Bloomberg Economics. Now, of course, it's going to be a big week for the UK. We want your questions. Join Kit Reese on the Bloomberg Market Today blog for a special UK budget Q&A at 11 a.m. London time. That's in about an hour and 5 minutes. They'll discuss what could be in store and what that means for your money. So send your questions to markets today at Bloomberg.net. And of course, the UK Chancellor Rachel Reeves expected to deliver her budget at 12:30 p.m. London time next Wednesday. Viewers in the UK and Europe can join us for full coverage and analysis on the day. Now, Switzerland's top trade diplomat has expressed her country's heartfelt desire for UBS not to move abroad. Well, I spoke to Hélène Budliger-Artieda, director of Switzerland's State Secretariat for Economic Affairs, and I began by asking her about the possibility of extra taxes on streaming services like Netflix.
We don't know. We have a law on that. And, Switzerland is a multicultural, multilingual country. So for us, it's important that, some of our national languages are actually on the list of being endangered languages. I don't know if you ever heard of Romansh. So we have roughly more than 30,000 Swiss speaking, and it's important that content for them gets produced both on TV and in radio. So we're coming from a different angle. I don't think that we want to, in any way close up the market, but I think for us it's important that we can lift that multicultural and multilingual identity. So who knows? Who knows?
But so the government won't necessarily push to actually get that law changed?
No, not necessarily. But, it's going to be a negotiation. Yeah. There's going to be two sides on that table. And we feel that we're ready. And we feel that wherever we will not be able to comply or to reach an agreement. I think we'll have good arguments. And I have to say, I've been now, I think, a record time to the US, and we've always had very constructive and very positive discussions, of course, robust. There are interests at stake, and the USTR has an excellent team, and they're quite tough negotiators. We think we're the same, so we shall see. But that is really for the second phase. And again, I have to repeat, we will, of course, follow due process according to Swiss constitution, consult the mandate. Once we have the mandate, do the negotiations, and then go through a ratification process.
UBS was once again in the news.
Yes.
With, we understand, the chairman of UBS speaking to the Treasury Secretary of the US about possibly moving headquarters to UBS. Your reaction?
I'm not aware of, I mean, I would think that such an important chairman of such an important bank would have a conversation from time to time with U.S. Treasury, but I cannot confirm that that is actually happening.
Do you know if they're thinking about it? I mean, how disastrous for Switzerland would it be if they were to move headquarters?
We love UBS, so we really would like them to stay.
That was Hélène Budliger-Artieda, the director of the Switzerland State Secretariat for Economic Affairs. Now, we have plenty more top interviews to bring you from the New Economy Forum tomorrow, including Adina Friedman, the NASDAQ chief executive, Ralph Arndt, the chief executive of the Australian Government Future Fund as well. Of course, geopolitics left, right, and center here at the New Economy Forum, including this diplomatic spat between China and Japan. Now, what started as a row over Taiwan has now resulted in Beijing suspending imports of Japanese seafood and halting approvals for new films. Joining us now is Roz Matheson, Bloomberg's chief Asia correspondent. And Roz, thank you so much for joining us. I mean, this does not seem to be escalating at all. So what are the latest moves from Beijing and from Tokyo?
Well, the challenge is we're kind of at a stalemate. So we had diplomats from China and Japan meeting. From the China side, their reading is they don't think the meeting went particularly well. Japan is saying we've explained the Prime Minister and her comments around Taiwan, which has been the cause of all of these renewed tensions, and that she was talking in a very hypothetical way. But China's saying, fine, but what we would need her to do is to retract the comments, and she's not about to do that. She's a very new Prime Minister. She's cut from quite a strong cloth. She needs to show, you know, from the outset that she's being quite strong. So she's saying we're explaining, you know, these comments, but we're not looking like we're going to retract them. So China wants that. Japan's saying that. How is the off-ramp going to come in all of this? Because as you say, in the meantime, we're seeing further measures from China, at least, to penalize Japan. And that's a very familiar playbook for China, is to use trade as a lever. It's done that against some of its neighbors in the past, including, you know, Taiwan, Japan, and also South Korea. And so is it going to escalate in a way that is more meaningfully going to impact the economies?
So is this just symbolically bad news, or does it actually have economic ramifications?
Well, it could potentially. For now, it doesn't seem to be. I mean, seafood exports had been suspended already. They were only just starting to resume, and so they're very, very low. You know, most Chinese tourists who go into Japan these days do not go in tour groups. They go under their own steam, and so it's a lower impact event. But the big question is, does China really ramp it up and start to include things like rare earths, critical minerals? And there you're getting at something that would fundamentally be damaging potentially for Japanese companies and for the Japanese economy. So for now, it's actions that are obviously meant to send a signal around beef, seafood, films, as you say, tourism, travel, business travel as well. Those all have some kind of impact, but they're not moving yet, at least, to the big one, which would be rare earths.
Roz, we had a good day here, the first day at the New Economy Forum. What are you most looking forward to tomorrow and the next day?
Well, it's interesting to hear the conversations around the first day. Obviously, what's happening around the world is being discussed here. The wobbles that we've seen in the markets lately, you know, are those healthy washouts? Obviously, we've got NVIDIA earnings, and so people are looking at the outlook for the financial markets. A lot of conversation around this debate around de-dollarization. Is it real? I mean, most people here so far speaking today seem to say fundamentally they don't see the case against the dollar continuing its dominance, and a lot of conversation around AI, which is something everybody wants to know, the future of AI, because it goes across everything: business, trade, politics, and security.
Yeah, and all the market traders are like this, waiting for the NVIDIA earnings. Roz, thank you so much. Roz Matheson, Bloomberg's chief Asia correspondent. Up next, Bloomberg Brief, and this is Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Nobu-san, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
You know, I met him 1988 after my first restaurant opened. He asked me to come to open the restaurant in New York. And beginning, I didn't know what he did.
You didn't know he was an actor?
No, I don't know. What he doing? Because I never watched the movies. You know, I was traveling the business. But of course, after people, hey, Nobu, so you must know him, and then I understand.
How is he as a partner?
He's for me and a great partner. He understands to my concept. He supports me 100%. But he's a very smart people. Sometimes so strange idea, but it's good idea. So example, Nobu Hotels idea come from him. He said, hey Nobu, so we have a lot of new restaurants coming in somebody's hotel. For him, doesn't make any sense. Then we start Nobu Hotel in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Good morning. It's 5 a.m. in New York City. I'm Matt Miller in for Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. Standing pat, futures steady ahead of the quarterly results from NVIDIA and the latest Fed minutes later today. Brace for more. Goldman Sachs President John Waldron sees further market pullback. We'll give you more from our exclusive interview coming up next. And President Trump plans to formally designate Saudi Arabia as a major non-NATO ally following a day of deal-making between Washington and Riyadh. Let's get a look at what's going on in terms of futures after the drops that we saw yesterday and the drops we've seen this month, the worst month since March thus far. S&P futures are down, up 0.3%, as are NASDAQ futures, about 1/3 of 1%. The small caps gaining even more. In terms of the stocks, individual stock stories that you need to know, let's get to Valerie Teitel. She's in London. Valerie?
Good morning, Matt. Let's start with a check in the energy sector. Constellation Energy, this is the U.S.'s largest nuclear power company, up 3.4% in the pre-market after they have secured a $1 billion loan from the Department of Energy used to reopen 3 Mile Island. Now, we heard from Constellation Energy back in September that they wanted to reopen 3 Mile Island in order to fulfill a contract that they signed with Microsoft in order to power their AI needs. So again, we are hearing more and more that nuclear power is going to be used to power this next stage of the AI boom. Now, the power that is not in vogue, that is green energy. We're seeing hydrogen fuel cell developer Plug Power down 14% in the pre-market. This comes after they announced a dilutive convertible bond offering, to the tune of $400 million. Now, this company will use the proceeds from that bond offering in order to pay down debt due next year. So this company needing to do this dilutive measure in order to aid them from a recent debt crunch. Lastly, let's move on to onsemi. This is a chip maker focused in sensors used in the automotive and industrial space, Matt. Those shares are up 3.2% in the pre-market, and this comes after the board signed off on a $6 billion buyback program to be used over the next 3 years. Matt?
Valerie, thanks very much. Valerie Teitel there looking at some of the single stock movers. Later this hour, by the way, we're going to speak to the CIO of Robinhood. Stephanie Gill joins us as she sees continued dip buying in this market, and the dip we can certainly see. First off, President Trump gave the Saudi Crown Prince a lavish reception in Washington yesterday. The two leaders spoke of business opportunities, peace, artificial intelligence, and tech. Trump designated Saudi Arabia as a major non-NATO ally at a dinner in honor of MBS, and the two countries signaled a loosely worded defense cooperation pact with the Saudis promising to invest as much as $1 trillion in the U.S.
The agreement that we are signing today in many areas in technology, in AI, in earth materials, magnet, etc., that will create a lot of investment opportunities.
So you are doing that now. You're saying to me now that the 600 billion will be 1 trillion.
Definitely, because what we are signing, it will facilitate that, and
I like that very much.
Joining me with the latest is Bloomberg's managing editor for the Middle East and North Africa, Onur Ant. Onur, talk us through what was announced during the Trump MBS meeting.
Well, the two leaders finalized quite a few agreements, Matt. One of the most notable ones was obviously the Saudi-U.S. Strategic Defense Agreement, part of which has to do with Trump's earlier approval to sell F-35 fighter jets to Saudi Arabia. In addition to that, we also found out overnight that the kingdom will purchase about 300 military tanks from the U.S. In addition to that, another important agreement was a memorandum of understanding that they signed on AI. Although that was a preliminary agreement, we expect that to be followed by a more firmer agreement that will allow Saudi companies such as the government-backed Humane to purchase AI chips from the U.S. to power its AI facilities and other facilities that the kingdom is planning to build over the next 10 years or so. And finally, again, as we've just seen in the video from the White House, we've seen that MBS, the de facto leader of Saudi Arabia, increasing his investment pledge to the U.S. from $600 billion to $1 trillion. That's quite important, quite significant for President Trump and the White House, which said that all that money will flow directly into American communities.
And of course, the U.S. and the Saudis have long had a strong relationship since Reagan and the Bush family. It took a breather after the dismemberment and murder of journalist Jamal Khashoggi, but it does look like it's back on the up and up.
That's certainly true. Khashoggi's death was obviously a big shock to the relationship. And yesterday's meeting, if anything, it caps this years-long process during which MBS went from, in Joe Biden's words, a pariah into a key ally for the U.S. And all the deals and the agreements that they've signed and announced yesterday is a testament to that. So yes, definitely this trip by MBS brings the relationship that was always strategic, but somehow suffered a shock after Khashoggi's death at the Saudi consulate in Istanbul in 2018, sort of turned into something that is now equally strategic as it was before that shock was suffered, so to speak.
Onur, thanks so much for joining us. Onur Ant there, joining us out of Dubai. Now turning to the main event of the day, NVIDIA earnings. The chip maker set to report results after the closing bell. Joining us now is Matt Bloxham of Bloomberg Intelligence. So Matt, just walk us through what we expect in terms of the reporting quarter and in terms of the outlook.
Yeah, so in terms of the quarter they're reporting, that Q3, the market's looking for revenues of about $55 billion, so that will be up about 57% year on year, and EPS of about $1.25, $1.26. I think more importantly, looking to their Q4, the outlook they'll give, the market's looking for them to kind of guide to around $62 billion, so that would be on revenue, that would be up about 58% year on year, so kind of keeping that same momentum that they're expected to deliver for the Q3. And I guess, beyond that, the market will be looking for anything they can do to kind of provide reassurance that beyond this big hyperscaler investment cycle, there's natural demand coming through from consumers and enterprises to kind of sustain the AI momentum into the midterm.
In terms of generating enough revenue, generating enough profit to justify their investment, NVIDIA is not one of those companies that worries this market, right? I mean, they're not trading at incredibly high valuations.
No, I think, well, I said the near term, not a problem at all. You know, they've got like kind of up to $500 billion of kind of expected revenue over the next 12 months or so that they talked about recently. And that's kind of underpinned by the hyperscalers investment cycle. The question is if that investment cycle doesn't get end customer demand from enterprise and consumers, then that hyperscaler investment cycle will come to an end quicker than expected, and that would then become a problem for the midterm growth outlook for NVIDIA. But for the kind of near term, I think they're in a very comfortable position, incredibly high margins, 75% gross margin business, so in a strong position.
China deliveries have stopped and I think are no longer accounted for in their forecast. What do you expect, though, from the future of that business?
It's a good question, and I think no one really knows for sure, but my sense would be that it's going to continue to be a very difficult market for NVIDIA to kind of play in, even if the US relaxes restrictions on them selling into China. I think the Chinese market's pivoted. The Chinese government is encouraging its domestic firms to source locally from the likes of Huawei. So even if NVIDIA gets back into that market in a meaningful way, they're going to find competition much tougher than when they were there before.
Matt, always great to catch up. Matt Bloxham there of Bloomberg Intelligence runs our NVIDIA and tech coverage out of London. Now, tune into our exclusive interview with the CEO of NVIDIA, Jensen Huang, after those earnings. That'll be at 6:30 p.m. Eastern tonight. And, of course, we'll be replaying that interview for you throughout the day tomorrow. Now let's get on to some of the other top stories trending on the Bloomberg terminal this morning. The Dutch government suspended its powers over chipmaker Nexperia, restoring control to the Chinese owner. According to the Dutch Economic Affairs Minister, the order that gave the Netherlands the power to block or revise decisions at Nexperia was dropped as a show of goodwill. The spat over control of chipmaker disrupted automakers from Honda Motor to Volkswagen. UK inflation fell for the first time in 7 months. Consumer prices increased 3.6% in October compared to the year earlier. The drop was driven by energy prices rising less than they did in October of 2024. The latest numbers keep alive hopes of a Bank of England rate cut when it meets on December 18th. And China escalated its retaliation against Japan, suspending imports of Japanese seafood and halting approvals for new films. Signs that the diplomatic spat is far from over. Beijing had also suspended talks on resuming beef imports and warned Chinese citizens against traveling to Japan. Relations between the two countries soured after the Japanese Prime Minister Sanae Takeichi became the first sitting Japanese leader in decades to publicly link a Taiwan Strait crisis with the potential deployment of Japanese troops. Coming up, Goldman Sachs President John Waldron says there's more market declines to come, but they could be modest. Our exclusive interview at the Bloomberg New Economy Forum next. This is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Earnings season is here.
This earnings season has been much stronger than expected.
Corporations seemingly are making money.
Bloomberg is first to break the numbers.
With earnings out of Amazon.
I'm looking at Coinbase.
All right, Zillow.
The name with momentum is Alphabet.
A big warm reception to some of these results.
With the smartest insights.
We had a tremendous amount of earnings enthusiasm and optimism in that last reporting season. Peak valuation, peak earnings revisions makes me very nervous.
We're going to talk more about earnings. Continuing coverage on Bloomberg.
This is Bloomberg Brief. I'm Matt Miller in New York City. The S&P 500 is down more than 3% on the month, on course for the worst month since March. Former Barclays CEO Bob Diamond called it a healthy correction at the Bloomberg New Economy Forum in Singapore. Goldman Sachs President John Waldron echoed that sentiment, speaking exclusively to our own Francine Lacroix.
I would say you're seeing in the markets right now a pullback, which I think is healthy. Markets have run quite a bit this year, U.S. equity markets in particular. Markets heavily focused on this AI dynamic. Are we going to get the returns on capital invested that the market expects and is priced in? It's a big debate. We're going to see the NVIDIA earnings later today. That'll be a very important moment for the markets. Second topic I think is very much on the minds of investors is labor. We've had government shutdown, which is obviously behind us now, but the statistics will lag and the data will lag. So the market is not quite sure what to make of labor. So I would say labor is a major issue and a major concern. And the third topic I think is inflation, which remains pretty stubbornly high. And we obviously saw in the election cycle in the U.S. a lot of focus on affordability. And so I think those three topics are really shaping markets right now. Markets have had a good run. And so you're seeing investors kind of pull back and I would say protect gains.
Do you think we need more of a correction? Like, when do you know, or is the AI in an actual bubble?
Well, I think we'll find out in NVIDIA's earnings today, kind of what they say about their own prospects, which has been a bellwether, and I think will have some impact on the psyche of the marketplace. It strikes me that the market could pull back further from here. I do think that the technicals are kind of more biased for more protection and more downside, more short activity, more macro hedging, and kind of protecting the gains that have been garnered this year. So I think there probably is a bit more bias to the negative, but I don't know that it'll be that much more pronounced from here. It worries me because anytime you see that much increase in credit formation in a short period of time, you wonder about standards, underwriting standards. And we've seen, in certain examples that have been well reported, standards have come down, terms have weakened, pricing has tightened. And so there is classic late stage behavior going on in credit. But that doesn't mean that we're going to have a credit crisis. It just, frankly, the most important thing is economic fundamentals. If the economy hangs in there, the credit markets will be fine. And I would say you're going to see more credit formation coming in 26 because I think you'll see deregulation in the banking sector, principally in the United States, which will release more capital into the economy and will create more lending in the economy, which probably keeps spreads tighter and probably keeps more supply of credit, which is actually needed because governments are pretty fully levered. And the private sector is going to have to come in and finance a lot of this AI investment, decarbonization, investment in energy and the like. So I think you'll see credit markets continue to be pretty constructive as long as the economy hangs in there.
But what are the real risks, though, that we're not looking at? Worry about underwriting. And there's then at
subprime. I think there'll be more problem. I predict more problems in subprime. I do think the weakest part of the economy is that lower end consumer. And there has been a lot of lending into the subprime parts of the economy, so I wouldn't be surprised to see more issues arise in the subprime lending arena. We worry a bit about leverage in the equity markets, particularly around wealth investing, levered ETFs and more investing in more levered form as you get asset prices that are that are rising. I think that extra leverage is concerning. So those are areas that we would be focused on and worried about. But again, economic fundamentals will be the most important thing.
Now, it's John Waldron of Goldman Sachs speaking with Bloomberg's Francine Lacroix at the Bloomberg Economy Forum in Singapore. Now, in terms of markets, we do see a bit of a recovery today in futures. S&P 500 futures up 0.3%. The Bloomberg U.S. Dollar Index on the rise this morning, up about 0.1% at 12.21, and the U.S. 10-year yield yields resume, I should say, their gains as investors feel comfortable enough to sell off that debt. Look at cable here, 131.22, as you see a bit of a drop in the pound. The UK 10-year at 4.550 as we get the first reversal in inflation in 7 months, and the FTSE gaining about 0.1%. Coming up, the U.S. Congress is set to send a bill to President Trump to force the release of the Jeffrey Epstein files. That and a look at what else is making headlines in your front page news. This is Bloomberg.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
This is Bloomberg Brief. I'm Matt Miller in New York. In the latest episode of Chief Future Officer, Bloomberg's Anna Edwards spoke with Standard Chartered CFO Diego Di Giori. Let's take a listen.
The game here is understanding. These digital assets have the ability to change the payment landscape of the world, and we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading cryptocurrencies. So what we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoin?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need, because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
And that was Diego DiGiorgi, the Standard Chartered CFO, speaking with Anna Edwards. You can catch the full interview of Chief Future Officer tonight at 9:30 p.m. Eastern, and I do highly recommend it. It's a fantastic program. Time now for your front page news. First up on the Washington Post, Congress is poised to send a bill to President Donald Trump to force the Justice Department to release files related to Jeffrey Epstein. The House passed the bill on a 427-to-1 vote, and the Senate agreed to deem the legislation passed as soon as it arrives from the House with no changes. Next up on the Wall Street Journal, Elon Musk's artificial intelligence company, XAI, is in advanced talks to raise $15 billion in new equity at a $230 billion valuation. The new valuation would represent a significant increase from the $113 billion XAI disclosed after acquiring Musk's social media site X in March. In fact, it's just about double that. And on the New York Times, President Trump is said to have authorized CIA plans for covert action in Venezuela. Sources say Trump has also authorized a new round of back-channel negotiations that at one point resulted in President Nicolas Maduro offering to step down after a delay of a couple of years, a proposal that the White House rejected. In terms of markets in Europe right now, the live trade doesn't look so bad. The FTSE is up 1 or 0.2%. The CAC down just about the same, and the DAX up 0.1%. So a mixed trade there after the big drops we saw yesterday. Coming up here in New York, Stephanie Guild, the CIO of Robinhood, joins us to talk about whether or not investors are buying this dip. It's the biggest monthly drop we've had since March of this year. It's the worst November that we've had since the great financial crisis in 2008, and yet we're only down 3%. Some are calling that a correction, the pause that refreshes. This is Bloomberg.
So I know from owning a sports team that owning one team takes a lot of energy and time.
Tell me about it, yeah.
So you decided after you bought the Washington Spirits to buy some other soccer teams. So you bought stakes in a team in England. Is that right?
Yes. I bought a team called London City Lionesses, and that is the only one of the 2 teams in the entire, potentially Great Britain, that are independent. 99% of the teams in Europe are part of the men's team. But this is one of the only 2 teams that was independent.
So now you have 2 soccer teams, one in England and one in the United States. So I would think for most people that might be enough, but you decide to buy a team in France as well?
Yes. Olympique Lyonnais Feminine is actually the best women's team in the history of women's football. In terms of how many trophies the team has won, they are the 8 times champions of the Pan-European League. And I can't even count how many times they won the French domestic league, the most successful team. I want to professionalize women's sports, right? I don't want people to think that somehow women's sports is a charity or a corporate DEI project. This is a legitimate entertainment product, and it is a business.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg. Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
It is 5:30 a.m. in New York City. Good morning. I'm Matt Miller in for Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. Standing pat, futures steady ahead of the quarterly results from NVIDIA. They come out after the closing bell. Brace for more. Goldman Sachs President John Waldron sees further market pullback, although it could be modest, he said in an exclusive interview coming up. And President Trump plans to formally designate Saudi Arabia as a major non-NATO ally following a day of deal-making in Washington and Riyadh. He said MBS knew nothing of the killing of journalist Jamal Khashoggi. In terms of the markets right now, we see an S&P futures rise of about 1/3%, so increasing from a half hour ago. The NASDAQ futures up now 0.4%, and Russell 2000 futures, those small caps gaining almost 0.5% in the pre-market. For some stocks to watch, let's get over to Valerie Teitel. She's standing by in London.
Good morning, Matt. Let's start with a check in the energy space. We're seeing shares of Constellation Energy in the green, up 3.5% in pre-market. Now, this is the U.S.'s largest developer of nuclear energy. They secured a government loan to the tune of $1 billion to aid them in reopening 3 Mile Island. Now, we did hear back in September that Constellation Energy wanted to reopen 3 Mile Island, and that is mostly to fulfill a contract they signed with Microsoft in order to power its AI needs. So again, this is telling us that nuclear power is really at the forefront when it comes to this energy race, and government backing is behind it. Let's move on to another energy source where government backing is lacking these days. That is green energy. The hydrogen fuel cell developer Plug Power is plummeting in the pre-market, down over 16%, and the most actively traded share in the pre-market so far this morning. This comes after they announced a dilutive convertible bond offering in order to pay down debt that's due next year. Lastly, let's end in the chip space on semiconductor. Now, this company makes sensors in the automotive and industrial space. Shares are higher this morning by the tune of 3.25% after the board authorized a $6 billion buyback program to take place over the next 3 years. Matt?
Valerie, thanks very much. Valerie Teitel there with a look at your movers. Joining us now is Stephanie Guild, CIO of Robinhood, and it's always good to get data from you because you have such a fantastic view of the retail investor. I know that this doesn't seem like that big of a dip yet, so it seems a little bit silly to call it a correction.
In crypto was, I'd say.
Okay, so, and that's important, I guess, to a large cohort of your investors. Are they buying the dip?
On the stock side, there's been a small net buy, not huge amounts like we'd seen in the past, but this dip is I mean, it's kind of normal. and I actually would love a correction, and if you could wish that into existence, because it would just make some opportunity.
A 5 to 10% drop.
Yeah, like a real correction. The names we've been seeing them by actually are in this whole tech space, like CoreWeave, NVIDIA's in there, Meta, like it's been mostly in the space that's been hurt the most. And that's pretty common for our customer base. But on the crypto side, there's been some dip buying, but again, the volumes haven't been as big as in other points when the markets were down way more.
Which is interesting because that's where you see a real correction.
Yeah.
I mean, we were at $125,000, $126,000 on Bitcoin, dropped down to $89,000, and so many people, when we were up at those highs, must have been saying, if only it would sell off a little so I could get back in here.
Yeah.
Are they not piling back in?
I mean, again, I'm looking at the last few days of data,
Right.
so maybe today, because you are starting to see a turnaround in some of the,
Starting to see 93,000.
Yeah, Ethereum is starting to come back. So, I mean, maybe that's driving it, because I haven't looked at this morning's volumes in overnight.
So what does the AI bubble debate look like to you? Because there are companies like NVIDIA, we were just talking about with Matthew Blockson from Bloomberg Intelligence, that make a ton of money and show still massive revenue gains. It justifies their investment, certainly. But then there are companies like OpenAI, obviously not publicly traded, but they want to invest $1.4 trillion and they only have, 13-14 billion in revenue.
Yeah, I mean, Oracle, I think, has become like kind of the proxy for some of those moves, and we've seen that totally round trip. It's increased from September. I mean, I think some of it is not unfounded in the fact that, like, I guess there's some people in the market that haven't forgotten about what happened in 2000, and including me, I was around for that. So I think there is some concern because there has been such a movement of money that you kind of can't tell where it's going. And while I do believe, in AI in the longer term and the benefit of it, I do think you also, as an investor, at those valuations that we had, have to look at like how much CapEx growth is happening versus sales growth. And, is that getting to a point where it's getting too much? And I think when Amazon is borrowing money for it, and also cutting jobs, you're kind of like, okay, where's the focus? And are you going to get the return on invested capital?
Does it, I mean, when we see companies like Amazon or we see companies like Google borrowing money, does it really bother you that a company with trillions of dollars in market cap is borrowing like double-digit billions? I mean, it's a bit like the OpenAI problem in reverse, right?
Yeah, I mean, Amazon, like, can they afford to pay the debt on that? Like, are they net earnings yet? I feel like their net earnings were still not like amazing.
That's always the case with Amazon,
yeah,
right? They turn it on, they turn it off.
Right. I mean, market cap doesn't matter that much as you look at a company like Nebius, which is really small, and they increased their debt from $980 million to $3 billion in this past quarter. That's maybe a little more concerning. They're also part of the whole AI trade. So I'm a little bit like, sure, can Amazon handle it? Probably, but I think it's just, again, starting to question, like, will we get the returns from the money that they're spending and borrowing? And I still think that's a little bit of a question because it's so probably far in the future to really see it through.
In terms of the rates and the layoffs, what do you see happening with the Fed and how much does it matter to this market?
I think the Fed matters a little less than it used to. I think the president and their actions matter a little more. But I think the Fed is a little bit between a rock and a hard place. I've shared this in other places, so sorry if you've heard this, but if you think about what happened in Europe post-2008, you had like one ECB and one monetary policy and one currency. Across all those countries, that Germany was doing fantastic and probably needed higher rates, Spain and Greece needed lower rates. And I'm a little worried that because we have this like bifurcation of economies, where you have like the lower end that really needs help, and then you have, the stock market, and you have the tech sector that doesn't need necessarily that help and probably needs some calibration, that I worry that they are kind of stuck between those two things. The labor market showed that the biggest layoffs are still coming from the government, but I think that's starting to change a little bit, because if they're raising money and cutting jobs like Amazon, then...
Yeah, we saw really a ton of layoffs in October, really starting to push higher, and yet obviously the top quintile is still doing fairly well. President Trump has talked about reviving the stimmies, right? Another $2,000 check going out to the lower half.
is just what's going to happen. How do you get long-term rates down if you're going to take the money that you earn to pay down your deficits and then give it away instead of paying down the deficits? Like, I think the 10-year and thus mortgage rates might be stuck unless there's some other stimulus that comes in to force mortgage rates down.
But would be fantastic for Robinhood, right? And for this market. I mean, retail investors, Wall Street bets, they're still running on full power.
Yeah, but I'd like a solid economy that doesn't need stimulus to operate and grow.
What do you like outside of the AI trade? I mean, we were just talking about constellation energy, as Valerie was showing it. Obviously, power generation has been huge. You need the picks and shovels. Caterpillar has done really well. Are there sectors entirely divorced, though, from AI that you like?
I mean, I don't know if you could say it's divorced, but so in October, we started increasing allocation to healthcare in our Robinhood strategies. And we actually, last week, increased some T-bill exposure because I felt like the market was giving you signs that it was going to sell off a bit. So we wanted to protect some capital. But in the healthcare space, we'd been allocated to names like Natera and Lilly. And we took down some tech in replacement of that just to take some profits. We do also own like the rare earth materials. We have an allocation there. We have an allocation to stocks like Vistra and Constellation Energy. But defense, like kind of industrial defense to me is also a place that over the longer term should benefit from a lot of the policies that have been put in place. Hegseth was, talking to I forget what the phrase he used, but it was something about like making CapEx great again in the defense space and kind of making it competitive again in terms of who gets contracts. And I think there's like a wider swath versus like the two biggest names in the space that could benefit from that.
Stephanie, I'm going to take your Europe post-2008 analogy and run with it over the next few days. So if you hear it coming out of my mouth on my program, Open Interest at 9 o'clock, don't be surprised. Stephanie Guild there from Robinhood. Coming up, Washington and Riyadh strengthening ties after a day of deal-making and a little bit of backslapping at the White House. More on that next. This is Bloomberg.
Coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. I'm not here to say what I would and wouldn't do in the future. But the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. But that's where I'm at today.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
The agreement that we are signing today in many areas in technology, in AI, in earth materials, magnet, etc., that will create a lot of investment opportunities.
So you are doing that now. You're saying to me now that the 600 billion will be 1 trillion.
Definitely, because what we are signing, it will facilitate that. And
I like that very much.
Saudi Crown Prince Mohammed bin Salman vaguely pledging that Riyadh will invest as much as $1 trillion in the U.S., helped out a little bit by President Trump, who said he'll officially designate Saudi Arabia as a, quote, major non-NATO ally. He also said MBS knew nothing about the dismemberment and murder of journalist Jamal Khashoggi. Let's bring in Bloomberg government senior Congress reporter Jonathan Tamari in Washington. So it does look like the diplomatic ties between the U.S. and Saudi Arabia are fully healed from that brief respite we had after the Khashoggi murder. How is this going to work, though, in terms of, for example, selling Saudi Arabia F-35s? There are other allies in the region who may have problems with that.
Yeah, I mean, this is going to be a concern for Israel, for one thing, to name one very close U.S. ally. And some of the details, honestly, are a little bit vague, both on the Saudi investments that are coming to the U.S., supposedly, and on the U.S. commitments to Saudi. I mean, there are many steps still left to go in exactly how all these things will play out. Commitment to sell F-35, to allow advanced AI chips to be sold to Saudi Arabia. So the details were left pretty unclear yesterday. But as you kind of saw from those images, maybe the biggest thing that concretely happened yesterday is a rehabilitation of the image, the way the president greeted MBS, the flyover of jets, a lavish state dinner at night, that basically says that the tension from the Khashoggi killing and other issues in the Trump administration is at least gone.
In terms of rehabilitation, we also saw Elon Musk making his return to the White House. Have those tensions thawed as well?
At least a little bit. The fact that he's there, and you remember the attacks that he and the president were launching at each other, so it is remarkable to see him there. I think the next step we're going to look for is, does he get back involved politically? Does he start donating money to candidates in the midterm elections? And is that a positive or a negative thing for Republicans? Because Democrats used Musk against Republicans pretty effectively last year, but obviously he has a lot of money that can aid candidates around the country.
President Trump also spoke about his Fed chair pick. Here's Bloomberg's Anne-Marie Horton at the White House event.
We're getting closer to the end of the year. Have you started the interviews for the Fed chair?
Yes.
Who have you interviewed?
I think I already know my choice.
Who is it?
Well, I liked him, but he's not going to take the job. He refused.
All right. I guess he was pointing at Scott Bessent. I mean, can I make that assumption?
That seems likely that is who he was pointing to. And Bessent has seemed to indicate he's not going to take the job. He's mentioned 5 different candidates, including current and former Fed governors, economic advisor Kevin Hassett, Rick Ryder of BlackRock. We know the president, likes a little bit of drama. He was the host of a show about, making big hires. So Bessent has said that they're looking for kind of towards the later end of December to hopefully have an announcement. The president at one point said every now and again he likes to go politically correct, so maybe it'll be a more conventional choice. But as I mentioned, he likes the drama. He likes to keep people guessing, and so we'll have to keep watching.
All right, Jonathan, thanks so very much for joining us. Bloomberg Government's Jonathan Tamari there in Washington. Appreciate your time so early this morning. Let's turn to earnings now. Investors counting down to the results from NVIDIA set to come out after the market closed. Joining us again is Matt Bloxham of Bloomberg Intelligence. So this is, in some respects, the big event, Matt. On another level, though, this isn't like the company that people are really that worried about. They still are going to grow revenue, 60%, regardless of which quarter we're talking about. and make a massive amount of money. What are margins looking like?
Yeah, margin's probably like in the 74-75% range. So it's like a hugely profitable company, and that's generating the cash that essentially is getting cycled back into the AI economy. And obviously they did a deal, announced a deal yesterday to invest more in Anthropic. So yeah, I think in the near term for sure, NVIDIA is not a company that people worry about too much, because they are the big beneficiary of all of the capital spending that's coming out of the likes of Google and Meta and Amazon, all kind of this huge demand for their AI accelerator chips. I guess, it's a bit further down the line, maybe 2 to 3 years out, where perhaps things become a little bit more clouded if the end user demand from corporates and enterprises doesn't pick up to kind of sustain the AI investments. And obviously there is competition there for them from the likes of Google and AMD, who are developing their own AI accelerator chips too.
What are you looking for today, Matt? I mean, are we going to see any sign of wilting end user demand? Are we going to see any sign of stronger competition in, for example, today's outlook?
Yeah, I don't think so. I mean, they're still clearly the market leader by some distance. And I think at the end user level, the momentum, certainly with corporates, is improving. I think, I'm not sure if we'll see too much detail, but I think what people would really like to see is some kind of more case studies, some real specifics about how big corporates are deploying AI, the kind of return on investment they're getting, and the fact that they plan to kind of continue to expand the scope of AI within their organizations. And Jensen Huang alludes to that a lot in his kind of big picture talks. He's talked about this kind of virtuous cycle that we're now in, and that we're kind of beyond Moore's law. But I think the more they can do to kind of show specific examples of that end user demand will give people more confidence. But I don't think we'll get too much of that later today.
All right, Matt, thanks very much for joining us. Matt Bloxham there of Bloomberg Intelligence runs our tech coverage for us out of London. Don't miss our exclusive interview with the CEO of NVIDIA, Jensen Huang, after those earnings, is going to sit down with Ed Ludlow at 6:30 p.m. Eastern, and you'll see it right here on Bloomberg TV, be able to hear it on Bloomberg Radio, and of course we'll continue to play that for you throughout the day tomorrow. Sticking with earnings, we'll hear from major retailers before the bell, including Target, Lowe's, and TJ Maxx. TJX joining us now is Bloomberg consumer reporter Maddie Parker. So, Maddie, what do we expect to hear from these retailers, as so many, I mean, John Waldron even voicing concern about the state of the U.S. consumer?
Yeah, totally. I mean, obviously Target are kind of the main results that are going to come out today. They're going to be watched very closely by consumers, by other retail brands, and also by Wall Street. It'll be really interesting to see whether in the third quarter they're kind of able to recapture some of their growth as they transition under their new CEO, who they appointed in February this year. He very much said he was going to focus on merchandising and technology, but it'll be really interesting to see, obviously, whether they hit the mark during kind of that key back-to-school period with consumers who are really kind of looking for good quality groceries and daily essentials, but obviously at reasonable prices as well.
All right, so who's expected to deliver the strongest gains here? I mean, typically a company like TJ Maxx does well in an economy where the consumer is weakening.
Yeah, definitely. I think obviously the kind of compounding inflation over the past few years, it will likely kind of give an edge to some of those kind of discount stores. So people like TJ Maxx may well kind of benefit from that. They're able to procure inventory and obviously sell it on at more of a discount to consumers. They're feeling the pinch from inflation. They're obviously also feeling the pinch from, things that retailers have been warning about for months, like tariffs raising prices for consumers. So it'll be really interesting, obviously, as we approach this kind of festive period as well, to see whether consumers are kind of going for those more discount things, whether they're taking advantage of those sales as well.
So more sales here. What about jobs? Are we going to see more hiring into the holidays, or are we going to see that slow down from past seasons?
Well, traditionally, yeah, retailers do definitely hire more. They kind of hire some of those seasonal workers as they approach the holiday period. I suspect that, retailers, despite kind of the wider kind of consumer uncertainty and consumer sentiment, has definitely taken a hit across lots of different markets. The kind of golden quarter of retail that we're approaching, so that includes Thanksgiving, it includes Black Friday and Christmas, we'll still likely see very strong sales, we're hoping. So, they may well kind of bring in more employees just for that period. But it'll be interesting to see kind of exactly how consumers respond and whether retailers kind of have a very strong quarter towards the end of the year.
All right, Maddie, thanks very much for joining us. Bloomberg's Maddie Parker talking U.S. retail earnings. We're going to get those throughout the day. Coming up, we're going to get you set up for your trading day with NVIDIA earnings, really the key event on deck, and Fed Minutes. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Let's take a look now at what's ahead today. As we said before the break, retail earnings are coming out. Target is reporting, as well as Lowe's and TJ Maxx before the bell. Then we get the Fed releasing its latest minutes. That's at 2 p.m. Eastern, has in the past moved the market, so definitely important to pay attention to that, especially if you're focused on rates or FX. But the main event for this market is NVIDIA. It reports earnings after the market close, and we're expecting to see massive 60% gains in revenue, as Matthew Bloxham said, more than 70% margins as well. Tune in to a conversation with Lawrence Wong, Singapore Prime Minister and Minister for Finance, with Bloomberg Editor-in-Chief John Micklethwaite from the Bloomberg New Economy Forum. And then, of course, after NVIDIA earnings, Ed Ludlow is going to sit down with the CEO, Jensen Huang. In terms of the share movement before the market open, NVIDIA shares up about 0.8% in the pre-market. This is Bloomberg.
Nobu-san, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
You know, I met him 1988 after my first restaurant opened. He asked me to come to opening a restaurant in New York. And beginning, I didn't know what he did.
You didn't know he was an actor?
No, I don't know. What he doing? Because I never watched the movies. You know, I was traveling the business. But of course, after, you know, people, hey, Nobu, so you must know him. And then I understand.
How is he as a partner?
He's, for me, and a great partner. He understands to my concept. He supports me 100%. But he's a very smart people. Sometimes, so strange idea, but it's good idea. So, example, Nobu Hotels, idea come from him. He said, hey, Nobu, so we have a lot of new restaurants coming in somebody's hotel. For him, doesn't make any sense. Then we start Nobu Hotel in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Caroline Connon in Paris, and this is Bloomberg.
The data center and AI build-out is going to be extremely expensive. That's starting to weigh on the market a little bit.
There is an expectation that we'll start to see a leveling out in Mag 7 earnings growth rates.
I still think there's probably some room to see more pullback.
New leadership can emerge or at least challenge some of these tech leaders. And that to me is a very healthy stock market.
12 months ago, the fundamentals looked better. We're more on bubble watch than bubble call.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday, looking for stability. The weight of the global equity market on Nvidia's shoulders as Target is preparing to shine a light on a very gloomy U.S. consumer. President Trump is inching even closer to naming the next Fed chair. That decision just weeks away.
Yeah, speaking to our own Anne-Marie Hordern, who is still down in Washington, D.C., President Trump saying, I think I know my choice. I'd love to get that guy currently in there out right now, but people are holding me back. He also talked about how occasionally it's good to be politically correct. So you have to wonder, is this sort of putting some wind in the sails of Chris Waller, or is there somebody else who he thinks is the more politically correct choice?
I had the same question. Who is the politically correct choice in the mind of the president? In the mind of the market, it's Governor Waller. He's already at the Federal Reserve. Let's go, standard call. Someone sitting at the Fed, ready to cut rates. He's my guy. In the minds of the president, what's a politically correct choice?
Right now, according to Polymarket, Kevin Hassett is the favorite with a 46% chance, and Chris Waller has a 19% chance. So I think that there might be some delta between the politically correct choice of President Trump and the politically correct choice of markets. However, Scott Bessent is very attenuated to what the markets care about, so how much is he going to maybe move the needle here?
We'll catch up with Anne-Marie in about 10 minutes on this story in just a moment. Need to talk about NVIDIA as well. NVIDIA in the pre-market, just about positive. NVIDIA's had a really tough go of it over the last month or so, down about 12% or so from the October high. Some high-profile exits as well. SoftBank sold its stake. Peter Thiel's hedge fund sold its stake. The stock's under pressure in a way it hasn't been in a long time.
The central bank of NVIDIA's decision comes after the bell today, and I have to say that the entire market is riding on it. To me, the idea, you pointed to that 12% drawdown, that includes $630 billion of market capitalization evaporating from the global tech sphere. And this raises a question about how much they're able to underpin the global rally and optimism around growth. Ultimately, one person was saying that this is a so goes NVIDIA, so goes the market kind of report. It does feel like they have a very high bar to cross, and it raises a question going forward about whether the people who've just recently got out of NVIDIA were just getting out to get into something even more ambitious, or whether they're getting out because getting out is pretty good.
We've heard from their biggest clients, the hyperscalers. their spending intentions are up, not down. There should be a good story to tell here. But the way the market treats these earnings has shifted, and shifted markedly. The way this market has treated this story has shifted markedly as well. If you think about the last 24 hours, we had a deal, another announcement. This time, I think it was NVIDIA, Microsoft, Anthropic. Have a look at how those two stocks performed yesterday. Microsoft down 2.7%, NVIDIA down by 2.8%. Do you remember not so long ago when you see a deal like that, the stock was up 10, 15, 20%? That's not happening anymore. Things have changed.
Yeah, people have gotten the joke. They understand they're all in bed together. So are they in bed going to a good place, or are they in bed going downhill? And this is sort of the question when you have Anthropic getting a cash infusion from both Microsoft and NVIDIA for power centers that'll be powered with NVIDIA chips and with the Azure cloud computing system of Microsoft. It raises a question, if one weak link goes down, how much is the entire ecosystem threatened? That increasingly has come to people's minds. Add tens upon tens of billions of dollars of debt upon it, well, and you have yourself a minor correction.
It's the main event later on this afternoon. NVIDIA in the pre-market up by 0.75%. An exclusive conversation with Jensen Wag and Ed Ludlow on Bloomberg TV later on this evening, so look out for that. Coming up this hour, we'll catch up with Julian Emanuel of Evercore with stocks on their longest slide since August. The former U.S. intelligence official Norman Rule as the U.S. and Saudi Arabia deepen ties. And the Nokia CEO, Justin Hotard, on the company's push to create the first 6G network. We begin this hour with stocks edging higher as investors count down to earnings from NVIDIA. Joining us now to discuss is Bloomberg's Mandeep Singh. Mandeep, good morning. Look, the stock story's not great. Surely the earnings story is going to be okay.
Look, I mean, the best way to frame it is, you were discussing about hyperscaler CapEx. We know at the start of the year, the expectation was that CapEx would grow 20% in 2026. Now it's close to 40%. So from that perspective, NVIDIA numbers should be revised upwards. And, everyone has talked about building more gigawatts when it comes to AI data center capacity, whether it's OpenAI or any of these hyperscalers. And the question that investors will ask is, how much is NVIDIA's share in that gigawatt build out? Because that's how they're going to generate, more revenue is if OpenAI builds 30 gigawatts and they have to rely on NVIDIA's chips, then there is no choice but to pay NVIDIA, the higher gross margins that they have commanded so far. Whereas Google told us yesterday that Gemini 3 was trained entirely on TPUs. So from that perspective, they're not going to get their cut in terms of what Google is building around AI data centers. So that's the key question for me is how much NVIDIA manages to keep their share going forward in this gigawatt build out.
Mandeep Singh of Bloomberg Intelligence on NVIDIA. Those numbers dropping later on this afternoon. Here's the view on Wall Street so far this morning. Julian Emanuel of Evercore calling for the S&P to hit 7750 by the end of next year, writing the path to a bullish long term is often a series of volatile, uncomfortable short terms. This is one of those times. Julian joins us now for more. Julian, good morning.
Good morning.
Things have changed. Why have they changed? What's behind this recent shift, the way the market treats this story?
It's actually the debt concerns, in our view. Again, because, and this is inescapable, and we talked about this a number of times throughout the year, you cannot get away from the comparisons to the late 1990s in many respects. And when you think about the late 1990s, the problem with the bursting of the bubble, besides the fact that the Fed was hiking in 1999, was the fact that a lot of the build-out was financed by companies that were incurring debt and had no revenues on the other side. And because you've seen this accelerating debt issuance, there is the worry that that is coming back. And we would say that's actually a good rational worry.
Well, and it's a worry potentially to buy. I mean, I guess that this goes to the question of what makes you so bullish on an ongoing basis, despite some of the rhyming features of this particular rally with respect to the debt component?
Well, so a number of things. Again, the macro backdrop is favorable, okay? The Fed is going to be cutting. We're going to have more stimulus. Whether we get $2,000 in our pockets at some point next year or not, we're going to have more stimulus. And from a valuation perspective, as much as angst as there is, in fact, certainly in comparison to the late 1990s, these names are, I wouldn't say cheap, but they're certainly not expensive relative to history, and they're not expensive relative to their own history. And what we've seen over the last several years in a lot of them is they just mark time going sideways, so earnings catch up to valuation, and that's an ongoing process.
At the start of the sell-off, at the start of November, it was very much what you're talking about, a realization of the debt component. It seems like the tone has shifted over the past couple of trading sessions to not just a tech story, but to an everything story, raising questions first about whether the Fed is going to cut next month, and second, whether the U.S. economy is strong enough to withstand some of the optimism without that rate cut. How much do you see that story continuing? The idea that maybe the weakness under the hood is part of what's pushing this story as much as the debt overlay to artificial intelligence?
Well, a lot of it is the fact that we simply haven't gotten data for the last month and a half. And, you know, in the beginning of it, it was okay, fine, the markets were doing well. You know, the uncertainty is a positive, but then investors realize that uncertainty is uncertainty and should be discounted. You know, our suspicion is that over the next number of weeks, as we get back to normalizing the data releases, people will at least have something to anchor on. And the question is, in terms of the economy, and which is certainly the question that's the backdrop for sustaining these valuations and, of course, monetary policy, is the economy okay with the slower speed of job growth? You know, we think the sort of the monthly break even is somewhere between 30 and 60,000 jobs. Is that palatable? We think the answer ultimately will be yes.
Julian, forgive me, it's almost like we've forgotten what it was like when we had the data. When we had the data, people questioned it all the time. They questioned the quality of it. They didn't like the payrolls data. In fact, the payrolls data was super weak, even if you believed in it. And I don't know how relevant the equity market story was to the payrolls data we've seen over the last 7-8 months anyway.
Well, we have never put stock in the monthly payrolls data. It's the weekly jobless claims data that's always been high frequency importance, and we've been sort of calculating it back of the envelope at Evercore ISI these
Anything
last
to worry
number
about?
of weeks. No, it's, you know, steady as she goes, 230,000 every single week, and I think once that becomes transparent, we're going to see that again.
Does it come down to this? The stock market, what it really wants, the earnings story that it's already got, but it wants the rate cuts too. And to get the rate cuts, you need the weak jobs data. Is that what it comes down to?
Look, at 26 times, you have to have constant positive narrative. Stocks are expensive. Stocks being expensive is not a reason to sell the market. You know, it can be a headwind, as it is at the current time when you have this uncertainty. But again, ultimately, to your point, John, is that, like, earnings revisions are just phenomenally strong. The runway to next year in terms of earnings growth is great. And as I look at it, our 77.50 price target is likely not going to imply any multiple expansion, which makes me want to mop my brow in relief.
Well, mop your brow in relief or put a higher multiple on the idea of bubble territory. We're on bubble watch, or maybe bubble call, or whatever you want to use the word, B word, that everyone seems to be overusing these days. What would it take in terms of Fed rate cuts to get to your extreme bubble call, full bubble, which you put at a 30% chance currently for next year?
You'd probably need 4 or 5 cuts in an economy. Well, look, back it up. The fact is that in the last several weeks, both the trajectory for growth and the trajectory for inflation appear to be improving. We took our number down to 2.7 on core PCE for the end of next year. That's certainly going to be sufficient enough for the Fed to cut. We took our growth number up to 1.9. And frankly, the way the setup is right now, there could be upside to the growth number and downside to the inflation number.
Julian, it's good to see you. An optimistic take on the future. Julian Emmanuel of Evercore, following a 4-day slide on the S&P 500. Futures near session highs up 1/3 of 1%. Later on this afternoon, earnings from NVIDIA. Later on this morning, numbers from Target. Look out for those numbers around 6:30 Eastern time. Let's keep an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahira for more. Hey, Yahira.
Hi, John. After Home Depot stumbled yesterday, we are seeing shares of Lowe's rising more than 5% after topping earnings estimates for the third quarter, while net sales grew 3% year on year. Lowe's also raising its full-year sales guidance as the company is updating its outlook for operating results to reflect ongoing uncertainty in the current macroeconomic environment. Meanwhile, President Donald Trump says he thinks he's identified his choice to be the next chair of the Federal Reserve. Treasury Secretary Scott Bessent narrowed the pool of contenders to current Fed governors Christopher Waller and Michelle Bowman, former Fed Governor Kevin Warsh, White House National Economic Council Director Kevin Hassett, and BlackRock's Rick Rieder. And in Europe, UK inflation fell for the first time in 7 months. The drop was driven by energy prices rising by less than they did a year ago. The data keeping alive hopes the BOE will cut rates at its next meeting. Traders are pricing in an 80% chance of a cut next month. That's your Bloomberg Brief. John.
That decision on December 18th. Some good news for the UK for once. Yahara, thank you. Up next on the programme, choosing the next Fed chair.
We're getting closer to the end of the year. Have you started the interviews for the Fed chair?
I think I already know my choice. It's nice to every once in a while go politically correct. But we have some great names.
Anne-Marie joins us next from Washington, D.C., live from New York City this morning. Good morning.
Is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Four-day slide on the S&P 500, the longest losing streak going back to August this morning. A bounce up by 0.4% on the S&P, on the Nasdaq 100 up by 0.5. Later on this morning, about 14 minutes away, we get numbers from Target. The numbers yesterday from Home Depot, not great. Numbers from Lowe's just moments ago.
Yeah, and the numbers from Lowe's had kind of a mixed feel. On one hand, their comp sales for the third quarter were below expectations, but full-year forecasts came in above expectations, which really gave people positivity. Also, they have a new partnership with a company that works with professional contractors, which seems to be bolstering some of their views as well. They did talk about the hurricane season, but still, they're talking about total sales for the full year of $86 billion. That is above where they had previously seen. That going forward, in general, a much more optimistic tone than what we saw at Home Depot.
They've got a better story to tell this morning, that's for sure, because Home Depot did not. Will Target? This is the issue. It's a market that's looking for a re-acceleration, a pickup in economic growth into year-end and out the other side. Is that what we're hearing from these companies?
Yeah, is it going to be a same story from Target that the consumer is kind of muddling through? Or is this going to be the same kind of story as what we saw from Home Depot and Lowe's? There's a winner and there's a loser. And there's a question of market share consolidation. Is this a question of Home Depot facing a very difficult macroeconomic backdrop, or is this maybe losing share to Lowe's, or potentially the Lowe's team doing a better job in managing efficiencies? Are you going to see the same kind of nuance with, say, Target versus Walmart? That's one of the key questions.
Target at 6:30 Eastern Time. Walmart numbers coming up tomorrow. Under surveillance this morning, let's talk about the central bank choosing the next Fed chair.
We're getting closer to the end of the year. Have you started the interviews for the Fed chair?
I think I already know my choice. We have some surprising names, and we have some standard names that everybody's talking about. And we may go the standard way. You know, it's nice to every once in a while go politically correct. But we have some great names.
So here's the latest this morning. The White House nearing its final round of interviews for the next Fed chair, saying we might have a pick by Christmas. Anne-Marie asking her questions in the Oval yesterday, joins us now from Washington for more. Anne-Marie, it feels like we're getting closer.
It does feel like we're getting closer, Jonathan. And we should say, the president immediately said to me when I asked that question, yes, he started the interviews and he already knows in his mind who he has. And then his glance and his eyesight went right to his Treasury Secretary, who was sitting there on the couch to his left, and said, you know, I'd like him, but he's happy at Treasury. And then Scott Bessent once again said, yes, I'm not leaving my post. And then Bessent clarified that interviews will start to begin in earnest and that they should be wrapping this up before the end of the year. It was also interesting. The Treasury Secretary was asked about this last night on Fox News, and he said, I will not be the Fed chair. And then he sort of turned it around with the president playing coy with him all the time and said, you know, I think President Donald J. Trump would make a great Fed chair.
Isn't it super on brand, Bramo? The Crown Prince Mohammed bin Salman is in the room alongside the President of the United States. What do we ask? Questions about the Federal Reserve.
I was thinking the same thing. Thank you for representing us well, Anne-Marie. We really appreciate it. Keep up the good work.
AMH, what was the big takeaway on the big Saudi meeting?
Well, also just to clarify, before I got to the Fed, I did ask about the agreements going on between Riyadh and Washington, D.C., and I also asked the Crown Prince. One of the big takeaways from that Oval Office meeting for the business community is that he wants to expand not $600 billion, but $1 trillion in investment. And how do you do that when oil prices continue to stay in a range of $60 a barrel? And for more on that, we're joined by former senior U.S. intelligence official Norman Rule right here in the studio. Norman, thank you so much for joining us this morning.
My pleasure. Good morning.
You have serious detail in regards to the relationship between these two countries. I would love to get your answer, because the Crown Prince, His Royal Highness, actually ignored me when I asked that. He wouldn't give me a price. But can Saudi Arabia maintain this level of investment where oil prices are now?
I believe they can, but I think it's a question of how long it will take them to execute this investment. And that answer will be over years. They did not indicate yesterday how many years it will be before these agreements are completely fulfilled. And I think we're probably looking at a decade or more. And that really strikes to the heart of what this meeting was all about. This was a transformational agreement between the two countries, where the Saudis and the Americans are investing in each other's futures, in energy, artificial intelligence, minerals, chemicals, and defense. And this will take a decades for this to play out. It's a really transformational agreement.
It will take years, because also looking at the fact sheet, they use a lot of words like commitments, memorandum of understanding. A lot of what we heard yesterday, we heard during President Trump's trip to the Middle East in May. If you're sitting in Saudi Arabia, though, and you want to make investments, is it challenging to do that with the United States that runs on a 4-year election cycle?
It can be, but I think we've seen a lot of progress that has not yet made it to the press. Over the last 5 or 6 months, there has been an intensive exchange of officials between the two countries. Diplomats have been working furiously to flesh out the paperwork. The F-35 announcement is not something that occurred yesterday, for example, and I know the same thing has happened on nuclear issues, on energy matters, and on broad defensive military industrialization issues for Saudi Arabia. So I think we should look for the next 3 to 6 months for rollouts of American companies engaging their counterparts on these issues. It's going to be a very busy season for U.S. and Saudi engagement.
You mentioned the F-35s. There's also this defense pact. The president yesterday talked about Saudi Arabia becoming a major non-NATO ally. What does this mean for the Israelis and the path to normalization between these two countries?
Well, being a major non-NATO U.S. ally does not bring a defensive component. It doesn't mean we come to a country's aid necessarily in time of conflict, although truth in lending, I think it's clear that if Saudi Arabia were ever attacked, the U.S. would be there for that country. What this does, it allows Saudi Arabia expedited access to equipment, increased intelligence sharing, some participation in research and development. A number of countries in the region have this relationship already, and it was long overdue for Saudi Arabia in my case. I think the Israelis are going to be uncomfortable with this, but it's a new regional security architecture, and I think the region will have to adjust to that architecture itself.
In the Oval Office yesterday, the president made clear he had this conversation about normalizing relations between Riyadh and Jerusalem. Do you think that gets done in Trump's term?
I think it's possible, but it's going to be difficult. The issue remains Saudi Arabia has made it very clear they will normalize relations with Israel when there is an irreversible path to a two-state solution between Israel and the Palestinian people. That appears very unlikely at present. And the Crown Prince was very clear. He wants to join the Abraham Accords when that happens. That does not appear likely now. And for that to happen, we would not only need to see significant political changes within Israel, but serious transformation among the Palestinian leadership itself, which appears a long way off at present.
I want to end on Iran. The Crown Prince reportedly got this letter from the Iranian President Masoud Pezeshkian before he went to the United States. What do you think was in that letter? Could Saudi Arabia be at the table to potentially facilitate talks between the United States and Iran?
And the Crown Prince was clear he would do what is necessary to assist in discussions. Right now, my sense is that the Iranians wish to have engagement with the United States, but the president, I think, is wise in not seeking engagement just to have engagement. You see, if you're Iran and you have engagement, that automatically raises your rial, supports the economy, it helps the government, but it doesn't actually produce a nuclear agreement. My sense is the Trump administration will seek engagement when they believe the Iranians are serious about talks, and they don't believe the Iranians are serious at present. And the Trump administration has many other fish to fry.
Norm, thank you so much for your time this morning.
My pleasure.
That was, of course, Norman Rule, a former U.S. senior intelligence official. My big takeaway sitting here, Jonathan, in Washington with Norm is that when you look at the fact sheet, it's a lot of commitments, MOUs. Norm is spot on. This is going to be years and a decade in the making.
AMH, with the latest in Washington, Anne-Marie, my takeaway this morning is the crude price is exactly where this president wants it to be. Low 60s right now, down about 16% year to date.
How much is that part of the tacit agreement behind the scenes? Because there's a question around what the U.S. got in return for some of the pledges to provide chips, et cetera. If you want an answer to that, some people have suggested, not me, but some people have suggested take a look at the oil price and how much it has remained within this 50 to 70 band. And that really is where it's going to remain regardless of the geopolitics, which really puts a lid on the potential inflation coming from energy costs.
I'm not sure how happy the shale patch is with these numbers, but that's a different question altogether. Crude this morning down about 1%, $60 and about 13 cents. Up next on the program, we'll turn to the retailers in America and the U.S. consumer. Sucharita Gadali of Forrester with target earnings just around the corner. Plus, Danny, how's your morning movers? Lowe's rising on better than expected numbers. That stock is up by 4%. Live from New York City, you're watching Bloomberg TV.
Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Live from New York City this morning. Good morning. Let's take a beat. 4-day slide on the S&P 500. 4 days of losses amounting to almost a 4% decline from all-time highs in the last month or so. We bounced back this morning, up by 0.38% on the S&P. On the Nasdaq 100, up by 0.46. On the Russell, the small caps up by 0.56. So a bounce so far this morning. Let's see if this sticks. In the bond market, not much offset coming from the long end of the curve. A bit of a debate on what this might mean for the Federal Reserve on the 2-year, 357, but Lisa still firmly in that range between 350 and 360 at the front end of the curve.
You've seen a fluctuation over the past week in terms of the Fed speak buffeting around next month's Fed rate cut expectations. And the long end, I wonder how much is the story I pointed to yesterday about what's going on over at the Bank of Japan and the idea that long ends are rising there and how much that's kicking around the long end of the yield curve around the world. I also wonder how much some of the long-dated issuance from some of the tech giants also is creating perhaps a supply and indigestion issue for that particular denomination. Nonetheless, to me, the real question is, what's driving the sell-off? Is it the Fed or is it tech fears? I mean, last night at the dinner table, people asked, they were like, what's causing this?
What did you say? We all want to know.
I was
Describe the Bramo household dinner.
I just, took a bite. I was like, I'm sorry, I'm busy. No, I said, look, ultimately people don't know. There could be just sort of this concern about the debt. I'm sure all the kids' eyes glazed over.
Sure.
Then I said it could be about the Fed.
Because they've heard that one before.
And their eyes glazed over. And then they said, please pass the Brussels sprouts.
Does this week have the potential to sort of reopen the door back towards that, melt up into year-end, that Santa rally? Two things have the potential to do that. The jobs report could unlock that Fed debate for December 10th, and NVIDIA after the closing bell could unlock some of those fears about the AI trade, maybe just calm things down just a touch.
Yeah, how much do they have to beat to get people really excited again? Or have we already seen the sort of pre-release sell-off that sometimes happens post-release, right? We've already had that 12% decline in NVIDIA shares. Is that setting up for just a wave of positivity when they come out and they say, actually, we do own the world, just pay us your money?
I mentioned this a little bit earlier. Don't miss the conversation with Jensen Huang, the NVIDIA CEO, sitting down with Bloomberg's Ed Badlow later on this evening. As we count you down to the opening bell, 3 hours to go. Let's get you some single names, some morning movers. Here's Danny with more. Hey, Danny.
Hey, John, some more retailer earnings to work through. We're getting Target now, but also Lowe's in the past half hour. Shares are up 3.7% because they did have a better third quarter than expected, but maybe some of this is about expectation settings. Shares sold off yesterday with Home Depot. They're down 11% year to date. Not to mention, for the full year, they did narrow their outlook below the high end, saying that the macroeconomic environment was weighing on them, and they also see a flat year for 2026. Elsewhere, Constellation Energy, those shares also higher by 3.2%, getting a $1 billion boost from the Department of Energy. The government giving them a $1 billion loan to help them reopen 3 Mile Island. Chris Wright, the energy head in the U.S., saying that this is helping lower the cost of energy. Again, it's that focus from the administration on the cost of living. Finally, rounding things up with some sell-side action, DoorDash gets an upgrade from Jefferies, saying that they basically have lowered the bar. They had a record sell-off earlier this month after their earnings with the new investments, but Jefferies says that after that sell-off, and not to mention that growth is looking good at DoorDash, they are recommending a buy on that stock, John.
Danny, thank you. That stock is up by 3% in the pre-market. Talking about affordability in this country, trying to order food now through anything like DoorDash, any of those kind of companies in, say, a city like New York, has become so expensive, ridiculously expensive, I think prohibitively expensive to order food through these destinations now.
It's actually spurring me to use my legs much more.
Right, get up and go and pick it
actually
up.
go get it, because I mean, ultimately, you're looking at a service fee, then you're looking at a potential processing fee, then you're looking at the driver tip, then you're adding to the restaurant manufacturing fee. I mean, whatever. The fees just start adding up in addition to the prices of the actual meals, which are going up as well. Yeah, you're right, but people are clearly still going.
Rebuild that relationship with these restaurants and the customer. There is a restaurant that I order from every Friday evening, almost every single week, and I bet they don't even have a clue who we are because we go through the order and the delivery company, right? The way it used to be is they knew who you were, they threw them some dessert, they gave you an extra piece of whatever you liked, and now no one knows who anybody is anymore because there's this weird intermediary that's charging you all this money to connect you to the restaurant that you go to every single week without the restaurant even knowing.
Yeah, there's not that relationship really with the restaurant and not really the recourse. Make ordering food great again.
Right, there you go. Okay, we've got some news to talk about. On our radar this morning, investors counting down to NVIDIA earnings due after the closing bell. Traders eager to see if the billions spent on AI are paying off. Analysts expecting the company to show 50% growth in both net income and in revenue. Elsewhere, the Apollo CEO, Mark Rowan, downplaying recent concerns over private credit. Rowan was speaking at Bloomberg's New Economy Forum in Singapore.
Credit stats are actually improving rather than declining. That does not mean we will not have late cycle banking behavior because there are good banks and bad banks, and good insurance companies and bad insurance companies, and good asset managers and bad asset managers. But there's nothing that I see that is systemic.
Roman going on to suggest it's probably rational to reduce risk in the current market environment. If there's a guy out there that I'd pick up the phone to just to calm me down, it would be that guy right there. Mark Rowan, always prepared just to talk you off the edge of the cliff.
Well, and frankly, he's got a lot of stake in the game. He's got a lot of skin in the game with respect to just how big their investment is in private credit. Of course, Apollo is focused more on the investment grade side of things. They're not focused as much on the speculative range of the credit. We've heard this from so many of the private credit investors. We've also heard from the big bank CEOs. Yesterday, we heard from John Waldron of Goldman Sachs, and he was saying, yeah, there could be a little bit more to go. It wasn't exactly ringing the red flag or ringing the five-alarm fire. There was a question here just about a blow-off top that seemed healthy. It seems like there's a contradiction between cockroaches that are going to unmoor the whole system and potentially valuations that got a little heady that are now getting a little bit lower. And it seems like more and more people are leaning toward the latter.
Given what's emerging there, can a 25 basis point reduction of the Federal Reserve make a difference? Who's going to lead the Fed in 2026? Anne-Marie had a little exchange with the president yesterday. The president indicating he knows his pick to be the next Fed chair. The president mentioning he may opt for a contender that's seen as, quote, politically correct, with the Treasury Secretary Scott Bessent saying he'll hopefully have an answer by Christmas. The Treasury Secretary hoping the answer isn't him.
Yeah, well, he is saying it is not going to be him. Most people tend to agree. Question is, and we were talking about this earlier, who's a politically correct choice for the Federal Reserve? Is it politically in the eyes of the market? Is this politically in the eyes of President Trump? Because ultimately, right now, people think it's Kevin Hassett. The market thinks the politically correct version is either Chris Waller or Rick Rieder. The other potential contenders are Kevin Warsh, who seems to have fallen off the map with respect to anyone ever mentioning him, or Michelle Bowman, who's making her own waves as the vice chair of supervision and kind of what she's doing with respect to some of the oversight of banks. So a real question here. It ultimately seems between Rick Rieder, Kevin Hassett, Scott Bessent can't get his name out of it, and of course, Chris Waller.
Keeps coming up, doesn't it? The president says, I've made my pick. And then he looks at the Treasury Secretary and said, I wanted him. So is that still your pick? Or is it someone else?
It seems like it's someone else because he gave him an out, and Scott Bessent was saying absolutely not. So it seems like that's not going to be the case. Nonetheless, there still is a chance, at least on Polymarket, that that is the end pick for the Fed.
I said this story had gone quiet yesterday Anne-Marie bringing some life back to that story down in Washington, D.C. in the Oval. We did get some earnings from Target, so let's talk about those numbers. They crossed moments ago. They see the full-year adjusted EPS outlook at about $7 to $8. They had seen $7 to $9. So just bringing down the top end of that range for the outlook from Target. The stock, Lisa, down by 2.3%.
Yeah, this isn't as good as a lot of people expected. Full-year adjusted earnings per share now between that 7 and 8 versus the 7 to 9. But also looking at third quarter comp sales, down 2.7%. The estimate had been 2.06%. Overall, pretty much a miss across the board. Net sales, net EPS gained a little bit. Then this headline drops. OpenAI and Target report a partnership. Target will continue relying on ChatGPT Enterprise, according to OpenAI. Not even a mention of OpenAI or artificial intelligence could help boost these shares in futures markets. I mean, I don't know what to make of this, but clearly this is going to be the tenure of the tone of a lot of different corporate earnings. How are they deploying artificial intelligence, and how will it actually improve their bottom line?
We often say on this program, you can learn something from the numbers and learn something from how the market responds to them. The way the market responds to this story has changed. There wasn't so long ago, maybe weeks, not even months, when you saw a story like that, the stock would be up 5, 10%. Likewise yesterday with Anthropic, Microsoft, NVIDIA coming out and doing the usual, we'll get together, I'll spend here, you'll spend there, we all do better, hurrah. And you'd see a 5, 10% move in all those stocks. We didn't see that yesterday either. Things have changed. Things have shifted. How permanently so? I've got absolutely no idea. It's an observation. But without a doubt, things have changed.
Investors want to see the money. They want to see the results. They want to see the use cases. They aren't happy enough with someday it will make an incredible difference. Right now, Target is coming out saying, the COO is talking about, we are relentless in our pursuit of returning to growth and not satisfied with our current results, talking about gaining more efficiencies with respect to their partnership with OpenAI and using ChatGPT in their systems. How can they do this? How effective will that be? Will this come from job cuts? This isn't the hopes and dreams pie in the sky that it will massively expand the business model of so many different companies. And I think that reality check is what's really got people's psyches in the market.
To make it super simple, do we have a Target problem or a consumer problem? Check out Walmart off the back of these numbers. Walmart down by 0.7%. Walmart reports tomorrow. There's a bigger and bigger worry that the more you hear from these companies who are struggling to generate growth, it's not just a company-specific issue. It might be a broader issue.
Especially if Walmart performs well. There is a question of how much they're able to do this in the back of efficiencies, on the back of just cutting costs through rapid deployment of technology. Is that a good story for the consumer, or is that potentially a negative read on the consumer in terms of the levers that people are pulling in order to have good results? It's not good enough just to have okay results. It's also the why. Where's the growth strategy? It might be good for Walmart's shares, but it might not speak to a consumer. Right now, what we heard from Target is that there was choppiness across their business. They've been trying to figure out what exactly it is. But again, that consumer discretion seems to not necessarily be driving results in the same kind of way.
Home Depot yesterday, look, they've turned around and told us mortgage rates have eased. We got what we wanted there, and it didn't result in a pickup in activity. What else do you need to know? The interest rate reductions, the looser financial conditions, the lower mortgage rates have not resulted in a pickup in economic activity, which is why the Governor Wallers of this world are still making a case we need to go even lower on interest rates.
Yeah, of course, Lowe's performed better. Lowe's had a better outlook. How much is this a strategy issue? How much is this a broad consumer issue? And how much is this a softness in things like the housing market or, frankly, the hurricane season, which, again, Lowe's also made mention of? I think Walmart's going to be the real key in all of this. If Walmart reports that the consumers are going gangbuster and are doing great and are going out there, well, Target will lose even more, and Walmart shares will do well, and it will speak to the muddling along kind of economy that so many people point to. It is a mystery wrapped in an enigma.
And we're going to unwrap that enigma with a mystery buried in it tomorrow morning, aren't we? Payrolls at 8:30 Eastern Time, Walmart as well. There's a real chance that you get some greater clarity tomorrow, at least I hope we do, on the American consumer and the path forward for this Federal Reserve. Numbers from Target out just moments ago. The stock is down by about 1.4%. The company just trimming the top end of its outlook as it looks forward and sees pretty flat growth at the moment, and that is a problem. That stock is down in the pre-market. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahira for more. Hey, Yahira.
Hi, John. Just to recap those earnings, we are seeing Target shares down 1.5% in the pre-market after posting mixed results for the third quarter. The retail giant beat earnings estimates but saw revenue come in lower than expected. Target also narrowing its adjusted EPS guidance for the full year. Along with the results, Target announced a partnership with OpenAI. Meanwhile, Meta defeating the government's antitrust case over its acquisitions of Instagram and WhatsApp. A district judge ruling the FTC failed to prove Meta still holds monopoly power, saying rivals like TikTok and YouTube are competing for user attention. And Elon Musk returning to the White House last night to attend a high-profile gala dinner honoring Saudi Crown Prince Mohammed bin Salman. Musk's appearance could be a sign that tensions between President Trump and the world's richest man have eased. Other guests included Tim Cook, David Ellison, Jensen Huang, Lisa Su, and football star Cristiano Ronaldo. That's your Bloomberg Brief, John.
Very cool. Yahara, thank you. More from Yahara in the next hour. Up next on the program, betting big on AI.
Nokia is in all of the world's base stations. So we now have this fabric that we can deploy AI computing services on top of it. It's going to be completely revolutionary.
We'll talk about that revolution in just a moment with the Nokia CEO from New York City. You're watching Bloomberg TV.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. And Botswana, the government of the Republic of Botswana holds 15%. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Four-day slide on the S&P 500. On the S&P 500 so far this morning, we're doing okay. Going into the opening bell a few hours away. Plus, NVIDIA after the closing bell very much in focus. Stocks up across the board here, up by 0.4 on the S&P. On the Nasdaq 100, higher by 0.5. One single name to talk about this morning ahead of earnings from Walmart tomorrow morning. Target out just moments ago. Target down in the pre-market, softer by 0.8%, just cutting the top end of its outlook. The outlook not great. growth's pretty flat, and we're trying to figure out if this is a Target problem or a broader consumer issue in this country.
And ultimately, Walmart might hold the keys to that. It seems like Target is looking at greater efficiencies, that they're not happy with performance. Target has struggled with inventory issues and a host of other lack of competitive power with respect to Walmart. I just wonder how much the OpenAI announcement really played into that question, saying that they're going to use ChatGPT's networks to try to make themselves more efficient going forward.
Target down by 0.9%. Under surveillance this morning, betting big on AI.
Nokia is in all of the world's base stations. We're going to be able to provide AI services, which is going to be able to make it easier for us to do robotics and autonomous vehicles and industrial automation and reach all of the different places around the world. So we now have this fabric that we can deploy AI computing services on top of it. It's going to be completely revolutionary.
So here's the latest this morning. Nokia announcing a new plan to streamline its business with a focus on AI. The Nokia CEO, Justin Hotard, saying Nokia changed the world once by connecting people and will again by connecting intelligence. Justin Hotard joins us now for more. Justin, good morning. Good to see you.
Great to see you, John.
We've got some time with you, so let's take a big step back. Our generation, of course, knows your company well. Late 90s, early 2000s, handsets. What do you want it to be in the next few years?
Yeah, I want us to be a company that's known for connecting intelligence and ushering in the AI era. And here's why. If you think about that time where the world came to know Nokia, it was about connecting people. That, of course, was the tagline. But it was mobile devices. It was text messaging on a 12-key keypad. It was calling people anytime, anywhere, calling our friends, our family, our work colleagues. And of course, it was about the game Snakes, which I got more messages from when I was announced as CEO.
Absolutely hooked on it.
So, but then the world changed, and the internet super cycle came, and it was all about connecting information. And as mobile devices became not just about calling, they came about applications and data. Nokia lost out and moved from being a handset provider to being a network provider, an infrastructure provider. And the reality is, if you look at the telecommunications industry, our primary customer base, the industry also was slow to capture that transition. Really, if you think about 2G and 3G mobile communications, they were largely about voice. Mobile data was coming in, and we were building better voice networks. So as bandwidth went from mobile apps to mobile streaming, the industry's been catching up. 5G still fairly low penetration when you think about it globally, 35% penetration in the market. So as we look ahead, we need to start anticipating where the market's going. And with AI, the market is going to change dramatically. It's already changing in the data center, which is a part of our business. We're building AI factories. Obviously, Jensen talks a lot about this. I know NVIDIA has earnings later today. But we're connecting data centers to each other and building massive AI factories. That's using our optical technology. It's using our IP routing technology. And where's the future headed? The future's headed to physical AI, robotics, autonomous vehicles, delivery drones, AR, VR, glasses, more and more devices. And fundamentally, that means our networks need to change to handle that. And that's what we're planning for and anticipating to seize that opportunity.
Can you briefly describe the growth opportunity here and how the growth profile of your company will change as you make this shift?
Yeah, look, I mean, today you see the pockets of growth that we have in the fixed infrastructure. And as we see this build for AI native networks going into mobile, we're going to see tremendous growth there. It's just not coming in the next few years. We believe it will come over the longer term as the market invests and builds, but it's not going to be in the next couple of years. So really think of our business in a couple of ways. Capturing growth in fixed infrastructure today, and then in mobile infrastructure, positioning the business for technology innovation and longer term growth as that market picks up.
What industries do you expect to be most dominant in? Are there particular industries that you think will be fastest to adopt the AI connectivity that you're hoping to provide?
Yeah, I think there's a few things. First of all, there's no question that the core tech industry that we're in today is the engine of growth, right? AI and cloud customers, hyperscalers, cloud providers. And that's, of course, serving the technologies we have today, LLMs, AI agents. But when we look ahead, I see it being in areas like transport and logistics and manufacturing, physical AI. Also, an area that we already serve that we call mission critical enterprises. Think of public safety, rail, transport. These are places where AI can add, better reliability, better security, better outcomes for people. If you think about public safety, for example, emergency services, And those are areas where I think we'll see faster AI adoption. But I don't think we can predict the future perfectly. We need to just anticipate what are the use cases and the needs. It may be that delivery drones, other retail applications also accelerate, and those are early users. So for us, it's about building the plumbing and the core capability that we need.
This is a difficulty for markets right now. This idea that there could be a duration mismatch between the amount of money people are putting into some of these technologies and when we'll actually see results. How do you prepare investors for the fact that the investments that you make might not turn a profit in the same kind of way that they're expecting for 2 years, 3 years, 5 years, even 10 years down the line?
Yeah, first of all, I think this is what's great about our company is that we have all of the assets to participate in those different duration profiles. And one of them I didn't talk about yet is actually our technology standards business, which we're now announcing as a part of mobile infrastructure. That's a business that does IP licensing. So that actually has an even longer duration. So we invest today and we see, we'll see a 10 or 20-year horizon on returns on that business. And the reality is in technology, we always invest well ahead of these curves. We're always 3 to 5 years ahead. And the benefit for investors for us is that you're getting the benefit of growth today with what we're seeing in AI and cloud. And you're seeing us prepare so that you can participate as the growth comes later in mobile. And ultimately underneath that is really strong cash flow with our IP licensing business.
Justin, you've seen the pushback in the market. I'd love some take from you, your reflection on what we've seen over the last few weeks. There is a worry about overbuild, overcapacity, and you operate in the physical world. Are you worried about that? And how do you position the company to leverage this potential, this opportunity, without being a big part of a potential bust down the road?
Yeah, I think, John, you said it perfectly. We need to be disciplined. And one of the reasons we announced the strategy that we announced today is around being disciplined. We can't invest in mobile networks assuming that we're going to have growth next year. The reality is the mobile network providers, the telcos, are largely flat. They have challenged returns on their capital. So we have to be disciplined around where we invest, and we have to be incredibly efficient around those investments. The other side, though, is even if you look, there's a lot of excitement and talk about a bubble, but even when you go back and look at the internet bubble, the dot-com bubble was a couple of years, and then growth and infrastructure continued. If you go back and look at the players that won, they were prepared because they were investing through that cycle. And from an R&D perspective, we have to continue to invest through that cycle. And honestly, when I look at some of the fundamentals, when I look at the value that AI delivers, the productivity impact, even the productivity impact we're seeing internally in some of our use cases, and the potential productivity impact for the things we haven't even deployed yet, there's so much ROI. And I think that's what's a little bit different about this, is that from a business and a productivity perspective, it's much richer than what we saw in .com. .com in the early days was largely a consumer phenomenon. This is much more about business productivity. And that's why I think even though we will have periods of digestion, and we may have some players come in and out of the market, all very natural in tech. By the way, we see this in every cycle. I think the long-term trends are very, very favorable. And for us, and certainly as a CEO of a tech company, we need to be looking at the long term. And that's why this partnership that we announced a couple of weeks ago with NVIDIA is so important. And certainly, I think Jensen obviously has clear vision for the long term.
Yeah.
But that's why there's so much synergy between us, because what he's doing and his vision for where this needs to go and our vision for what we need to deliver are just very, very naturally matched.
Looking forward to tracking the story with you. Thanks for dropping by.
Great to see you.
Enjoyed the conversation. Justin Hote out there, the Nokia CEO. Up next on the programme, in the second hour of Bloomberg Surveillance, we'll be catching up with Libby Cantrell of PIMCO, Francis Donald of RBC, and Ashok Bhatia of Neuberger Berman. From New York City this morning, good morning.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
I think the economy is worse than we realize. There is a chance of recession.
The consumer is under a bit of pressure.
It's about the K-shaped economy.
You're probably likely to see the low-end consumer get a bit better.
At the end of the day, we are seeing still strength in the consumer spending, and that is fueling business on Main Street.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now. Following a 4-day slide on the S&P 500, your scores look like this. On the S&P, bouncing back just a touch. We're higher by 1/3 on the S&P 500. On the NASDAQ 100, we're up by 0.4. On the Russell, we're up by 0.5. The main event a little bit later after the close. We'll hear from NVIDIA. Before we get there, let's head over to Singapore. Bloomberg's annual New Economy Forum is underway. Bloomberg Editor-in-Chief John Micklethwaite is speaking with the Prime Minister. Let's take a listen.
China will feel the same way. And while there may be differences, the two countries can still get along and work together.
The current atmosphere, what do you think the chances are of a war over Taiwan?
We've always said that we don't think this is likely to happen in the foreseeable future, at least in terms of a unilateral, unprovoked action by China. You've asked this question repeatedly to my predecessors, to me.
So far, you've been right.
And our views remain the same. It is an important issue for China, Taiwan. It is the reddest of red lines. But I don't see, and we don't see it happening unless something happens that really crosses China's red lines in terms of, for example, a unilateral move by Taiwan to declare independence, because then it becomes two Chinas, not one China. I think America's policy here also is very critical, and America has always been consistent and very careful with its policy that there should not be any unilateral change to the status quo. And number two, that while America defends or supports Taiwan's ability to defend itself, it does so in accordance to the Taiwan Relations Act and to America's One China policy. It's a very carefully crafted statement, and up to now, across different administrations, America has, broadly speaking, maintained a consistent approach with that policy. And if it does so, I think there will be a good chance of us maintaining peace and stability in the Taiwan Straits.
You also talked about a post-American order, which sort of interests me because it implies that America's move towards isolationism and protectionism is not just Donald Trump, that even after he goes back to Mar-a-Lago or heaven or what, maybe he doesn't know the difference, that America no longer will be a champion of globalization, no longer be a sort of partner that you can rely on in the same way as you did. Do you really think that America has gone?
We hope not. When I said post-American order, I was referring to the forces that are driving us towards a more multipolar world. Yeah. So the unipolar moment where America was the leader that helped to guide, underwrite the global system, that moment I think is over. So the old rules do no longer apply, but the new ones have not been written. But as we transit into this new multipolar world, it's not as though every pole remains the same. America is still the biggest, most powerful country and still maintains, America's leadership remains vital. And we certainly hope that America will be actively engaged in the world. Maybe not now, maybe not with this administration, but there will be a time when America can take up its role, be actively engaged, constructive, and continue to have good relations with all its key partners. America's role is critical for stability and continued prosperity in the world, and the world needs America to behave like that.
To look at from the outside, America's policy towards China seems somewhat schizophrenic. On the one hand, there is a very strong desire to keep China in check. On the other hand, most people would say you keep a country like China in check by bringing all the other allies, all the people in the region onto your side. And yet, as you pointed out, when tariffs happened, Trump has hit everyone with a variety of things which would not seem like ally-like behavior.
I visit China regularly just to find out how things are developing. And all the actions that America takes vis-a-vis China has, in a way, only strengthened their resolve to work even harder, to move faster on technology self-sufficiency, and they are determined to grow. So one China commentator tells me there's nothing America can do to stop China. Only China can stop China. And when I heard that, it reminded me of something I heard a long time ago about the US too. There's, Abraham Lincoln once said, if destruction be our lot, let us, Americans, be the author and finisher of it. And so it strikes me that
I think that was shortly before a civil war, but so it may be rather bad.
But it strikes me that in this great rivalry, everyone is focused on what one country does to another.
Yeah.
But really, the fates of these two great powers will be determined by their own people at the end of the day. Americans decide Americans' future, Chinese people decide Chinese future. That's what it comes down to, and it's their actions, their agency that determines domestic reforms, that determines the direction that these countries will take.
In terms of Singapore's position in that world, I suppose if I was to look at Southeast Asia, I must have been coming here for 3 decades or around that. When I first came, I think there was a general presumption that if things came to a head with China, most of Southeast Asia would probably stick with the West. You look at what's happened over the past year, that's become Southeast Asia, including Singapore, has become home to many more Chinese companies. As I said, Donald Trump hit the allies with tariffs. Joe Biden wasn't that kind to you either. Your first visit as Prime Minister was to Beijing, outside ASEAN, was to Beijing, not Washington. I mean, is America losing this region?
We've put a request to visit Washington, waiting for the dates. but I wouldn't read too much into these sorts of things.
But that's indicative, isn't it? You would imagine an American president would want to see one of his main allies.
But you know, where I go, what countries I visit, and I also wouldn't say that in the past it's very clear-cut that countries would side with one side, the West, and now would side with China, and things have flipped. I think that's too simplistic a portrayal. There is no doubt America's actions over this recent period has impacted America's standing in Southeast Asia. All the surveys would suggest that, and it's very clear-cut. But I think there's still tremendous goodwill and desire for ASEAN countries to engage the US. President Trump came for the ASEAN summit meeting. He presided over the peace accord between Cambodia and Thailand. And then he sat down for a meeting with all the ASEAN leaders, patiently listening to each one, engaging and listening to each one. And at the end of all the interventions said that America and him personally is committed to ASEAN. I think that's well received by ASEAN. In the previous administration, Gina is here, Secretary Raimondo. We worked on the IPEF, Indo-Pacific Economic Framework, under the Biden administration. And many Southeast Asian countries welcome that, because America is still the largest investor in this part of the world in terms of FDI. And all the countries look forward to having more linkages with America, more engagement with America, more investments from the US. So, yes, America's standing has taken a hit, there's no doubt. But we hope America can recover from this, and we would like to see America recovering from this.
Just on that, you've spent quite a lot of time, though, talking about a multipolar world, and one where you've tried to, I suppose, bring together what might be described as a coalition of the willing of kind of free trading countries that would deepen ties and that would sort of get on with the business of globalization, whilst America and China go about building walls of different sorts. But that particular way, you know, what can you do with that in practice? You've accumulated a group of countries. What can you actually do? It's the sort of, is it just about having slightly better documentation and things? What is the end of that?
Let me put it this way. The stable multilateral framework that we were all familiar with is unraveling. That framework was optimized for trade efficiency. In today's world, countries are more concerned about security and resilience. So countries everywhere are prepared to accept some inefficiency, higher cost in return for higher security and resilience. But this is now being done unilaterally, country by country taking its own actions. And that's just not sustainable. In the worst case, you will end up with something that, like what happened after the Smoot-Hawley tariffs in the 1930s. Someone does something, another one retaliates. There will be a dynamic where it's just escalating. And before too long, we will end up with devastating consequences. On the other hand, we know that the WTO, which was meant to solve these problems, isn't working. We would like to see a new framework in place. It's not easy to get that happen now, but ideally a new framework that finds ways in which countries can legitimately exercise and protect their own national interests, but with restraint, with some shared rules, and not on the basis that you can unilaterally do things to coerce another country or to punish another country, which is somewhat happening now. So how do we get there? And I think it's very hard for all of us to imagine ways to get there, but I think we should not give up trying. And that's what we would like to do, which is work with like-minded countries. Some of the, we have a future of investment and trade partnership with 15 or so countries doing this, but also working with the WTO, working with regional groupings like the CPTPP and the EU. And all of these efforts ultimately are not just about tariffs. They are about setting new norms, new rules of the road that would allow us to facilitate trade and investments and find some way to ensure supply chains remain resilient and secure. And in a way, we are laying the foundations for a new multilateral framework that may come later on.
So I looked and saw the Future of Investment Trade Partnership, FITP, as it's known, and the members group is Brunei, Costa Rica, Chile, Iceland, Liechtenstein, Morocco, New Zealand, Norway, Panama, Rwanda, Singapore, Switzerland, the UAE, and Uruguay, which is a fantastic kind of World Cup group to be in. But, it doesn't feel like the beginnings of a big trade bloc.
I know, but don't sweat the small stuff. You know how the TPP started and the CPTPP started? P4. Very small countries, 4 tiny economies came together in the P4. That became the TPP, and when America decided not to continue, we had the CPTPP. So great things can start from small places, including Singapore.
What about something you've already? What about something you've already got, which is ASEAN?
Yeah.
And you are next year, no, 2027, you take over the chairmanship of it. And you look at ASEAN, as you say, it's been very successful at preventing conflict.
Yes.
It's become a kind of grouping. When you tried to negotiate with Trump as a group, he sort of pushed it aside and made you negotiate one with each other. I wondered, is there a way of making ASEAN into something bigger, something deeper? You know, at the moment it's based wholly around consensus. Could you ever move to something like a majority agreement instead? I hate to mention the words European Union in a good light, but if you were to take it a little bit closer to the European Union, does that make sense?
We certainly want to integrate faster and bring together the single market. I mean, there's so much that still needs to be done, but we also have to recognize the wide diversity of ASEAN, countries at different levels of development, and so we move as fast as we can. I would say that it was not so much that the US didn't want to negotiate with ASEAN collectively. It's just impossible given the diversity in ASEAN. ASEAN would not be able to negotiate a trade deal with America as a collective. It had to be country by country. We are not quite there yet to negotiate deals like that collectively. But ASEAN has its advantages and strengths. When we talk about ASEAN centrality, for example, it's not as though it means ASEAN dominates everything, but it means ASEAN has pooling power as a convener. And precisely because of the fracturing of the global economy that we see now and the uncertainties, more and more major powers would like to strengthen their links with ASEAN. EU is interested in an FTA with us. The GCC, we've been talking to them. Canada is interested in an FTA with us too. So we are discussing these initiatives very seriously, and hopefully we'll do this next year when Philippines is chair and when Singapore chairs ASEAN in 2027, we hope we can continue to build on the foundations and make progress.
So the way in which ASEAN would grow would probably be going broader rather than deeper. You're not going to end up with a...
We have to do both. I think we have to go deeper as well, but it's just that going deeper takes time. It's not straightforward, and countries will be able to move at different paces. And in some instances, we may very well say the countries that are able to move faster do first. I wouldn't rule that out.
When we talked about the region, you said you didn't think there was the war coming on or anything like that, but there is. Do you think in the end, a country like Singapore will have to choose between China and America? You've managed to avoid that so far.
Yeah, another favorite question.
Yes, it's coming that way. Journalists are notoriously unoriginal, but the problems don't change. No, the choice is arguably getting bigger.
The pressures will always be there. The great powers say we don't want you to choose, but of course each one wants us to be a closer friend to them. And that's always, the tension is always there, the pressures will always be there, but at the end of the day, we don't have to choose, really. We have to, it's not issue by issue. There will be some instances where we look at the issue, and we so happens that the particular position we take is the same as the US, for example, or as China, for example. But it's not from the lens of choosing one versus the other. It's from the lens of Singapore's national interest. And that will always be the case for us. And it's the same, not just for Singapore, it's the same in ASEAN. ASEAN countries feel the same way. We have been the arena for proxy wars before, It's been such a painful experience. We don't want that to happen again. And so ASEAN will continue to be fiercely independent. Not so much non-aligned, but multiple aligned. Engage with all the key players.
On that subject, no hot war, but there's a lot of Cold War going on, and there's been this issue about state-sponsored cyber attacks, people interfering in the election. Your party complained about that in the election you won. You've had cyber attacks, and you're going to adjust, I think, your foreign interference law further.
Yes.
And I wondered, are there any particular countries you're worried about? Is it China, Malaysia, Indonesia, or all the above?
We don't call out our adversaries, but we know who they are.
It's a good way to be around. Can I ask a bit about Singapore?
And we are not naive.
Can I ask about Singapore as a financial hub?
Yes.
You've had this onrush of money coming here. You've had this big push to lure people here, the family offices, you see many of them here. A lot of wealthy people coming here. And you get two issues from that. And the first one is this issue of inequality, which I know the Gini coefficient has got better, so that in income terms...
In income terms.
Income terms getting better. But there is this, every time I come here, people talk about inequality more.
Yeah.
And I wondered, you've already introduced taxes on luxury cars and properties, but do you see Singapore moving towards other things, a capital gains tax, for instance?
They're two separate issues, really, because wealth management, Singapore is a financial center. I think we can grow in terms of wealth management. Family offices may set up here. They are not Singaporeans. They, have their offices here. They manage their funds out of Singapore. We welcome that. It creates jobs for Singaporeans. I think that's a good thing, and we can explain that to Singaporeans. Sometimes it creates frictions, especially when there are ostentatious shows of
Ferraris and things, yes.
And we have just to remind them, Singapore is a different society. We are egalitarian, our norms are different, please understand. And for the most part, they do. Tackling wealth inequality where it comes to our people and our population, that's something we continue to work on, whether it's income or wealth. We have a range of policies. It's not just about tax alone, because in Singapore, we have the ability to also provide wealth injections. And a major reason why we can do that is housing. Almost everyone owns their own home. Majority live in public housing. And when you buy a flat from the Housing Development Board in Singapore, you get housing equity. And that's the reason why even at the lower end of bottom 20% of households, actually they have significant net wealth, net asset value because of home ownership. So that's one way we can continue to fine-tune our policies to provide more support and uplift for lower income groups. We also have a Central Provident Fund, which is Social Security, which is the individual's own retirement nest egg, which we do top-ups from time to time. So our tool sets are not limited. I know there's a lot of interest. Again, yes. Bloomberg's favorite question for me.
Capital gains
tax, wealth tax. A lot of questions about tax, but our toolkits are not limited to tax alone. We also have wealth transfers.
I'll take that as a maybe. Just the other issue about a lot of wealthy people coming here is that not all of them have been virtuous, if I can put it that way. You had the money laundering.
Yeah, we've got illicit flows.
Yes, and you had the accusations about from the US about one of the heads of the main Asian crime families being here. You've dealt with these things, but there is, and one of your ministers had a very nice Chinese saying, when we open the windows, some flies may also enter.
And sometimes we get more than flies.
Yes, but how many flies can Singapore tolerate? And do you need a bigger fly swatter?
We do have quite a big fly swatter. I mean, we take it very seriously. It's not unique to Singapore. The illicit flows are everywhere. All financial centers have to deal with this. So to us, it's not so much about that there is an incident. There are bound to be incidents, and there are bound to be suspicious transactions, and then with intelligence, with cooperation across different countries, eventually we get to the bottom of it. The key is what do you do, and we are very stringent and we take swift action. And we are determined to protect our reputation because that's what keeps Singapore going, a trusted business and financial center.
Can I ask you about energy? I've been quite struck being here for the past day or so is that a lot of people are talking about all those new data centers,
yes.
The idea that AI particularly will need more energy. You look at Singapore energy at the moment, virtually all of it comes from LNG, very successful. But the idea that somehow in the end, Singapore has to kind of get energy of its own, and there you're really in a choice about either trying to do something with one of your neighbors, maybe a renewable thing or whatever. The other big, very obvious option is nuclear energy. I mean, is that something which is going to become a much bigger part of Singapore's future?
We don't know yet, but we are certainly studying the options seriously. There won't be an easy silver bullet in our case because we are small. We are unable to scale up renewable energy in terms of the amounts that we need. Some of the solutions, as you highlighted, would include plugging into an ASEAN power grid, which we are building, taking time, complex, but it's happening. But still, we would like to have our own source of clean power. Hydrogen might come up as one possibility, but it's expensive. So you could ship hydrogen and then burn it through the turbine. It's got lower emissions than LNG. That's possible. But we are also studying the possibility of nuclear power, especially when you look at some of the new technologies with SMRs, which are safer. We are looking at whether it might be possible in our context. We are very small, 750 square kilometers, or less than 300 square miles. That's tiny.
Yes.
So we have to take it, we have to look at it, consider the safety very closely before we decide, and look at the technology and how it's evolved.
Is there a kind of time scale on that? When do you think Singapore?
It really depends also on how the technology evolves. And as of now, we've been looking at different technologies. You don't really see very many operational SMRs, particularly the SMRs which are grid scale. We're not talking about the tiny ones like 50 megawatt, those don't serve our needs, right? We're talking about grid scale, commercial scale SMRs, and you don't see a lot of them around as of now. And so we are studying, looking at, we are working with partners, including America and others, Europe, looking at the technology, understanding it better, understanding the implications, and then if we think it's possible, we will have to also convince the public that this is indeed a technology that is safe and deployable in Singapore. But we are not there yet. We are still at the very early stages of building up capabilities.
Many things about you. I'll ask you a personal question at the end. You're the first leader to be born after Singapore declared independence.
Yes.
You're also only the second leader outside the Lee family. And I wondered...
We only had 4 prime ministers in Singapore.
Not many people have had 4 prime ministers for that long. What makes the biggest difference to you? Is it that generational thing?
Difference in terms of?
Well, in terms of the way that you want to go ahead, that you are somebody from a new generation of Singapore. Does that make a bigger difference to the way you want to lead Singapore over the next period?
I suppose me being from a different generation is part of it, but in terms of ethos, mindset, values, I represent the party, and the foundational values remain the same. We are here to build a better Singapore because history has never been kind to small states. And we know, despite our success these last 60 years, the world is a dangerous place. It's become even more dangerous. And our mission, my mission, is to keep Singapore going, not just in my term, but to leave behind a better Singapore for my successor and for future generations. So that remains the ethos, the foundational values in which my party represents, which I represent. I keep going back to this very vivid memory of when I was in Michigan studying. I've told this story before, but not all the guests here might know this. There is a ghost town in Michigan, and it's called Singapore. Truly. It was founded
was it based around free trade and minimal government?
I don't know. It was founded in the 1830s near Lake Michigan. Why Singapore? Perhaps 1830s. Perhaps it took inspiration from the fact that in 1819 there was this exotic port in the exotic Far East founded by Sir Stamford Raffles. And so maybe the name traveled. It took some time for things to travel in those days. And perhaps it took inspiration from that. But Singapore and Michigan didn't last very long. I think about 50 years. It's overwhelmed by the sifting sand dunes. And now there's only a marker that says this is where Singapore, Michigan stood. We want Singapore in Southeast Asia to last for a very long time. That's my mission.
Well, we all hope you achieve that. Thank you very much, Prime Minister, for talking to us. And thank you very much for hosting us here.
Thank you.
That was the Bloomberg Editor-in-Chief, John Micklethwaite, alongside the Prime Minister of Singapore, live from Bloomberg's annual New Economy Forum. Plenty more still to come on Bloomberg TV and on Bloomberg Radio. If you're just joining us, welcome to the programme. Equity futures on the S&P firmer by 1/3 of 1%, following a 4-day slide on the S&P 500. Earnings very much in focus. Target earlier on this morning did not impress. Later on tomorrow, you'll get Walmart. Later on this evening, you'll hear from NVIDIA. Let's turn back to the economy. The Trump administration looking to provide $2,000 tariff dividends to U.S. consumers. The Treasury Secretary, Scott Bessent, telling U.S. media families could save the checks.
Would a $2,000 tariff dividend check be inflationary?
Well, there are a lot of things that are going to happen next year. That could be one of them. And again, maybe we could persuade Americans to save that. My prediction is that first quarter, second quarter, what we are going to see is we have brought the inflation down.
Can you persuade Americans to save that $2,000 check?
Good luck. How would you persuade them? You're going to get a sale. You'll get a Birkin bag in December.
Seriously.
Yeah, I mean, honestly, try that with kids.
$2,000 getting spent almost immediately. Libby Cantrell of PIMCO has this to say. We're very skeptical the Republicans in Congress at this point are interested in adding more to the deficit with another tax cut. Libby joins us now for more. Libby, good morning.
Good morning.
There's a shift at the White House. Affordability in focus, new initiatives. Where's this shift coming from, and is it durable? Is it sustainable into next year?
Yeah, well, I mean, yes, there is a shift, and obviously it was precipitated, partly at least, by the election 2 weeks ago when Democrats, if anybody who had a D, on the end of their name, basically did well, and most Democrats did run on affordability, probably in some ways learning the lesson from 2024, where they didn't sort of lean into that issue as much. And so now the White House, I think understandably, a little bit like how President Biden did in 2021 and 2022, maybe in vain, is trying to shift more to affordability. I think there are obviously limitations to what the president can do unilaterally, and I think Secretary Bessent understands those limitations. You do need Congress in order to cut taxes, even if the revenues that are going to offset that tax cut would come from tariffs, which obviously were put through unilaterally. So we are skeptical. Now, with that said, and this is something we think that the market is obviously focused on, is that there will be a really nice, healthy tax refund come next spring. I'm not even sure Americans actually realize that they're going to get such a nice refund, but on average, households will likely receive $1,000 kind of plus, sort of depending on their tax bracket and their tax situation. So that could maybe, have the same effect, but in terms of an additional tax cut paid by tariff revenues, we think it's very unlikely.
What do you think is on the menu? So we've seen some tariff relief already. We've seen the prospect of a $2,000 rebate check. We've also had a conversation about 50-year mortgages as well. What else is on the menu?
Yeah.
What other proposals are?
So, I mean, obviously, the reduction in tariffs for foodstuffs, for beef, for coffee, for bananas, a little bit of a tell that maybe tariffs do raise costs, at least incrementally. And then, obviously, the 50-year mortgage, we, again, skeptical that actually goes through. Lots of issues with that. Maybe provide some upfront affordability, some cost savings in terms of mortgage payment, but obviously reduces the amount of equity that folks are able to build in their homes. Is not TBA eligible, to be very wonky, so probably has a liquidity issue as well. So I think the upshot is that we think that's unlikely. Of course, the real issue with housing, as we all know, is supply. And so trying to incentivize developers and folks to build, that probably takes Congress as well. And there's some things that they can do from a permitting perspective unilaterally, but really difficult even on the federal level. So I think the upshot here is there just limits to what the president can do unilaterally. He can talk about it, but he probably needs Congress to do most of it.
But what we learned from the midterms, and I'll call them the midterms, that's essentially what they were, is that there is this shift to affordability, and there seems to be bipartisan support to really help consumers with the cost of living concerns that they have. It is a bipartisan issue politically. Why has the vibe shift not moved into materially higher long-term yields if you have bipartisan support to reduce the amount of tariffs, to reduce the amount of cuts just broadly to government, et cetera?
Yeah, I mean, it's a good question. I think we've obviously, I mean, of course, as you all know, the curve has obviously steepened a lot over the last year, and so it still remains relatively steep, at least relative to the very kind of flat yield curve that we had seen, for years previously. So in some ways, that term premium has come back a little bit. But there still is a bid, obviously, for treasuries. There's, we always say the kind of the cleanest dirty shirt, this expression of Bill Gross's, our founder at PIMCO, used to talk about kind of the, there is no alternative. You have a lot of dirty shirts, you wear the cleanest dirty shirt, doesn't look great on an absolute basis, looks good, pretty, relative to the other shirts, and I think that still stands. So, there is going to be some natural limit in terms of how, at least right now, how high the 30-year, how much that term premium does expand, but all things equal, if you just go back to where we were back in, October of last year, the yield curve has steepened.
Yeah, I just wonder if bond vigilantes have either gone to sleep or never existed, right? Because at a certain point, we're talking about, the deficit that at one point was the rallying cry for people who are saying yields are going higher, and all of a sudden we're looking at the potential rollback of tariff revenue, the potential addition of policies that could potentially support consumers, whether that $2,000 gets passed or not. Yeah. You're talking about a bigger deficit. Suddenly nobody cares. What's the deal?
Yeah, and I mean, we've been talking about kind of the 6-7% deficits, really for the foreseeable, for the foreseeable future. I have teenagers at home.
Well done, 6-7.
But really over the foreseeable future, and that was our view going into this, that regardless of who won the election, the deficit would be the biggest loser. That has obviously come to pass. And nobody is talking about sort of fiscal responsibility. I mean, they're not talking about increasing taxes or changing entitlement spending, and that's really what you actually would need in order to change the fiscal trajectory. But the same thing, just from an investor's perspective, I mean, people are looking at the U.S. as the sort of source of growth, right? I mean, if you just look at what's happening, obviously, with AI, with labor mobility, still immigration, I mean, the dynamics of the U.S. economy are still much more attractive than the other developed, rich world. So I think there is a little bit of that where there's just going to be kind of demand, at least as of now, for our debt because of those dynamics.
I cannot believe 6-7 made it to Bloomberg.
Sorry about that.
It's okay. I think that it's great.
And Libby Cantrell made it happen.
Honestly,
kids would be so proud.
You made us relevant because right now that is ultimately relevant.
We're farming.
Yeah, exactly.
Nice. Okay. Let's not take this too far.
I'm going to get an email from our PR people. Definitely.
Where is Libby taking this? I think PR at PIMCO are confused already. Libby, I want to finish on maybe a fracture in the Republican Party. Congressman French Hill was on the program a little bit earlier this week, and he made the point that he didn't like broad-based tariffs. And he's typically very diplomatic, but I think a little bit more vocal now. We're starting to see signs of the Republican Party on the Hill. It's pushing back a little bit to the White House. Are you sensing the same thing?
Yes, I mean, obviously the vote on the Epstein files was a little bit like that, just sort of put the exclamation point on that sentiment. I do think that, and this is actually a bipartisan phenomenon. If you just look at the Biden administration, at the end of 2021, the coalition around Democrats was fracturing then as well. So there was more pushback on President Biden by his own party. I think the same thing is happening now, right? After the off-cycle, the midterm election of 2 weeks ago, you are now seeing that political runway for the president shorten. And again, this is, I think, pretty consistent with history, but I do think you will continue to see more pushback. And as it relates to fiscal policy, tax cuts, adding to the deficit, a lot of Republicans very uncomfortable with that. I also think it has implications for the Fed chair in terms of who's actually the nominee. You may see, if the president were to nominate somebody who was viewed as not independent, was viewed as too political, I think that Republicans are increasingly feeling a little bit more comfortable to push back. They have been privately, but maybe more publicly as well. And again, pretty consistent with other cycles in history.
Do you think just finally that could lead to a sensible Fed chair choice?
That has been our view. We think that there's going to be a much more conventional, orthodox Fed chair than I think a lot of people at least feared in the market.
That's what sensible is to me.
That's
right?
To me, right? That's exactly
it. He would be the easiest. He would be the easiest.
Who do you think the president believes is politically correct? What does that mean to the president?
Yeah, not sure. But I think probably somebody who's more familiar to Washington. So whether that is Governor Waller or Kevin Hassett, somebody who's going to be a little bit more familiar.
Seem like different characters. I don't know.
Very different.
6, 7.
Let me get to
6,
see
7.
you. Oh, nice. Okay. Aura farming again.
We're farming over
That's
here,
just
guys.
overwhelming. Okay.
I'm never getting invited back.
Livy, you'll be invited back. Thanks for being here. Livy Cantrell of PIMCO. Thank you very much. Whether PIMCO lets you come and talk about that again, I don't know. 2 hours away from the opening bell. Let's get you some single names, some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John, some earnings from the retailers to work through this morning, starting with Target. Those shares sliding 2.4%. They trimmed their outlook on the high end. It shows maybe this turnaround that they've tried in an effort is going to be taking more time. They also announced about $5 billion of capital expenditures on things like opening new stores, refurbishing the ones they have, an investment in merchandise. So again, those shares falling. We also heard from Lowe's earlier this morning. For them, it's been a rocky road. They're down 11% this year. They fell 2.5% yesterday after the poor earnings from Home Depot. For them, it was a beat for the current quarter, so that was enough to uplift shares. Those are higher by 6%. Finally, about 10 minutes ago, we heard from TJX. That was a beat, too, for the third quarter. This is one of those companies that, of course, is selling discounted merchandise. So if there is stress among the consumer, it's one that you'd expect to do well, and doing well it is. And they also improved their margins. They're at 11.6% net of taxes, so those shares up 2.4% in the pre-market, John.
Danny, thank you. The latest on TJX and some of the retailers this morning. More still to come, as Danny pointed out. We'll hear from Walmart tomorrow morning. Let's turn to the labour market data. Investors eyeing the long-delayed September jobs report due tomorrow. Francis Donald of RBC writing, we think fourth quarter data will likely add more confusion than clarity. Francis joins us now for more. Francis, welcome to the programme. If we're going to be more confused than clarified, what does that mean for that decision on December 10th?
Well, it means the Federal Reserve is going to be more confused and clarified, and the Federal Reserve, just like markets and economists, are going to have to think a little bit further out into what Q1 and Q2 are going to look like. And probably that tells us that employment will become slightly more problematic, not dramatically, and inflation will continue to rise. It's a continuation of that stagflation-light type of environment. And even if we have a bit of a hole here in a couple months of data, looking through, our view is still the same, which is growth is going to be slightly below comfort level and inflation is going to be slightly above. And that will be the situation that this Federal Reserve and future Federal Reserves will likely continue to have to deal with.
What are you looking at to confirm that view? We know that September data is going to be backward-looking. Yes, we get that tomorrow. We know that October data is going to be muddy at best, confusing at worst, and potentially might even distort the picture further because of the government shutdown. And it's unclear what CPI data we're going to be getting. So what are your benchmarks right now?
You know, we definitely have enough on the job side from a variety of private sector data in order to give us a sense of the momentum. Do we know the exact level? No, but we know it's sort of soft, stabilizing, enough to bring us towards our forecast to an unemployment rate of about 4.6 later into 2026. So that in and of itself, we can see the big problem is on the inflation side. That's where we have really minimal perspective. We don't have the ability to see much of what happened in October, and we're probably not going to get full clarity on what that level looks like until early in January. And actually, you don't even get the January data until February of that month. But I think one of the stories here is that we get so obsessed with month-over-month data as if we need to see what happened last month or 3 weeks ago to know the trend of the economy. And the truth is, we don't. We actually have the ability to map out over an extended period of time. That's why economists have 1-year or 5-year forecasts, because if we know the direction, we can make various assumptions. And our assumption is that we have not seen the inflationary impact of tariffs as of yet. We are still drawing down on inventories in the United States, and we're likely only going to start seeing that real pressure on inflation in early 2026 and in the middle of 2026 going forward. So we can maintain those assumptions even if we don't have week-to-week maybe obsession over what the exact level will be.
One thing that a lot of people said during the pandemic was listen to the companies. The companies have the front view in terms of how to plan their businesses. We heard from Lowe's, we heard from Home Depot, we heard from Target, kind of a motley picture here. Are you getting a sense from the retailers, from the consumer-facing companies, of a picture that gives you more clarity heading into 2026?
Absolutely. We're looking for anyone who can give us information. I might add things like the Fed's beige book into that story. So some of the anecdotal evidence that some of these core themes are coming through. The big thing we're seeing really now accepted in the broad-based narrative is something we've been talking about for well over a year now, and that's that concept of the K-shaped economy. And while I think there's still maybe a little bit of a view that that just means the haves are getting richer and the not-haves are getting worse off, I don't know that we've really internalized how this is changing the dynamic of consumer spends. That we've got some consumers that are trading down, and that benefits some companies, and we've got other consumers that cannot trade down at all. It even flows into conversations of, for example, potential $2,000 checks to American households. Will that be inflationary? Not for the lower part of the K, who are still really struggling with affordability crises. So we're looking for sort of evidence of what the shift in the consumer is really doing. And I'll add on top of that, it's not just a K-shaped economy, it's also an increasingly retired consumer. What are those spending habits looking like? Because this is really a consumer that we haven't seen for many decades in the American economy, and any type of anecdotal or hard data that we can get on it is very helpful in constructing that narrative and helping companies navigate an increasingly difficult operating environment.
Francis, I don't expect you to get deeply philosophical when I ask this question, but just to take a step back, what has gone wrong in the West? Why do people hate these economies so much? Because it's not unique to America. I see it across Europe as well. What's gone wrong here since the pandemic, and what can we get right?
Well, when we look at the data, which is the economist's perspective to the philosophical questions, what we see is really a break in 2023. And it comes back to this perspective that historically, while, the wealthy spent more than the not wealthy, most of the economy followed the same economic cycle. So if your upper incomes were doing well, so were your lower incomes. It was tides that lifted and sunk all ships at the same time. So even though maybe some had more than others, it really felt more egalitarian that we're all sort of following in the same economy. After 2023, and that's where we see the data really start to break down, that's when we see that the haves, or the upper part of the K, are really experiencing an entirely different economy and a different economic cycle. And this is, I think, the biggest question for the Federal Reserve. It's not who's going to be the chair, is that how does policy act in an environment where interest rates impact everybody at the same time, but some areas of the economy require different interest rate policy? What about things like fiscal policy? It has to become extraordinarily more targeted. My concern heading into 2026, if you've asked me to be philosophical, is maybe that lowercase k becomes even a uppercase K, because we're going to see things like changes to the SALT cap deductions. That's going to benefit the upper part of the K. Financial markets doing well benefit one side, and we still haven't seen any material relief on the affordability side. So when I talk to clients about the K-shape, they say, well, what solves it? And my answer to them is you should really think about this as maybe semi-permanent type of dynamic. It's not going away anytime soon. And if you're a company trying to figure out how to service your clients, you have to be really, really aware of what part of that K, or maybe we should increasingly call it a fan, you need to be looking at.
Francis, super well framed. Appreciate your time. Thank you. Francis Donald there of RBC. That was bang on the money, almost perfect. This is not a perfect parallel, but thinking back in history and monetary policy, same challenge for Draghi in the Eurozone debt crisis. There was an interest rate that the rest of Europe needed, particularly the South, and there was an interest rate that Germany thought it needed. And it was completely different, two completely different economies, different worlds existing at the same time, and a monetary policy committee trying to set policy for both worlds. You can't.
And this really is going to be the key question. Do you cut rates to try to cater to people at the lower end of the K, the bottom part of the K, even if it benefits potentially disproportionately the upper leg of the K, which is what we saw after the pandemic? Or do you keep rates solid and potentially damage the lower part of the K even more? It is not a good choice to have to make, and yet this is where we are.
Not easy at all. Equity futures this morning on the up. We're bouncing back by 0.4% with an update on stories worldwide with your Bloomberg brief. Here's Yahara with more. Hey, Yahara.
Hi, John. China made its biggest daily purchase of U.S. soybeans in 2 years, signaling support for last month's trade truce. President Trump says he still wants China to speed up its buying, even as U.S. soybeans trade at a premium to Brazil's crop. Meanwhile, former Treasury Secretary and Harvard President Larry Summers has resigned from the board of OpenAI. Summers and the startup released separate statements after Congress released new emails between Summers and the late disgraced financier Jeffrey Epstein. And Elon Musk's foundation gave away a record $474 million in 2024, with the vast majority going to entities he controls. The bulk went to a STEM-focused nonprofit. He also gifted to groups focused on healthcare, disaster relief, and education. That's Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Up next, cashing in on AI.
There is going to be an incremental degree of kind of skepticism and scrutiny that's done on a lot of these bond deals and transactions, thinking about, what is the actual useful life of the things that these companies are investing in.
Up next, we'll catch up with Ashok Bhatia of Neuberger Berman, live from New York City. You're watching Bloomberg TV.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Live from New York, welcome back. Equities looked like this morning on the S&P 500. Going into the opening bell, we're firmer by 0.4% later on this afternoon. Earnings from NVIDIA. Under surveillance this morning, cashing in on AI.
The AI value chain is not only in the tech sector, it spans across a lot of sectors that are very capital intensive, especially utility. There is going to be an incremental degree of kind of skepticism and scrutiny that's done on a lot of these bond deals and transactions, thinking about, what is the actual useful life of the things that these companies are investing in, especially as a lot of these bond deals are not just concentrated in the front end of the curve.
So here's the latest this morning. Global bond issuance surging as big tech races to turn AI dreams into reality. Ashok Bhatia, the CIO and global head of fixed income at Neuberger Berman, writing many issuers are well positioned to leverage AI advances to deliver cost efficiency, enhance productivity, and unlock potential growth drivers. Ashok joins us now for more. Ashok, good morning. Good to see you.
Good to see you.
We've seen a lot of issuance from some big players. Is the market starting to push back?
A little bit, but I think the important, like just to take a quick step back, I mean, these AI hyperscalers have been issuing about $30 billion of debt a year for the last 5-10 years. In the last 2 to 3 months, they've issued $90 billion. So in the space of a couple of months, we've done triple the volume. And it's hitting all parts of the bond market. It's hitting corporates, it's hitting asset backs, it's hitting the private markets. Now, I don't think the bond market is pushing back that much. I mean, Microsoft credit spreads have moved from like 30 basis points to 60. And the reason for this is that these companies have a ton of free cash flow and very low leverage. And even something that's in the news about Oracle has widened from maybe 120 basis point credit spread to 180. So I think there's a lot more noise and concern about this than is being really reflected in credit spreads
Indexes
today.
change over time. I remember more than a decade ago, I used to talk with Lisa about it all the time. High yield was all about energy. Things change. This market's changing too. When you start to see an industry take over the issuance, the net new issuance, what does that mean for how you trade and invest in that market?
Well, it's a great point because the AI issuance at this pace, it'll become 5 to 7% of the index. So it is going to go from a very small component to something meaningful. And I think, you know, if you look back, like a big investment cycle that is debt financed with a lot of uncertainty about how the winners turn out, intermediate term, long term, that has a lot of risk for bondholders because, you know, with AI, a lot of the productivity and the gains, it's unclear if the hyperscalers will get all of it. Will it go to other parts of the value chain? Is this a winner take all, or will there be multiple winners? But ultimately, as bondholders, the best we get back is par. So we, the bondholders, are going to ultimately absorb any downside in how this is being financed, while the gains go to the winners in the equity markets. And that's something I think everyone's got to be very cognizant of.
Are you staying away from this debt?
We're being pretty selective. So what we're trying to do is own things that are on the balance sheet, so it is corporate unsecured. We're trying to avoid things that are highly structured where, you know, some of these deals involve, you know, you're financing chips, you're financing real estate, you're financing the overall capital, the cash flows of the corporation. And we're trying to stay a little bit more at the corporate cash flow level and at the margin try to avoid some of those other risks right now.
Which raises the question of who's getting the better deal, the public corporate bondholders or all the private debt investors who are investing in some of these huge asset managers that have taken an increasing footprint. Brookfield this morning announcing a $100 billion infrastructure fund. I mean, do you have a sense of that?
I think this one is going to take a while to play out because, you know, just a couple of the quick, you know, uncertainties about this. You know, a lot of this debt is 30 to 40 years. Chips have a useful life of 4 years. Now, there's an argument that those chips can be valuable and cash flows longer. The plants, we're financing the construction of these facilities. Well, the facilities have use if you can get energy and how that's all going to play out. So I think, you know, our guess is that the structures, whether it's held in public or private, will be more determinative of the outcomes longer term rather than this is public good, private bad, or vice versa.
We've had some market volatility over the last few weeks. We haven't seen much of an offset in the Treasury market. I just wonder how you're thinking about things, the front end of the curve versus the long end. Tend to have been pretty stable in this environment, about 4.1%. Is that good news? Is that bad news?
I think, you know, I think people are looking at it saying it's bad news, right? The Treasury market can't rally on bad news. But I think there's two things going on. One is I do think some of this long-term debt issuance that's come up from, you know, from the hyperscalers is impacting yields. The other is Japan, right? We still very, you know, if you look at the global bond markets, Japan is the one that it continues to trade pretty weakly. So I think we need some stability there. But our view is, you know, the funds rate is coming down, whether it comes down to 3%, 3.25%, 3.5%, it's coming down, and that will help stabilize long-term yields.
Is Japan re-anchoring the global bond market, bond yield higher?
Yeah, I do think that is, and that is a theme that has been there for the last 12 to 24 months, and it is not going away. I mean, Japan just exports so much capital, and that Japanese buyer who is looking at, can I buy JGBs, or can I come to the US or come to Europe? That's a decision they're making every day, and we have to be more attractive if JGBs keep going up.
Waiting to see if that great repatriation develops or not in the coming months and years.
I love it. So if you're a Treasury buyer, just analyze Sanai Takaichi's budget.
Basically.
And potentially the independence of the Bank of Japan, and you might have a clue of which tenor to invest in the U.S.
It's a tug of war right now between risk aversion on the one side and what's happening in Japan. and the additional supply on the other side.
It just highlights how the 30-year, the 10-year really are international markets, and how difficult it is for the Fed to get control over this at a time when the mortgage market really is hinged on this key rate that is instrumental in getting the housing market back up. I mean, it's just sort of, we're tying ourselves in knots because, frankly, this is a complicated backdrop, and it's hard for one entity to have too much control.
It's not going to get easier, not anytime soon. Ashok, good to see you.
No, great to see you.
It's been too long, sir. It's great to see you in person.
No, it's great to be back here in person.
Thanks
So
for being here. Thank you. Ashok Badia there of Neuberger Berman. Coming up, Alicia Levine of BMY, Beth Kindig of the IO Fund, and Erin McLaughlin of the Conference Board. The third hour of Bloomberg Surveillance is up next.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. I'm not here to say what I would and wouldn't do in the future. But the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. But that's where I'm at today.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
The data center and AI build-out is going to be extremely expensive. That's starting to weigh on the market a little bit.
There is an expectation that we'll start to see a leveling out in
Mag 7 earnings growth rates.
I still think there's probably some room to see more pullback.
New leadership can emerge or at least challenge some of these tech leaders. And that to me is a very healthy stock market.
6-12 months ago, the fundamentals looked better. We're more on bubble watch than bubble call.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures positive by 1/3% on the S&P 500. On the Nasdaq, up by 0.4. Similar move on the Russell following a 4-day slide. Equities bounced just a little bit. The numbers from Target this morning, not great. Tomorrow, Walmart. Later on this afternoon, the big one. The weight of this market on the shoulders of NVIDIA. NVIDIA reporting after the closing bell.
Yeah, and it already has lost more than $600 billion of market capitalization since the end of October when it saw its peak. And this comes as people are not rewarding the idea of spending more without showing the results. And that really is the key. Can NVIDIA show that the spend is consistent and proving out to be beneficial to the companies that actually are buying these chips and can actually see a return on those chips before they become obsolete because they're used up?
The stock is up by 1.5% of the pre-market later on this afternoon. Following those numbers, don't miss this conversation. Jensen Huang catching up with Bloomberg's Ed Ludlow, 6:30 p.m. Eastern Time. A must-watch conversation. This market has shifted. It's a big change. There was another deal announced yesterday, and you and I have been talking about it through this morning. Anthropic, Microsoft, NVIDIA coming out and saying, we're getting together, I'll spend here, you spend there, we'll all make money, fantastic, move on. This market sold Microsoft, sold NVIDIA. That's new. That's not what we saw taking place a month or so ago.
Yet fears of circular financing seem to have taken on a life of their own. This idea that they're all sort of hinging on one another's success. We saw that with OpenAI as well as Oracle, and the potential tie-up there has also led to some skepticism about exactly what will transpire. Nonetheless, I think ultimately it comes down to companies, what they're saying about how they're deploying AI, how transformational it is, and what they can give in terms of visibility to a pathway to a future that we still cannot fully imagine. Is it robotics, as Nokia CEO is talking about? Is it mobility? Is it public safety? Or is it just making sure that your spreadsheet is all dotted and your T's crossed in a more effective way? I mean, but these are sort of the near-term and the long-term issues. Target partnering with OpenAI, also not seeing the reward in the share price. So we just need to see a bigger visibility into what that future looks like.
Then once you get past NVIDIA later on this afternoon, tomorrow morning's a big one. Payrolls and Walmart. If you want some visibility on the US consumer right now, develop some thoughts about what the Fed might not do on December 10th. Tomorrow morning, payrolls and Walmart. The payrolls estimate in our survey, 54K.
Yeah, and watch the revisions too, because we're also probably going to get some revisions to August, and that could be interesting as well in terms of getting a backward look about where the labor market was. Walmart might actually be the greater tell, though, and it might not even be in the results, but in the rhetoric that the new CEO talks about, the outgoing CEO, I should say. He's not going to be the ex-CEO until January, but there's a question here about whether Target is representative of the softness or whether this is Walmart eating Target's lunch, and that's what we'll find out tomorrow.
Equity futures this morning firmer by 1/3%. Coming up this hour, Alicia Levine of BMY, as stocks look to avoid a 5-day losing streak. Beth Kindig of IO Fund as Wall Street braces for NVIDIA's earnings, and Erin McLaughlin of the Conference Board looking ahead to the longer-awaited payrolls report. We begin this hour with stock cycle recovery as tech concerns continue to weigh on equity markets worldwide. Alicia Levine of BMY Wealth writing, we do not anticipate macro downside and so expect the market to rally into year-end. The risk is to the upside from here. Alicia joins us now for more. Alicia, good morning.
Good morning.
Said that last time. What's gone wrong in the last few weeks?
Well, I don't think anything's gone wrong yet. I mean, if you think about it, the S&P is off about 5%. Really, it's the tech stocks that took the hit. But what's interesting, we talked about how high the multiple was in the S&P at 23 times. We're now at 21 times. So the market's done a little bit of work here to take some of the froth out. In the end, we're always looking forward for our client portfolios 12 to 18 months forward. We think this will be a buyable moment. Where it ends, there's going to be, as you said, the next 24 hours gets to all the issues, gets to the earnings, the spending, the depreciation issue on how the P&L is being managed for all these tech companies, which has come up in the last week, as well as what's happening with the labor market, as well as what's happening with the lower-end consumer. So you're getting all these issues answered in 24 hours, and I just think that market participants did not want to carry risk into this. It's just too big because you are getting the macro story as well as like the micro of what's going on with this particular trade that has driven the market for the last 18 months.
So Alicia, let's unpack some of that. So we've got a big morning tomorrow, Walmart, and we've got jobs as well. So that should give you some indication, a little bit at least, of what the Fed might do next month. I want to sit on NVIDIA. As a company and as a stock, as a company, the earnings should be pretty good because we've heard from their biggest customers, and their biggest customers want to spend more and keep spending more. So I've got that sorted. As a stock, there's an attitude shift that's developed in this market. The things we used to rally on, we don't rally on anymore. What's behind that, and why do you see it changing?
So, look, the big difference here, and you know I can't talk about particular companies, but this is a theoretical, this is, the
entire market itself.
The entire market itself. Is that the debt financing versus financing from equity or financing from cash flow is the biggest change, and it does introduce a different risk metric. So to me, it does make sense that you're bringing the multiples in a little bit simply because if you're debt financing, that is a different kettle of fish. In the end, we've talked about how the margins are so high, how the cash flow margins are so high, particularly for this sector, that it's able to sustain higher multiples. If that is the case, then in this new world, you're going to compress some multiples here if there's debt financing. So that's the big change here. The tech sector, as a standalone, has already dropped 2 turns of multiple as well, from 31 times to 29 times. So there's been a lot of work done here. I think it's a reset because I think we're in early innings of this. I also think it's healthy that there are larger questions asked. As we look forward, we expect consumer stimulus coming from the tax code, February, March, and April, as refunds to households, the lower-end households. I think you're going to get a broadening out here, in part because of the questions about how this money is actually getting spent. And in the end, as we know from 25 years ago, there are winners and losers. We've not asked ourselves that question as a market, and it's almost impossible to know. It's impossible to know. So, the companies that are the behemoths today were like, a gleam in an eye of some college kid in a basement, back in the late 90s. So it's hard to know how this is going to get monetized. But the questions are being asked. I think the questions are good questions. You don't want a straight upward move in the market. So this, I think, is healthier.
Although, as an investor, if we're in the early stages, how do you pick the winners for even the mid stages, right? And it sort of goes to the heart of, do you just hunker down with the big tech names that are the big tech names today and generating cash? Or do you bet on the evolution of AI to the rest of the index, the idea of other potential winners in this potential race?
So I think part of what we're seeing here is that evolution from sort of the picks and shovels and the direct beneficiaries to implementation into business strategy. And you're starting to see it in some of the industrials, and you're even starting to see it in the hyperscalers. Like if you just look at some of the revenue per employee for some of the hyperscalers, it's gone remarkably higher since ChatGPT was released. So there's already implementation. The market is going to start picking the winners and losers in the other 493. And that's what we're going to see. That is a healthier place to be. If you're changing your business model, what we know is that the overall margin for the S&P continues to march higher, separate from the top 7 stocks. That means productivity is increasing, and it's likely because there is AI being used across the value chain in many, many companies. Whether, if there's data as part of the company, it's being used.
Well, one thing that people keep saying is that all of this is predicated on enough energy to power it. And increasingly, a lot of the hyperscalers are realizing, oh no, we don't have that. So we have to come up with a backdoor way off the grid to try to power our sites. I just wonder at what point you can invest in the energy sector, or whether it's hamstrung between policy and politics, between Saudi Arabia and President Trump and the potential agreements on oil.
Right, so look, there are no accidents here, right? I mean, I think that part of the new administration, well, that's not new anymore, but part of the Trump administration's policy was to keep a lid on energy prices, and that is exactly what's happened. We're sitting at $60 on WTI, 64 on Brent. That's exactly what the policy has been, and I think it's no surprise that bring energy down to drive all of the innovation. In the end, it is a competition with our adversaries out there, and so this is part of the plan. There will be questions asked along the way. The expression is wiser but sadder, sadder but wiser. We are wiser about technological innovation than 25 years ago. We understand there are bumps along the way. What I see is a remarkably resilient corporate sector. The productivity is going across all sectors. We will see it. The margins are higher. And so we can ask questions about debt financing on the top 7 stocks. We got 493 that can also power the market. And I think as a business, we are raising our earnings estimates for next year and for the following year into this. So we believe in the productivity. We see it. We see it in earnings estimates. Yes, some sectors are coming down, like communication services because of the spending of some of the hyperscalers. But overall, we're raising estimates.
Do you think there's some scarring from .com? The issues that we saw then have conditioned a certain group of investors?
100%. The way we've had scarring from GFC, right? Like there's scarring there about, is this a bubble? Well, we're up 100%. It's not, a great colleague of mine sent me a bunch of charts on like what previous bubbles look like. We're just like a tiny little speck, right? The appreciation in the market and the particular companies at the heart of this are actually exhibiting a shallow rise in compared to what we know were bubbles in the past. We think we're actually early to mid innings of this, and there's a way to go. The fact that the market appreciated for 6 months in a row, 7% in the third quarter, and we're quivering over a 5% downdraw just tells you how great a year it's been. And there was broadening out. And I think, look, we have to get the Fed question also. Like, is the Fed going to cut? I think the chair has been very careful to keep the probabilities at 50-50. Even though we've had hawkish comments, the market's not pricing in anything less than 50-50 on the chances of a cut. And that's done for a reason, because they want optionality to cut.
Let's finish on this. What's a good number tomorrow morning on payrolls? I can tell you the estimate in our survey, it's 54. What's a good number for this month?
I think anything over 50 is fine, right? Because the 3-month rolling average is 29, and that's pretty awful. So anything that pulls, so I think 50 is fine. That will change the probability of whether we get a cut or not also in December. I think overall, you'd rather see a stronger economy and a better labor market. So I think that's important. I think NVIDIA, we'll have to see what the earnings are. But like you said, the hyperscalers are spending. So that's, I think, more knowable than not. And then ultimately, for the largest retailer on earth, half of the American population is a customer. So we'll see what half of America is doing.
And the other half thinks they're group one at the airport. That's the US economy right now. Alicia Levine of BNY Wealth. Alicia, thank you.
Great to
appreciate it. Thank you very much. Looking ahead to payrolls tomorrow, 54K the estimate. Bramo, the high's 105, the low 25.
Yeah, and pick your narrative in terms of how to interpret it. I'm still stuck on what Alicia said about sadder but wiser. And I want to just say that this time is different also than .com.
And wiser but sadder.
And wiser but sadder. Because in the .com bubble, people were excited about the technology. They were excited about the internet. People are less excited about artificial intelligence, and that is different. And there have been surveys showing that people are skeptical, and they're worried they're going to lose their jobs because a lot of these efficiency gains come at the behest of jobs. Is a different tone around the sort of trepidation that people have about the robots.
You can replace people and the word they with I in a lot of those sentences,
but you're
because I feel the same way sometimes.
But actually, surveys have shown that you're not alone. A majority of people feel this way toward artificial intelligence. There is a PR war to be had, if it is a PR war, or at least some kind of way to combat it where people can get a little more excited.
Not alone. Feels like therapy.
Yeah, you're not alone.
It's beautiful.
Join
Thanks, Lisa. Thank you.
Sadder but wiser.
Right, we can hold hands at a commercial
wiser.
break. All right. Sadder, wiser, wiser, sadder. Let's give you an update on stories worldwide with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. Shares of TJX are rising 2.8% in the pre-market. The discount retailer boosting its fiscal year outlook after third quarter sales came in above estimates. The results signaling that U.S. shoppers are becoming more frugal as the economy shows signs of stress. Meanwhile, New York Police Commissioner Jessica Tisch is accepting Mayor-elect Zohran Mamdani's offer to stay on the job. The police executive is staying on after several conversations with Mamdani. Mamdani's team praised Tisch and the drop in crime under her leadership. And in sports, Roger Federer was elected to the International Tennis Hall of Fame. This was Federer's first year of eligibility to be nominated, and he was the only candidate with enough support in the player category to join the 2026 class. Federer is the first man to win 20 Grand Slam singles titles. That's Bloomberg Brief, John.
That was inevitable. Yahara, thank you. Appreciate it. Up next, the Morning Calls Plus, Beth Kindig of IO Fund as Wall Street braces for NVIDIA's latest earnings report. That's next. You're watching Bloomberg TV.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
You cannot get away from the comparisons to the late 1990s. A lot of the build-out was financed by companies that were incurring debt and had no revenues on the other side. And because you've seen this accelerating debt issuance, there is the worry that that is coming back. And we would say that's actually a good, rational worry.
That comparison just keeps coming up. That was Julian Emmanuel of Evercore on the program a little bit earlier on this morning. If you're just tuning in, welcome to the program. Off the back of a 4-day slide on the S&P, we bounced back by just 0.2% on the S&P 500, on the NASDAQ 100 up by 0.3. As we count you down to that cash open, let's get you some morning calls. First up, Guggenheim raising its price target on McDonald's to $3.10, seeing strong same-store sales growth in the U.S. Elsewhere, Wells Fargo lowering its price target on Home Depot to $400, noting Q4 appears off to a rough start after the company reporting earnings in the last 24 hours. And finally, Jefferies upgrading DoorDash to buy, believing the company's execution and growth algorithm are underappreciated. The stock is up by 2.4%. Let's stay on tech. All eyes on NVIDIA earnings today as companies pour billions of dollars into artificial intelligence. Analysts expecting the AI giant to show more than 50% growth in net income and revenue in the third quarter. Bloomberg's Ed Ludlow will be catching up with Jensen Huang later on this evening. Ed, looking forward to that, buddy. What's top of mind for you today?
Yeah, it's a very simple equation whereby if they're going to hit more than 50% revenue growth, net income growth, they
I think we've lost the connection with Ed Ludlow from our own office, in fact, which is bizarre. So we'll try and sort that out in just a few seconds or so. We talked about the difference between the company and the stock. The company should be okay because the earnings of their biggest customers have been great and their biggest customers are looking to spend more. Down with that. The stock and how it's been treated by this market, That's been a change over the past few weeks.
Well, it was a meteoric rise up, and now there's a bit of a sort of blow off top. And there's a question here about long term, how much companies are going to be willing to potentially continue to buy chips and upgrade at the same pace going forward if the gains are so great. So the forward look in terms of what the sort of runway is for the upgrade cycle for NVIDIA might be really important in terms of some of the rhetoric.
We can't reconnect with Ed, so I'm just going to say it for him. 6:30 Eastern Time. Later on this evening, don't miss the conversation with Ed Ludlow and the NVIDIA boss, the CEO, Jensen Huang, coming up on Bloomberg TV later on this evening following those earnings. Beth Kindig is the lead technology analyst of the IO Fund, which since starting in 2020 has outperformed the S&P 500 by more than 100%. Beth writing, NVIDIA has no debt or cash flow issues in funding its AI roadmap. Unlike big tech, with large capex bills, the market hasn't fully factored this in yet. Beth joins us now for more. Beth, welcome to the program. We've got the stock and we've got the company. I want to focus on the company. This should be quite straightforward, shouldn't it, after we've already heard from their biggest customers, and they're looking to spend and keep on spending.
That's a great point. Thanks again for having me. Big tech CapEx, you cannot underestimate the importance of that number. We're seeing 19% quarter-over-quarter growth. Now, this is at scale. These are large numbers to be growing nearly 20% quarter-over-quarter. Our largest growth this year in big tech CapEx. It's communicating and foreshadowing what we will see from NVIDIA this evening.
Beth, how this market treats this stock has shifted. How this market treats this story has changed. I think yesterday's a really interesting example that Microsoft, Anthropic, NVIDIA come out and announce a deal, an agreement to invest in each other and all make money and everything's going to be fine. And we've seen those kind of agreements before, and the stocks would typically rally. Beth, they didn't yesterday. Have you noted a change in the reaction function of this market to incoming information? And why do you think that's going to change anytime soon?
The market is emotional. It's sentiment driven. However, for years now, I have encouraged investors to look at NVIDIA according to its GPU generations. You had Ampere, you had Hopper with our big moment in a couple years back. We're moving into the Blackwell-Rubin cycle. Jensen Huang gave an incredible statement when he said there would be 500 billion cumulative revenue. Now, what my company has modeled is that means we will end next year in the 300 billion to 320 billion data center mark. Now, stay with me. We have been forced to update our models. I originally had a 10 trillion market cap by 2030. I am now raising that to a 20 trillion market cap by 2030. Therefore, I am not concerned as to how the market feels from day to day. The long-term roadmap is laid out, the product roadmap, and the vision as to how this data center revenue will continue to grow could not be more perfectly handed to investors than what we've seen over the last month.
Beth, if the revenue is so sustainable, why does NVIDIA have to give money to so many of its clients to buy its chips?
That's a great question, and I would look at it less as this big .com worry, and I would look at it more as an exercise of R&D. We have a common denominator, which happens to be NVIDIA's GPUs. We want NVIDIA to work alongside the R&D labs and big tech and make sure that America remains competitive. I would not look at this as some big concern that everyone's depending on each other. I would look at it as a race to try to be in the lead. And that piece is something that all AI investors should want. And I believe it will continue on an upward investable trajectory, which is very different than those who have .com concerns.
Well, it does raise a question, though, and it's not just the U.S. companies. We were just speaking with Nokia earlier, and they have also a partnership with NVIDIA. I just wonder, at what point do all these companies become so intertwined that if there is a weak link, it will have ripple effects that are much more substantial than many people appreciate?
What I would argue back is that AI is very early. So investors have this incredible opportunity to get in early. Usually that happens at the venture capital stage. So you see, all of these startups trying to bring, a technology to the market. Instead, because AI is so incredibly expensive at the onset, public investors have an opportunity to get in early. What we're seeing, in my opinion, is very normal for early stage technology. And My company has done quite well by positioning with the picks and shovels trade. And that piece has so far paid off in spades. I expect it to continue to pay off. And look, you know what, come on, big tech has a lot of cash. It's not going to run out of cash. The company's spending all of this CapEx. They're pretty cash efficient companies. I don't have a huge concern as to big tech running out of cash anytime soon.
Beth, appreciate the update from you. Beth Kindig there of the IO Fund. Big tech, super strong balance sheets. They're the one issuing the debt. Totally with her on that. We'd all agree. We've been asking a question, though. Is this story built on that or built on OpenAI, where things are a little bit more flaky compared relative to the strength of those balance sheets elsewhere?
And as NVIDIA leveraged the idea of an eruption in technological prowess and advancement that it needs to also fund because nobody else can? How much are they going to be sort of instrumental in the money and the purse behind any kind of advancement that people are hoping to achieve?
NVIDIA higher this morning in the pre-market by 1.7%. Coming up, Erin McLaughlin at the conference board as we look ahead to a longer-awaited jobs report tomorrow morning from New York City. You're watching Bloomberg TV.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francina Sintra, Portugal, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
4% correction on the S&P 500. Can we call it a 4% correction?
It feels like it.
S&P?
It feels like a 4% depression compared to the way some people talk about it.
So spoiled, up and to the right. Since the lows of April, 4% move, and it feels pretty depressing at the index level.
It was more than that, though, for some names, and I think that that's the reason why people who have invested heavily in tech are taking it on the chin, and you're seeing the NASDAQ underperform the S&P 500 in the equal weight almost by twice as much over the past, frankly, since the start of November.
NVIDIA in the pre-market this morning doing a little bit better, but over the past few weeks, we've had a correction of more than 10% on that name, down about 12%. Going into that earnings report later on this afternoon. Equity's doing better so far this morning, though. As we count you down to the opening bell, about 60 minutes away. Let's get you some morning movers with Danny Berger. Danny has more. Hey, Danny.
Hey, John. Some of the retailer earnings we got this morning. Target was among them, down 3% in the pre-market trade, reporting results that disappointed, having to trim some of the high end of its expectations. The fear is that this turnaround that they've been trying to engineer is taking longer than expected. So not only are the results not showing up, but they're having to invest more money for that turnaround too. $5 billion is their capital expenditure target, saying that they are going to do things like build more stores, invest in the stores that already exist, invest in merchandise. So again, those shares moving lower. Some of the other retailers we heard from this morning include TJX. Maybe a bad sign that this company is doing well. It sells a lot of discounted clothes, and they beat expectations. They also raised what they see as comparable sales for the year, so those shares trading up 3%. Finally, ending with a little bit of deal news. Adobe will be purchasing the AI and marketing company SEMrush for about $1.9 billion. The price tag on that will put it at $12 a share, so you can see the premium starting to lift shares of SEMrush by about just under 75%. And this is Adobe's first deal since the failed attempted takeover of Figma, so that moving the shares higher this morning, John.
Danny, appreciate it. Thanks for the update. TJX, so far this year, higher by more than 20%. It's one of those names, it's like Walmart, right? If it's doing badly, it must be really, really bad, and if it's doing well, it must be bad.
Yeah, exactly.
But, and that's the game we'll play tomorrow.
That's the story that we're playing right now, because TJX is viewed as doing well because people are looking for discounted clothes. How much are people trading down? And that's going to be a big question with Walmart, I'm sure, on the call tomorrow.
Walmart tomorrow and the jobs report as well. Later on this afternoon, we get some Fed minutes. Bit of data just moments ago. Let's get you an update and cross over to Bloomberg's Mike McKee for more. Morning, Mike.
Good morning, John. It feels very weird to be back in the chair talking about data that has crossed, but we do have the first data since the shutdown ended, and it is international trade for September. The trade deficit falls to $59.6 billion. The estimate was for 60.8, and we were at 78.3 in July. Now, this is old data in the yes, but category. It does matter because it's basically the final piece of data that analysts need to put together the third quarter GDP report, which is going to be released in next week. So good news for the overall U.S. economy, and kind of one headline out of this. Imports from Canada in September were at their lowest since May of 2021, and that, of course, was during COVID. We're not getting along with Canada very well on a trade basis these days. Now, as I mentioned, GDP comes next week. Tomorrow we get the September jobs report. Not sure how much that's going to matter, but we will also get the latest numbers on jobless claims from last week. The Department of Labor is not going to publish the missing numbers between the start of the shutdown and the number that comes out tomorrow, but they will put the data online tomorrow afternoon. So if you want to go back and look at it yourself, you can, but we'll get the latest numbers and see where we are there. Real earnings Friday, not a big deal. The September PPI comes out next Tuesday, and then we get that GDP number for the third quarter, and they're going to go straight to the second version because they've already skipped past the first. That comes out Wednesday, along with income and spending for October. That's going to be an important number for a lot of people trying to calculate where we are. Then we get November income and spending on December 19th. We still do not know the fate of October's jobs, CPI, and PPI. The White House says they're not coming out, but we haven't heard that from the BLS. Jobs, CPI, and PPI for November. We don't know when those will come out, and we're still waiting on the status of October and November retail sales. But we get started this morning with trade.
Mike, can I ask you about claims? You mentioned jobless claims. Has that been a reliable anchor to establish a view on the health of the labour market, or has it been a misleading one? If you focused on that, have you missed what's happened elsewhere?
Well, from what we have seen, the data that we've been able to download and adjust, we look like the theory that everybody's had of a low-fire, low-hire economy. So if we get something in the 220 range tomorrow, that would just confirm it, and it kind of gives the Fed the idea that they have a good idea of where the economy is, at least in the labor market.
Mike McKee, thank you, sir. Mike down in Washington, following that trade data. More data still to come. This could be very noisy over the next few months. Erin McLaughlin at the conference board writing the shutdown's ripple effects could shave roughly 0.5 percentage points off of GDP growth in the quarter, but most of it will likely be recovered in the beginning of 2026. Erin joins us now for more. Erin, welcome to the show. This Federal Reserve starved of economic data. They'll finally get some. How noisy is it going to be?
Well, I'm not really sure it will change much since it's so backward looking. And I think similar to your other guests that you had this morning, a lot of it will be business as usual. As Mike just said, low hire, low fire. I do think that sort of the era of labor hoarding, which we've seen over the last couple of years, is probably coming to a close.
How much have we already gleaned from consumer confidence and from a sense that people are not feeling good about their prospects in the labor market? Can you connect that to what's actually going on the ground, or have you seen a divergence between sentiment and the reality to a degree that makes it unreadable?
Well, the sentiment from our consumer confidence index has essentially been very sideways moving. So, there's a little bits of change here and there. But when you dig a little bit deeper, what's really interesting is that consumers feel relatively optimistic. I mean, it's still pretty low, compared to last year or the year before. However, they're pessimistic about their expectation for 6 months forward. And so I think that that's really, really telling. The other thing that we asked in our most recent survey was about holiday spending, which obviously will be really key for a lot of big companies. We're still in a very consumer-driven economy, and our surveyors said that they expect to spend 4% less this holiday season than they did last year. And I also think that they will experience higher prices. We saw inventories, when we look at trade data, really up in the first quarter of this year, but they were very flat, or lower than other years. And so sort of pulling that inventory earlier to save on tariffs and being able to pass that down during the holiday shopping season might not happen. And so the combination of increased prices and the expectation of increased prices may result in just lower spending.
Erin, if people started their day with a cheaper cup of coffee and a cheaper banana, do you think that they would spend more elsewhere?
Yes.
Okay, so coffee is that affecting things?
Coffee is up 20 to 40%, depending on the kind of coffee you're purchasing. And, it's really, I've been focused very much on trade at the conference board this year. And it's very interesting to look at these policies and think about how overly broad they were when these tariffs were enacted, because we only grow coffee in Hawaii. Right? We do not grow bananas. And so to have to go back and revisit some of these policies is really interesting. And to pick up on what we were just talking about with Mike McKee on Canada, when I dove really deep into trade data for this year, after China, where trade is down about 19%, the only other major trading partner that we're down both imports and exports this year is Canada, where we're down about 3 or 4%. And so I think there's still that continued uncertainty. The USMCA trade agreement is not up for that renegotiation until next summer. Our agreement with China is, basically our truce is only for 1 year. So for so many importers, manufacturers, and others, we still have continued uncertainty.
Congressman French Hill made a similar argument, Bramo, earlier on this week. The Republican from Arkansas, not a fan of broad-based tariffs, sympathetic with the national security objectives of doing certain things on certain countries, but doing broad-based things like this and hitting things like coffee and then needing to backtrack kind of undermines the decision to begin with and the objective behind it.
Which raises this issue going forward. Are there other tariffs that are going to be walked back? What does this mean for the Supreme Court decision? Will that be used as a smokescreen to walk back serious parts of some of this initiative? And what does that mean for the deficit? I know I sound like such a negative Nelly, but you have to wonder if people are counting the idea that we're going to get revenue from these tariffs. Is that revenue not really countable, given the fact that potentially this will be rolled back?
Erin, we're running deficits of 6 to 7% of GDP in this country. And this is something that this administration has inherited. I understand we can talk about the trade story, but the mood of the consumer was pretty dire before President Trump walked into the White House, and that has continued. Erin, what's behind that? And is there a spread opening up between how the consumer feels about this economy and how businesses feel about this economy, the companies that you track?
Yes, that's a great question. So we also have our CEO quarterly survey that we do, and CEOs were so excited at the beginning of the year, essentially because they were looking forward to lower regulation and to sort of an increasingly friendly business environment. The tariffs have upended some of that, and the continued uncertainty has upended some of that. For consumers, I think a lot of their malaise is really related to the really big changes that we see that we can't predict or necessarily get excited about, you know, and sort of thinking about AI, for example, and really understanding what jobs may be displaced, or in really understanding how they may benefit or their families may benefit. That and uncertainty has just increased. Things like the federal deficit, most consumers do not think about that when it comes to their day-to-day or month-to-month spending.
Erin McLaughlin at the Conference Board. Erin, thank you. Fantastic to catch up. As always, it's good to see you. This is an interesting situation for corporate America to feel good about the future, to forecast better earnings, and yet we look at the labor market, employment growth is so bad, and the way the consumer feels about things is so dire. How are we going to close that spread? Because I tell you, for society to function normally, for politicians to be comfortable in the seats they've got, that gap, that spread, needs to close.
And this is the reason why the Fed is talking about cutting rates. And I understand that they're not a political body, although some people might disagree, but there is this feeling that that sentiment in the rank and file of people who don't feel the benefits that companies are talking about are going to be more important or sort of given the priority on the Federal Reserve. You're right to point this out, because a lot of what companies are saying, the optimism comes in their creativity and innovation of becoming more efficient, of doing more with less and reaping more profits, even if they don't necessarily have the best backdrop. And this is really a conundrum that's going to be a political issue for a long time.
Futures this morning positive by about 0.2%. A big 24 hours coming up. Later on this afternoon, earnings from NVIDIA. Tomorrow, we'll get numbers from Walmart and a much-delayed payrolls report. September payrolls dropping on November 20th. What has been going on?
Yeah, and is it going to be useful at that point? And that's the reason why I keep saying maybe revisions to August could be really important, given the fact that you get more of a trajectory heading into October, which we're not really going to get, because it'll be really messy and we're not going to get an unemployment rate.
It's all good news. Other than that, let's get you an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahara with more. Hey, Yahara.
Hi, John. China made its biggest daily purchase of U.S. soybeans in 2 years, signaling support for last month's trade truce. The USDA says Beijing bought 792,000 tons on Tuesday, taking total purchases since October above 1 million tons. President Trump says he still wants China to speed up its buying, even as U.S. soybeans trade at a premium to Brazil's. Meanwhile, the Department of Energy is backing Constellation Energy's restart of 3 Mile Island. The Trump administration has lent the company $1 billion to restart the Pennsylvania nuclear plant. Constellation unveiled plans last year to start the plant through a power purchase agreement with Microsoft to support the company's data centers. And shares of Target are lower by 3.5% in the pre-market after it lowered its profit forecast for the year as a retailer deals with markdowns and soft demand in key areas. The incoming CEO said Target experienced choppiness across its business during the quarter and that it's been difficult to pinpoint specific drivers for the softness. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Thanks for this morning. Up next, we'll set you up for the day ahead. Plus, we'll catch up with Zach Griffiths of Credit Sites. You're watching Bloomberg TV.
Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The Federal Reserve, just like markets and economists, are going to have to think a little bit further out into what Q1 and Q2 are going to look like. And probably that tells us that employment will become slightly more problematic, not dramatically, and inflation will continue to rise. It's a continuation of that stagflation-light type of environment.
Francis Donald of RBC, Stag Light. Sounds like a really bad drink, doesn't it? I remember the first time I heard that, Stag Light. But ultimately, that's what she's looking for in 26.
It's a stag dance where you don't get a dance, essentially, right? I mean, it's sort of, yeah, but this is kind of where we're at. But we don't get the CPI data, so we can't even know how stag it is, just light.
Stag light, a terrible night out. Equity futures on the S&P, positive by 0.25% right now. We're up by 1/3 on the Nasdaq. On the Russell, we're up by 0.4. In the bond market, Treasury shaping up as follows into tomorrow. Yields down at the front end of the curve, 356. It has been a snooze at the front end of the curve. Anywhere between 350 and 360. Why? Because this Fed is just totally gridlocked. What is going to break the gridlock? If you can work that out, you can work out which way this one's going to come, which way this is going to break in a month to come.
Yeah, and potentially what the rhetoric is going to be going forward, because it seems like the last time was clearly a hawkish cut. There was a signal that Jay Powell put to the whole market, which is this is a split committee and December is not a certainty. We've gotten that pricing in. How much can they give guidance going forward, given the fact that there's going to be a real composition shift to the Federal Reserve?
And a new leader at the top of that Federal Reserve, a politically correct leader at the top of that Federal Reserve.
What does that mean?
To me, that's Governor Waller. We talked about this.
Right, but
to me, that's Governor Waller.
But you are not President Trump, so
I know. So I can't get in his mind.
I mean, you could try. What do you think it is?
That would lead me to believe it's Hassett.
Yeah, that's
right?
kind
Based
of,
on that.
And that's what the market believes. Well, that's what the market's pricing in right now. That's the greatest chance would be Kevin Hassett as the new Fed chair.
He's the favorite. Politically correct? I don't know.
To who?
That's up to the president. Equity futures on the S&P 500 doing okay. Yields down by about a basis point. Big week coming up. Big few days coming up. This is the trading diary. This is what things look like. So later on this afternoon at 12 p.m. Eastern Time, President Donald Trump will be speaking at the U.S.-Saudi Investment Forum in Washington. At 2 p.m. Eastern Time, the Fed meeting minutes. Then after the closing bell, the big one. NVIDIA earnings followed by an exclusive conversation with the CEO, Jensen Huang, at 6:30 Eastern Time. On Thursday, so tomorrow morning, a delayed payrolls report, jobless claims, and Walmart earnings. And for good measure, into the weekend, UMich consumer sentiment. All of this, some new data for the Federal Reserve. Zachary Griffiths, the head of US IG and macro strategy at Credit Suisse, is still expecting a cut in December. We expect continued labor market weakness to produce demand-driven disinflation, leading to the need for more aggressive easing. Zach joins us now for more. Zach, welcome back. Always good to catch up. What does aggressive easing mean? How many cuts is that?
Thanks, John. So right now we have a cut in December, and we're looking for 3 more in 2026. But what I think is more interesting is our expectation for the market to price in a terminal rate that's lower than what we currently see in SOFR futures. So we think the Fed could ultimately cut to 2.5%, but it may be a bumpy path in terms of what the indicators tell us about the balance of labor market and inflation. To us, we are expecting more labor market weakness to lead inflation lower and to allow the Fed to deliver more rate cuts and what we think is going to be a much more challenged consumer environment in 2026. I think we've gotten very used to a consumer that's been very resilient and surprised to the upside. We think that comes to an end in 2026.
Zach, why are you seeing this in particular? Because ultimately the corporate earnings, while they haven't always beat expectations, they've been okay. And they point to, yes, some potential softening, but not exactly softness. What do you think we're getting wrong about just how weak the consumer is?
I think the big thing, Lisa, is going to come down to the labor market. If we actually see job losses, and we have seen more announcements of layoffs, that's going to be the key to the scenario that drives actual consumer weakness. I think throughout all of this, we've heard excess savings have fallen. We've heard consumers exhibiting value-oriented behavior, but we really haven't seen the downshift yet, and it's because we haven't seen material job losses. I think we can see net monthly job losses, fiscal concerns, the potential for the Bank of Japan to be hiking rates. So it's not a one-way trade, and I think that's really what the Fed has been trying to communicate. The market had gotten very comfortable with kind of one direct path toward lower rates on the magnitude of 100 basis points getting to around 3%. They've called that into question. On the inflation side, we ultimately think that the labor market's going to deteriorate further and cause their focus to shift there while also causing disinflation. So I think you have the monetary policy side in the U.S. as the key driver. You have the curve steepening and yields moving lower across the curve.
Zach, you said some things there, and I heard QE. Did you mean to say QE?
Not QE necessarily, John, but the balance sheet growing to accommodate growth in the liability side of the balance sheet. So we're not calling for quantitative easing. We're not calling for a recession, but we are calling for a more notable downshift in economic growth than what we think the market is priced for and what the consensus is. And so to us, that means moving into long duration for total return focused investors. For excess return focused investors, we think it could be a more challenging environment. We prefer moving up in quality and shorter in duration for those focused on spread, as we think we could see decompression across the ratings curve and a steepening of the spread curve.
Zach, just stay on credit, just for a beat. A question I wouldn't typically ask you. How important are the earnings from NVIDIA later on this afternoon to your universe, to investment grade corporate credit in America?
That's a great question, John, and I think it's huge for sentiment broadly when you think about risk sentiment for equities and even credit, perhaps to a lesser extent. When I think about what is going to drive the credit market from a broadly tech perspective going forward, right now, tech makes up around 6-7% of the investment grade index. Our analysts are calling for issuance next year, tech to compose 20% of that. And so I think really when we think about balancing technicals and fundamentals, we think the tech side of the ledger becomes more of a technical and fundamental headwind, as Oracle, we expect, may need to come with as much as $85 billion in new debt over the next 2 to 3 years. So to me, I think earnings are important, but looking at how much of this future CapEx will be debt funded is kind of the key and a driver of our more cautious view toward fundamentals in IG credit in 2026.
Zach, thank you, sir. Well framed. Zachary Griffiths there of Credit Sites. This market's changing. The way these companies operate is changing. The way credit trades is changing. What compiles these indexes changing. There's a lot to track here. It's all changing.
Yeah, and the terms are changing too, because it's not quantitative easing anymore. It's balance sheet expansion. It's not shadow banking. It's now private investing. So we have new terms to go along with a very different market.
Did you hear QE?
I mean, no, I heard balance sheet expansion to accommodate different liabilities, which is
it's a different flavor.
It's a different, which is not quantitative easing, John.
Coming up tomorrow, Brian Levitt of Invesco, Angela Zeno of CFRA, Seema Shah of Principal Asset Management, Sarah Malik of Nuveen, and a whole lot more. NVIDIA earnings after the close. Don't miss Ed's interview with Jensen Huang of NVIDIA at 6:30 p.m. Eastern Time from New York City. From us, good morning to you all. Have a wonderful day. We'll see you tomorrow morning. This was Bloomberg Surveillance.
Okay, ready? David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
So I know from owning a sports team that only one team takes a lot of energy and time.
Tell me about it, yeah.
So you decided after you bought the Washington Spirits to buy some other soccer teams. So you bought stakes in a team in England, is that right?
Yes. I bought a team called London City Lionesses, and that is the only one of the 2 teams in the entire, potentially Great Britain, that are independent. 99% of the teams in Europe are part of the men's team. But this is one of the only 2 teams that was independent.
So now you have 2 soccer teams, one in England and one in the United States. So I would think for most people that might be enough, but you decide to buy a team in France as well?
Yes. Olympique Lyonnais Feminine is actually the best women's team in the history of women's football. In terms of how many trophies the team has won, they are the 8 times champions of the Pan-European League, and I can't even count how many times they won the French domestic league, the most successful team. I want to professionalize women's sports, right? I don't want people to think that somehow women's sports is a charity or a corporate DEI project. This is a legitimate entertainment product, and it is a business.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Caroline Conan in Paris, and this is Bloomberg.
NVIDIA earnings today, 30 minutes until the start of trading. I'm Matt Miller.
And I'm Danny Berger. Bloomberg Open Interest starts right now.
Markets face a critical earnings test. NVIDIA, the world's most valuable country, reports results with investors wary of AI spending.
And Wall Street executives ahead of that urging caution. Goldman's John Waldron saying that markets are primed for further declines.
And a cautious consumer. Retail results this morning signal that shoppers are turning to cheaper options as the economy shows signs of stress.
Matt, it's the one to watch today. You said it. It's NVIDIA earnings, especially given this thing has fallen 12.5% from its peak in October. This morning, shares are moving higher, but again, we've had back-to-back consecutive declines for NVIDIA, 1.8%. And it's the direction of the stock market. Sentiment, it will all hinge on what they report this afternoon. Options, Matt, are implying a 7% move in either direction. That on its own would add or erase $300 billion in market cap, which I think is like Oracle's market cap. So that could be a very large swing.
And speaking of, by the way, Oracle has made a complete round trip this year. It was a huge gainer, and now we're back to where we started. Target is the latest retailer to narrow its profit forecast as consumers get picky. Target cited discounts and softer demand for the revision. You can see Target shares down 3.5% in the pre-market.
Well, let's start with NVIDIA, the story of the day. Joining us around the desk is Bloomberg Tech co-host Caroline Hyde. Caroline, how different is the setup for this NVIDIA earnings, just given the fact that it's fallen to the degree it has, bringing down the AI trade with it?
What's interesting is even when NVIDIA tends to beat, and it has beaten 12 straight times in terms of revenue, it tends to fall anyway. A lot of the time, a lot of optimism is baked into NVIDIA's numbers on the earnings, and on the actual day after, they tend to sink, and then it rallies on some other types of news, like the GTC event that Jensen Huang had, where he articulated that he's got line of sight on $500 billion of revenue in just the next fiscal year. And so here we have yet another company that not only is riding on its own fundamentals, but is going to be a signal for the entirety of the market. Is capital expenditure going to be solid? How much can he answer questions on whether indeed, yes, CapEx is set to rise some 30% to the end of this year for the main key players, the Metas, the Amazons, of course, Microsoft, that make up a bulk of his revenue. But how solid is that into 2027? Can he talk a little bit more about some of the data center spend and how much it's going to expand out of the United States? There's some extraordinary Bloomberg Intelligence analysis out there today that's showing that really the US spend is what's propping up the entire global AI spend. Europe has not been increasing its AI spend much, about 1% more broadly, whereas over here in the United States, it's up and to the right. So will we see it spread? And will you and I actually use it more? Only about 10% of people are surveying, saying that they're building products and they're winning revenue for their companies at the moment by using generative AI.
I think NVIDIA is not the company that we're worried about, right? The concern is, are we seeing ROI on CapEx? And NVIDIA is the one getting the CapEx. But if you look at the SPLC on Bloomberg, that's the supply chain function that's really fantastic. Right now, you've got a 3-month price change in there. But if you put in a 5-day price change, you would see all red, right? Microsoft is down over the past 5 days. Meta's down, Supermicro's down, Amazon's down, Alphabet's down. I mean, the whole tech sector is down over the past 5 days. So it's not like buy on the rumor, sell on the news is terribly likely to happen today because there hasn't been a lot of buying into this report.
There hasn't. $1.8 trillion has come out of the NASDAQ since the end of October. $500 billion of that is down to NVIDIA. And yes, NVIDIA is going to get the wall of money in this fiscal capital expenditure money circle that we keep seeing. But will that continue?
I like that. It is a money circle.
I mean, look at what Anthropic announced yesterday. More equity coming from $10 billion from NVIDIA, $5 billion coming from Microsoft, and in return, they're going to use GPUs and innovations from NVIDIA.
Which, by the way, the market didn't rally off the back of that. In the past, when we'd hear stuff like that, it would rally. Yeah. So it feels like something has changed, at least with the circularity of it.
I think people aren't loving that. They're not applauding it anymore. Instead, they're worrying about it. Over in China, there's yet another new DeepSeek. Moonshot AI a couple of weeks ago released a new LLM that is beating out all of the competition. How much did it cost to train? Reports are about $5 million. Is there a question that innovation will happen, that inference isn't going to be so necessary for the latest Rubin or for the latest Blackwell? Can we do more with less? And I think that's what he's really got to prove out once again. He can continue to innovate that makes his chips so necessary. It doesn't matter if Amazon's making their own, if Meta's making their own, if OpenAI is making their own with Broadcom.
All right, definitely excited to watch your program today. Caroline Hyde anchors Bloomberg Tech. That kicks off at 11. By the way, her co-anchor, Ed Ludlow, is going to be sitting down with Jensen Huang after the earnings. So tonight at 6:30 p.m. Wall Street time, if you're not out to dinner yet, go ahead and tune in. And if you are, you can see it on Bloomberg.com. And of course, you can listen to it on Bloomberg.radio. This is really an exclusive interview because we'll be the only news outlet talking to the NVIDIA CEO after earnings tonight. Turning to retail, because we have a ton of earnings coming in. September retail sales report, that report has been rescheduled for the 25th of November. Maybe that's what Michael Burry was talking about. This morning, though, we get results from Target. Target narrowed its profit forecast as we were talking about discounts and slowing demand weighing on earnings. Bloomberg retail reporter Emily Cohn joins us now. So what are we learning about the consumer that we're already a little bit worried about, Emily?
Yeah, I mean, Target is seeing a consumer that is choppy in its spending, not leaning into the the discretionary things that Target is known for. The retailer trimmed its forecast again, signaling that its rebound is going to take a bit more time. And despite an exciting announcement about a partnership with OpenAI, which boosted Walmart's shares, Target is down this morning on its trimmed forecast for the year.
How does this set us up for Walmart tomorrow?
So Walmart is in a different position. Walmart has really leaned into its value orientation. It's brought in higher income shoppers who are looking for a deal. Its grocery assortment is bringing in people who otherwise might have shopped at a more expensive grocer during these times. So we're looking at Walmart. TJ Maxx was also another interesting one this morning. I think TJ Maxx is pulling in that discretionary shopper who's looking for value, looking for a deal, looking for fun.
Is it fun, TJ Maxx? Do you like TJ Maxx? Because I've heard from a lot of people on our staff. You know, our executive producer, Antora, she says when she has had a bad day, you know, rather than a glass of wine to unwind, she'll go to TJ Maxx.
Yeah, and I think that actually speaks to part of Target's problem. Look, like, you don't go to TJ Maxx because you need stuff from TJ Maxx. You go to TJ Maxx for fun, for discretionary things, for things that you wouldn't otherwise.
Do that at Target though? Like you go because you're like, I need to go get some more toilet paper, and then you're like, oh, cool, like a little running top or something.
There's no hunt, right?
That
I
is
think
true.
the
There's
idea
no
is
hunt.
that you get to hunt through. But, you know, Romaine Bostick says it's just too messy for him.
Yeah, I get that. Look, if you are a ball of anxiety like I am, sometimes that's very difficult to bargain hunt.
I think that's exactly Target's problem. I think that used to be what boosted Target. That used to be what they were known for, and they've lost that. And now they're trying to bring it back.
More bargain hunting. Emily, thank you so much for joining us. That's
Thank
Bloomberg's
you.
Emily Cohn. Now, in other retailer reports, Lowe's shares are climbing. They did, though, trim their outlook, but they reported strong online sales, growing demand for professional contractors, a stark difference from rival Home Depot, who had earnings yesterday. Bloomberg Intelligence home builder analyst Drew Redding joins us for more. Drew, how much of this is just the fact that Lowe's was down 11% heading into this earnings this year, that it was down yesterday off the back of Home Depot, so expectations were incredibly low?
Hi, Danny. I think you make a good point, and that's certainly part of it. The bar had been lower coming into the quarter. So I think this was really, you could characterize this as better than feared results, particularly in light of what we saw from Home Depot. As you alluded to, they did trim their full-year same-store sales guidance. Now they're looking for flat comp sales versus flat to up 1%. So that would imply that 4Q is relatively flattish. First consensus was looking for about a 1% gain. You know, so big picture, I think that Lowe's is still facing some of the same challenges that Home Depot is, whether it's, you know, challenges among the consumer and housing in particular, which just hasn't reaccelerated despite the pullback in mortgage rates.
I wonder about the, you know, the immigration problem that has hit Home Depot a little bit harder, right? ICE likes to go to HD parking lots to round people up, but also, you know, they must be losing customers because of that. Is that affecting Lowe's at all?
This isn't something that we've heard too much of. As you alluded to, Home Depot does get a larger share of their business from professional contractors at about 50% compared to roughly 30% for Lowe's. It is an area of the business that they're expanding. But to your point, we haven't really heard of any direct impact to sales, you know, from immigration actions. But I think that it's something that both retailers will probably need to address in the near future.
All right, Drew, thanks very much for joining us. Drew Redding talking to us about Lowe's, which is where I would go if I had a bad day, just to chill out. Check on futures here. We're looking at gains after 4 days of losses. It's actually been the worst month since March. And we're only down about 3%. It's the worst November since the great financial crisis.
That is a statistic, but that's because November is usually good, right?
That's
it doesn't
exactly
mean
right.
that it's just like
That's exactly
so
right.
bad.
Yeah, November is normally a banner month.
Right. Speaking about nerves in markets, we know private credit has been one of them that's been percolating around. Some recent breaking news from Blue Owl, the credit giant. It has called off the merger of its two BDCs. Those were two private credit funds. One was publicly listed, one was not publicly listed. And the idea behind that was they wanted to combine them, would give more liquidity. But if you were in the non-publicly listed one, you wouldn't be able to have any redemptions. And Matt, that caused a lot of fear. Why would Blue Owl not let you have redemptions? Of course, for them, they said it's because they had to combine the two. But that caused a sell-off. And again, today, just announcing that they have called off the merger of these two BDCs.
Yeah, I think this is a very interesting story about kind of the tail that wags the dog, right? The market is telling Blue Owl what it can and can't do right now, and that is a sign of stress. I just want to point out, I've gone through the seasonality chart for the S&P 500. 29 years is as far back as I can go, but if you look at the average over that time period, November is typically the very best of all 12 months.
Better than December, even though the Santa rally and all that.
Yes, yes. December over the last 29 years averages a gain of 0.9%, whereas November averages a gain of 2.6%.
Okay, so maybe this will be a November to forget then. We won't get that rally. Elsewhere, Matt, the U.S.-Saudi Investment Forum is taking place in Washington, D.C. Bloomberg's Anne-Marie Hordern is sitting down with the CEOs of ACWA Power, Aramco, and Chevron. Let's listen in.
Really positioning itself, the real energy transition for Saudi Arabia, but for the world. And Saudi Arabia is going to be a major player, you know, in this regard. And we have many partners. We are very proud with our partnership also with GE. GE is really working with us now more than 20 years. And I have to say that with their innovation and their development, they have been really a great partner that we are making. Baker Hughes, you know, we are working with them now in using their technology to produce electricity from green hydrogen for the AI. And I'm sure that everybody knows that the AI in the state and everywhere else is going to be the new energy change. Because we are talking about normal growth in the world, 1%, 2% of electricity. Today, we are looking at 10%, maybe more than 10% growth. For how you could make this electricity, Saudi Arabia is the only country, I have to say, they have been very well prepared for this infrastructure of electricity, of the grid, of the production, to be the host of the AI. And Saudi Arabia will be the export, really, of data, and will be the hub of data. Why? Because Saudi Arabia is positioning itself. It's really the host of the energy, but this energy, it become a key component. And I'm sure you know 60% of that cost of the AI compute is going to be energy. And who could compete today? And thanks to His Royal Highness the Crown Prince yesterday and our Prime Minister, President Trump, this agreement, it will be unlocking this huge opportunity of Saudi Arabia is going to be connecting the world on data. Is it Africa? Is it Asia? Is it Europe? Is it the state? Saudi Arabia will be the hub of energy, but the hub of data and AI connectivity to the world. That's the reason this partnership with the United States of America, we cannot find any better partnership, trusted partnership in this journey, but we complement each other. And we are not here to create any competition at all, directly or indirectly. Is it in the energy or in the AI? We are here to complement this partnership and make this partnership to improve quality of life of people in the world, to have a better life, but also to have a great, you know, development of young youth. Because Saudi Arabia, you know, as our Crown Prince always said it, in Saudi Arabia, we did not have the oil. With due respect, I mean, he will get only upset from me. But we have the young youth. This is the real energy of the world in Saudi Arabia. Without this young youth, we will not be where we are today, and we cannot deliver our ambitions and our strategy of the future.
I believe 60% of Saudi Arabia's population.
That's Bloomberg's Anne-Marie Hordern speaking with the energy CEOs at the U.S.-Saudi Investment Forum in Washington. You can continue to watch that conversation and the whole event at LiveGo on your terminal. Meanwhile, at the Bloomberg New Economy Forum, Apollo's Mark Rowan downplayed Jamie Dimon's concerns that there are cockroaches in credit markets, but he did warn of late cycle dynamics.
credit stats are actually improving rather than declining. That does not mean we will not have late cycle banking behavior, because there are good banks and bad banks, and good insurance companies and bad insurance companies, and good asset managers and bad asset managers. But there's nothing that I see that is systemic.
That was Apollo's Mark Rowan speaking at the Bloomberg New Economy Forum. Now, credit markets are far from a panic, but there is one corner that caution appears to be seeping in. At least for the public debt market, spreads have started to widen on the debts on the AI-linked giants from Oracle to Meta. So what's happening in private markets? I'm pleased to say joining us now is the private credit and private markets powerhouse Fortress co-CEOs Jack Newmark and Drew McKnight. Thank you both so much for joining this morning. And I wanted to start on this topic of AI because, of course, you are participating in the energy of AI, in some of the real estate. And Drew, of course, you're a UVA alumni, which makes you a genius in all things. So Drew, I want to know, with some of the fear in AI creeping into public debt markets, is that risk accurately reflected in private markets?
That's a great question. I think if you look at just the sheer amount of capital that AI that was required for AI, it's consuming massive amounts of capital. And so I think what you're seeing in the credit spreads of some of the Metas and Oracles of the world are just a reflection of the amount of capital that's going to be consumed. I think, we're big believers in AI. You can be big believers in AI. You can also question what the investment returns that are going to be yielded through some of these infrastructure investments, because just the sheer amount of capital and, will the revenues produce the amount of capital? A lot of folks like to point to the internet bubble in the late 90s and early 2000s. Obviously, the internet was a wild success, but the amount of capital that was required for infrastructure didn't match the revenues in the early days. And I think what you're starting to see reflected in some of the credit spreads is just that question around whether the revenues are going to be there to support the amount of capital that's been spent and the amount of capital that's going to continue to need to be spent as the upgrade cycle flows through.
Jack, let me bring you in on this, because a lot of your peers have been inking monster deals. Again, yours has been more on the energy side and some of the real estate too, but we've seen some of your peers tens of billions of dollars financing packages with Meta, with other big giants like Intel. Is there a sense that deployment has gone too far, to Drew's point, that sometimes maybe the revenue won't fully reflect the capital expenditure that's being done?
Yeah, I think from our perspective, we find it tough to predict, what the future is going to look like. As Drew said, what's the use case for data centers? How much capital needs to go into them in 5 to 10 years' time? So I think from our perspective, we've been focused on investing in, the companies that are providing services around the AI space. We made an investment in a company that owns 30 mobile turbines. Those mobile turbines are used to provide temporary power to data centers. That's a hard asset that we can get our hands around. We have the ability to reposition those assets to other use cases that are outside of AI. So I think from our perspective, that's a better way for us to play this investment than compete with the firms that are focused on writing these multi-billion-dollar checks into the data center space.
Well, Jack, just on that, is you don't want to compete because of the size of it, or there's just too much risk in there?
Well, I think it's a combination from our perspective. Those are massive checks. And so I think you really have to have a lot of conviction. And to compete, you have to have a lot of capital. And so, we like to focus on areas where we can have an edge. And I don't think we necessarily have an edge to compete in these big data center projects. And again, I also think when we look out at the spectrum, it's tougher for us to have the conviction that, we know what these assets are going to be worth 5 or 10 years in the future. And so we'd rather invest in other types of services or assets that we have a better picture on the long-term visibility of values.
Well, let's talk about where that edge is. And Drew, Fortress has a history of being very active in the regional banking space. In the summer, you gave an interview where you said there's going to be an opportunity set in private credit because of the gaps that exist with small and regional banks. I wonder, does that sort of hint at a dislocation that still exists within the regional banks, that there are still some cracks there that maybe the rest of this market doesn't fully appreciate?
Sure. Look, I think if you look at the growth in private credit over the past 10 years, a big part of that growth hasn't necessarily been the overall credit pie growing. It's been what we now call private credit and capital from private equity firms, filling the void that both investment banks post-financial crisis and regional banks have left. As you've seen regional banks pull back, I think we've seen that opportunity really since 2023 when you saw the regional banks pull back post-Silicon Valley, Signature Bank, First Republic. You saw a lot of banks reassess their liquidity requirements, reassess their duration, and that's where we've seen a big opportunity in private credit, and for us specifically in the asset-based credit space, where we've been quite active. We've had a business going back to 2002, but really in the past, call it 2 years, we've really seen that opportunity set expand, and that opportunity set has expanded not by us doing anything different, but by regional banks deciding they want to pull back or need to pull back because of some of their own liquidity issues around the fractional banking system.
Well, Joe, one of the reasons I ask, and I understand that, but one of the reasons I ask is also because we were just hearing from Mark Rowan speaking to Bloomberg about these late cycle dynamics where they're, in his words, good banks and bad banks. There have been some very high-profile blow-ups when it comes to things like Tricolor and other investments. Again, that's been both in private credit and the banking system. You have so much experience in some more of these distressed assets. Drew, for your has the list of stressed assets, the watch list, has it been ticking up recently?
Look, I think both Mark and Jamie Dimon can both be right. I do think credit events like Tricolor and First Brands are showing signs of some folks and some competitors that are probably getting out ahead of themselves and aren't doing the proper amount of diligence in researching their investments and structuring their investments. And I think, just like Mark said, there's going to be good asset managers and bad asset managers. One of the things that we've said for a long time in the credit space and the private credit space is it's going to be hard to tell who's doing a good job when defaults are very low, right? Because the reality is in credit, if you get paid your coupon, you're going to perform as expected. And so I think if you look back, and really private credit as a distinct asset class came about post-financial crisis, we've been investing in private credit going back all the way to 2002 when we founded the credit business at Fortress. But it's really hard to differentiate yourself when there's no defaults. I think when you start to have some defaults, you start to have just a normal credit cycle, a normal investment cycle, economic cycle, you're going to start to see variance in returns. And from our perspective, we've always invested deeply in the asset management part of the business, which means taking care of those assets if you start to have the watch list. And so as we look forward, I do think you're likely to have a little more volatility, right? The economies, I think there's a lot more uncertainty around the economy. There's a lot more uncertainty around interest rates, geopolitics. That's going to lead to potential defaults. The good part about credit, if you structure it right, is you don't have to lose money if you have a default, if you've got a well-structured loan. And so from our perspective, we actually believe this is an opportunity for us to really outperform and start to differentiate from a performance perspective.
Jack, I'd love your take on this because you have a career history in focusing on bankruptcy, restructuring, litigation. Is now the time to focus in and brush up on all the restructuring skills needed?
Well, I think the restructuring world has changed a lot. When you go back and you look at the world of distressed debt that some of us grew up in the aughts and great financial crisis, that was a world in which, you had a bunch of groups of lenders trying to work out restructurings inside of the context of the bankruptcy courts. I think in today's world, you're seeing a lot more emphasis on out-of-court restructurings and liability management exercises. And so I think when you look at what the default rates actually are, there's a question of what you're including in those default rate calculations.
Yeah.
But I mean, I agree with Drew. I think that, ultimately, asset management here is going to be a key differentiator. Firms that are able to take agent positions or control the loans that they're involved in, that are able to have financial covenants that give them early warning signs and the ability to negotiate, amendments early in the process are going to be the ones that are best positioned. And to the extent you're inside of a bankruptcy, I think it's
Jack,
going to be focused on your
Drew, just because we only have a minute and we have to address this, the fact that if we had been doing this conversation a month and a half ago, it would have looked very differently with the tragic passing of your colleague and former co-CEO, Josh Pack. Drew, again, just a minute here, but I would love to get a feeling from you, just the legacy he leaves behind.
look, Josh and I had worked together since I joined Fortress in 2004. The first investment I made in Fortress was alongside Josh in the bank debt of Krispy Kreme donuts. I think one of the things as we've had to take a step back and reflect on just what Josh meant, not just to the firm, but to each of us personally, it's actually been, I think we've all drawn some strength and some inspiration around what we want to do together to help realize that legacy. Josh, what I said to folks is, I know a few things. Josh loved his family and he loved Fortress. And so the best thing we can do is do our best for his family, but also do our best for Fortress to help build that in his legacy and his vision.
Thank you both so much. That is Jack Newman and Drew McKnight of Fortress.
NYK's sustainability efforts have produced a breakthrough. The tugboat Sakigake is the world's first ammonia-powered vessel in commercial use.
LNG can decrease emission of the carbon dioxide compared with the heavy fuel oil, the 25% more or less. But ammonia, 95% decrease can be achieved.
According to Bloomberg NEF, ships powered by LNG and other alternative fuels make up nearly 40% of the global shipping order book.
This is funded by the NEDO, so-called Japan agency. And also the NEDO has the kind of the GI funds and the Green Innovation Funds. And also the Japanese government is supporting the usage of the ammonia as the power-generating fuel.
It's more expensive than normal standard fuels.
Yes, it is. And at this moment, the supply of the ammonia volume is very much limited compared with the LNG and also the heavy fuel oil. But in order to promote ammonia as a marine fuel, together with the other industry players, and we can have the kind of the mass production, then the cost will be decreased. Then the next 10 years, we try to increase the number of the vessels powered by the ammonia.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
We are moments away from the start of trading on NVIDIA Day. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures. Really little changed here after 4 days of drops on the S&P. NASDAQ futures also not moving much, nor are Russell futures. We've got, quite fittingly, an AI infrastructure acquisition SPAC ringing the opening bell on the NYSE, and this I think really focuses the mind on the question the market is asking: is all of this CapEx going to be rewarded with return on investment? You got big brothers, big sisters ringing the bell down at the NASDAQ market site. Fun day, fun activity for them, and a really great charity to participate in or to give to. Danny, in terms of the stocks that we're watching, I guess one stands out front and center.
Yeah, it's going to stand out throughout the day. If it ends the post-market session this way, I mean, it will be impossible to know. But NVIDIA at the moment is up 1.4%. I mean, look, the direction of this monster stock will dictate the direction of the entire market when it reports after the bell today. Options imply a move of 7% in either direction, which is about $300 billion in market cap. So we could add that, we could take away from that. But from its peak in October, Matt, NVIDIA is already down 12.5%.
All right, we are also focused, though obviously less so, on retailers. Target is the latest retailer to narrow its profit forecast as consumers get picky. Target cited discounts as well as softer demand for the revisions. Those shares are down 2.4%, but NVIDIA is obviously the most important company to watch in this market, the biggest company in the history of the universe. And joining us from San Francisco is a man who knows this company well, Bloomberg Tech co-host Ed Ludlow. Ed, you're going to sit down with Jensen Huang for an exclusive interview after the earnings this evening. What do we need to get set up for the results?
Yeah, there are very high expectations. You know, at a minimum for NVIDIA to move the needle, they'd probably have to far exceed consensus, which is more than 50% revenue growth, more than 50% net income growth. And then a lot of focus will be put on the forecast for the fiscal fourth quarter. But, you know, the calculus for NVIDIA is quite simple. You know, 40% of their customer base is the hyperscalers plus Meta. And collectively, they are forecasting CapEx growth beyond 30%. And it simply comes down to, for many investors and the industry writ large, is that CapEx forecast right? And does Jensen Huang signal any sense that actually they won't go through with it? Loads of questions: depreciation of older chips, the circular financing thing, and bigger picture, longer term, electricity. Is it there or is it not? But it's a very high bar, and there is, as you guys know, increasing skepticism around the revenue generation of those that use GPUs from NVIDIA to train models and the software side, but also, you know, valuations right now more broadly.
Ed, and you're, of course, going to be sitting down with the man himself, Jensen Huang, at 6:30 tonight. You mentioned some of the big questions outstanding for the company itself. What is your top priority in your conversation with Jensen Huang? What will you be asking the man?
Yeah, I think that depreciation is very top of mind for a lot of people at the moment. But long story short, NVIDIA commits every year to having a brand new generation of GPU. And there is a high concentration of customers that have millions and millions of now obsolete GPUs running in data centers that are pending being swapped out for the latest cutting edge chip. And there are two ways of looking at it. You can either say, well, those older chips are running at 100% utilization, and so just swapping them out is a good thing. But you then have to look at the balance sheet of those companies that bought the older chips and how they are working that out mathematically if they are to be depreciated. And then, yeah, I kind of mentioned it before, but Jensen Huang really has a lot of confidence about the staying power of this infrastructure build out. But he only controls one side of the supply chain. There are lots of questions about whether they see material ability for this country, in particular the United States, to supply electricity or the energy that's needed. So that will be a big part of the conversation.
All right, Ed, great to get some time with you, and really look forward to both your program at 11 a.m. Ed, of course, co-hosts Bloomberg Tech with Caroline Hyde, and he will, as I said, sit down exclusively with the CEO of NVIDIA, Jensen Huang, live at 6:30 p.m. Wall Street time. So tune in for that. You can hear it on Bloomberg Radio. You can watch it on Bloomberg.com. Business leaders are raising red flags around tech valuations as investors better understand the economics around AI. Here's Algebra's CEO, Davide Serra.
If we're not going to find $2 trillion of revenue to justify the AI revolution, which I think is impossible by 2030, given the level of public debt around the world and where taxes need to go to pay for this debt, the likelihood is we're going to have a significant correction.
Joining us around the desk is Morgan Stanley Senior Portfolio Manager Andrew Sliman. He sees the current volatility as classic late cycle behavior. So first of all, it's great to have you here in the studio.
Thank you.
We're typically down the line with you. So, when you say late cycle volatility, that makes me think we're nearing the end of possibly a bubble. Is that how you see it as well?
Yeah, the question is, the late cycle can last 4 or 5 years, or it can last like in 2021 for 1 year. And so I would argue that all this skepticism about this big technological revolution we're having is good news, because it's keeping the valuation, it's keeping the bubble down in these stocks. Now, off the low of April, what I saw was the best thing to invest in were not the hyperscalers, it was the money-losing tech stocks. That did the best until about 3 weeks ago, and that's kind of started to deflate. So I would argue that this, as I said before, this level of skepticism, it's good news. It's keeping too much, it's keeping the valuation down.
There's like a good meme about this of someone with a bloodied up shirt, and like the strategist is saying, no, the correction's good for you. You're feeling pain, but it's a healthy thing.
Well, that's true, because think about it. In 2021, the bubble grew so quickly, so fast, that when it burst and those SPAC meme stocks came down a lot, it really hurt the market a lot. So I'd rather keep it down.
So we have seen 4 of the Mag 7 stocks underperform the S&P 500 this year, which I had to double check that when I saw it in Dan Curtis's note this morning. Do you buy those stocks?
Well, the stocks have underperformed, but the earnings haven't. They've all beaten, right? So that means the valuations have come down. So if you liked them at the beginning of the year, you must really like them now because the valuation's lower, right? But I go back to, if you listen to third quarter earnings report, what I heard these companies say is, we can't keep up with demand. We can't keep up with demand. This is very different than the year 2000 when, the demand for routers was slowing and the telecom companies were saying, we've got a lot of dark fiber we're not going to turn on, right? This is a very different environment. I think it's early cycle in the AI. It doesn't mean it's early cycle for investors. The market bottomed in 2022. We're 4th year of a bull market. It's late cycle.
Andrew, one of the things I do know that you are worried about, that you've been writing about, is the dynamics that are going to start early next year. When you have a Fed embarking on their cutting cycle, at the same time, we're going to get checks handed out and tax refunds from the one beautiful bill or tariff refunds, what have you. Stimmies
right,
for everybody.
2021.
The Oprah economy, you get a check, you get a check. What is your concern about how that could play out?
Too much liquidity and too much. Didn't we learn that in 2021? Everyone got liquidity. What they did, they traded stocks, and so it inflated the bubble. And so I think if the Fed were actually to go slowly, I think one of the reasons why you've seen some of the deflation and some of this bubble come down in some of these very speculative stocks is the chance the Fed may not cut in December. I'm not a Fed expert, but I would argue that's good. That keeps it, keeps the, kind of the speculation down.
What do you like that's divorced from the whole AI trade? I mean, we're talking today about retail earnings because they're concerning, so I imagine that it's not that.
That ain't that.
Yeah. But is there, healthcare, I realize, for example, there's an AI play there, but it's a separate thing, and a lot of people are very bullish healthcare.
I'm not.
No.
I'm not, because I think it's very hard. You have to get 2 things right that are really hard. One, you got to get the drug right, and then you have to get what happens politically in Washington, D.C. about pricing right. And I think that's very, very hard, someone that's been in this business a long time. I would say if you listen to banks, like the banks all had great numbers. Follow the numbers. The banks blew out. Why? More capital to invest. I think that's the other really big opportunity. Could that be correlated? Well, maybe, but to me, the big banks and the loosening of capital, I think it's a great other story.
And look,
that's happening outside the U.S. also.
I don't want to. I'm going to ask this question. I don't mean to say that big banks are now an AI trade, but there is this feeling where there's a great story in the Bloomberg today that big banks are writing a lot of these AI checks for financing just because their sheer size, they're allowed to do it. But it's funny because Matt asked, okay, what besides AI do you like? Is there not a concern that just so much is correlated right now, that it's like utilities is AI, infrastructure is,
100%.
that it's even hard to answer Matt's question because so many things are connected?
I have a very simple way you're going to find that out. Go back and look how your stock did the day DeepSeek came out. Because the day DeepSeek came out, some of those utilities, that were not sectorally in the technology area, they went down a lot. And some of those industrials went down a lot. So it's a great way to measure what truly your correlation. But I think you've nailed it. I think that's a big risk. Everyone thinks they're sectorially diversified, and they're not so much because they're really playing the AI trade. And I think emotionally, investors go, well, I missed the well-known trade, so now I'm going to find something tangential. but what we learn in DeepSeek is they're all correlated.
Also, I mean, it is a great story by Hannah Levitt and co. on the banks, talking about how much they stepped up with to underwrite the acquisition of Skechers, $8 billion. Warner Brothers Discovery, that split $17.5 billion. Electric Arts, $20 billion, a check from JP Morgan alone for $20 billion. None of those are really AI,
No, it's true.
right? So it's a play on the real economy.
And trading also. Capital has been freed up for more trading, and I think some of these big banks made better profits in trading.
So there's more capital freed up because of deregulation, right? More liquidity in the system, and that's going to play out at least for the rest of this administration's term.
Correct.
How
and these
else?
stocks trade at 30% discounts to the S&P.
So how else do you play that? I mean, the money flooding in, because it's not great news for inflation, right?
Correct.
Yeah.
Goes back to the original. That's absolutely right. But I think it's the money center. I'm concerned the alternative. If you watch the alternative stocks, you know,
you mean the alts, like private equity, private credit?
That index is not doing well.
Really poorly.
So is that a credit problem, or is that there's going to be more competition in your world? I think it's the latter.
Jamie Dimon would be very happy to hear you say that. Andrew, thank you so much for joining us this morning. Please come in again soon. That's Morgan Stanley's Andrew Sliman. All right, let's get a check on your equity market this morning. I guess we're all just bracing for NVIDIA earnings, but we are higher by 1/3% after consecutive days of declines. Breath is not good, though. Feels like it tends to be the case for these up days. 193 stocks up, 307 are down. NVIDIA is what's leading us higher, 2% higher after on track for a tough month. By the way, it's going to be the first time since ChatGPT was announced at the past 30 days heading into an earnings call that we've seen NVIDIA decline. That's according to Deutsche Bank. On the downside, it's other tech players, Amazon, Meta, Microsoft, Exxon. A bad day for energy today. If you look at what the sectors are doing, energy is faring the worst out of all of them. I promise you that will be coming up shortly, that we have energy doing poorly. In the meantime, Netflix, Berkshire, there we go. I knew it was there. Actually, it has apparently flipped.
Yeah, it's
Actually, I don't think this is it, Matt, because it says we're currently down 0.8%. If we can get a little refresh there, and we're currently up on the stock market. So maybe don't believe anything you're currently looking at, and I will leave it there, Matt.
That's interesting.
Right, this isn't it, right? We're up currently.
Well, I'm looking, I got to do SPX L1 index GRR go.
Yeah.
And yeah, you're right. That's wrong.
Yeah.
Whatever you're looking at there is wrong.
Don't look at this. Don't look at that. Matt, take it away.
I don't think it was typed in correctly, because I do see energy as the biggest loser by far, gapping more than 2% down, and the big gainer up more than 2% is communication services, which is what we call the hyperscalers. We'll sort that out behind the scenes. When we come back, TMX Group is stepping up its U.S. Footprint with a new Manhattan office. We're talking about the Toronto Stock Exchange. CEO John McKenzie joins us next to talk about the expansion and whether prediction markets could be the next big frontier for exchanges. This is Bloomberg Open Interest.
We have two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Let's look at some top calls, the analyst action that we are following. First up, Molson Coors. They get downgraded at Wells Fargo, where the analyst says that the brewer is facing weak category trends and share losses. Meanwhile, rival Anheuser-Busch offers strong growth potential into 2026. Those shares down more than 1%. Next up, Jefferies, they upgrade DoorDash. They say the company's annual forecast has reset expectations. It had its biggest drop ever after it reported earnings earlier this month. They say that it still has room to invest and beat estimates. They cited faster growth in restaurant delivery and calls DoorDash strong execution underappreciated after the recent sell-off. That not helping shares this morning, down 2%. Finally, Wall Street is weighing in on Amer Sports after it raised guidance for the third time this year. Truist and Evercore ISI called the update a confidence boost following recent sentiment drag. Citi called them a standout retailer, and Nomura raised their rating to a buy because, Matt, everyone owns those Solomon shoes that they sell. Like all the West Village girlies are wearing their little hiking shoes every day out there in the wild.
Do they make Wilson tennis rackets also?
And yeah, the clothes. So okay, yeah, I support this company also.
Yeah, I thought you might use those on occasion.
Correct. You have called me out, actually.
Let's get to the Toronto Stock Exchange, planning deeper roots in the U.S. as we were talking about before the break. TMX Group just opened a new office here in Manhattan as part of a bigger push to grow its footprint beyond Canada. The CEO, John McKenzie, joins us at the table to talk about the company's growth. So, John, you know, it's interesting at a time when there are growing divisions, at least in the capitals, between the U.S. and the Great White North. You're pushing further into the South.
I mean, we've been doing this for years, so we weren't going to stop just because there's any changes in administration. The Canadian and the U.S. capital markets, you know this, are the most integrated markets in the world. And so for us to keep growing globally, U.S. is a natural point to that. And we've got ambition to keep growing the firm. We've been growing it on what we call our 2X, TM2X strategy. We've almost doubled the firm in the last 5 years. And that means really investing in core markets like the U.S. and Europe, because that's going to be where we're going to get the larger expansion. So we're now more than 50% of TMX is outside of Canada, even though we've got that strong Canadian footprint.
I believe the first ETFs in the world were in Toronto, right?
Invented on the Toronto Stock Exchange over 35 years ago.
Yeah.
By the way, I love in the video of your office, we saw some pretty cool snacks. I think that's important for opening up any office. So you're talking about this immense amount of opportunity in the U.S., but in some ways it's a double-edged sword because these capital markets in formation here in the U.S. are saturated. There's mature. So where is there a gap?
That's such a good question. And part of that gap is we've actually been doing this for 173 years as well. So we've got deep innovation, expertise. You mentioned it. We invented the ETF in Toronto. The first fixed income ETF happened in Toronto 25 years ago. So there was natural things that we could bring to the U.S. market. And when 2 years ago, I was down here in New York. I was able to put our entire business team around a dinner table of 8. Now we have over 200 people in the U.S. across multiple business lines supporting energy, indices, as we talked about, ETF support, new data operations that we brought in this year. We launched a new trading market this year, very much focused on capabilities we built in Canada that we saw an unmet need for here. So everything we're doing is based on where we believe we've got capabilities that add value to the clients, not just to be another player.
One of the things that you might have to imitate rather than innovate is prediction markets. ICE is buying one, and it seems to be like the hottest new thing. Are you looking to get into prediction markets? And then where do you draw the line between, finance and sports betting?
And that's the real question, and that's the regulatory question on this as well, in terms of what is investing and what is gambling. At the end of the day, we believe our client base is to serve the brokers, the dealers, the asset managers that go out to the retail investors. Our retail side is more about investor education, information, content, helping them understand investment options. So for us right now, we don't see us being kind of first mover in that space. But there's a lot of trends like that that our team's got to make sure we're up to date on. Not just prediction markets. We need to be ready for 24/7 if the U.S. market moves. We need to be ready for tokenization if there's a greater interest in tokenizing, equity assets. So all those are on the table in terms of investing to make sure we're ready. But it's unclear in all these where the real demand's going to be in the investment market in terms of the real money demand.
When, again, something like a prediction market, though, because it feels a little bit like the Wild West at the moment, do you think that this is, and people are calling it an asset class, I mean, Cliff asked us if AQR was in the building talking with Odd Lot, saying that they're going to start maybe trading sports prediction markets. Does it make sense, though, for you to say, okay, this should be under a roof where we have the expertise and we can deliver it versus like a poly market or whatever sort of else off-exchange thing that exists that maybe has a little bit more risk within it?
Yeah, if you think about that crossover, and it's not just those markets, you've got other markets that are looking to provide not just predictive pieces, but stepping into other tokens on equities, things like that. If they're going to move into the investment space, why wouldn't we expect that everything we've built around investor protection, liquidity enhancements, separation of assets, why wouldn't that apply there? Would we want that same protection? So I do think that there is an element that there's a blow up waiting to happen on some of these. That's going to put shine a light on it, and we're going to look to, okay, how do we bring the same kind of scrutiny to this, just like we brought to crypto markets a couple of years ago?
By the way, just quickly, about 45 seconds. Are you staffing up with ETFs? There's been a divergence with some of the exchanges on whether they're adding or subtracting.
We are adding. So ETFs, both in the index building to create indices for ETFs, but also the support of ETFs in the Toronto Stock Exchange. This year, we've already listed over 200 new ETFs. So this is absolutely a place we're investing in Canada, in the U.S., and also in Europe as well to help build out the European market.
John, this is great. Thanks for stopping by on your trip through New York. That is TMX Group CEO John McKenzie. Now, coming up in the next hour, MFS Investment Management Ted Maloney on his firm's focus on public markets over private markets. You're watching Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China? When they wanted to poke holes in the relevance of something. Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on stocks. We are, I guess, 6 hours away from NVIDIA earnings. S&P 500 doing quite well, up 0.7%, although it's the first up day in 5. The NASDAQ gaining more than 1%. On bets that NVIDIA may do well, that stock itself is up more than 3%. And we see Alphabet shares also gaining right now 6%. So tech doing well. In terms of retail, we've had a ton of earnings. Target, Lowe's, TJ Maxx, and Williams-Sonoma all out. You can see those moves as well. Coming up in the next hour, JP Morgan's Gabriela Santos shares her outlook for 2026.
People today are not as happy as their parents were. That's in part because of social media and things like that makes people isolated.
So it's a complicated thing, but there's basically a climate and weather problem that we find, and I don't mean that literally. The climate of happiness is all about faith and philosophy in life, about family life, about friendship, and about seeing your life as a calling, your work as a calling that is meaningful and serves other people. And all of those have been in a decline. That's the climate of happiness has been ticking down since about 1990. Then the weather, the hurricanes in happiness have been really threefold. Number one was the advent of social media and screens in everybody's lives in 2008, 2009, 2010, which has just raised absolute havoc in the brains of everybody under 35 years old. That's what my new mini book is about how we use our brains differently, and it's vacating the parts of our brain that we need to assess questions of meaning. The second is polarization, where baby boomers have tried to conscript young adults into their culture war, particularly on campuses. You should feel aggrieved. You're a victim. Everybody's trying to ruin the world. You need to be angry and afraid. And last but not least, of course, is what happened with the really misbegotten reaction to the coronavirus epidemic, which is to send everybody home, make sure that people don't interact socially, and that was catastrophic for happiness.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Caroline Connon in Paris, and this is Bloomberg.
There's still work to be done.
Do you think after all the negotiations, the trade deals, and adjustment in the tariff schedule,
we might be converging to your algorithm in the first Trump administration?
No, I think that what we'll be converging to is something like a border-adjusted business cash flow tax, because we, in the big beautiful bill, one of the things we did is we expanded the various export subsidies for multinationals, and so if you have this is inside baseball math, but if you have an export subsidy plus a tariff plus a payroll tax, then you basically have a border-adjusted business cash flow tax. And so I think that in equilibrium, what we're seeing is that we're getting lots of revenue. It's a few $100 billion already this year, and it's not causing a lot of harm. GDP now is at 4%. Inflation has been trending slightly down. And so I think that it's working the way it would if it were a border-adjusted business cash flow tax.
And what have you learned about optimal, how tariff fits in this optimal tariff as well as optimal fiscal policy?
I think that there's a race to produce in the U.S. to avoid tariffs that is very beneficial for U.S. workers. And if you look at capital spending year over year, we're having one of the best years ever, and that's even before we go through the trillions of promises that we've made in the trade deals. And so there's that, which is the sort of capital spending effect. That was somewhat of a surprise to me how big it was, because I again thought that what you might see is like price adjustments and so on by the inelastic suppliers, and then the consumers wouldn't really see much of a price increase. But I think one of the things we're seeing is a massive onshoring of activity, unlike anything I've ever seen. So I think that it's really been a very net positive policy, despite what sort of conventional economics has been teaching us since we went back to the textbooks when I was in grad school.
Okay, so I think in Wall Street, most of the firms, many of the firms have come up with this cost burden of tariff composition of around 5%. Exporters cuts, discounts, 70%, 60 to 70% absorbed by domestic firms, and the rest, 20 to 30% with the tariff showing up in consumer prices. Do you disagree with that sort of breakdown, or?
Well, I think it will depend on, it's a product-by-product kind of analysis, and I think that it's still work in progress to figure out what the final story is. But again, we've got high growth and no pickup in inflation. I think that the Wall Street folks, or a lot of Wall Street folks who I respect and read, in the spring were saying that we're going to have stagflation, that we're going to have 4 or 5% inflation because of the tariffs and no growth. And so I think that allocating like the current state of the economy and the impact of tariffs on it, from people who told us that we'd have a recession with high inflation with those models is probably not the best thing to do.
Yes, certainly Wall Street have been caught wrong on their forecast of an inflation surge, which did not happen. In fact, I remember, I think, the consensus upon Liberation Day, everybody revised up the core PC inflation to well over 3%, even some closer to 4%. And now we are on track to hit 2.9 or 3% at the end of this year. So for sure, the consensus has been wrong on that. So recently there's a viral San Francisco Fed paper that looked at 100 years of history of tariffs, and they found the net effect of tariff tend to be deflationary. However, they also found that because it's deflationary, because it as an aggregate demand shock more so than a supply shock, and hence ultimately it raised the unemployment rate. And so far this year, when we began the year, the consensus on Wall Street is 4.1% unemployment rate. Currently, it looks as if we are heading to 4.3 to 4.4 at the end of this year. How much do you think of this slower hiring and increase in unemployment rate as attributable to trade policy, or what other policies?
Well, I think it's actually quite a mistake to look at 100 years of history to learn about today's situation. To do that, you're making an underlying assumption of what econometricians call ergodicity, the idea that the data generating process is the same over time, so that you can identify it in this period and then use your knowledge to think about the next period. I think that, 100 years ago, if you wanted to move production from one place to another, it was like almost impossible. You'd have to like get it on the Queen Mary or something and move it around. And now it's really, really easy. If 100 years ago, I guess we didn't have a telephone, or maybe we just started to have a telephone. But now we've got the internet, and we've got AI helping us decide how to move stuff around. We've got a capital spending boom that would have been impossible 100 years ago. And so I don't think that, I don't think that history in this case is going to be that useful, because it's clearly a point where the assumption of ergodicity is not going to apply. And so we're seeing, massive movements. You've seen the big drug companies, every movements of production to the U.S. that will benefit U.S. consumers, and especially U.S. workers. We're seeing real wages already this year going up, recovering maybe about a third of the ground that we lost under Joe Biden with the high inflation. And I think that those real wages are going up because we're getting a lot of onshoring. It's not just because of the big, beautiful bills tax cuts, but also because of the onshoring from the tariffs.
That conclusion is not just from that paper based on 100 years of history. Actually, back in 2018, when we look at the historical FOMC presentations, there was a staff presentation that used the internal workhorse model of the Fed, the Sigma model. I don't know if you're familiar with that, to evaluate your tariff algorithm back in 2018. Suppose there's 15% tariff on intermediate goods only and 15% on consumption goods only, and that model found that if you impose tariffs on intermediate goods, it is also over time deflationary, and it boosts the unemployment rate by a little bit. In which case, how would you explain then the unemployment rate increasing from earlier this year, 4.1 to 4.3 or 4.4% later this year? What are the drivers?
Yeah, I mean, it's such a small movement that it's hard to say exactly. But I would say that one of the interesting puzzles is that, first we're having a productivity boom that is really unprecedented in the following sense, that when I worked with Alan Greenspan back in the 90s, it was just at the dawn of the computer age, really. And they didn't even have Netscape Navigator when I first started working at the Fed, and so you had to use something called Gopher. I don't know if you're old enough to remember this, which really wasn't that good. And Greenspan had an intuition that the computer was going to revolutionize the economy and give us lots of growth. It was a big positive supply shock. And so then when the unemployment rate actually kind of went down, we had no evidence of the productivity. Remember, Robert Gordon was saying it's everywhere but in the data. But Greenspan decided not to hike rates because he believed that we were in the midst of a positive supply shock that was perhaps unprecedented. And we had a kind of 5-year run that's one of the best 5-year runs we've ever seen, even all the way to the point where the U.S. Fiscal situation was in surplus. And so I think that it's one of the great moves of Federal Reserve history that Greenspan saw, that it was a positive supply shock that would be both pro-growth and deflationary.
Yes, I have a...
You have more stuff about that, don't you?
Yes.
Okay, but I say that to reference today. It's really interesting that there's like evidence in peer-reviewed papers, or not quite peer-reviewed yet, but at NBER, which is kind of a lot of my friends at NBER, by the way, this is a secret of NBER authors like myself, is that you'll very often take a paper and submit it to a journal and get the referee reports before you put it into the NBER working paper series, because if you got some stupid mistake, the referees will catch it. You don't want to embarrass yourself in front of everybody by just throwing it out there. And so actually NBER is kind of almost peer-reviewed, but there's a lot of stuff showing big AEI gains. And the thing is that we also see it in productivity. And so if you think about the difference between, say, 1996 and today, is that we've got this revolutionary new thing that probably is going to be a big positive for productivity. And Steve Olner and Dan Sickle, your former colleagues at the Fed, had a famous paper that you only see productivity booms after the benchmark revision, right? So you never actually experience it while it's happening in the data. And this AI boom is significant enough that we're already seeing it in the data probably the benchmark revision is going to revise it up. And against that backdrop, I think that the open question is how do we have high growth and then less growth in employment than we expected? I think that the tariff could be part of the story, but I think that probably is a very small part of the story.
Yeah, I mean, when we looked at the earning transcripts from this third quarter and where so far the earnings have been surprisingly positive.
In fact, it was like the best quarter ever.
So we use AI to extract some of the themes, and we did find that one of the dominant theme is that there are other stuff happening outside the trade policy that's helping offset a lot of this tariff bill. So, but focus. Yeah.
I don't mean to cut you off, but I just want to highlight how important what you just said is. And the way to think about it is that trade is about 15% of the economy, and the rest of it's like 85% of the economy. And so you could do a lot of stuff in trade that has effects on the trade space that is completely overwhelmed by the 85%. And 85% of the economy is getting this massive productivity change. And it'd be hard for a large change to 85% to not overwhelm something you did to the 15%.
Yet at the same time, 66% of the economy is labor share, and a lot of academic studies are also looking into whether AI is already causing low hiring rate among young graduates. Whoever is graduating from college this year is probably in for a bad deal. I think there is a puzzle out there, which is if you have GDP growing at 3 or 4%, at the same time you have a lot of a sense of job insecurity in this labor market, and the labor market is lagging these other the GDP growth indicators, and the question is, can this GDP growth be sustained at this 3 or 4% while the labor market is going sideways, basically, with labor share probably going down, probably because of productivity gains in the future.
It could be that. And also, don't forget that there's been a big reduction in illegal immigration and employment from that aspect. And so the population growth is pretty low compared to what it was when we had tens of millions of people crossing the border. And so the break-even jobs number for the payroll survey people think is down like quite a bit, to maybe around 40 or 50,000.
Yeah, between
right?
30 to 60,000.
Oh, well, I was 40, 50, you were 30, 60.
Yeah.
I think we're about the same range, right? and so that's like another thing that we could have big increases in productivity and big increases in output, and a healthy labor market with job numbers like the one that you forecasted, and we'll see whether you're right or not.
So 54 sounds good to you.
I'm saying that
it's not 100.
That's enough to sort of keep up with population. You'd want stronger growth than that and unemployment to go down, but the unemployment rate's a little higher than what's probably the equilibrium unemployment rate in a full employment economy, but not a whole lot.
So Kevin, going back to this productivity boom, I recently tweeted a couple pictures that seems to suggest some emergent micro evidence of how AI is boosting business formations, and St. Louis Fed also has a piece out showing how AI adoption is correlated to rise in sector-specific unemployment. So, just evidence that AI is working through at the micro level. But then the response I got made me realize that it is actually a really polarizing topic. With if you survey a lot of people, half of them probably say AI is a bubble. Half of them would say that there's no evidence that there's a productivity boom yet, that productivity is still on trend, and the improvement reflect more of a cyclical thing that happened post-pandemic as opposed to this sustained AI-driven productivity. So we are going to touch on you being one of the leading candidates for Fed chair, and going back to that 1995, 1996, those two critical years at the Fed, You mentioned that Alan Greenspan was really the only one of the few who saw evidence of productivity boom. And I reread the historical transcripts in December 1995, that particular FOMC meeting where half or more of the FOMC were agitating for holding rates constant, and in 1996, many of them wanted rate hikes. And somehow Greenspan was able to convince these skeptics that something is afoot without the data to support that.
Let me talk about this, because there's an interesting anecdote that I don't think has ever been made public about this. So because computers were improving so quickly, then it was decided by the Bureau of Economic Analysis, a lot of great professionals over there, that they needed to what we call hedonically adjust the computer price, which meant that if you had a computer chip that was twice as fast as the one from last year and it costs the same, then that's like a big reduction in the price of computing. And so that in a typical year, right around when we were starting to have to make the judgment on this, the computer price was dropping at about like 16 to 20% at an annual rate, and there was so much computer investment that real GDP was getting a real big kick from the fact that the deflator for computers was dropping so much.
Yes.
So I was in charge of that part of the world for the staff. I spoke a lot to Greenspan, and he said to me once, how do they deflate communications equipment? Because communications equipment is basically like computers now. And went back and looked, and communications equipment, rather than dropping 15 or 20% a year, was going up like 2 or 3% a year. And so then I called over, because they're actually very open about, like the technical people at BA.
Right.
And I talked to them about, well, why is that? And they say, well, that we use, when we're making our deflators, we use something called a match model approach.
Yes.
So if something, we sold it yesterday and we're selling it today, then that's like, we look at the price change for that, and that's where we get our deflator. And we don't change the bundle of things that we use the match model approach for very often. And it turns out that there was at that point a lot of communications equipment produced in the US for developing countries that were kind of like really old-fashioned analog things where you got like Josephine moving the wires and stuff to connect the phone calls. And since we had this really old equipment that we were exporting to developing countries, they were using the price of that to deflate communications equipment. It sounds like a very technical matter, but then Chairman Greenspan said, well, Kevin, what if we deflate communications equipment with a computer deflator? And instead, like, how much more would GDP be going up? And it was like about 1.5% because of that. And so he was kind of like, yeah, we're really growing way more than we think. We've got a serious measurement problem. And then if you extrapolate from that, then if you were hedonically adjusting everything that gets like a computer to make it better, then you're putting like a deflationary force into the economy that's not being measured. And so I think that it could be that the communications story was a key moment where, you know, everybody at the board had I can understand why Alan is so convinced about this.
So I was going to ask you, it's interesting, you were in the price and wages section?
No, I was the business fixed investment person.
Oh, okay.
At economic activity.
Oh, I see. And what other sections were you, or have you?
No, that's the only one.
Wow, you're very well placed for that.
Well, that was my area, right? Is capital spending and taxes and business investment.
He did mention in the transcripts the rapid deceleration in the prices of high-tech prices. Mm-hmm. But I mean, Greenspan is the pioneer of alternative data. He used men's underwear sales for a recession.
The weight of GDP.
Right.
Remember that?
Yes. Lipsticks.
People who had to calculate the weight of GDP. I'm not kidding.
Oh wow. So I mean, he's a chairman who's really in the weeds in the data, and very creative as well. But let's not underestimate the challenges he faced on the committee, where half of the committee was against this. How did you did you have any insight then on how he was able to, well, first of all, how was he able to win over the Fed staff, Fed staff is very influential. Back then, you have the Green Book and the Blue Book now.
I used to write the Green Book twice a year.
Yes, and do you know what color is the book now?
Is it the
teal book?
Teal book. Why did they do that?
To mix the green and the blue together. That gets you teal. I mean,
that's probably where all their problems began.
So you know, it was true in 1995, 1996, whenever the staff presents the data, because you know at the Fed, the bar to argue that something is a structural change is very high, because you will agree that the quality of the Fed staff is very high, and you know, some of the smartest people I know. And so for 2 years, even up to 1997, in the transcript, they were talking about no evidence of productivity increase. Only once they have the revisions did it show that, in fact, in 1995, productivity was running at 2.5 or 3 as opposed to 1 point something. But how did the interaction between the chairman and the Fed staff, how did the chairman convince the Fed staff to go on? Like, what was it like? Was the chairman directing the research and statistics division, here, look for these signs of productivity?
No, I think that there was just an excellent, so the people who were there working with me at that time, the person who was doing consumption, there were two of them. It was Karen Dinan, who's now a Harvard professor, and Chris Carroll, who's now at Johns Hopkins, two of the top consumption analysts like over the last 40 years. The people doing business fixed investment were me and Steve Olner. Let's see, prices, that was, what's his name? Actually, I forget the guy's name that was doing prices, but then we had Steve Braun, who's now at the CDA, who was putting GDP together. But I think that the really big thing that was happening was that the data were actually telling us that there's a capital spending boom really early on. And then the way that the Fed worked then, and I probably still does now, is that we take, people are assigned to be like the consumption person, the investment person, the government person, the net export person, and then they forecast that with very complicated models. And then those forecasts get sent to the GDP coordinator, and the GDP coordinator aggregates the models, the forecasts from each of the segments of GDP, and then thinks about like what that means for interest rates, in discussion back then with Mike Prell, who was the research director, and with Chairman Greenspan. And then Chairman Greenspan might say, well, what if we move rates this way or that way? And then everybody would change their forecasts. And so most of the stuff that really influenced decisions by Greenspan was coming out of that section of the Fed, not the section that was using, at that point, an updated version of what used to be called the MPS model that was developed by Albert Ando and Franco Modigliani. That was a sort of big kind of general equilibrium model, ad hoc Keynesian general equilibrium model without a whole lot of expectations. That was the model they were using back then. And so I think it was very much data dependent. Lots of work bottom up. I don't know if you worked in the economic activity section, but we wrote, a fellow named Greg Brown, who's now a professor at North Carolina, was my research assistant at the time, and we wrote computer code to do the business sector. And I think back then at the Fed, the research assistant who wrote the code, you would name the code for that part of the program by the research assistant. So there was like the GDP code that aggregates all the forecasts was named Ruth, because there was a RA named Ruth. And so when we finished the capital spending program, Greg Brown did a lot of the programming, so we called it Trout. And people say they're still running Trout at the Fed that are doing capital spending. But the point is that we really, because we were the first ones to have computers, really, and we had the data, and we were studying computers with computers. I don't think it was a top-down thing.
I see. That's great. So since you started on the topic of the Fed in the 1990s, you know, spotting a productivity boom is tricky, but if one thinks there's a productivity productivity boom, but there actually isn't one, or you overestimate productivity, you could be in a pretty bad situation. The 1990s, 1960s is one of that example. And also spotting whether inflation expectations are anchored is another skill that Greenspan has. He pioneered the term rational inattention, right, about prices. Do you think right now inflation expectations are anchored?
No, I don't think that I know that the Fed wants them to be appropriately so, but I think that we lost control of inflation in recent memory, and it's more under control now, maybe not all the way there. And so, I think that people would be right to worry, well, suppose that the policy mix that we saw, post-COVID in the U.S. economy were the policy mix that came back. I don't think President Trump would do that, but say in the next administration, then wouldn't inflation go back up around 9 or 10% again? Why was it, if you're a person forming expectations over the next 5, 10 years, which is very often a planning horizon for buying a house or something like that, that you could legitimately worry that inflation is going to come back up. And it's very important to think about why the Fed was unable to control inflation for so long, and it got out of control, and what the Fed can do to signal that that's not going to happen again. I can tell you that what Greenspan did when he saw really reckless spending is that he testified and said, you guys can't do this, that it's going to make it impossible for me to run the Fed and keep inflation under control. And what this set of folks did is they said, oh, it's transitory.
If you were confirmed as Fed chair, would you do that?
I wouldn't say, oh, it's transitory if it wasn't.
So speaking about inflation, so recently President Trump said that he would like to give out these $2,000 checks to low-income individuals by mid-2026. I thought the administration agreed that the stimulus checks during the Biden administration was responsible for some of that inflation we've seen. How do you assess this trade-off of trying to improve the affordability of these low-income, medium, middle-income households who are struggling with these affordability issues versus giving more checks out and perhaps stoking inflation?
Well, obviously the best way to address affordability is to increase real incomes, real wages. Right before the COVID emergency, we had promised, it's kind of like the ranges you and I just talked about. I had promised, based on our modeling, and the president promised in all his speeches, that we'd get about $4,000 of an increase in real wages. And I had actually told him, based on our modeling, it was between 4 and 8. If it was you would have said 6. But he wanted to, under-promise and over-deliver. And then we got the 6 increase in real wages, and so therefore things were affordable. And then for the Biden 4 years, the real wage decline is, depending on which measure you use, $2,500 to $3,000 or a little bit more. And so real wages went down, which meant that wages went up slower than prices, which is kind of typically a key feature of most Keynesian models, is that wages are kind of stickier than prices. And so that real wage decline means that people are right to say that there's been a problem with affordability. And, real wages are up this year, in part because of the things that we're doing. But if you were to be as fiscally irresponsible as the previous Congress was, then you would for sure see inflation go up and affordability jump back into being the change in affordability as bad as it was before. The thing is, though, that we've basically so far this year reduced the deficit for just this year by, I think it's $390 billion now.
It's
calendar year or this
calendar year. It's actually like a weird thing that she's right about the calendar year. The fiscal year, the previous fiscal year numbers don't look as good, but it was because in the first quarter of the previous fiscal year, Joe Biden was shoveling money out the window. And so about 40% of the deficit came from that first quarter because they were shoveling money out the window. So if you wonder, how are we doing, we prefer to talk about calendar year rather than fiscal year, because then we don't get blamed for the quarter where they're shoveling money out the window. And if you look at that, then year over year, calendar year, we're down 390 billion, and it extrapolates to maybe 6 for the year. And about a third of it is higher revenues, tax revenues, because of higher growth. About a third of it is tariff revenue, and about a third of it is reduced government spending. But if if we stay on path and cut the deficit by 600 billion, that's with a little bit of growth, you're looking at 7 or 8 trillion over 10. That's like a very significant event that reduces inflation with a big macroeconomic punch to inflation. And so against that backdrop, when it was July, we hadn't seen all this positive development yet. And so when we were negotiating with Congress with a big, beautiful bill, then it was the position of the president that the tariff revenue should just buy down the national debt. But we're making so much progress on reducing the national debt that I think it's fair to think about what other policies we might pursue in like a reconciliation next year. And with all the tariff revenue that's coming in, without causing a stagflation, I think it would definitely be on the table to think about how that might be rebated to
on the
people.
table, but not necessarily a sealed deal.
Well, it would require legislation.
Right. Speaking about that, so we did try to, see how my team, we did try to see what path there, what requirement we would need in the economy to get fiscal deficit to the 3% that Treasury Secretary Scott Bessent had proposed, the 3% real GDP growth, which we look like we're getting in the third quarter, 3% fiscal deficit and 3 additional barrels per day of oil. But there's a group, million barrels. So
3 barrels isn't going to do so much. Right?
So there's a bunch of fiscal experts who calculate that to stabilize the debt to GDP ratio, which is hitting 100% of GDP this year, you do need an annual fiscal deficit of 3%. So I do agree with you that in the fiscal year, even fiscal year 2025, you can see a lot of encouraging developments. But still, we are at 4.9% of GDP in terms of fiscal deficit this year. And tariff revenues is probably about 1% of GDP per year. But still, it seems really hard to get to a 3% deficit. And I will note that in the fiscal year 2025, the net interest payment on the debt has breached 1 trillion for the first time, and the increase was on par with the Medicare spending increase, which is a mandatory spending. What's your plan for bringing down interest payment?
Well, I mean, what we've done so far this year, as you concede, is we've made an enormous amount of progress. But there's still, let's say that if the progress that we see, were to persist next year, then we'd still have only made up about half the ground that we need to make up to get to 3. But given that we've made so much progress this year, I think I'm highly confident that we have a team that has a well-identified goal from Scott and from the president, and we'll work it out. But it'll have to be worked out with Congress and future spending restraint. And, I think that the tariff revenue will continue, and that if we get the kind of growth effects from the capital spending that we expect, then I think we can hit 3% even next year, perhaps.
Wow, so it's your forecast that we could.
It's not my forecast. I'm saying that we could.
It's possible.
We really could hit it next year.
Is the necessary piece of this a productivity boom?
The productivity boom is a real necessary piece of it. That I think that if productivity, I actually kind of wonder what your guesstimate of what the rate of productivity growth is. But let's say it's between 2 and 3 right now. Is that What's
yeah,
your
yeah. I think it's just the Fed's practice is to average over two years because it's very noisy, and if you do that, it's about 2.2 right now.
Yeah. So let's just say it's 2.2, and then we've got investment divided by capital minus the depreciation rate is the capital stock growth, and investment is skyrocketing. So let's just say capital stock growth gives you like 3%, 4%, because capital stock's big, and then that's about 0.3 times that. So that gets you up to 3 before you do something to labor, and so you're looking at pretty good growth accounting right now. They easily could be looking at a sequence of years that are from 3 to even 4. Because of the productivity, if the productivity stays where it is, which I think it will.
Okay, so now I'm switching to the hardball questions.
Oh, okay.
Fed independence.
That's an easy question.
Are you aware you're the leading candidate for the Fed chair position? Would it be fair to say that you are working a lot of hours right now? Are you working 60 to 80 hours?
How is that related to Fed independence?
No, sorry. I just wonder whether...
If I look tired, there's a reason.
I mean, a Fed chair position would certainly be an improvement in work-life balance for you, probably. But on the Fed independence issue, so let's face it, if you are confirmed, when you go in, you'll be facing a lot of skeptics. You will have a lot of colleagues who you will have to convince to win over to your side of the argument. Would you say so?
First of all, I think the idea that government service, makes it less likely that you'll pursue an independent Fed, basically rejects the evidence of the 5 Council of Economic Advisory chairs that went on to be independent Fed people. And so I think it's a very common path for people who have worked in the White House to go on and to work well at the Fed and to do so independently. I have been critical of the policies of the current Fed because I think they haven't been data-driven enough. I think that the way you convince your colleagues is that you make sure that you're using models that make sense and forecasts that make sense, and that you have a strong argument for, say, productivity, producing growth that doesn't cause inflation, and then you really have to be convincing with the economics. And the thing about independence that I just want to tell a little story about it that shows how much that it's really important. There's a big literature that says that if the Fed loses its independence, then inflation expectations become unmoored, and so you can't let the Fed lose its independence. And the story is one that goes back to the 90s that you and I were talking about with me and Chairman Greenspan, that one of the first papers that I wrote when I was on leave from Columbia and working at the Fed was with my colleague, Gib Metcalf, who was at Princeton at the time. And President Clinton had run on having a BTU tax, if people are old enough to know. And the BTU tax was one of his main things that he and Al Gore, because they were way ahead of the curve on climate. And so Gib and I are public finance economists, so we wanted to know, well, what does a BTU tax do? How does it work? How did we model it and stuff? And we wrote a paper on the economic impact of a BTU tax, and it was really, I think, the first paper in the economic literature that also we said, well, we're doing the BTU tax, we should do a carbon tax too. So we had the economic effects of a carbon tax and a BTU tax. And so we had this paper, really good paper, I thought, but you had to go through the review process at the Fed, and Chairman Greenspan ordered us not to publish the paper. He said that right now President Clinton has said that there's going to be a BTU tax, and we can't have the Fed looking like it's put its finger on the scale. What's a political debate about the BTU tax? And so, sure, it's a great paper, but the Fed's not going to publish it until debate has finished on this topic. And then, like maybe 9 months later, the BTU tax failed in Congress, and then he said, well, it's okay, you can publish your paper now. And we subsequently got it published in a top peer-reviewed journal. It's been cited 1 million times. But I think very fondly of that story because I think that that's what it means. That's how much you have to pay attention to independence. And so if you're thinking about things that could improve with the current Fed, it feels like first, there's way more communication than there was when Greenspan was there. It seems like everybody's out giving a talk every day, but they're giving talks about things that are relevant for what Congress is deciding today in ways that, basically are not necessarily relevant for monetary policy. And I think that Greenspan's approach is a superior one.
Meaning, I think he has a term for it. If you understand what I'm talking, then I'm not talking either.
No, that was something else. He very often would want to communicate things, and you understood what he was saying. It's just sometimes he didn't want to answer questions directly because people very often will say, hey, so what are you going to do with interest rates next week? Or something like that. And that's when he would be hard to understand.
So maybe that won't be a problem with you.
I don't know.
Former Chairman Bernanke was actually one of the person who pushed for all this Fed communication and transparency, and the Fed is in the process of framework review. And one proposal that seems to be on the table is for the Fed to publish Fed staff scenarios to increase the public understanding of how the Fed's forecasts actually have a various risk and uncertainty band around it. Would you support that type of transparency?
I think that you should have transparency about the things that matter to you if you're a decision maker. Where did you come up with, now's a good time to do this or that? What do you think? Like, if you think that we're in a boom, how come? And I think that one of the negative long-run effects, probably the only one, of Chairman Greenspan's presence is that because he was always looking at every data item and then sorting it in his head, and he was doing it in a really miraculous way, which made him a legend before there were computers and so on. And he was always kind of suspicious of time series models, which are really conditional expectations that are getting better and better in the Stock and Watson world at helping us think about the path of the near-term economy. And I think the one thing I can say is that in terms of at least looking at the research papers, it feels like the bias against that type of work, which I think could be very useful for policy analysis, and which we used a lot when we were at CEA to think about what the forecast would look like if we passed the Tax Cuts and Jobs Act and we got the number right within a tenth or two out a couple of years, right, with those models. I think that those time series models probably need to be invested more in the Fed. And then if there's a bigger staff that's doing that, then I think that there'll be a lot of product that'll be useful for markets to digest about, look, if we do it this way, if we do it that way. No model is the right model, but you need to look at a bunch of models when you decide what you're thinking. And I think the Fed hasn't done a good job of helping people do that.
So that's the area you would want to invest more in these model building exercise. How alternative?
Again, just if you look at the economic report of the president, if you look at the analysis that we did in the first Trump term, we had put on the table the models we were using. We ran horse races with models and figured out what's the best model for modeling this type of thing or that type of thing, and then would publish tables where we said, well, here's all 8 models that help you do this, and here's the central tendency, or this is the one that we believe. And so I think that level of detail is available to us now because the economic science, macroeconomic science, forecasting has advanced dramatically since Alan was talking to the CEO of GE and using that to decide what GDP next quarter was going to be.
How about alternative data and machine learning and AI, bottom-up style of forecasting?
Yeah, everything. Everything. Look at everything and then see what works.
Okay. We only have a couple of minutes left.
We are kind of past time, and
Oh, really? I will just ask you one last question then. So, if you were confirmed to be Fed chair, will you commit to preserving independence in the way that you just understand the conduct of monetary policy?
100% independence is anyone. There are a lot of really good candidates that the president's talking with and about. But I think that everybody I know that's a candidate 100% understands the importance of independence. And I think that it is important and that commitment will be made, whoever the president chooses, over and over again during Senate confirmation.
Yeah. Okay, thank you. Kevin has it. Thank you.
That was NEC Director Kevin Hessett speaking fireside chat with Bloomberg Economics' Anna Wong. Let's get a little bit of a reset here of this marketplace. We do that with Lisa Mateo and Bloomberg Business Flash.
You got it in this Bloomberg Business Flash, brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. We got a big test for the tech-fueled rally today. NVIDIA reporting after the close. Right now, its shares are up about 3%. Now, ahead of NVIDIA, we have retail in focus. Target, they trimmed its profit forecast for 2025. That was due to markdown, soft demand in key merchandise areas. Target shares down nearly 1%. And from Target, we go to TJX. It runs chains like TJ Maxx, Marshalls. Sales last quarter above estimates. Shoppers turn to cheaper options. TJX is up about 0.5%. Also reporting Lowe's. Profit topped expectations. Positive same-store sales growth for a second consecutive quarter. Consumers, they spend more on home renovations. Its shares are up about 5%. To the markets we go. Stocks recovering after that sell-off in the world's biggest tech companies led stocks lower yesterday. The S&P 500 stopped a 4-day slide. Its shares up. It's up about 0.7%, 50 points. The Dow, little changed, up about 41 points. The Nasdaq up more than 1%, 283 points. The 2-year yield 3.57%. That's little change. The yield on the 10-year 4.12%, and that is little change. The Bloomberg Dollar Spot Index is strengthening by about 0.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. This is a Bloomberg Intelligence program. Let's get right back to these markets. As Lisa was just reporting, we got some green on the screen here today after a sell-off yesterday. So a little bit of uncertainty in the marketplace, and that's reflected in a VIX that sits out here just under 23 on the VIX. Dana Dioria joins us. She is co-chief investment officer at Envestnet, joining us here. Dana, it feels just over the last couple of weeks, a little bit of pause, a little bit of angst in this market, maybe people calling into question some of these AI themes in the marketplace. How do you view this market right here?
Well, I think it's almost a bit of a relief, to be honest with you, that we're not continuing to just plow forward, right, on this AI trade. And I think a lot of people maybe are thinking that, and we're not at Armageddon, right? We aren't seeing terrible economic news. There's clearly cracks in the labor market, but it looks more at this point, at any rate, as, you know, exactly what you said, some misgivings about, you know, this AI trade, the circularity of it, you know, the fact that a lot of people going about their daily lives working are not yet seeing AI suddenly create these productivity increases. And so you hear a lot about investment in AI, $400 billion coming from just a few top tech companies over the next 12 months, investment in AI, but people look around and they're not seeing these great productivity increases. So it makes sense, I think, that the market, you know, took a step back from this trade for a bit. And notwithstanding, of course, NVIDIA will absolutely drive markets because everybody knows we're all levered to NVIDIA right now, however you're invested. So I think obviously that's going to have a huge impact how they come out tonight. But at the same time, you know, just kind of a little bit of a step back, I think, made sense.
That all drives with what we're seeing in the markets and sentiment, but to what extent will NVIDIA drive the tone and the confidence in the market versus the economic data that will be kind of dribbling out over the next couple of days and weeks?
That is a great question, because I think to a certain extent, you know, NVIDIA coming out with, yes, we're over 50% growth, everything's great. To a certain extent, I think that's almost a threshold matter at this point, that if NVIDIA showed signs of weakness, it could be, you know, a pretty bad day in the markets tomorrow. But I do also think that because of the circularity, because of the concentration in the investment, showing that growth doesn't necessarily calm the markets either. Because the markets are saying, well, okay, you're growing, you're getting all this investment, but you're getting it from these big tech companies that have yet to show us their own productivity increase, their own, you know, kind of benefit from this. So I think where NVIDIA comes in is almost a threshold matter, that we have to keep seeing that growth, because otherwise, the main thesis underpinning everything is faltering, and it's obviously faltering. But I also think, this concern around now we don't get a December rate cut, that labor market is actually pretty stalled, that as data comes in, we're not going to like the looks of it, I think is also a heavy weight on, the economy rate or the stock market, and could potentially cause problems.
So I'm looking at the WIRP function, WIRP function, and the odds are now a little bit below 50% that we'll get a rate cut in December. And maybe, presumably, those odds are probably going to be impacted by all the economic data we're going to get starting tomorrow here. How are you going to look at this economic data over the coming days?
So, I mean, it will be, if economic data isn't already heavily scrutinized, this is going to be looked at, with very bated breath. I think we're hearing a lot out of the Fed, and certainly it will be looked at in large part because, it's going to be a determination of is bad news good news to a certain extent for the Fed's decision making. So, yes, the odds, quote unquote, of a rate cut are under 50%. I'm in the camp that we do get this rate cut. I think, the Fed, and obviously we're also, what's interesting about what's going on in the Fed right now is the dispersion in the commentary, right? You're getting very, kind of different views. I think at the end of the day, kind of the hawkish sentiment that we're hearing is in part the Fed asserting independence, asserting that we need data to make decisions, and we're not going to move based on, kind of not knowing what's going on. By December, they will have, to your point, the data in. And I think net, we would really have to see something, kind of extraordinary in my mind to prevent them from doing this rate cut. Because I think, at this point, it's becoming pretty clear that, again, we're not at Armageddon's gates here, but we are looking at a soft patch, and the labor market is absolutely starting to experience, the effects of the shutdown, just a softening in general.
All of these are well-established concerns that are lingering, and for now, they're taking center stage. How much are you looking at what's happening in the credit market, Dana, to kind of get a sense of people's appetite for risk? You have Blue Owl this morning scrapping a merger of two private credit funds after a sell-off in its shares, and then you also have, of course, these concerns about high yield junk bond risk is now at its highest level since June. The notes with the lowest junk ratings carried the biggest spreads since June, so that's about 5 months worth. How much of that is spilling over into equities? Because there's that adage that credit always leads.
Yeah, it's a very good comment. I do think, the bond market, to a large extent, you kind of look at and get a little bit more concerned, right? The equity markets are volatile. Even I go back to Liberation Day, and the turmoil in the equity market didn't move anything, but the administration, when it saw the bond market start to crack, there was a response there. It's like, okay, we're going to put this off. So your comments, I think, are valid. I think people, do legitimately worry a bit more about when you see credit markets starting to show cracks. But notwithstanding, the Blue Owl was, there was a lot of negative feedback about that. I think you can set that aside as, not necessarily indicative of the general market. And we've had really tight spreads for a long time. So some of this is, I think also just part of a recognition that, hey, the markets are sort of ahead of the economy to a certain extent. There's this expectation of rate cuts. The Fed is, again, I think we're going to get this rate cut, but I think the Fed, to a certain extent, is doing what it does and holding up, at least some members are holding up their hand and saying, you can't assume that, we haven't seen the data, stop kind of overshooting here on this thing. And so I think it makes sense and is normal that you'd see some widening of spreads given what's going on in the rest of the market. But I think your point is valid. I think more of that, it's a feedback loop at that point, because then you do raise concerns about overall where are we going with this.
All right, Dana, thank you so much. We appreciate it. Dana Dioria, she's a co-chief investment officer of InvestNet, joining us there in just moments. Our plan is to go to NVIDIA CEO Jensen Huang and Tesla CEO Elon Musk. They are speaking at the U.S. Saudi Investment Forum in D.C. When they begin speaking, we will bring that to you. But I can't imagine. I mean, you think about just talking about Elon Musk and Jensen Huang, talking about AI and a theme of the marketplace and of the global economy. And then those are two of the folks right in the middle of it. And again, we'll hear from NVIDIA reporting earnings after the close tonight.
Yeah, and of course, the context for this with this investment forum is that Saudi Arabia has been seeking approval to buy advanced AI chips, the likes of which NVIDIA dominates. And any deal that does get struck would lack binding commitments because Congress has to give that. But obviously, we want to hear about the ambitions of NVIDIA to sell these chips, the goals that Saudi Arabia has, and how this all plays out. Of course, NVIDIA reports earnings today. So Jensen Huang speaking at this event in Washington. He'll also be speaking later on when the company reports its results and speaking exclusively to Bloomberg at 6:30 p.m. with Ed Ludlow following the results.
Okay, so we're going to hear a lot from Jensen Huang today, is the takeaway here.
Absolutely.
And of course, no discussion of technology is complete without Elon Musk and getting his thoughts, given all of the businesses he runs.
He's been quiet lately.
He has been quiet lately, and I'm not really sure why. And I mean, his Doge time may have had some impact right there. All right, let's go to Washington, D.C. NVIDIA CEO Jensen Huang and Tesla CEO Elon Musk. They're speaking at the U.S.-Saudi Investment Forum in Washington, D.C. Let's take a listen.
Of revolutionizing space travel is reusability. If you throw the rocket away every time, the cost of access to space is extremely high. With respect to electric cars, there weren't any electric cars when we started making them, really. You couldn't buy any, to the best of my knowledge. So with Tesla, we wanted to make electric cars compelling and affordable. That was the goal. With respect to humanoid robotics, there are no useful humanoid robots at this point. There are sort of gimmicks, but there are no actually useful humanoid robots. And I think Tesla's going to make the first actually useful humanoid robots. And this will be quite a revolution, and I think something that everyone will want. Because I was thinking, like, who wouldn't want their own personal C-3PO R2-D2?
Oh, yeah?
Of course. Everyone would want one, right? And then there would be many in industry providing products and services. This is why I say that humanoid robots will be the biggest industry, or the biggest product ever. Bigger than cell phones or anything else, because everyone's going to want one, and or maybe more than one, and there'll be many in industry.
I just want R2-D2 in C-3PO's body.
Yeah.
There you go.
Well, I mean, a humanoid robot would be better than R2-D2 and C-3PO combined times 10.
Yeah.
So people often talk about sort of eliminating poverty and that kind of thing, but really how long have they been talking about that? There's lots of talk. There's lots of NGOs sort of trying to do these things, but really not succeeding. And the evidence speaks for itself. But AI and humanoid robots will actually eliminate poverty. And Tesla won't be the only one that makes them. I think Tesla will pioneer this, but there will be many other companies that make humanoid robots. But there is only basically one way to make everyone wealthy, and that is AI and robotics.
And we can't talk about robotics without AI factories. And yesterday was such a historic day for the two nations, but also for all of us, where we celebrate the AI strategic partnership with the U.S., signed, witnessed by the Honorable President and His Royal Highness, about how we are committing our capital, energy, land to energize the AI U.S. ecosystem, to be able to build inference nodes, training nodes, and to be the most AI-enabled nation. With that announcement, tell me what's next in AI factories, Jensen? There's a beautiful story about how Saudi Arabia is building AI refineries and how building AI or oil refineries to AI factories. I love that. I've said that AI is an infrastructure, and the reason for that, of course, we understand AI from the perspective of the technology and how it's revolutionizing every industry. Digital intelligence, of course, has applications into every field. And so it's going to be used by every company, every industry, every country. In that way, it's foundational, and therefore it's part of infrastructure. What is new about AI from a computer science perspective is that the way computing was done in the past was largely retrieval-based computing. Mm-hmm. Somebody typed in a story, or somebody created a piece of art, or came up with 4 versions of a digital ad, or it's all
pre-built by somebody, which is then using a system to retrieve the appropriate version for you. It's a retrieval-based computing model. Hadoop and many of the frameworks and operating systems that have passed, all designed to retrieve the appropriate information for you. But today, software is going to be generated in real time. It's generative. Based on the context, based on the circumstance, based on who you are, based on the problem you asked, based on your prompt, it will generate unique content for you. Every single time for everybody, it's unique. When you use Grok, every time you use it is different. Just based on the right, based on the prompt that you give it, and based on the circumstance, and so therefore, it used to be retrieval based. Today, it's generative, and if it's generative, then and every time is different, then you need AI factories all over the world to generate the content in real time, which is the reason why you need AI factories. And this is a unique way of doing computation, but the benefit, of course, is that everything isn't preconceived and pre-documented, and it's contextually sensible and therefore intelligent.
So AI factories and robotics, and we heard it yesterday from His Royal Highness, his vision, how to augment our workforce with roughly tens of millions of robotics to be able to infuse the next wave of productivity and progress. But this scares a lot of folks here when it comes to the future of jobs. So let's hear about your thoughts, Elon and Jensen, on that.
Sure. Well, if you say like in the long term, where will things end up? Long term, I don't know what long term is. Maybe it's 10, 20 years, something like that. For me, that's long term. My prediction is that work will be optional.
Optional?
Optional. So
we'll take that.
Yeah. I mean, it'll be like playing sports or a video game or something like that. If you want to work, in the same way, like you can go to the store and just buy some vegetables, or you could grow vegetables in your backyard. It's much harder to grow vegetables in your backyard, but some people still do it because they like growing vegetables. That will be what work is like, optional. Now, between now and then, there's actually a lot of work to get to that point. And I always recommend people read Ian Banks' culture books to get a sense for what a probable positive AI future is like. And interestingly, in those books, money is doesn't exist. It's kind of interesting. And my guess is, if you go out long enough, assuming there's a continued improvement in AI and robotics, which seems likely, the money will stop being relevant at some point in the future. There will still be constraints on power, like electricity and mass. The fundamental physics elements will still be constraints. But I think at some point, currency becomes irrelevant.
Jensen, any thoughts?
By the way, the NVIDIA earnings call is later today.
And by the way, since currency is relevant.
Cheers.
Elon just wants to share with you some breaking news. The two of us would like to share some breaking news. Let's see. I would say there's different horizons you could look at. Everybody's jobs will be different. I think that's for sure. How the students learn will be different. How people do their work will be different, obviously, because a lot of the things that we do mundanely or arduously or very difficultly are going to be done very simply. And so we're going to be more productive from that sense. One of the things that I will say is that for most people or a company, if your life becomes more productive, and if the things that you're doing with great difficulty become simpler, it is very likely, because you have so many ideas, you'll have more time to go pursue things. It is my guess that Elon will be busier as a result of AI. I'm going to be busier as a result of AI. And the reason for that is because we have so many ideas we want to pursue so many things that we still have in our backlog inside our company that we can go pursue. If we were more productive, we can get to those things faster. And so in the near term, I would say that there's every evidence that we will be more productive and yet still be busier because we have so many ideas. One thing that I will say, give you some evidence, is that, and I was just telling Elon about this earlier, radiology, for example, has largely been converted to AI-driven radiology, and there's some really great companies doing that. And the surprising thing is the prediction that all radiologists would be the first jobs to go was exactly the opposite. The trend shows that there are more radiologists being hired now as a result of AI. And the reason for that, if you take a step back, it's because the goal of a radiologist is not to study the images. The goal of a radiologist is to diagnose a disease. Now the studying of the images became so productive, they could study more images, study more modalities, spend more time with the patients. And as a result, they're actually accepting more patients. We're doing more radiology all around the world. We're doing a better job with diagnosing disease. And so that's kind of the near-term outcome of AI and productivity. And we'll see what happens long-term. You know, when currency doesn't matter anymore, just, you know, let me know right before.
You'll see it coming.
All right, that was NVIDIA CEO Jensen Huang and Tesla CEO Elon Musk speaking at the U.S.-Saudi Investment Forum in Washington, D.C. And as they were talking about referencing NVIDIA reporting earnings after the close today, and that's important for NVIDIA, that's important for tech stocks in general, and I would argue it's important for the market overall. AI has been such a big dominant investment theme for the markets in general, so we'll hear from that as well.
Yeah, I just read something in a Bloomberg News story that says that NVIDIA drove 20% of the S&P 500's gain this year alone.
Okay,
so
there
yeah,
you go. That's
very much tied to the market.
Let's get a little bit of a preview of what we might hear from NVIDIA. Ryan Vestelka joins us here, Bloomberg News. Ryan, what do you think investors will be, kind of looking for in this earnings release, listening for on the earnings call?
Good morning. Thanks for having me. So I'd say that the outlook that NVIDIA provides is by far going to be the biggest takeaway, the biggest thing that investors are going to be looking for in this report. We've already had a bunch of NVIDIA's biggest customers, meaning Microsoft, Amazon, Alphabet, Meta. They all reported in recent weeks, and they gave very strong CapEx numbers, which is a very strong signal that demand at NVIDIA for all these AI chips is going to be quite strong this quarter and probably for the next few quarters because they're giving these annual CapEx views. But anything NVIDIA says really about the state of the AI trade in terms of sentiment for more additional spending from here, whether it's a return on investment that its customers are seeing, anything like that is going to be really taken as the next big catalyst for this trade, whether it's up or down.
And it feels like this is the high water mark for so many people this earnings season. And we've already seen some big name investors change their position on NVIDIA, according to the latest 13F filings. Peter Thiel's macro hedge fund dumped its entire NVIDIA stake in the third quarter. SoftBank Group also sold out its entire NVIDIA stake for different reasons because it wants to fund other investments. But it feels like a lot of big investors might make moves on the back of these results.
Yeah, so NVIDIA has been the strongest stock in the S&P 500, really of the AI era. It is by far the poster child for this moment. People are starting to question the AI trade as it stands right now. There's a lot more skepticism about how much companies are spending on it. There's increased focus on the number of companies that are issuing debt to pay for CapEx. People are getting a little bit impatient when it comes to when are we going to start seeing the return on all this investment that has been made. And NVIDIA is really at the heart of that. So while it remains really the strongest AI chip company, there's a lot more debate going on about where does this stock go from here? Does the valuation look appropriate? What if we start to see some of these companies pulling back on their AI spending? What are the implications for the company? And what are the implications for the market? This company is worth about 8% of the S&P 500. That is basically unprecedented in market history. So obviously there's so much writing on this company and what they say about where things are going from here.
Ryan, one of the big topics for this company, for NVIDIA, is China, and kind of where they are from a competitive standpoint in China. What of their products can they sell in China? What products can they not sell in China? I know that was led to some uncertainty with some of the analyst revenue estimates in the past. What do you think we can hear from the company today about that?
Yeah, so remains a very fluid situation here. We've seen a lot of back and forth from the government about what chips are allowed. Right now, it seems like the most advanced chips are not being allowed, but there are some, workarounds for this. There is a lot of debate going on about what is this kind of policy going to look for going forward. We've seen a couple of, news stories come out this week that are maybe pointing to maybe some changes in the landscape. So right now, it does remain very fluid. I would say this is something that people are really focusing on. I don't know that it's baked too much into estimates right now. I think people are sort of zeroing that out for the most part. But yeah, this is a major focus for the company.
You look at the stock price performance. I know we talk about how it's so crucial to the overall market, to the Mag 7 trade. Its shares have gained almost 40% this year, outperforming the NASDAQ 100, certainly. But since its peak on October 29th, it's actually come down quite a bit in correction mode. And as a result, if you wanted to look for value in NVIDIA shares, you could say that they offer some value now versus a couple months ago.
So it's fair to look at NVIDIA as a very strong growth company. I believe revenue is expected to grow more than 50% this year, slowing over the coming years, but certainly still strong growth, much stronger than the overall market, much faster at least. And if you look at the multiple, I think it's trading around 30 times estimated earnings right now. That is not nosebleed valuation for a company this significant, this central to the market, and growing at this kind of rate. So I think you do see people out there saying, this stock does look attractively valued right now, or certainly it's not a situation like Palantir, for example, a company that is trading at a much higher valuation where it seems like in order for them to keep their stock momentum going, they really have to outperform expectations.
Ryan, I think the market's probably at the point, as you mentioned earlier, that, okay, we get the numbers. We know investments in AI are just astronomical. We haven't seen these numbers before. But what's the return on that investment? Is there anything that NVIDIA can say to that point?
I think would probably be a lot stronger coming from the companies that are doing the spending right now. We have seen some of that from them. Like Microsoft did come out and say that its Azure cloud computing business is seeing stronger growth, and it does pin that to AI. Alphabet, with its report, showed very strong growth in its own cloud business. So did Amazon. So you are seeing that. As far as NVIDIA, they have come out in the past and said that for every dollar that they spend, they're getting, however much money back in return on investment. So they can speak to it, and they can talk about how efficient their chips are getting and how these customers are going to get more bang for their buck. But I think would probably have more weight coming from the real customers. I'd say those are the ones that people are focusing more on.
All right, good stuff. Ryan, really appreciate your joining us today. Ryan Vostelic covers equities for us here at Bloomberg News in Chicago, giving us a preview of what we might be able to hear from NVIDIA when it reports earnings after the market close today. Of course, we will have live coverage of that here on Bloomberg Radio with Carol Massar and Tim Stanovic and Romain Bostic and Katie Greifeld on the close. All right, let's talk a little bit about the other earnings that have come out. Lowe's just reported this morning, and the stock is moving higher. It's up 5% on the day, snapping a 5-day losing streak. So let's bring in Drew Redding, Bloomberg Intelligence U.S. home building analyst, to give us a recap of what we need to know about Lowe's results. Drew, good to speak with you. What does Lowe's look like when it comes to its results compared with its bigger rival, Home Depot?
Yeah, so I think Lowe's results could be best characterized as better than feared, particularly in light of what we heard from Home Depot yesterday. They did fall short of consensus estimates on same-store sales, but I think the buy side was probably looking for something flat to lower, so a little bit better than they were looking for. Now, that being said, they did trim their full-year outlook. Now they're looking for full-year comp sales to be flat, from flat to up 1%, so that would imply that 4Q is relatively flat. But similar to what we heard from Home Depot, they had about 100 basis point impact from hurricane activity that was not replicated this year. So again, if you were to back that out, it looks like the underlying trends in the business are pretty stable. That being said, they're still grappling with the same consumer uncertainty and the same weak housing market that their competitor is. So still challenges out there in the market.
Drew, I think I understand it correctly that Lowe's has a lower percentage of sales to professional contractors than does Home Depot. If so, are they trying to narrow that gap? Are they targeting that segment a little more?
Yeah, great question. So Lowe's is about 30% professional contractors, 70% DIY. Home Depot is about 50-50, maybe even a little bit higher on the pro front. What's interesting, and to your point on investment, is the pro space, especially in building products distribution, has really become a battleground among home improvement retailers. You had Home Depot recently do acquisitions for SRS and GMS, and then you have Lowe's who recently acquired Foundation Building Materials. So it's certainly an area where they're making a concerted effort to grow. Now, Lowe's has historically focused on the small and medium-sized pro, and what this acquisition does is it gives them exposure to larger pros who do more complex projects. So they're able to, be the supplier of choice, across more building product categories and at a larger scale.
So basically directly competing with Home Depot in many ways. Is this going to become a duopoly, or are there still a lot of other places that professional contractors can go to?
Yeah, so the building products distribution space is still very highly fragmented. I wouldn't be surprised to see further consolidation within the industry, across different categories. Home Depot and Lowe's are certainly, two of the behemoths in the industry who have, the scale and financial flexibility to further consolidate the industry. But there's some other players as well, like QXO. So it is a fragmented industry, but I would expect, in the coming years, it's something that continues to get consolidated.
Drew, I'm probably like a lot of investors out there. I can't keep track of where all the tariffs are these days on all the different products, but I'm just guessing if I'm a Lowe's or a Home Depot, my plywood from Canada, that's probably being tariffed. A power tool from somewhere in Asia, that's probably subject to tariffs. How are these companies dealing with it? What have they been telling you guys?
Yeah, good question. So Lowe's gets about 60% of its products from the U.S. So their exposure internationally is maybe not as high as you would expect. China's probably around 15 to 20%. There hasn't been a whole lot of talk. I think we have seen their average ticket increase this quarter was up about 3%. And part of that is in response to tariff-related price increases. Lowe's told us that there were only modest increases, and they'll take a portfolio approach to how they increase prices. They'll look at their product lineup and see where they have more elasticity. But I think the impact of cost will start to come in a little greater as we look into Q4 and early 2026. And some of the areas that we're looking at, you mentioned plywood, so lumber tariffs from Canada. We also had the implementation of tariffs on cabinetry, both kitchen and bath, which could go up to 50% in January. So I do think that the impact gets a little greater as we look at the next year. So I would expect further price increases from both retailers.
All right.
I'm glad that I redid my bathrooms. Get in front
long
of those
before
tariffs.
this.
Yeah. Got in front of the tariffs. Also leased an automobile before the tariffs.
It's like you knew this was going to happen.
I knew this was coming. Now, my question is, since my Vespa is from Italy, do I now have a trade deficit with Vespa?
You personally do.
I think I do.
Yeah,
okay.
You personally do. If we want to graph that, we could. Drew Redding, Bloomberg Intelligence U.S. home building analyst. Thank you so much. Recapping Lowe's results, and Lowe's shares are higher by 5.2% right now, snapping that 5-day losing streak, and comes on the heels of Home Depot's somewhat disappointing forecast.
Right, absolutely. So we'll see. I mean, Home Depot, that stock traded off pretty hard when they reported the numbers. It's pretty steady here today. But again, Lowe's up 5% today. Still down about 6% for the year. So there is definitely some concern out there. Coming up, we're going to talk to Mary Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst. She covers the retail stuff. TJ Maxx tops expectations again. I know. This is...
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow lower, the S&P, NASDAQ. They are both higher right now. And this Bloomberg Business Flash is brought to you by Oracle. Attention growing businesses. Oracle's offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitments. See if your company qualifies at oracle.com/Bloomberg. We've got the Dow lower right now, 68 points in the red, down 0.1%. S&P, though, higher, rebounding after 4 days of selling, up 27 right now. Perhaps rebounding, an overly strong word. It is gaining 0.4%. We got NASDAQ up 173. The NASDAQ Composite Index right now up by about 0.8%. The NASDAQ 100 Index up 0.7%. Our Mag 7 Index up 1.2%. NVIDIA in that index ahead of earnings. NVIDIA surging now by 2.7%. Your 10-year 4.11% with a 2-year 3.57%. Gold up 0.6%. 4,090 the ounce on the precious metal, while West Texas Intermediate crude back with a 59 handle, 59.37, down 2.3%. And look at Bitcoin. The slump continues. 89,965 right now on Bitcoin. Bitcoin is lower now by 2.7%. We were just talking with our Drew Redding with about some of the housing-related building names. Home Depot shares down today, again down 1.2%. But this morning we heard from Lowe's. Lowe's shares, they are surging now by 5.3%. Lowe's reporting profit that topped expectations. So again, recapping here, S&P 500 index up 0.3. NVIDIA after the bell, higher by 2.4%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio in New York City. We're streaming live on YouTube. Head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. TJ Maxx reported some earnings here today, some pretty solid numbers. The stock's pretty much unchanged on the day, although it did hit a 52-week high intraday here today, so good news for the folks at TJ Maxx. Mary Ross Gilbert covers the stock for Bloomberg Intelligence as a retail analyst. She's based out there in L.A. Mary, I know you guys like the TJ Maxx. I mean, Alex is a fan. Alex Steele's a fan. Scarlett Fu's a fan. Lisa Mateo's a fan.
I have the card.
You've got the card.
I have the credit card.
All right, very good. Mary, are you a fan? Are investors a fan?
Paul, you are absolutely right. I'm a fan too, and it's because they carry such a variety of brands, and it appeals to all income groups. So if you have a luxury consumer, you can get Balenciaga, you can get Chloe, Lowe. So they carry all of the brands, and then if you're more pressed and you're really a value consumer, they have Steve Madden, they have Theory. So they have Puma, they have Nike. Adidas. So they have all the brands that consumers want, and that's why their Marmaxx, which is TJ Maxx and Marshall's division, reported a comp sales increase of 6%. So, and that's why, you know, if you look at the overall results, they were up 5%. So a lot of strength there within the Marmaxx home goods. And of course, Canada was up 8%. So we're seeing consumers flock to get the brands that they want, and they've had some amazing buying opportunities, so their margins were higher.
So the way that TJX stocks its stores is that they get inventory that hasn't sold at full price stores. But if all these merchants, all these retailers are managing their inventories better and don't have a lot of excess inventory, where does TJX get its inventory? I mean, it has to have another option, right?
Yeah, Scarlett, you raise a good question, but the fact is that some of the retailers, but also the brands themselves. So if you think of, for example, PVH, which has the Tommy Hilfiger and Calvin Klein brands, we see those brands pretty prevalent throughout off-price. So that's been a good channel for them to sort of release some of that excess inventory. And when they work with some of their wholesale partners, including the department stores, so where you have product that's not selling, off-price is just a natural fit to be able to release that inventory. So you want to keep your inventory fresh in the stores, especially when you're a full-price operator.
and there hasn't been any slowdown in terms of that excess inventory. And that's why even on the luxury side, where typically you wouldn't think you'd find markdowns, it's been pretty prevalent, especially with overall weakness in luxury.
So what is the folks at TJ Maxx, what are they saying about the consumer these days?
Well, the consumer, I mean, they're really seeing strength. So it's interesting because when you sort of read the take on Target with their results today, and they sort of cited, you know, the consumer is very cautious. But that caution, I think what's really going on is that they've got the brands that consumers want. So those that are executing are the ones that are getting the sales, because even some retailers that are more full price oriented are generating sales. Or they may be promotional, like we're going to get Gap when they go to report tomorrow, and we think we're going to see strong results there out of Old Navy and out of Gap, and those are their two largest brands. So we think that they're just executing really well and providing great fresh merchandise, but they're also promotional and they provide value to the consumer. So the consumer is flocking to value, there's no doubt about it, but we do see some, you know, operators. You've got Ralph Lauren on the luxury side. They continue to outperform, and their sales are always topping expectations too. And consumers there are willing to pay full price. So they're a lot less promotional. Every year, they seem to be less promotional. For that reason, they're able to sell at full price.
So clearly, TJX has a strategy that works well given the current environment. And even when the economy is doing well, I would argue it has a strategy that works well. At what point do investors want more from the company than just executing on the strategy? Will they want, I don't know, M&A? Do they want consolidation? Do they want innovation from TJX?
Yeah, well, so that's the reason why TJX is focused, you know, internationally. So they're going to be entering Spain in 2026, so coming next year. And of course, they've had some, they have two joint venture investments, one in Mexico and then one in the Middle East. And they're both off-price retailers that they've invested in. So they're basically taking their talent and providing them a platform to leverage their talent in these joint ventures and to grow that way. So they're always looking for ways, because Scarlett, you bring up a good point. TJX trades at a pretty high premium in the off-price space, and generally it's a pretty big premium. That is due to their very consistent execution. But you're right, consumers keep wondering, well, how can they keep growing on top of all this growth? And yet they keep doing it. But as they talk about, look, they have drops several times a week. There's not a lot of retailers that offer fresh merchandise several times a week. And they curate the merchandise by location. So they're very cognizant of the demographics for each location.
Mary Ross Gilbert, thank you so much for joining us. Mary Ross is a senior equity analyst covering the retail space for Bloomberg Intelligence. Is out there in our LA office talking about TJX. Let's get back to these markets here. Mixed kind of performance out there. The S&P's up a little bit, the Dow's down a little bit, but the Nasdaq's up about 0.6%. Rebecca Walser joins us here in our Bloomberg Interactive Broker Studio. Rebecca is the president of Walser Wealth Management. Rebecca, crazy times. The government's back open. We're going to have a lot of economic data starting tomorrow. We've got earnings. What are the conversations you're having with your clients these days, given all these crosswinds out there?
I think a lot of clients are saying, oh my gosh, you know, we've had 4 trading sessions to the down, and that's a little bit nerve-wracking. Obviously, on Monday, we had the first time in 138 trading sessions where both the S&P and NASDAQ dipped below the 50-day moving average, so that's obviously alarming. And, you know, you've got a lot of consternation about, is there an AI bubble? Is there a lot of just hyperscalers funding each other's projects? And is that really something that we need to be alarmed about? And so I think today we're seeing positive momentum, because obviously we're expecting a double beat on NVIDIA earnings after the bell revenue and EPS, and I hope we get it, and I hope we also get, you know, some consensus or some forward guidance that says, hey, things are well, and that will maybe settle a little bit of the market. If you look at the Bank of America Fund Manager Survey in September, there's only 11% risk of, as the top rated risk of tailwind risk of AI bubble, and that went to 45% in October. So we really are looking at calming this. You know, it's really awful when you're getting these massive exponential returns on AI and then any kind of bubble or any kind of news of that, and you get we switch over to the CNN fear and greed, like extreme fear. Like we need to calm, and we need to understand that as we monetize, this is a prickly process. Expect the rose to have thorns, and as long as investors are level set on expectations, then I think that they will stay the course, and that's what they need to do. You have to be on this frontier. You have to stay the course. And I hate to use a comparison to the .com bubble, but if you look at 2000, 2001, 2002, 3 years in a row of negative S&P 500 returns, never happened before, it's never happened since. And so it's just what happens when we're on a new frontier and we do not know what the true valuations are.
Right, you make a good point that you can't expect linear progression here. Having said that, it very much feels like this is the one event that everyone's waiting for, these set of NVIDIA results. And yes, there's going to be government data that comes out in the coming days, but it's so backwards looking, and we're not even sure if it's high quality or not. And the FOMC meeting is not until December 10th. So what happens between 4:30 p.m. today and December 10th when the Fed meets? It feels like we're in a vacuum.
I know, Scarlett. And the thing is that if you look, even Monday, I checked the Fed watch, obviously, and it was like it had flipped, right? We were majority percentage that we were going to get a 25 bit cut. It had flipped to 55, no cut, 44 cut. I was like, what? It's back up now. It's still only just under 49% chance that we get a 25 bit cut. Listen, I think the Fed has sounded, and the people that are speaking have sounded more hawkish in the last couple of days. And I think they can blame that on saying, look, we are in a fog. We don't have data. We need data. So unless we get really severely bad economic data, obviously we see Verizon announcing the largest layoffs they've ever had in the history of the company. So they see that they've got labor to really deal with. That is one of their mandates. Obviously it's conflicting, but that means accommodative Fed. That's what people are kind of expecting. I think the market always gets ahead of its skis. It had already priced in a December rate cut. So if we don't get it, it's going to be bad. And so we're looking for it. We need it. And I'm still expecting that we will get it unless we get massively positive news that is, that inflation could be further exacerbated if we cut in December. I don't think that's going to happen. So I do expect a cut.
Are the earnings that we've been seeing out there from corporate America enough to support this market, do you think?
I mean, they are. And if you look at them, I mean, obviously we've had tremendous third quarter earnings. If you look at the results expected in the summer, we were only expecting to get an 8% return. We're looking at closer to 13% with the actual returns that we've seen. So I think that there is a lot of positive. It's just that it's all on, or a lot of it is focused on the tech front, and that's where investors come back to. But is it a bubble, Rebecca? Is it a bubble? And I'm like, okay, listen, we're going to be on this frontier, and we have to accept that it's prickly. That's my word for this description of where we're at. I think it's the best word I can describe. It's like getting that flower with the rose and having the thorns. It is going to be prickly. And so, yeah, they're concerned. But I do think that you have to be a part of this. And whether it's overvalued or not, it remains to be seen. But you cannot get out of this and say, oh, gosh, I'm going to sit on the sidelines. You will miss out. You will be overlooked. So you can't do that.
Rebecca, very quickly, if your clients want to invest but want the safe havens and want to, go defensive, where would they find that defensiveness?
I'm going to say commodities, gold and silver have been phenomenal. We have been a gold and silver bug since 2020, and I do believe we're in a global macroeconomic transition from fiat currency to blockchain currency. That is coming. Stable coins are coming. And so I really like Visa. They're doing a pilot program for their businesses to pay in USDC stablecoin. And so that's what we're looking for. We're looking for traditional finance companies to move over to the blockchain, and those ones that do are going to survive, hopefully, and those that don't, I think are going to get left behind.
Rebecca, thank you so much. We appreciate
Thank
it.
you,
Rebecca
guys.
Walser, she's the president, Walser Wealth Management, joining us live here in our Bloomberg Interactive Brokers studio. Again, a lot of data coming up for the market to digest. Really starting tomorrow. It's just going to be a deluge starting at 8:30. We will have it on Bloomberg Surveillance for you. Lisa Mateo, I don't know how she's going to do it, but we're going to help her out. We got mixed markets here. S&P up 18, the Dow's down 100, the Nasdaq's up 130 points here. 10-year Treasury yielding 4.11%. A little more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. Right now, we have got the S&P 500 index trading a little changed, and this Bloomberg Business Flash is brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/around-the-clock. Right now, we got the S&P. We'll call that little changed, up 0.1%, higher by 966.26 where we stand. We've got the Dow down 145, drop there of 0.3%, while NASDAQ higher now by 93. The NASDAQ Composite Index up by about 0.4%. The Mag 7 Index, of which NVIDIA is a part, we've got our Mag 7 Index up 0.9%. NVIDIA ahead of earnings up now by 2%. 10-year at 4.10% with the 2-year 3.56%. Spot gold currently trading little changed, up 0.1%, 4,072 the ounce. West Texas Intermediate crude down 2.4%, 59.27 a barrel. And Bitcoin now lower by 3%. Bitcoin 89,570 on Bitcoin. As for the market backdrop, Rebecca Walzer is the president of Walzer Wealth Management. She was a guest moments ago right here on Bloomberg Intelligence.
So I think today we're seeing positive momentum because obviously we're expecting a double beat on NVIDIA earnings after the bell revenue and EPS, and I hope we get it. And I hope we also get some consensus or some forward guidance that says, hey, things are well, and that will maybe settle a little bit of the market.
Rebecca Walzer of Walzer Wealth Management. After earnings, right now we have got Target shares down by 0.7%. Home Depot trading lower by 1.3%, and Lowe's up by 5.4%. Again, recapping, S&P 500 index up by about 0.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio in Midtown Manhattan, streaming live on YouTube as well. You can go over to youtube.com, search Bloomberg Podcast, and that's where you'll find us there. Let's talk a little bit of commercial real estate here. We can talk about big markets, small markets. We do that with Liz Hart, president of leasing for North America. The name of the firm is Newmark, joining us live here in our Bloomberg Interactive Broker Studio. We appreciate that. Liz, you step back. Let's start with retail.
Yeah.
Talk to us about the retail marketplace. Where are we in terms of filling that up?
Absolutely. So overall, retail's performing really well this year. Lowest availability we've seen is 5%, and we're at 5.3 right now. So across the market, it's doing pretty well. But like most of the market, it's a quite bifurcated story. So indoor malls performing very well. Power centers performing very well. But if you look at what the availability is, the availability that we're tracking, half of it's been on the market for over 24 months. So it's that bifurcated story that stuff that's not moving, it's really not moving.
What does it look like in city centers versus the suburbs? I think about a couple of places I've been to, like Seattle, which there are parts of downtown Seattle which look vacant, but then you go to the suburbs like Bellevue, and I mean, traffic is out of control, and it looks like everyone has gravitated over there. For certain cities that have really been hit hard by the work from home phenomenon, what does that look like?
So we're seeing that trend start to stabilize. It definitely was a COVID trend that was very, very pronounced. And in the last 12 months, it started to smooth out so that it is starting to show that it's starting to blend. But in the market that you just showed, Seattle is a very occupier-friendly market. So that's one in which the retailers are really calling the shots. And that's true in a lot of those West Coast markets right now. You're not seeing that as much in other markets, particularly in the Sun Belt, where it's really the landlords who are calling the shots. So it is a suburban-urban trend, but it's also a geographic trend across the United States.
Here in New York City, we just had one of the, maybe the coolest office building open up, the JP Morgan building on Park Avenue. Just
what one to watch, right?
Awesome.
We can't go in there yet, though.
We can't?
Well, maybe we can ask Jamie Dimon. You think he'll let us in if we ask him on the radio?
If he allows us to.
Remote broadcast there. But again, across the street from Penn Station on, I guess it's 6th Avenue, you know, the empty lot there where that old Pennsylvania Hotel used to be. So it seems like the city's definitely getting better. It's back. How does New York City look just from an office perspective?
Absolutely. So in the trophy category, you're below 5% availability. So low single digits, very, very high performing. Again, you do have that kind of tale of two cities going on where the lower end of the market isn't performing as strongly, but we're seeing very high absorption in the top category, very strong demand being led, again, financial services sector, tech sector, which is coming back, and you're having a little bit of an AI boom here in New York City. A lot of companies coming out for the West Coast that want to get into New York City's tech talent, which is bigger than it's ever been. It's great to see that happening here in New York City.
That is super interesting. Talk a little bit more about that. What kind of space are they looking for? How quickly are they growing? And, where do they want to be situated? Do they want to be in Midtown near banks? Do they want to be downtown where it's always been more of... Yes, that. And what's the New York name for our tech sphere? It's Silicon Alley? No.
Yeah, maybe.
Silicon Alley.
I'd say Midtown South and then south of that. They do like to be more downtown for the most part.
No Midtown then, really.
No. Although AI is a little bit of everywhere because it's also, very much where we are right now, right? Because it's even in this building, you guys have an AI division, and the talent here is going to be in your building as well. So it really is everywhere. But in terms of how quickly it's growing, I'll talk about San Francisco first, then we'll mimic how it's here as well. It's pretty incredible. It's growing as quickly as I've ever seen it in my 20-year career. There's several companies in San Francisco that started less than 5 years ago that are already looking for over 100,000 square feet. I think there's 7 as of the last count, but the number's changing so quickly it's hard to keep track of. And what you're really seeing is a commitment to the office space. So how interesting is this, right? They're able to build new companies. They certainly have access to technology, you know that, and they're a tech-first company, but why are they choosing to be in the office? Well, they're solving big problems, and when they're doing it, they want to be doing it face-to-face, and they're choosing to do it mostly in higher-end buildings, creative buildings. They love high ceilings. They love to have natural light. And one thing that's really interesting is a lot of them are thinking about productivity hacks. So how do they get snacks that are elevating their productivity? How do they make sure that they even have the level of oxygen? Isn't that interesting? To make sure that they're maximizing their productivity. So a lot of an analytical approach to real estate that's probably much more than we've seen in that past generation.
How about industrial space? It seems like for a while there, we were building these Amazon distribution centers everywhere you could. I mean, New Jersey, half of the state of New Jersey is an Amazon distribution center, I think. Talk to us about industrial.
Yeah, absolutely. So Amazon doesn't seem to be slowing down, so that trend does continue. But what I would say in general is that we are still seeing, some absorption that's happening. We built quite a bit of industrial, so it does feel like from the data there's a little bit of a pullback in the data of an increase in availability, but it's just because the market's catching up to what was built. And we'll see that for the next couple of quarters, but we are very long on industrial being a very solid market in the U.S., especially with the reindustrialization that's happening and kind of the reformation of supply chains based on what's happening with tariffs. But what's also interesting is small bay industrial. Wow, what a hot part of the market. I mean, very, very low vacancy, a lot going on there too. So the market's feeling pretty hot. And then from a user perspective, 3PLs are really...
What's a 3PL?
3PLs? Oh gosh, make you explain these things. I'm like, it's what you do when you're redoing the supply chain and logistics. So it's kind of like I don't want to call it the WeWork of supply chain. That might be too simplifying it. But that kind of thing. They basically have them take it on, and then they reposition it for you. But 3PLs, that's really the dominant player in the market.
Which city is kind of hitting on all cylinders here when it comes to industrial, when it comes to office, when it comes to retail?
Oh, all three. I think probably if you're going to say all three, it would have to be somewhere in the southeast quadrant. So Sunbelt and southeast quadrant is where I would say is probably hitting on all three at the same time.
30 seconds left. If I want to go out and build something, build a building, office tower or something, can I get the capital to do it? Can I get the banks to lend me money to do it?
Well, it certainly depends on what you're building, but if you're building for trophy in a place with good demand, you can now.
Okay, so that's the thing. I don't know.
A retro and JP Morgan Chase fortress.
Yes, I'll go over there and just knock on Jamie's door and see what he can do for me. Liz Hart, thank you so much. We appreciate that. Liz Hart, she's president of leasing for North America for Newmark, joining us live here in our Bloomberg Interactive Brokers studio. And again, we still have some retail space on Lexington Avenue. On the
right across the street from our office.
Yes.
It's been empty for a while.
And then there's a big sign in there with a phone number. I'm going to just call the phone number and say, guys, I mean, you either have to lower the rent you're asking, or do something to it.
You know what? It has been occupied by banks. There's a lot more banks now than there
And I
used to
think
be.
the bank branches they're just like walking,
Advertisements.
Yeah, outdoor advertisements. Instead of
Yeah,
buying a
pretty
billboard,
much.
you put a branch on a corner.
It's a lot of square footage for that.
It is, exactly, in Midtown Manhattan. S&P up 11 points, the Dow off 130, NASDAQ up 94. We're looking at 10-year Treasury yields, 4.10%, pretty much unchanged on the day. BitDog, 89,400. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so head over to the IntraWeb and check us out there. NVIDIA, looking at the stock here, it's up a couple of percent today. It's up 37% year to date. Of course, they report earnings after the close. Really going to be, it's obviously become such a big bellwether, not just for the tech space, but for the markets overall. So it gets closely watched. Although people have been pointing out to me that it's less of a market mover than maybe a year or two ago. So we'll have to see. But it's going to be big for Mandeep Singh. Why? Because he runs all the technology research here at Bloomberg Intelligence. He joins us here in our studio. A couple things. I mean, I guess the street is really baking in what you guys like to call, you tech guys, a meet and beat. They are beat and raise kind of thing. So they beat the estimate and then they raise the forecast. I would think the bar continues to be pretty high for them.
It is, and look, when it comes to NVIDIA now, you have to factor in the newer generations of their chips. So Blackwell is the most recent chip that they have released. And so you want to see a growing contribution from Blackwell than their Hopper generation, simply because they talk about how the chip has a much higher power density, it can generate more tokens, it can do more computation, and that's the reason, frankly speaking, why people would upgrade,
Okay.
So when depreciation comes into equation, you have to ask yourself, why would an NVIDIA customer upgrade to the Blackwell generation when they just bought the chip 2 years back?
Right.
Because the chip is 5 times or 10 times more power efficient. It generates more compute. And so from that perspective, I think NVIDIA has done a phenomenal job of, coming up with these new generation of chips that people have no choice but to upgrade, because right now the limiting factor is power.
Right.
You want to optimize for the power limitation that's out there and use the chip that's most efficient, and that's NVIDIA's pitch all along.
One of the other questions out there, I think, for NVIDIA investors is China. And what can they sell to China? What can't they sell to China? It seems to be a moving, fluid situation that maybe the company doesn't have full control over. Maybe it resides partially in the White House and in Beijing. What do you think you're going to hear from them today about China?
So I think the guide completely de-risked that China number, and it used to be 20% of NVIDIA's revenue. So they've done a phenomenal job of, overcoming, that China hole that was created with someone else's demand, and that's most likely going to be more sovereigns. I mean, we just saw Jensen at the Saudi Forum.
Yep.
So you can imagine, sovereign buyers, whether it's Saudi or someone in the Middle East, other countries in the EU, those would be big buyers if this AI super cycle were to go beyond the hyperscalers, which everyone is anticipating.
I kind of feel like Jensen gets put, and probably will today, in a little bit of an awkward position in that we're kind of at the part of the AI story in the marketplace where people want to see, all right, what's the return on all this investment by Amazon, by Microsoft, and so on and so forth. And that's up to them to kind of,
exactly.
It's kind of them to express that to the marketplace. But I'm sure Jensen Huang's going to get asked 5 ways to Sundays this evening about that same question. What can he say?
I think he will cite the Meta example. So Meta is a company that is using all of the NVIDIA GPU capacity in-house. I mean, Meta would be spending probably north of 100 billion in CapEx next year. They don't have a cloud business. What Meta is saying is we are using the GPUs for our recommendation systems, and that is helping us with ad targeting. That's why we are growing north of 20%, whereas everyone else on the social media side is not even growing mid-teens. So from that perspective, there is a clear use case around recommendation systems. But look, Meta has a hard thing, I mean, in terms of raising the CapEx further without having an infrastructure play like a Microsoft or Google or Amazon have.
So what's still, if there is a non-value, if there's a fundamental concern for NVIDIA, what is it right now? Like, what do they have to get across on the call today?
So Google releasing Gemini 3 yesterday and training it entirely on their own TPU stack without using any NVIDIA chips, that's the biggest risk. Okay. What if Google commercializes their TPUs?
Now, TPU, I got the CPU, the GPU. What's a TPU?
TPU is their own tensor processing unit, which is nothing but a custom accelerator. So imagine Google has built its own infrastructure, its own chips, just because it wants to run its own, workloads, whether it's YouTube or search, on its own stack. And that stack is useful for training LLMs, inferencing, and that is the big risk when it comes to NVIDIA, is a hyperscaler getting off the NVIDIA stack.
All right, should I really listen to this call here today? Because I'll listen to an Elon Musk call. I have no interest in Tesla, but just to see what Elon's going to say. Do I listen to the NVIDIA call today, or can I just stick with my, Nick's highlights?
I think, it definitely has a lot of repercussions in terms of, the build out, the power constraints, because NVIDIA is at the center of seeing it all in terms of how it's playing out, whether it's the fate of neoclouds or just what the hyperscalers are doing. And I bet you people are still lining up to NVIDIA to get an allocation of their Blackwell GPUs, because that's what NVIDIA has been able to deliver, constant improvement in the next generation of their chips.
All right, very good. I think I will. I'll pop it in there, pop the earpiece in, we'll see how it goes. 5 o'clock tonight, Eastern time, is the conference call report numbers. Around 4:20 it hits the tape, so pay attention to that. Mandeep and the entire Bloomberg Intelligence technology team worldwide will be paying attention to this, because that's how big that stuff is. Mandeep Singh, thanks so much for joining us. Always appreciate your support. Mandeep Singh, he heads up the research technology side over there at Bloomberg Intelligence. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network coast to coast 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. Your top stories and your global business headlines are coming up right now.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Steve Kathan, a survivor of Jeffrey Epstein's sexual abuse, applauds Congress.
This feels like a victory, a long overdue victory in a fight that, many people have fought.
Annie Farmer on CBS Mornings. The bill to compel the Justice Department to release the Epstein files is now at the White House. President Trump's vowed to sign it. CBS's Caitlin Huey-Burns.
Where this goes from here, the Justice Department has 30 days to release all of these files to the public. But remember, the president has also urged the DOJ, or told the DOJ, to look into ties between high-profile Democrats and Jeffrey Epstein. And so there are some concerns among lawmakers up here that those investigations could delay or limit what will or could be released.
Harvard University's reopened its investigation into links between former school president Larry Summers and Epstein. Summers has resigned from the board of OpenAI. The Justice Department says the grand jury that charged former FBI Director James Comey wasn't presented with a copy of the final indictment. Comey's lawyers say that lapse is grounds for dismissal. CBS's Ed O'Keefe has more on the second day of Saudi Crown Prince Mohammed bin Salman's visit to D.C.
The Crown Prince and the President now heading over to the Kennedy Center for a U.S.-Saudi investment summit, basically the follow-up to the meetings they had in May in Riyadh, where Saudi Arabia initially announced plans to invest up to $600 billion in the United States. The Crown Prince now says the plan is to invest up to $1 trillion.
There's a bipartisan bill to ban stock trading by members of Congress, colorfully backed by Tennessee Republican Tim Burchett.
Yeah, everybody talks about this place being a dadgum swamp. It's not a swamp. A swamp is something cool God created. It filters water. Animal life lives and flourishes around it. This is a sewer.
On campus, CBS's Michael Wallace tells us college students indicate poor nutrition is more of a problem than drug or alcohol abuse.
A poll conducted for the health organization Touch Grass Together found 82% of college students say unhealthy diets are a problem on campus, while 71% cited alcohol or drug abuse. Many students say their campus dining halls, cafes, and vending machines lack healthy food options and serve too many ultra-processed foods, which they say leaves them feeling sluggish or down.
In 1975, pitcher Randy Jones appeared in baseball's All-Star game.
Randy Jones from San Diego Padres will be the new pitcher for the National League.
Jones, who won a Cy Young Award while with the Padres, has died at 75 years old. Wall Street, the Dow is down 18 points. This is CBS News.
A Sotheby's auction brings in big money for a portrait and a toilet.
The Gustav Klimt painting, Portrait of Elizabeth Lederer, which helped save its Jewish subject from the Nazis during the Holocaust, has sold for a record amount.
At $205 million. Here it is for this Elizabeth Lederer portrait, only at Sotheby's. The Klimt, Julian, is yours. Congratulations.
Add in the fees, and it comes to $236 million at an auction where a solid gold toilet also sold for $12 million. Jennifer Kuiper, CBS News.
There's news from the scene of the nation's worst commercial nuclear power accident back in 1979, 3 Mile Island, Pennsylvania. Energy Department says it will loan $1 billion to help finance the restart of that nuclear power plant. Constellation Energy has a 20-year contract to supply power to data centers for Microsoft. I'm Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
And on the second day came the deals. Welcome to the Wednesday edition, as this week's visit by the Saudi Crown Prince here in Washington resolves to an investment conference that's underway right now with the likes of Elon Musk and Jensen Huang. They're all in town for this, including, of course, President Trump, who has just hit the podium speaking at this conference now underway at the Kennedy Center in Washington, D.C. We're going to bring you in the room for some of these remarks, and we'll have much more news and analysis straight ahead here on Balance of Power. This is live on Bloomberg Radio as we hear the president in Washington. Let's listen.
We're giving him one plus, and it'll be something. But you'll be here. You'll be among the first, if not the first, if you'd like. You know, we'll work it out. But you had a lot of people that wanted to be there. They really would have witnessed something that was really incredible. The entertainment last night was incredible, including our great opera singer, but including the military. The talent and the military musically is also incredible. So it was great to be with you last night. I think it was something to behold. We officially designated the kingdom yesterday as the major non-NATO ally. That's a big deal. That's actually a very big deal. It's a great honor. That happens seldom, very seldom, if at all. So I just want to congratulate you on that. That's a sign of trust. We signed a historic strategic defense agreement yesterday also, and that's something that is likewise very rare, and it's a very honored company that you're in. And we're going to be selling Saudi Arabia some of the greatest military equipment ever built. We build the best military equipment in the world by far. That's why we do the most business, including nearly 300 American-made tanks is what you're buying, among many other things, the airplanes, and we're working on getting that approved very quickly. It's already approved, but don't worry. We have to go through a process. The process will take, Elon knows, the process will take about, would you say 24 hours? I think so. You're in good shape, very good shape. The partnership between our two nations is among the most consequential in the entire world, and together the Crown Prince and I are making an alliance stronger and more powerful than it's ever been before. We've had good relationships and frankly not good. You didn't have a good relationship with Barack Hussein Obama. You didn't have a good relationship with Sleepy Joe Biden. But you had a great relationship with me, and now it's as good as it was, and probably even better if you think about it, because we took the dark cloud away from your country. It was called Iran and its nuclear capability, and we obliterated that very quickly and strongly and powerfully. But that was a real cloud over the whole Middle East, and now they want to make a deal. They want to make a deal. They want to see if they can work out a deal with us, and we'll be doing that probably. But that was a terrible cloud that you had to live with for a long time. 22 years they were thinking about doing that, the B-2s. That was even before the B-2s. Those B-2s, what machines they were, they flew in, they were undetectable, and they dropped their payload, and every single bomb hit its exact mark, which was a shaft going deep into the mountain. and every single one of them hit, and it was total obliteration. And then I was criticized by some of the fake news for saying the word obliteration was too strong, perhaps. They had no idea. Nobody saw it. 3 days later, when the Atomic Energy Commission went, they said it was total obliteration, beyond obliteration, they said. But they want to make a deal. We'll see what happens. This week, our countries also signed groundbreaking agreements on civil nuclear energy, critical minerals, and artificial intelligence. And I want to congratulate a lot of the great American leaders, business leaders that are in the room. And you'll do a great job for Saudi Arabia and for a lot of other people in the room that are buying your product, taking your product, and using your product. All of that is in addition to the $600 billion investment in the United States that Saudi Arabia announced during my unforgettable visit there last spring. Well, I said, could you try and get that up to $1 trillion? And yesterday, the Crown Prince announced that the number that they'll be investing in the United States is $1 trillion. So that's really an honor. And we just took a picture backstage with some of the great business leaders and some of the great people, friends of mine from your country, and beautiful picture. And while we were taking the picture, I said, could you make it 1.5 trillion? So he's got something to think about. I don't know. We'll get something. I think we'll get something, Scott, right? But many of you in the room are playing a key role in making these projects happen, and we're told that $270 billion in agreements and sales are being signed between dozens of companies, and that's just happening today, $270 billion. That's big stuff. So on behalf of the thousands of American workers who I care about most, I want to thank you for bringing all those jobs and all those great opportunities to America and bringing great wealth to America. We've become a very wealthy country. We have a couple of little things. We're waiting for a decision. We hope that's going to be good, but if it's not, we always find ways, we find ways, but we've done things that nobody thought were possible, and we're taking in trillions and trillions of dollars. Tariffs have been, frankly, the best thing that's ever happened to our country. They've always been used against us, and we never had people that were smart enough to use them in the opposite direction. But now you do, and we have taken in trillions of dollars, and it's been absolutely amazing. We're going to be doing a dividend to the people, low and middle income, moderate income people, of at least $2,000. In addition to that, we'll be paying down debt very substantially. It's the kind of money we're taking in. And really, countries that took advantage of us are no longer taking advantage of us. Friends, some of our friends treated us far worse than our enemies on trade anyway, and we've got that all straightened out. And everybody's happy. They respect us again. It's like one of those things. I think they like us better, and they actually respect us, and it works out much better for us, too. But I especially want to thank our numerous Saudi friends here today, including the ambassador to the United States, a friend of mine, Princess Rima. Thank you very much. Great job. Great representative you have. You sent a good representative. And many distinguished ministers and members of the cabinet, governor of the Public Investment Fund. Where's Yasser? Yasser's here someplace. Sometimes I see him dressed both ways. I don't know. It's cooler that way. I'd dress that way if I could. Yasser's terrific. He's a terrific man, actually. So thank you very much, Yasser. And Secretary Scott Bessent, who's been fantastic. Where's Scott? We're thinking about him for the Fed, but he wants no part of it. He likes being Secretary of the Treasury. I think we'll leave him. So let's cross your name off, right? Officially, right? Remember, you said that. I love the Fed job. To me, it's the easiest job in the world. You play golf for 28, 29 days, then you go and make a little speech, tell everybody, in the case of the current guy, the wrong information because he has no clue. But if you have good instincts, it's all based on instincts. I see they want to hire 3,000 economists, 3,000, to report to the Fed chairman What are they going to do? Take all this information? 3,000 economists. That's why they're spending $4 billion on renovating a building that should have cost $25 million to do. They should have spent $25 million. They're building a basement into the Potomac River. I could have told them that's very tough to do when it doesn't work and it's very expensive. But they're up to $4 billion headed by this clown. But we have 3,000, think of it. They want to hire 3,000 economists. So they took a poll and they interviewed 71 people. And of the 71 people, 2 people got it right. 2 people. One was a great economist whose name I won't tell you because I don't like him personally, but he is good. And the other one that got it the most right was a man named President Donald J. Trump. Do you believe it? Everyone else was wrong. And I didn't have an economist. Well, I had Scott. But we got it right, didn't we? Huh? We got everything right. Doug Berger.
Live from the Kennedy Center here in Washington. Of course, President Trump speaking to the Saudi Investment Forum that is underway today, featuring the likes of, as you just heard, Scott Bessent, Howard Lutnick, both in the front row as we look at the room here. Elon Musk there in person as well, along with dignitaries from Saudi Arabia. He was introduced while we were just coming to air by the Crown Prince himself, Mohammed bin Salman, who was not speaking through translation. And President Trump now, if he makes some more news, we'll keep you posted on what's being announced, because this has become a day of deals announced by the likes of the aforementioned Elon Musk, his XAI, to build a 500-megawatt data center in Saudi Arabia that will rely on chips made by NVIDIA, which brings both of these gentlemen here to Washington, D.C. on NVIDIA earnings day, which is quite remarkable. That we'll be talking with him later, Ed Ludlow, in an exclusive interview with Jensen Huang, not to mention his earnings call apparently will be coming from the nation's capital here. This follows news yesterday that the president was going to green light the sale of advanced AI chips made by NVIDIA to Saudi Arabia, not to mention the sale of F-35 fighter jets. So a lot to unpack here. And we're lucky to have Aaron David Miller with us as we try to let some of this news settle to get a sense of exactly what the U.S. got in return for this treatment. The senior fellow at the Carnegie Endowment for International Peace is with us now on Bloomberg, and it's great to see you, Aaron. The headline on the terminal is Trump's warm welcome gives Saudi prince lopsided rewards. Does this feel lopsided to you?
It does. You know, having worked for administrations from Jimmy Carter to Bush 43, having voted for Democrats and Republicans and worked for them, on this one, I think clearly the Trump administration gave a lot more than it got. Now, maybe some of the deets are not yet clear in terms of the reciprocity, but this was a visit designed, I think, far more than anything else to demonstrate that whatever concerns, doubts, anxieties that the U.S. and the Trump administration has had about MBS, his human rights record, the murder of Jamal Khashoggi, full disclosure here, Jamal was a friend of mine. Whatever doubts, they're all in the rear view mirror now. And what struck me extraordinary Oval Office yesterday was how comfortable the Crown Prince felt, both in that Oval meeting with the president, and how comfortable he now feels. In fact, he introduced the president at Kennedy Center. It's rather remarkable. And I think, Joe, you have to keep in mind that the average length of a Saudi king's tenure, and they've had 7 kings, including King Salman, who MBS will one day replace, is 13 years. Mohammed bin Salman is 40. He could rule Saudi for 50 years. It's extraordinary, and he's got a long view, and he wants to get as much as he can from the U.S. without giving a whole lot with respect to distancing himself from Russia and China. 360-degree foreign policy for this guy, and we're part of it.
Wow. All right. So you pointed us there, and I want to ask you about the comments that we heard from both of these men in the Oval Office yesterday when an ABC News reporter named Mary Bruce had the gumption to ask about this. The president himself, who said that MBS is doing a phenomenal job on human rights. He said, you're mentioning somebody that was extremely controversial. A lot of people did not like that gentleman you're talking about in Khashoggi. Whether you like him or didn't like him, things happen, he said, but he, MBS, knew nothing about it. We heard from Mr. Khashoggi's widow on CBS News last night. Aaron, here's what she said.
There is nothing to justify the crime, even if you don't agree or like certain person because of his opinion or vision for his country. To say he's controversial and he's unlikely, it does not give anyone right to just kidnap him, torture him, kill him, and dismantle his body. Yes, and it did hurt me a lot. And it's taken away as well. It's look like taking away the freedom for the journalists to do their job.
I want to give you some space here, Aaron. How did we go from the killing of Jamal Khashoggi, the fist bump heard around the world, to now Saudi Arabia being designated a major non-NATO ally?
And 18 other countries, in addition to Saudi, have that distinction. It doesn't imply a mutual defense agreement, or at least a defense agreement, but it's significant. The Qataris have it as well. So the president's notion that Saudi is among a rare few is really not accurate. How we got here? Just one data point, Joe. When U.S. presidents are inaugurated and they take their first foreign trips abroad, they don't go to Saudi Arabia. And in Trump 1.0, 2017, this was the president's first foreign trip. Now, he went on to Israel and then on to meet with NATO allies. But clearly, the best part of his trip, without a doubt, was the Saudi part. Sword dances. And I think it reflects the fact that of all the sub-regions of the Middle East, Saudi Arabia is the most important country to the president. It represents the scene of his diplomatic triumph, the Abraham Accords, and he hopes to add Saudi at some point. It represents hydrocarbons and oil. It represents extraordinary business opportunities for the Trump business organization. And again, let's be very clear here. I worked for a lot of administrations. No American president has ever blended the line between the American national interest and the president's family's business interests. It's extraordinary to me. It really is remarkable. So that's how we got here. And I think the justification and the president's comments, I mean, even the Crown Prince, if I heard him wrong, and he said this before, that this was a mistake. 8 Saudis were put on trial. That's right. Where they are now is unclear. I'm not sure at all that they're in prison. But the president's remarks, not only dissing Jamal Khashoggi, but essentially a blanket excusing of the prime minister. He had no knowledge of this. So I think it, again, reflects the fact that for this president, Saudi Arabia is a valued partner, and human rights, Khashoggi's killing, the repression and arbitrary detention of Saudi citizens that is pervasive in Saudi today, this stuff doesn't matter.
We've got about a minute left, Aaron. Should Saudi Arabia be leaving town with F-35s?
They're not going to be leaving town with the F-35Is, which represent enhanced avionics and comms capacity and radar function. That F-35I is what we give to the Israelis. It strains the bounds of credulity to the breaking point that this administration would give F-35s, given to our NATO allies, without demanding certain intelligence constraints and protections from allowing this technology to be accessed by the Chinese. And I'm hoping the export version of this, I suspect, won't be the F-35I that we give to the Israelis. But again, President wants to make Mohammed bin Salman happy. And the F-35s is a part of that happiness package.
I feel like we're going to need to talk again when we do get the deets. As you say, Aaron David Miller, thank you, as always, for being with us here on Bloomberg, Senior Fellow at the Carnegie Endowment for International Peace. I'm Joe Matthew in Washington. That's where we start today on Balance of Power. We've got a lot more ground to cover. It's NVIDIA earnings day. Ed Ludlow's going to join us. And there's new talk of a peace plan for Ukraine, just now quietly emerging from the White House. Some important dignitaries are in Kyiv today. We're going to talk about that with our panel coming up as well. I haven't even mentioned the name Jeffrey Epstein yet. Let's get to Wall Street, though. Charlie Pellet has the markets for us. Latest on the Wednesday trade, an important day here for earnings with NVIDIA. Charlie, how's it look?
Absolutely key for sentiment and beyond. All about NVIDIA. After the close of trading, we got you covered on Bloomberg Television and Radio. Right now, we have got stocks churning ahead of that report. The Dow lower, the S&P, NASDAQ, they are both higher. S&P right now up 7 at 66.25. That is a gain of 0.1%, only hours away from the last of the Mag 7 mega caps to report. The Dow, though, down 81 now, down 0.2%. The NASDAQ Composite Index up 61. NASDAQ up right now by 0.3%. Again, putting it all in context, S&P up by about 0.1%. The Mag 7 Index pushing higher by 0.7%. Thank you, NVIDIA, up 1.7%. The 10-year, 4.10%, with the 2-year currently yielding 3.57%. Gold now little changed, up $2 the ounce to $4,070. West Texas Intermediate crude, $59.36 a barrel, down 2.3%. And the selling in Bitcoin continues, now at $89,420. Bitcoin right now is down by 3.3%. After earnings, we have got shares of home improvement retailer Lowe's trading higher, up by about 5.5%. Lowe's reported profit that topped expectations yesterday. We heard from Home Depot. Home Depot shares down again today, falling by another 0.9%. Recapping, S&P up 7, up 0.1%. Heading into earnings, NVIDIA shares up by 1.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. And back we go to Washington. Once again, your host, Joe Matthew.
All right, Charlie, good to see you. Charlie Pellet with us here every day on Balance of Power, and we'll have more on the markets with Charlie about 20 minutes away as we count down to NVIDIA earnings. Ed Ludlow's on deck to talk to us about that because it's going to play into wherever this market is going, for better or worse. The jobs data for October will not. Just ran this headline across the terminal. BLS will not be publishing an October jobs report. It is canceled. Is that like having Christmas canceled? Have you ever heard of a jobs report being canceled? Hey, you can't go back and redo this stuff. As we've learned, the government was shut down if you weren't paying attention, and you can't go back and interview all those people and compile the data in a way that you normally would. So here we are. BLS will not publish an October 25 employment situation news release. Establishment survey data from the current employment statistics survey for October will be published with the November data. So we go September tomorrow, then we'll get November. Market can figure out what it's going to do here. The president will say what he will about the Fed. We're concerned about what happens at 4:20, and no, that's not an Elon Musk joke. That's when NVIDIA results are going to pop after the bell here. And as I look at things, Charlie just mentioned this, actually going pretty well so far. There's some hope. That does not go for the whole sector, by the way. But NVIDIA shares at the moment are up about 1.5%. We're back above $184 here. What will happen after the bell, at least what we are told, will determine the near-term direction for not only NVIDIA, but the entire AI space. Maybe the Mag 7 and maybe a lot more than that. You think about all the nuclear stocks, all the ancillary data center stocks. The entire market sentiment, you could argue, is tied up in this. And what I keep hearing from analysts is they're going to blow the doors off. It's going to be a beat and raise like you've never seen. Just think about the deals Jensen has announced recently. So, yeah, we're just raising the bar here as we get closer. And Ed Ludlow is going to spend his day not only talking about this, but talking with Jensen Huang. After the report comes out, an exclusive interview, and we've got our exclusive now with Mr. Ludlow, the co-host of Bloomberg Tech. Ed, I don't know how we can underscore the importance of this report anymore. So why don't you talk to us about what you're going to be looking for and whether we've got a whisper number that's simply not realistic?
Yeah, expectations are super high. And one reason that the expectations are so high, when I was in Washington, D.C. in that last week of October, during the 2-hour presentation that Jensen Huang gave, he had one single slide behind him. It was a bar chart, and it showed that over the next 6 quarters, he's expecting $500 billion of revenue just from their Blackwell Rubin generation product, and that excludes China. And in one slide, he basically told markets that what they're seeing in terms of demand was anywhere from about 5 to 10% above consensus. So to answer your first question, that's why expectations are so high on the data we're going to get for the quarter and maybe a raise for the last fiscal quarter of the year. But what it comes down to are the big picture things you talked about: energy supply, the staying power of capital expenditures for hyperscalers, and all of that's very much in the commentary on the analyst call, but also hopefully in the interview that we'll have after that.
Okay. Talk to me about depreciation, because we've heard from the likes of Michael Burry and others here that it's time to start shorting NVIDIA, that the fact that they're replacing chips like Blackwell with Rubin a year at a time instead of on a 5 or 6 year cycle is not being accounted. And that's been dogging the stock recently here. Ed, you could argue that this is a pretty decent setup because it's pulled pretty far back from its all-time highs. But how do we answer those concerns? How will Jensen answer them?
So NVIDIA commits to an annual cadence of a new generation of GPU. Every year, it has a new chip. And the very simple concern about depreciation is that there are prior generations of now obsolete chips that show up on the balance sheets of NVIDIA's biggest customers. And as is always the case in an original capital expenditure in a piece of technology, the value of those chips depreciate. And the concern about everything that we're talking in the context of AI valuations, froth and a bubble, is that that depreciation is not accurately reflected. There are people who sit on the polar opposite of the argument and say, well, hold on. What are those chips, even if they are being depreciated accurately over a 4 to 6 year time period, being used for? And they talk about utilization. So there are many prior generations of chips that are running at 100%. At their max capacity, waiting to be switched out for a new generation. That is, without giving the game away, Joe, that is one of the key questions to put to Jensen. What's his answer to the depreciation debate? I'm sure he'll have a positive one.
Well, I bet that's true. You're going to ask him about that, I know, Ed, but will he address that in the call? Is that something investors are waiting to hear?
Honestly, don't know. How can we know, without the crystal ball? Often the questions that the sell side analysts have are not necessarily in line with what everyone else wants to ask. Now, on this occasion, many have written about depreciation. I think I'm right in saying that Stacey Rasgon, for example, an analyst from Bernstein, said that the depreciation cycle of up to 6 years was completely justified and that we need not worry about it. So maybe he'll ask about it on the call. But it speaks, if you just get away from the jargon, depreciation, life cycle of a chip, utilization, the main thing is that right now, everything that's happened is based on the idea that just a handful of NVIDIA's customers are completely committed to spending tens of billions of dollars annually, and that capital expenditure will grow by more than 30% into next year. But what happens if they don't? They change their mind. They don't go through with it. Because right now, NVIDIA has 90% of the market for advanced chips for AI that go into data centers. And so they keep telling us that what they see longer term is very positive. But things can always change, of course.
Well, we're hearing more skeptics when it comes to the likes of OpenAI and some of the deals that have been announced. To your point, are we ever going to see that money? But I'm looking around the rest of the neighborhood here, Ed. NVIDIA seems to be in a pretty good vibe today. Micron Technology, down hard, almost 5%. Broadcom is actually higher. The cybers are in different directions. There's no direction for the Mag 7. I'm looking at even at shares of something like Caterpillar, which has rallied on the data center play. Will they all move tonight on these results?
NVIDIA earnings have that kind of macro level event. At the index level, NVIDIA is 8% of the S&P 500. From a weighting perspective, it is the highest weight. So take that into account. Micron is a supplier of high bandwidth memory chips whose fate is directly correlated with the success of NVIDIA's gear. So if NVIDIA says something positive, good for Micron. Says something bad, negative for Micron. But remember as well that this momentum and hype and happiness in the markets isn't new. NVIDIA was up 40% year to day, almost when I last checked my Bloomberg, and so that's double the performance of the Nasdaq 100 and S&P 500. The bar is now high because of that, right?
Fascinating. So I saw him with Jensen Huang, that is, with Elon Musk over at the Kennedy Center. He's wearing a suit today. Does he put the leather jacket on to talk to you?
Gosh, how should I say this in the most safe and appropriate way? If I was a betting man, I'd say he would put the leather jacket on. I'm not a betting man. I'm just also going off track record and past precedent. But yeah, you know, he's in DC, right? And so some of the questions that we need to ask are like, are you given permission by anyone to start sending your chips to the Middle East? Like, that technical detail is quite important. And dare I say, China, you know, all these kinds of things. So he's in DC right now. That's what's top of mind.
Can't imagine. He's going to do the call from here, from Washington. And your interview, right?
I'm just going on the time that it takes to fly from Washington, D.C. back to Santa Clara. And I'm feeling pretty confident that the interview's going ahead. And so he'll do it from Washington, D.C., I'm sure. But which building, which zip code in your part of town, no idea.
That's not for us to talk about. What a treat to hang out with Ed Ludlow. I can't wait for the interview, Ed, and I'll see you on a special NVIDIA edition of Balance of Power after the bell, 5 p.m. Eastern Time with the great Ed Ludlow, the co-host of B-Tech and the one man in the world who's going to interview Jensen Huang after the report tonight. How about that? That's why you come to Bloomberg. We'll have our panel next. Rick and Jeannie coming up next on Bloomberg.
12:40 on Wall Street. We do check markets all day long here at Bloomberg. Just getting word that the Bureau of Labor Statistics says it will not be publishing an October employment report and notes it will incorporate those payroll numbers into the November report that is set to be published in December. U.S. stocks now lower across the board. Since our last update, we have got the S&P and NASDAQ both trading in the red. The Dow lower now by 155 points, selling there, intensifying. We've got the Dow down by about 0.3%. S&P worst level of the session right now in the red by 0.2%. NASDAQ, the composite index, down 29, drop there of 0.1%. Our Mag 7 index holding on to a gain, up by about 0.1%. Just talking with our Ed Ludlow about NVIDIA. He's got the big interview tonight coming up on Bloomberg Radio and Television. NVIDIA up by 1.1%. Of course, we'll be talking to the CEO, Jensen Huang. Right now, we've got the 10-year 4.10%, with the 2-year 3.57%. Gold, little changed, up $4 the ounce to $4,071, up by about 0.1%. A retreat for West Texas Intermediate crude oil, down 2.3%, $59.33 a barrel. And Bitcoin just above $89,000 right now, $89,050. Bitcoin down by 3.6%. The earnings report that could make or break the AI investment story comes after the bell when NVIDIA reports. Dan Ives is Global Head of Tech Research at Wedbush Securities.
It's easy to call this a bubble from the 25th floor of a New York City office building. But the reality is, when you see the demand, like we've said, this AI party started at 9 p.m., 10:30 p.m. Party goes to 4 a.m. I'm not saying DJs doesn't stop playing music at times. There's glass in the dance floor. The bears will watch that party through the windows from the outside.
And we will be watching that party, indeed actively involved, right here on Bloomberg Television and Radio when we speak with the CEO of NVIDIA, Jensen Huang, 6:30 tonight, Wall Street time. Again, NVIDIA shares up now by 1.5%. He's partying on in Washington. Back we go once again. Your host, as Balance of Power continues. Here's Joe Matthew.
All right, Charlie, thanks so much. Charlie Pellet live at World Headquarters in New York. He'll be back at the top of the hour here, 1 p.m. Eastern Time, as we welcome our global television audience to the program and get ever closer to earnings from NVIDIA, as we were just discussing with Ed Ludlow. We've got a special, by the way, special program and a special edition of Balance of Power set for you on the late edition, 5 p.m. Eastern Time. Ed will be with us, Romaine Bostick and others, as we wrap our arms around this NVIDIA earnings report, also through the view of Washington, knowing that Jensen Huang is, in fact, here right now. We didn't necessarily expect that to be the case. He'll be speaking exclusively later on with Ed Ludlow, and we're going to seize on the important issues in Washington with regard to the AI story when it comes to energy, when it comes to permitting, red tape, NIMBYism, and the rest surrounding the data center build-out. We'll have much more, and I hope that you'll join us here on Bloomberg when we get there. It's an important day in Kyiv, and this is a story that's likely not getting enough attention with so many other issues swirling from MBS to Jeffrey Epstein. But the fact of the matter is the president has dispatched Army Secretary Dan Driscoll, plus two four-star Army generals to Kyiv for talks around what appears to be a peace plan that's taking shape here, and it's one that we're very curious to know if Ukraine might be open to. Axios got the reporting going here, and we've seen additional reports from the likes of the New York Times, the Wall Street Journal, and Bloomberg itself. The new Trump plan to end the war in Ukraine. This is just the latest now from Axios. So what was said to be a 28-point plan that did not involve Ukraine or our European allies would grant Russia parts of eastern Ukraine that it does not currently control, ever more of the country, in exchange for a U.S. security guarantee for Ukraine and Europe against future Russian aggression. This is where we start our conversation with our panel, and we've been through this a lot of times with Rick and Jeannie since this war began, and I'll be deeply curious to hear what they think. Bloomberg Politics contributor Jeannie Sheehan Zaino, our Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center. Rick Davis, partner at Stonecourt Capital, our Republican strategist. Rick, this sounds, again, like a non-starter for Ukraine. Do you think this is going anywhere?
You know, look, I mean, both sides, the Russians and the Ukrainians, are looking for some kind of a peace agreement. Obviously, the failed effort in Alaska earlier this year between Putin and Trump set things back quite a bit. And we don't know more than we know about this 28-point plan and what components of it would try to make this right. But the Axios reporting came really from the Russia side. And so the fact that they are indicating a willingness to come to the table, which is really, you know, a first in the last 6 months, indicates, I think, you know, that there's a deal to be done. I'd also say the involvement of the military that you described earlier is a real plus for Ukraine, because the touchy point in all this has been whether or not Ukraine can get a security guarantee. Obviously, they can't get a guarantee to get into NATO, which would create its own security envelope. But if the U.S. is willing to establish a zone of security that would give new credibility to the sovereignty of Ukraine, that's a new development that could be really an interesting component of this peace plan.
What do you think about that, Jeannie? It's not just Steve Witkoff at work this time, although he is apparently leading the charge in drafting this plan. We've got the top brass in Kyiv. For this conversation, they're going to be meeting this full delegation with President Zelensky. And then Dan Driscoll, again, the Army Secretary, is going to be meeting with Russian officials later. Are we on the precipice of a breakthrough?
We could be. I think we have to be obviously very cautious, because to your earlier point, we've been here before. We are hearing a lot of optimism out of the administration, that some people even saying in just a matter of weeks, we could see an outline. And already with this reporting that you're talking about, we're beginning to see an outline. But so many hurdles remain. One of the big ones is that it's an unusual way to negotiate, right? Usually you find out what your friends want, and then you go to the aggressor, the enemy, if you will. In this case, they seem to have started with Russia. They have Witkoff with a very good relationship over there, trying to emulate what they did successfully, or at least at this point successfully in the Middle East, and sort of try to copy that. It would be remarkable if that was able to work, but so much remains. I mean, you know, just one example, a lot of this plan, what we're hearing, talks about, you know, exchanging land for security. But when you look at it from the Russian perspective, it has never for Putin been only about territory. He is more interested in the fact that Ukraine not turn to the West, not be Western facing. So how do you guarantee that in a plan like this? And then from the Ukrainian perspective, of course, you are allowing this aggressor who invaded your country to take land they took illegally that is yours in exchange for security. Well, there may have to be a lot of security to guarantee that. And whose boots are going to be on the ground there? And what does that look like? Because it can't be NATO. So much of this is up in the air. It would make sense for both sides to make an agreement because they're both suffering. But who's going to give up what remains a big hurdle in all of this.
Well, and you wonder about our European allies here, Rick. I guess I presume they'd be part of a security presence. At least that's what the president has suggested. A senior White House official telling Politico about this story, quote, "What we are going to present to Ukraine is reasonable." Going on to say, "We don't really care about the Europeans. It's about Ukraine accepting." What will our NATO allies think of that, Rick?
Yeah, look, I mean, it's not significantly dissimilar to the approach they took in negotiating the Gaza settlement. You know, the interested parties in Europe were sort of brought in post-agreement, trained up on it, and became a very active part of the sort of rebuilding and peacekeeping effort. So, look, Donald Trump doesn't like multilateralism, right? The last thing he wants is a bunch of people getting on a conference call and telling him what to do. And so my guess is, you know, he's been pretty communicative to Europe on these issues before when we've had situations like this. And I would anticipate, you know, if he makes progress this week, getting those Europeans either back in the, you know, White House or on a conference call to get fully briefed on the status of this. I think the once burnt. I mean, they have tried this before and it didn't work out. So my guess is, they want to see real progress by the Russians and an acceptance by the Ukrainians around the concepts before they actually get too far afield and start creating an expectation that this is something can actually be done.
And then it's on to Hungary, Jeannie, Viktor Orban, and the big summit that the president had floated in Budapest. Is that what this sets the stage for?
It very well could be. I think one of the interesting questions, and at least if I'm reading the reporting right, we haven't heard of any communication directly between President Trump and Vladimir Putin. But does that happen in advance of, say, a meeting like the one you're talking about? And if so, when? This is quite remarkable, though, if you think about it from a lot of perspectives. But one is, here's an administration that has made its name wanting to return focus to the United States and to the Western Hemisphere. Here we go. They are going to be what? Even if they involve, in best case scenario, our European allies in NATO, that is a big commitment to NATO, to Europe, and to defense of Ukraine, presumably, if they get some security guarantees. So that is fascinating. And knowing Donald Trump the way we do, I suspect he is also thinking about the United States getting something monetarily out of the rebuilding of Ukraine and whatever needs to be done in the western part of Russia. So that's going to be a component of it, not to mention mineral deals and the like. So, the president, I'm sure, has a lot on his plate. Obviously, he wants peace and that Nobel Peace Prize, but there's a lot of other elements that go into it. But it really does, maybe some people's estimation, bog the U.S. down again in Europe at a time when some people want to be going to the east and other people want to be looking at our own hemisphere.
So Russia gets all of the Donbass, Rick. They get to keep Crimea. And while the U.S. and other countries will recognize these two regions as lawful Russian territory, Ukraine won't have to. So we're going to have a demilitarized zone there or something. Nothing really has changed except the security guarantee, right? That's the win for Ukraine here?
It's hard to tell. There would have to be a reconstruction funding for Ukraine. They obviously have a different hurdle post-peace plan than the Russians are going to have. There's obviously exchange of prisoners that would be probably included in all this. There's 28 points is going to cover a lot of turf. And I think that's the devil that's in the detail. Like, how much can Ukraine sell, frankly, to their own people? Because they'll probably need to change their constitution in order to get this deal done if it pans out the way it's being described in the news. So, that effort of making sure that Ukraine has a foothold to recover from this war, rebuilding its energy, rebuilding its infrastructure, rebuilding its housing, is really going to be a massive effort. And this is where Europe would probably play an important role. And what happens to all those frozen Russian funds? Would they go to reconstruction? What happens to the sanctions? Because right now, part of the reason I think you see this happening is the sanctions are working. The Russian economy is in a nosedive. There's a lot of reporting on Bloomberg around Lukoil trying to sell all their non-Russian assets because they are going broke. They can't get oil for thousands of oil stations that are all over Europe. And so we're really seeing a culmination of years of effort to try and push Russia to the point where they're actually going to be sincere in their negotiations.
Does that set the stage for peace, Jeannie?
Absolutely. The economy is battered. It is at $60 a barrel for Russia. They, just this weekend, Donald Trump was asked by reporters, what about this secondary sanctions bill that Lindsey Graham has been pushing for? And he said, could pass, looks like it might pass. Some people have suspected that maybe that's what has, sort of animated the Russians because they know that they can't take another hit like that. Although it sounds like this has been in the works broader than this weekend, but a lot of this has to do with the shape of Russia. And let's not forget the shape of Ukraine. The population in Ukraine, some people estimate, has been halved. The average age of people fighting this war, Joe, is said to be around 40, maybe even mid 40s or late 40s. That is very tough. And, as much as the Russian economy is battered, they can win on the battlefield because of population versus Ukraine.
Great conversation with Rick and Jeannie. They'll be back in our second hour as we keep the bead on what the president's talking about at the Kennedy Center. The big Saudi investment forum is underway, saying earlier that he is with Elon. Yeah, Elon Musk is there, along with Jensen Huang. We'll have much more in our second hour. We're joined by Michelle Jamrisco right here on the fastest show in politics. This is Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
Saudi Arabia brings the deals, but what does the U.S. get? Welcome to the Wednesday edition of Balance of Power, as this week's visit by the Saudi Crown Prince settles into an investment conference today at the Kennedy Center with the likes of Elon Musk and Jensen Huang. Thank you for joining us. I'm Joe Matthew in Washington alongside Michelle Jamrisco. Coming up in the next hour, we'll be joined for insights by Anna Ashton, founder of Ashton Analytics, with the idea of a technology transfer to Saudi Arabia that could include the Chinese. And we're going to bring you a special conversation as well with the Commerce Secretary, Howard Lutnick. Bloomberg's Anne-Marie Hordern is at the conference and will be bringing us those remarks a little bit later on this hour. So let's get started on this NVIDIA earnings day by looking at Wall Street. Charlie Pellet has that covered for us, live from World Headquarters in New York. How nervous are we, Charlie?
Right now, it is all about the big end. Yes, complete coverage right here on Bloomberg Television and Radio. After the bell, we got you covered on NVIDIA. Right now, the stock higher ahead of earnings, up by 1.9%, but lots of questions what this means for the broader market. Do want to begin, however, with a developing story headline right off the Bloomberg Professional Service. U.S. government plans to buy and own as many as 10 large nuclear reactors, projects that could be paid for by a $550 billion pledge investment fund being offered up by Japan. Indeed, that story breaking right now on the Bloomberg terminal. The Dow Jones Industrial Average, last update, we had stocks lower. Right now, the Dow does remain lower by 45 points, down by about 0.1%. But both the S&P and NASDAQ, they are both higher. S&P up 13 at 6630 right now, a gain of 0.2%. NASDAQ Composite Index up 0.3%. The NASDAQ 100 Index up 0.2, and our Mag 7 Index up 0.6%. NVIDIA shares ahead of earnings up now by 2%. 10-year is currently yielding 4.11%. We have got the 2-year at 3.57%. Spot gold right now up 0.3%, $4,079 the ounce. West Texas Intermediate crude down 2.3%, $59.32 a barrel, and Bitcoin 89,332 on Bitcoin. Bitcoin slumping by 3.8%. So again, all about NVIDIA today. Focus on that stock after the close of trading, but ahead of earnings, up now by 2%. Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, you know it is all about NVIDIA, and we'll have much more after 4 p.m. with special coverage here on Bloomberg TV and radio, including a special late edition of Balance of Power that starts at 5 p.m. Eastern Time. We're going to be looking hard at the Washington angle surrounding the AI race, the investment race, including the pursuit of energy, of course, the red tape, the permitting, and the NIMBYism that comes along with the data center build-out, never mind regulations around the use of artificial intelligence itself, its impact on the job market and intellectual property here in the United States of America. All of that is coming later and will be buttressed by an exclusive interview with Jensen Huang himself. That's going to come in the 6 p.m. Eastern hour. Our own Ed Ludlow will be sitting down with the CEO at NVIDIA, who's in the nation's capital today. He's over at the Kennedy Center with Elon Musk, Donald Trump, Scott Bessent, and the rest, including Howard Lutnick, who's going to be talking with us here on Bloomberg TV and radio a little bit later this hour with a flurry of deals that have been released since the Crown Prince arrived here in Washington. I want to mention a couple of red headlines that just crossed the terminal. And Michelle, it's great to see you back here today. All of this ties into the AI story. Mm-hmm. The United States now planning to own up to 10 new nuclear reactors, according to officials at the Department of Energy. The DOE Chief of Staff speaking at the conference in Tennessee that we've got an eye on here when it comes to energy. This would be an incredible development in a country that had completely turned away from nuclear energy, but is in desperate need of this power now because of data centers.
Right, that's right. And certainly another tangent in a long speech that is ongoing right now with Trump at the investment forum. So a lot to unpack today, but it all comes back to this part two, day two of the MBS visit and what will come out of it. So hopefully we can kind of organize all the thoughts that are swarming.
Well, that's for sure.
But that is certainly one of them. Jensen Huang is playing center stage today.
Yeah, that's right. And to see Huang and Musk together on stage. By the way, Jensen Huang was wearing a suit, no leather jacket. Let's see if that is the case when he talks to Ed Ludlow later on. But we're talking about just a massive data center and a massive amount of computing power that's being dedicated to Saudi Arabia with Elon Musk rolling this out with Jensen Huang, because they'll be relying on NVIDIA chips.
Well, certainly, and there's the big question too, not only with Saudi Arabia, but also with China. How much do we allow to be transferred?
Right.
What is advanced? And when you transfer the tech, will it be safely in the hands of the person that it's intended for?
Exactly.
Or could it be transferred further?
I wonder what Anna Ashton has to think about that. This is coming off our conversation with Denver Riggleman yesterday as he described the potential for leaks or creep or whatever we want to call it in Saudi Arabia, knowing that the country is buying, for instance, weapons, defensive weapon systems from Russia, will now be owning F-35s, will now have access to high-end AI chips made by NVIDIA, the likes of Blackwell. Does any of this end up in the hands of the Chinese? She's the founder of Ashton Analytics and a specialist in U.S.-China trade, former China analyst with the Department of Defense. Anna, it's great to have you back. Are we on the right track here?
Far be it from me to answer that question, but I will say, it's reasonable to ask whether or not this presents some sort of leak risk that could allow the Chinese to get a hold of the more advanced NVIDIA chips that NVIDIA is not allowed to sell into the Chinese market. These are definitely much closer to top-tier chips than what China can buy. And, there's this awkward reality that China has built large parts of Saudi Arabia's digital and telecom infrastructure in order to strengthen its relationships in the Middle East. Now that stuff's going to be run, with U.S. chips, according to U.S. rules, maybe. So that, that does potentially give China access, although there are a lot of controls in place on the U.S. side that are supposed to prevent that. But more importantly, it changes the strategic game for China vis-a-vis Saudi Arabia and in the Middle East. It potentially limits China's influence and it complicates its strategy of making Saudi Arabia a long-term tech partner. It complicates China's plans for the digital Belt and Road.
Well, just to offer the counter argument, Anna, and of course you've been attuned to this, I'm sure, but the debate has really been heating up between the China national security hawks and the tech world. And what we hear often from the White House, particularly the likes of David Sachs, is that you can be a China national security hawk or an XYZ national security hawk and still embrace the tech side of it. Is there a way to thread the needle? Is there a way in this argument to assure that the tech can be transferred safely and securely and still benefit in all the ways that you would from tech prosperity while also guarding against the national security risk?
I mean, certainly that is the position of people like Jensen Huang, and it is also, absolutely the case that these very tech companies that give the United States its competitive edge in any tech competition with China, do need to be able to access bigger markets than just the U.S. and Europe. They need to be able to sell their chips abroad and lots of other places in order to have the funding to remain at the competitive edge, especially when we're talking about China's government bankrolling a lot of the efforts to catch up with U.S. tech advantages. And one of the biggest markets there is, of course, is China.
Well, Anna, I want to follow with something a little more China-focused, and given that's also your expertise in any case. Bloomberg was reporting last week that the U.S. and China have yet to agree on the sort of rare earth export controls lifting that was agreed between the two leaders. Where do you see that conversation going? Do you have any sense of whether or not there will be some sort of agreement to kind of free up the rare earths that the U.S. side so badly wants?
I mean, definitely we've had lots of signals that there is an agreement in the works. I mean, there have been announcements from Chinese government agencies and announcements from the U.S. government indicating that that's the track that the two countries are on. The question is, are the U.S. perceptions of what was agreed to the same as the Chinese perceptions of what was agreed to? In the past, it really mattered coming out of any U.S.-China talks whether or not there was a joint statement. And it mattered because of the fact that there often were differing perceptions about exactly what the two sides had signed up for. We don't often have any sort of written outcome document now. one from either side, let alone one that is a joint outcome document. So there certainly are questions there. And I think it's important to reiterate that even with the agreement in place and moving forward, regardless of whether it looks like something that Washington thinks it is or whatever Beijing thinks it is, it's not permanent. It is temporary, and it is not a total lifting of all restrictions. It's simply, a lessening of the hurdles for the U.S. To get access to certain of these materials.
Anna, what does Beijing think? What does President Xi think of this dance this week in Washington between President Trump and the Crown Prince?
I'm sure that it is not a surprise, because we've seen that Trump has courted the Crown Prince in the past, and he takes a very different view. Is he threatened by this relationship? I don't think that Xi Jinping is threatened by this relationship, but I do think that he has to be taking it seriously as potentially complicating his own relationship with Saudi Arabia. Absolutely.
Yeah, certainly a lot to explore there, and also the Russia component. That's one thing that we were bringing up yesterday in our conversations with guests about whether or not the tech transfer, particularly of F-35 military aircraft, could fall in the hands, or the wrong hands in any case, in the U.S.'s view. I mean, going back to what we were talking about previously, where do you see Russia kind of play into this conversation at the moment?
Well, I mean, I imagine that there are both worries and reasons for optimism in Moscow as well as Beijing, because, on the one hand, I think that it's obvious that there is a desire to not see the U.S. cozy up to the Crown Prince and be able to facilitate a stronger U.S.-Saudi Arabia relationship. Both Russia and China have interests in keeping that relationship from being too close. On the other hand, the kinds of technology that the U.S. is offering to Saudi Arabia absolutely are of interest to both China and Russia, and Saudi Arabia may potentially provide an avenue for accessing those.
Anna, we talked earlier on the sidelines of Bloomberg's New Economy Forum in Singapore with John Waldron, President Chief Operating Officer at Goldman Sachs, who addressed the geopolitical risk here when it comes to the engagement of the U.S. and China. Listen to what he said.
I think that the dynamic between the U.S. and China, which we call increasing strategic interdependence. So the countries are interdependent, but there are going to be areas where they're going to be more focused on national security. And because that relationship is getting much more complicated, you're seeing more fragmentation around the world. And so a lot of the conversation here in Singapore this week has been about fragmentation, new regional alliances, redesigning supply chains. I worry about that because it's a new world order, and we don't really know what to expect in that new world order. And I think that will create disruption and pressure in the system, which is, kind of unprecedented for the system that we've operated under for quite a long time.
So, Anna, where does the Middle East and where does Saudi Arabia fall in that new world order?
I think that Saudi Arabia and the Middle East are going to be important to a new world order, maybe not any more important than they are in the current world order. They're positioning themselves to sort of graduate from their traditional dependence on fossil fuels to run their economies and their economic growth to becoming tech hubs. And they've been doing so pretty successfully so far. So I do think that they're going to remain important. I also think that the thing that was said there that deserves a little extra attention is that the U.S. and China remain interdependent. Because yes, we do. But one of the things that China's working very hard on is reducing that interdependence on its own side, just as we have been trying to reduce that interdependence. And, I think that there's a real question as to how fast that might happen. And, what will this new world order look like if there is less interdependence, especially on the tech front?
Well, certainly a lot of big questions we've been tackling today and all week, Anna. If I could just go in the moment. Today, we've got the NVIDIA earnings report. What are you looking out for?
I'm looking out for any sign that gives more clarity as to exactly what the U.S. government is prepared to allow NVIDIA to sell, and what that means for possible U.S. government earnings or U.S. government accruals of like a piece of the pie in those NVIDIA sales.
Anna, it's great to have you back. We appreciate your insights. The founder of Ashton Analytics, on an important day here as we gear up, indeed, for the NVIDIA earnings report. And Michelle, the thread that goes through all of these stories is national security, whether we're talking about AI chips or F-35s, the transfer of technology, and that's going to be a big part of this earnings report this evening when we consider export controls for the likes of China and other countries. We want to just do a quick beat with our panel on this. Rick and Jeannie are here, Bloomberg Politics contributors. Rick Davis, our Republican strategist and partner at Stone Court Capital, joined by our Democratic analyst, Jeannie Shanzano, Democracy Visiting Fellow at Harvard Kennedy School's Ash Center. Jeannie, what's your take on this? Are we mortgaging our national security in the sake of creating this new world order?
You know, we've had this debate so many times in American history. I think back to the post-Cold War era, this was the debate going on. Bill Clinton was trying to move towards free trade with China, and all of the more hawkish folks in the Democratic Party said not so fast. So it's a continual debate. It is necessary that we keep up with the times, so to speak, and that we really do have this openness. But at the same time, we have to be careful about the impact on national security. And so I don't see this as you can go one way or the other. You've got to have people in both camps in the United States who are watching like a hawk to make sure we don't veer too far in one direction or the other. So I think moderation is the watchword here.
Well, Rick, we talk a lot about, who are our friends? Is the White House dealing with the right people? Are they talking for the sake of talking, giving an open forum, or is it resulting in deals that are worthwhile for the U.S.? I mean, can the White House and Trump specifically, can they make the case that this Saudi visit is part of something that is a down payment on longer-term prosperity?
Well, I think that's exactly where this administration was headed even in the first term. Look, there's a reordering of the global alliances, and this administration and previous administrations, both Republican and Democratic, have been fighting over turf in the Middle East. Remember, at one point in time, the Chinese were trying to build a port in the UAE, and the United States stepped in and said, you got to make a choice. Either you're going to be aligned with us or you're going to be aligned with them. There's no in between. UAE decided to be aligned with us. I think this is part of the same kind of an effort. It's not whether we can fit into the technology that China has on the ground in Saudi Arabia. It's how hard can we push to get it out of Saudi Arabia. And moderation hasn't worked with China. That's what put us in the position we're in now. China is an adversary in trade, in national security, in international culture and regulations. I mean, there's nothing that we really agree upon right now with China. And so as this world gets, more and more opportunistic, we have to be there shouting our name.
Rick Davis and Jeannie Shanzano will stay with us. Our panel of Bloomberg Politics contributors up next with much more as we wait to hear from Howard Lutnick. We'll bring you that conversation live from the Saudi Investment Forum at the Kennedy Center straight ahead. You're going to want to stay here with much more to follow. On Balance of Power, alongside Michelle Gemrisco, I'm Joe Matthew. This is Bloomberg.
Wall Street, we do check markets all day long here at Bloomberg. Stocks higher. NVIDIA up by 2% now, ahead of earnings after the close of trading. The Dow, the S&P, NASDAQ, all in the green. Traders sending stocks churning ahead of earnings out of NVIDIA. NVIDIA's revenues will be closely watched to justify the billions of dollars that are being spent in artificial intelligence. NVIDIA shares right now up 2%. S&P now up 19. That is a gain of 0.3%. The Dow up 28, up 0.1%. NASDAQ Composite Index up 83. For NASDAQ, a gain of 0.4%. The Mag 7 Index up 0.6%. Again, the focus on NVIDIA. NVIDIA ahead of earnings up by 2%. 10-year, 4.11%. The 2-year, 3.57%. Gold up 0.5%. 4,085 the ounce. West Texas Intermediate crude, 59.33 a barrel. Crude down 2.3%. And Bitcoin, 89,250. Bitcoin down by 3.5%. Investors pulled more than $500 million from BlackRock's iShares Bitcoin Trust, the largest single-day outflow since the fund's debut, marking the latest blow to a digital assets market already short on confidence. Again, shares of the iShares Bitcoin Trust trading lower now by 3.8%. Recapping, S&P up 22, up by about 0.3%. Balance of power continues now, and back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, it's any time now. The president at any time could sign the discharge petition, the bill that was passed to force the release of the Epstein files. I guess technically the discharge petition is what forced the vote on the Epstein files. Now the question is whether the DOJ will be compelled to release them, knowing, in fact, that the president ordered investigations into Democrats like Bill Clinton that could prevent these files from being released while an ongoing investigation is underway. But I'm jumping too far down the road here. The fact of the matter is, all but one member of Congress voted for the release of these files yesterday. Only one member of the House, Clay Higgins, the aforementioned Cajun John Wayne, back when he was a sheriff, now Republican member of Congress from Louisiana, framed this as a stand on principle. He voted no. Everyone else voted yes. I asked Pete Aguilar, Democratic congressman from California, who chairs the Democratic conference in the House, his thoughts on this and how the numbers were so overwhelming. Here's what he said.
This shows that, Donald Trump allowed them. He said he was in a losing position. He knew he was in a losing position. He knew this was going to happen. And so he basically directed all of them, all of our colleagues on the Republican side, to vote for this measure. And so that's the power of Donald Trump as well. He has said himself he's the president and the speaker. He proved it today with that vote.
Remembering, of course, Michelle, that the president could compel the DOJ to release these files literally at any time. We'd pick up the phone, release the files, we'd be done. But he's still following this channel.
Well, and far be it from us to predict what will happen next, but we can raise these questions, and that is a good question. Where does he go next with the DOJ, and will he draw on the powers that he has of the president to direct them to keep things safe?
Knowing he could have done that at any time in the last 9 months or whatever it's been here. Knowing as well that he's, as I mentioned, ordered the investigations into the likes of Bill Clinton, Larry Summers, and others. He's pointing the nation's attention toward Democrats. But he has also said he's going to sign this bill. So we're wondering when this happens. You've covered the White House. He could pick up the pen, do that anytime today, right?
Yeah, he's got quite a busy day, of course, just coming out of that investment forum. And of course, he wants to keep the narrative on this sort of prosperity as well as affordability that we keep losing in the past few days with everything else going on. But certainly he wants to own the narrative and not in a way that highlights any of this. So maybe, we could see a midnight signing or something meant to be more under the radar to try to keep it out of the front page of the news.
Maybe late Friday night. We'll see. Could happen any moment now. And that's where we start with our panel. Bloomberg Politics contributors Jeannie Shanzano and Rick Davis are with us. Rick is partner Stone Court Capital, our Republican strategist. Jeannie, our Democratic analyst, democracy visiting fellow at Harvard Kennedy School's Ash Center. What do you think, Jeannie? Are we ever going to see these files, or will there always be the so-called smokescreen of an ongoing investigation?
I don't think we know yet, but I do think that you were just talking, you and Michelle, about the right question. Is the next step is the president signing, and I am very curious if he does try to do a midnight signing, or if he listens to the victims. I was so moved, Joe, by those victims, those women standing out there and holding up, and I'm sure you saw this, the pictures of themselves, 13, 14, and 15, very young girls saying, this was me when I was abused, raped, assaulted by Jeffrey Epstein. And they have asked the president, some of whom voted for him, to please have them in for a signing ceremony because they want what they have gone through to be recognized. And I think it would be so powerful if the president would do that. So I'm very curious to see what happens. After that, of course, it is on to PM Bondi and the DOJ. And to your point, do they try to hide behind a smokescreen of new investigations to not release files? But I think in the long term, the fact that this is a bill out of Congress, it's going to make that all that much harder to do, but they could try.
Well, Jeannie, you hit on one thing that I did want to kind of ask about, which is the survivors, as they call themselves, haven't gotten a whole lot of play amidst the talk about will he or won't he sign, what is he going to do with the DOJ, that sort of thing. But they were the center of attention for the likes of Marjorie Taylor Greene and others who have been pushing for this. And they were actually, in fact, the center of attention arguably for Representative Higgins, who said that he voted against it because he was worried about the disclosures hurting the survivors. So where do you see that going from here? Where we can, I mean, we're obviously focused on the procedure of all this, but are we going to be hearing more from the survivors, you think, in the days to come?
I do think so. They have waited so long to get any relief. They suffered in silence for so many years, and they have been pushing for this. Their attorneys worked with Congressman Massey, worked with Ro Khanna to get this bill put together. And I think, when we talked about it, it was, it's a discharge petition. Those never go anywhere. The fact that they pushed this, and I think I agree with Massey and Khanna, it's really on the work of these victims that they were able to push this over the line in the sort of triumphant, victorious way I don't think any of us imagined. And so I do hope that we hear more about them. This is what they've been asking for, that what happened to them not be forgotten, and that the people who either were a part of it or who turned the other way and apparently are prominent members of our society even today have their reckoning. And I think that we will hear, I hope we hear more from them about that.
Well, there's an interesting ad that's on the air that involves the victims themselves. I don't know if you guys have seen this, but it's kind of interesting that it's coming from Reid Hoffman, who has been linked to Epstein in a series of reports, and even the President of the United States has called on him. Reid Hoffman posting this ad on Twitter, writing, "The Epstein files must be released in full. Tonight I supported World Without Exploitation," behind the ad, "to run this ad on Monday Night Football." So you might have actually seen this already. Let's give this a taste for our viewers and listeners.
I was 14 years old. I was 16 years old.
I was 16,
17,
14 years old.
This is me.
This was me.
This is me.
When I met Jeffrey Epstein.
This is me when I met Jeffrey Epstein. There are about 1,000 of us.
It's time to bring the secrets out of the shadows.
Now, for the benefit of our radio listeners, it was exactly what Jeannie was just describing. Close-up shots of the victims' current faces. Now they're standing directly in front of the cameras with a black background and holding images of themselves when they were victimized. We see the contrast of their young faces with the way they look now. The ad goes on to read, 5 administrations, and we're still in the dark. Now, I don't know what the deal is with Reid Hoffman or what any of these files may or may not say about him, Rick, but as someone who has worked with campaign advertising extensively over the years, I wonder what you see the impact of this campaign being.
Yeah, look, this is a very powerful ad. I think that it reminds us that this Epstein controversy has been in the public domain for almost 25 years. And so it's sort of a subtle reminder that just because it's been around so long doesn't mean we actually know much about it. Previous administrations, both Republican and Democratic, have swept it under the rug, which gave rise to incredible conspiracy theories as to why that was and what we don't know. And so we finally come to the pinnacle of this moment where Donald Trump will sign a bill passed by Congress, started by a discharge petition, with unanimous consent from the Senate, which never happens. And we will now then see these documents. I can't imagine a scenario where the Justice Department can take that kind of volume of activity that has welled up over 25 years and not respond to the moment. This administration arguably has done everything wrong when it comes to managing this crisis since the day of his inauguration. And you just got to hope that they get this part right, because this will not go away. It's had legs when everyone thought it would go away. It didn't. And it's not about to be out of the front page of our attention spans in the future. When these documents come out, and with all the search capability you have, we're going to learn a lot of new things. And if it's not clear what it is, the Department of Justice and the Trump administration is going to come under withering pressure to clarify things that are maybe redacted and or not ultimately produced.
So, Rick, understanding that the White House hasn't taken your advice in the past several months on this issue, I'm wondering what you would say to the Republicans, especially in the Senate, but also in the House, who maybe said don't release the files and now have voted for the release of the files. What do you say to them as they prepare for this midterm campaign that is not so far off in the future? How are they going to play this? How should they be prepared to defend switching on this issue?
Yeah, look, I mean, it's going to be difficult for Democrats to attack a Republican, since they all voted right. I mean, save one that we've described who isn't about to have a challenge in his district. And so the reality is everyone's going to stand up and said, I did what I thought was the right thing, right? Regardless of their positions before, no one's going to remember that. My name is a yes on the passage of that discharge petition. And by the way, that takes it kind of out of a partisan political environment, right? I mean, like, I can't imagine a Democrat who's going to want to say, he voted yes, I voted yes, and by the way, we're different. If anything, this is why it's so crucial right now that the administration responds in kind, because the entire political system has done something we have not seen done in a long time, and that's through almost complete unanimity, supported something that is very, very important to the public trust, and now they got to make good on it. And so, can this be completely depoliticized? I think so. I'm not sure that the Epstein files are going to be a political issue in the 2026 election unless the Justice Department withholds the information.
Jeannie, the Attorney General, Pam Bondi, talked to reporters a little earlier today. We just got these quotes on the terminal. The Justice Department, quote, will follow the law. She said, the law will be followed while providing maximum transparency and protecting victims. She went on to say, and here's the news, the DOJ, quote, has new information. New information has come forward, is the line. She did not elaborate, encouraging all victims to talk to prosecutors. What do we think this means?
Your guess is as good as mine. I mean, to Rick's point, this has been 25 years. It's hard to imagine, but we do know the president ordered her to begin a new investigation. Maybe it's related to that. But I think there are huge political implications here. I don't think this is depoliticized. And one of them is the fact that we saw Donald Trump for the first time in his second term beat by the backbenchers of his own party, Tom Massey, Marjorie Taylor Greene. Marjorie Taylor Greene said this nearly destroyed the MAGA movement, and President Trump was forced to retreat 180 degrees and say, okay, vote for it. I know why his voice was not, he had something of a sore throat this week. He was probably screaming his head off at Mar-a-Lago over the weekend as he lost this. He is losing the fight over redistricting. This shows that the coalition has cracks, and Donald Trump is feeling that. Now he's going to have to put it in Pam Bondi's lap, but note his comment on Truth Social, release whatever is legally releasable. That is a sign that they could try to withhold.
Be interesting if it turned out the Oversight Committee gave us more insight into Jeffrey Epstein than anything around the discharge petition. Thanks to you both, Rick and Jeannie, always here for us, Bloomberg Politics contributors, Rick Davis and Jeannie Shanzano. We're going to get back to the story involving a potential breakthrough in Ukraine, a peace plan that the administration is working on now with top brass, including the Army Secretary, as well in Kyiv today to talk about this. We're going to have more on that coming up with retired General Wesley Clark. First, we want to update Wall Street. We're counting down to NVIDIA earnings, and this is a big one here. Charlie Pellet's got the beat on the markets as we get ever closer to the close. Charlie, at World Headquarters in New York, how's it look?
Right now, looking higher across the board. NVIDIA, of course, not just about the quarter itself for the chip maker, but also how it affects overall sentiment in terms of perceptions about AI spending. Right to the numbers here, because I got a lot of green on the screen, a lot to get to. The S&P up 23 right now, 66.41 where we stand, up by about 0.4%. Has been a choppy day. The Dow spent much of the morning in the red, up 45 right now, up by about 0.1%. We've got NASDAQ up 100 points now, up by about 0.5%. Our Mag 7 index up 0.7%. And NVIDIA, the big story, special coverage on Bloomberg Television and Radio, up now by 2.2%. Your 10-year at 4.10%, with a 2-year 3.57%. Spot gold up 0.3%, 4,081 the ounce. And West Texas Intermediate crude down 2.2%, 59.40 per barrel of WTI. Bitcoin holding just above $89,000 right now. Bitcoin is down by 3.7%. Earnings, specifically retailers. Lowe's, the home improvement chain, reported this morning up 5.8% right now. Yesterday, you recall, Home Depot also reported the stock down again, lower by 0.6%. Target also reporting today, along with TJX. And of course, tomorrow morning, we will be hearing from Walmart. Target right now down by 2.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, many thanks. He'll be back around 2 o'clock, top of the hour, with another check on the markets as we walk into Bloomberg Business Week Daily. It's going to get a little bit hotter as we get ever closer to 420, and it's got nothing to do with Elon Musk. That's when the NVIDIA results typically come out. 20 minutes after the hour, we're going to have Ed Ludlow with us here on a special late edition of Balance of Power that starts at 5 p.m. Eastern Time with the Washington view on the AI race, followed by an exclusive interview with Jensen Huang. Ed Ludlow will bring that to us here on Bloomberg TV and radios. The after-hours session is going to be a doozy, and we're ready for it, ready for you, with much more to follow here. I'm Joe Matthew in Washington, alongside Michelle Jamrisco, with news of a potential breakthrough in Ukraine when it comes to peace. A 28-point plan, according to reporting from Axios, from Politico, and from Bloomberg. We're hearing more about it as the Army Secretary and a couple of top brass, couple of top generals arrive in Kyiv today to talk with Ukrainians about this plan that was born in the administration, we're told, without input from Ukraine or from our European allies. The president clearly agitated and not impressed at the moment with a lack of progress when it comes to Russia. He talked about it during his speech earlier today at the Saudi Investment Forum at the Kennedy Center. Listen.
I've settled 8 wars. I have 1 to go. You know what that one is. I thought that was going to be my easy one because I have a good relationship with President Putin, but I'm a little disappointed in President Putin right now. He knows that. I thought that was going to be the easy one.
The plan right now, Michelle, according to the latest from Axios, would essentially give Russia, recognize Russian territory for all of the Donbass, for all of Crimea, in exchange for a security guarantee. This is the security guarantee, the apparent breakthrough.
Well, there's some that we know, and there's a lot that we don't know, Joe. And I would just say that there's a lot of people talking on either side, and particularly folks in Europe that are concerned about the possibilities here. And we just don't know yet from the White House exactly what the conversations have been and who has been talking. But a lot of rumors flying about some side dealings between the U.S. and Russia that are certainly rankling people in Kyiv as well.
A lot of this said to be coming from the Russian side. So we've got much to learn here, and wanted to talk about it with the general. Wesley Clark, retired 4-star Army general, served as Supreme Allied Commander Europe, Commander U.S. Southern Command, Southcom from June of 1996 to 97. Now Wesley Clark and Associates General, it's good to see you. Welcome back. There was a refrain in the Biden administration that we heard over and over again: nothing for Ukraine without Ukraine. We've come a long way from there. Is it possible to achieve peace without the input from European partners and Kyiv itself?
I think the administration is seeking to get that input. I know that General Randy George and the Army Secretary met with General Sirski today in Ukraine, and they're seeking first a military appreciation and also an understanding of exactly what's needed to strengthen Ukraine's defense in this. But as you all were saying, there's a lot we don't know about this plan. And the difficulty is the security guarantees and the breach of the concept of, hey, if you can invade and you can take it and you can hold on for a while, the world's going to give up on it, it'll be yours. And that's a dangerous principle to set loose. We have tried our best for 80 years not to allow aggression to pay. And you can argue that Russia's paying a terrible price for this, et cetera, which they are, but so is Ukraine. And the consequences of a faulty deal will echo for a long time. So it's not just a matter of getting the shooting to stop temporarily. Putin will take a pause whenever it suits him, if he thinks he can gain from the pause. But the real question is, will he give up his long-held aim of controlling all of Ukraine and undercutting all of NATO's post-1997 enlargement in Europe? That's the question, because on the answer to that question, it really depends whether the peace agreement's any good or not.
Well, General, thank you for being with us today of all days, and happy belated Veterans Day to you. We thank you for your service. We particularly want to draw on that service today in your time, especially at the head of NATO, to talk about this sort of how do you deal with Putin. You were with us last month, and you said it was sort of a stall, strike, and try to gain territory strategy on the part of the Russian leader. Is that where we still stand now, and is there anything that President Trump can do to kind of make Putin change course in this, or is this a fool's errand?
Well, I think the general consensus, and a consensus that I share, is that as long as Putin believes he's winning, he's not going to be diverted from the course that he has pursued for 25 years. If he feels that he can gain something from a temporary pause that he can then break at will, with weak security guarantees, or blaming it on the Ukrainians, or going in another direction with his forces while holding in Ukraine, then he might choose to accept a peace agreement. But, you know, all of these agreements are difficult. We're looking at what's happened in Gaza, and despite the great leadership of President Trump and the vision of putting this forward and all the pressure he's put on, it's still touch and go in Gaza. And here you're dealing with something that's just as intractable, in the sense that the Ukrainians don't want to give up their land. This is their land. And to give up all of Donbass, where there are hundreds of thousands of people living, where there's industry, where there's families, where there's history and cemeteries, and people have fought for this land. And if you give up all of Donbass, there's no real defensive position for Ukraine all the way to Kyiv and the Dnieper River. So would be a huge strategic surrender by Ukraine based on trust in the United States. The question is, can they put their trust in the United States? Will we put our forces at risk? Because remember, what a security guarantee really means is that if there's a breach by Russia, if there's a preparation for a breach by Russia, it means that Europe and the United States would join forces and defend Ukraine. In other words, it's war. It's not that if Russia comes, then we'll talk about it and we'll get out of the way. That's not a security guarantee. So it's Ukraine is going to have to ask some hard questions, and I think the Europeans will ask hard questions too. Everyone wants a war to stop.
You framed that so well, General. When it comes to that trust, then, if this in fact is the scenario, how important is it for the Army Secretary to be there? Dan Driscoll is there. There are 2 4-stars in Kyiv talking to Ukrainians today. How significant is that, and what must the message be from our military?
It's really not a message the military can deliver. The military is a symbol of the United States. It really comes down to President Trump. And if he participates, if the U.S. participates in the security guarantee actively. Now, he has said we won't put any troops there. Okay, so that's one mark against us because that weakens a security guarantee, the fact that the United States isn't on the ground. But you could still have a security guarantee if the Europeans were there in sufficient numbers and far enough forward. But a few European forces, say 10,000 men, multinational force, located around Lviv, ready to leave if there's a sign of trouble. No, that won't satisfy Ukraine, I don't think, and it won't deter Putin if and when he's determined to go forward. It may be that Putin is licking his wounds right now and saying, "Look, I'm just ready to stop. Give me something for it." But in that case, we should be driving a hard bargain, not giving up Donbass. That's just my impression from having followed this thing at very close range for a number of years. So many questions remain here, but it really does come down to the President of the United States. He's the man who is going to make the difference in peace and war in Ukraine.
Well, General, you mentioned that it comes down to the president, but we've also had a lot of other players in the administration, including Special Envoy Witkoff, who was rumored to be going to Turkey, and then officially we hear that those plans were canceled or never were in the works. But do you see European officials, are they going to be in town by the end of the week? I mean, this stuff has been moving so quickly in various stages. Can you expect that, they'll want to get in on this conversation very soon in Washington?
It could move for a lot of different reasons quickly. But remember, this war would stop instantly at the moment Putin says, I'm stopping the war. So he has it totally in his power to stop. He can stop it with an hour's notice. So really, when it stops, is more a function of Putin than anything else. So the president will want to determine what is the minimum that Ukraine can give up to assuage Putin, keep him there, lock it in, and then what must be done to secure it by the Europeans. The Europeans have to be willing to put their men's lives on the line to secure this. That means they've got to be forward. It means they've got to have fighting capability, not an observer mission, not people in Humvees running around with radios and blue helmets reporting on what's happening. There may be some of that required to determine whether there's been a violation, but it's got to be backed up by hard power.
Come back to the Kennedy Center with us for a moment, General, because the president, of course, is there not to talk so much about Putin or even Ukraine, but Saudi Arabia. And we've seen a flurry of deals that have been announced that all invoke the prospect, or at least a question, of national security. They include advanced AI chips. They also include stealth F-35 fighter jets. The president talked about this a short time ago. Here's what he said.
It was great to be with you last night. I think it was something to behold. We officially designated the kingdom yesterday as the major non-NATO ally. That's a big deal. That happens seldom, very seldom, if at all. So I just want to congratulate you on that. That's a sign of trust.
So seldom. There are 18 nations that apparently enjoy that status, General, but the F-35s are a question. Knowing that a special variant had been put together and designed for the Israelis, the F-35I, that allows Israeli military to plug directly into that system with their own avionics. Will Saudi Arabia have a similar arrangement with the United States? And doesn't that put the Saudis on par with the Israeli Air Force?
I believe there will be some kind of special arrangement. I think that'll have to be worked out in private discussions. This is an effort to advance the Abraham Accords. Saudi Arabia has been a reliable partner of the United States, despite what happened on 9/11 with some individual Saudis and all of the furor going on for that. But for 80, 90 years, the United States and the Saudis have worked very, very closely together. And I will say also that their armed forces have rapidly improved over the last 30 years. They've come a long, long way from where they were, let's say, when they were aligned alongside us in 1990-91 for the Gulf War, especially in the Air Force. The Air Force is excellent. It's got excellent equipment, and I know, of course, they want that F-35, and I think they'll be capable of employing it effectively and in conjunction with the United States and perhaps with Israel if the Abraham Accords go through the right way and if Iran remains a major security threat in the region.
Well, General, there certainly has been a lot of soft power at play yesterday and today in this Saudi visit. And I wonder, sometimes it might be okay in critics' view that Trump says, okay, this is a great gentleman. We have 80 years of a bond between our two countries. But do you have any concerns about the deals that are supposedly in the works yesterday and today, supposedly being approved, how those move into a hard power territory with a country that hasn't traditionally been an ally and maybe at the risk of national security to the U.S.?
Well, actually, Saudi Arabia has traditionally been an ally. Even back in the late 60s, early 70s, the United States relied heavily on Iran under the Shah and the Saudis as the twin pillar strategy in the Gulf. After the Brits had withdrawn from the Gulf, then we picked up the Saudis as a major ally. They weren't designated as a major non-NATO ally, but they were a major ally. We've done a lot over the years. We helped rebuild created the Saudi Arabian National Guard, their military. We've been with them. We provided them intelligence. We provided them military hardware. We've given them advisors. It's been decades and decades of excellent security relationship. And you can't forget that in 1990, when Saddam invaded Kuwait, Secretary Cheney went to Saudi Arabia. He talked to the king. That's when they accepted the presence of major U.S. forces there in Operation Desert Shield to deter a further Iraqi advance into Saudi Arabia and the eastern province oil fields, and that deterrence was successful. And then we went on in conjunction with Saudi forces that were allied and aligned with the United States in some of these operations. So it's been a long record of security cooperation. I don't think that's an issue, really.
Saudi Arabia is employing Russian-made air-to-ground missiles, though, correct? In our remaining moment, General, do you worry about the creep of technology transfer getting into the wrong hands?
Well, we always have to worry about this, but technology does migrate. You simply can't keep it secret. It's just the way it works in the world. And really, starting in 2014, when the Saudis formed OPEC Plus, there was an alignment of interests with the Russians. And that wasn't necessarily a bad thing at the time. And so we have to appreciate that Saudi Arabia is not the United States. It has its own position in the world. But in terms of advancing U.S. interests, they have been a reliable ally, and we would expect it to continue.
It's good to have you back, General. Wesley Clark with us live on Bloomberg TV and radio as we learn more about this arrangement between the U.S. and Saudi Arabia following the investment conference this morning featuring the likes of Elon Musk and Jensen Huang. We'll have much more on that in the late edition of Balance of Power starting at 5 p.m. Eastern with full coverage of NVIDIA earnings after the bell. Alongside Michelle Gemrisco, I'm Joe Matthew in Washington. Thanks for being with us once again on Balance of Power. This is Bloomberg.
is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. We are just moments away, 30 seconds to be exact, from the latest minutes from the last Fed decision. That was in October 28th, 29th, that two-day meeting that led to a decision where we saw another quarter of a point decrease, but we did get 2 dissents, Tim.
We did. We'll be looking for clues in there about what exactly led to those 2 dissents, and also, of course, any preview of what we can expect in December. But fair to say a lot has happened since that meeting, and that meeting on December 10th, Carol.
Yes, indeed. So just moments away, we're going to head to D.C. and our own Mike McKee. He has the Fed Minutes.
Well, the minutes show no surprise that there was a very divided Fed at the last meeting. Some thought that inflation was going to rise too high. Some thought that unemployment rise too high, and nobody could agree on what to do at the December meeting. In general, they agreed that inflation had moved up, the economy was expanding at a moderate pace, and the unemployment rate remained low. But they did not agree on the outlook. Several said that inflation ex tariffs was close to target, but many noted inflation had been above target for quite some time and showed little sign of returning to target. Several pointed to the persistence in core non-housing services as an inflation worry, as well as additional tariff-related inflation in core goods. Quote, several participants remarked that businesses, including those not directly affected by tariffs, indicated they plan to raise prices gradually in response to higher tariff-related input costs. At the same time, a few suggested AI-related productivity gains might help keep profit margins in line, limiting the pass-through of tariff costs. A few thought the softening labor market would keep prices in check, as would recent changes in immigration. A couple said in general, officials saw elevated risks to the labor market, a few noting the impact on groups historically more sensitive to economic cycles, and some noting the apparent divergence between the subdued job growth we'd seen and the relatively strong GDP. A few saw a risk that trade tensions could weigh on economic activity. And the minutes say, against this backdrop, many participants were in favor of lowering the target range for the federal funds rate at that meeting. Some supported such a decision, but could have also supported maintaining the level of the target range, and several were against lowering the target range. In discussing the near-term course of monetary policy, participants expressed strongly differing views about what the policy decision would be that would be most likely appropriate at the committee's December meeting. In other words, guys, everything we thought we knew, the minutes basically confirm they didn't know what was going to happen with the economy, and they are pretty divided over that.
All right, Mike, hang on for a second. We're going to come back to you in just a moment. I'm looking at markets right now. We are seeing a slight blip up when it comes to Treasury yields. Right now, I'm looking at a 2-year with a yield of 3.57, so slightly to the upside here. 5-year note with a yield of 3.68, and I'm looking at the longer end of the yield curve here in the U.S., 4.1% on that 10-year note. But again, a little bit of a blip up, and that's got to be on that headline of many saw December rate cut as likely not appropriate. Meantime, to the equity markets, of course, a big focus of the equity markets, NVIDIA earnings after the closing bell. Right now, equity markets look little changed after those Fed minutes. Right now, up 1/3 on the S&P 500, Tim, and you've got the NASDAQ 100. Same percentage gain, 1/3.
Hey, Mike, the words many and several come up a few times here to describe the number of Fed members who thought one thing or thought another thing. How can we translate those into actual numbers, many versus several?
Well, there is a whole code, actually, that the Fed has published on this, and you can find it on the Fed's website. Many means almost all, while several means two. A few means two or less. And there's always the idea that one participant said, and obviously in this set of minutes, one participant was Stephen Myron, who wanted to vote for a 50 basis point cut.
You know, it's funny. It sounds like a parent, you know, oh, honey, I said you could go to a few parties, not many parties or several parties. Stu, come on in on this in terms of the Fed minutes. Anything that jumps out for you?
The thing that actually jumps out at me is what's been red-headed on the terminal. Many see a December rate cut as likely not appropriate. Now, even before this was, the minutes were released, markets were already fading the probability of a rate cut. About 12 basis points of a cut were priced in earlier this morning. That had fallen down to about 8 basis points of cuts priced in for December. That was on the back of the Bureau of Labor Statistics deciding not to release the October jobs report in advance of this December meeting. So folks are basically looking out at the Bureau of Labor Statistics and saying what would have been a bad jobs report is not going to be available for the Fed to make its decision. So there's going to be one fewer data print encouraging a rate cut. Now we're seeing as early as October, many committee members were ready to take that December cut off the table. If we were to rewind the clock back to September, it really was a knife edge sort of distribution when we looked at the dot plot for just this year. It was very close to half of FOMC participants saw fewer than 75 basis points. They saw about 50 and fewer cuts this year, 50 and fewer basis points of cuts this year. So this should not be shocking to see most FOMC members taking that additional rate cut off the table when we look at the minutes.
That, of course, is Bloomberg Economics U.S. and Canada economist Stuart right here in our New York studio. Mike, back to you in D.C. You know, is the Fed, with the government closed, now reopening, but data, yes, coming, but not coming, are they not going to have really a full picture, enough data to really clearly figure out what's going on in the economy, or will they kind of have a good idea come December?
Well, they talked about that a little bit in the minutes. They suggested that not having the data in October was something of a problem, but they also said we have enough alternative data that we have a pretty good idea of what's going on in the economy, and I imagine that would hold true through the December 10th meeting, although we just found out we're not getting any jobs data until that's over. I wanted to note one thing. Stuart's absolutely correct about the many participants thought that a December move wasn't necessary, but that's not the end of Fed loosening. The minutes go on to say that they think, the many participants think that there is reason to keep cutting one or two more times next year and try to get back closer to neutral, but not necessarily in December. And of course, Fed officials have always chafed at the idea that we have to figure out how many rate cuts there are going to be before the end of the year. They don't look at it that way. It's just an ongoing process.
But Stuart, on that point about December, if we just focus on December, hasn't a lot changed in terms of the labor market between the end of October and where we are right now? Not officially, but the alternative data points that could actually cause members of the Fed to say, wait a second, we should do some loosening here?
Well, so it's interesting. We built a composite index that looks at all of the available alternative data. So we're not depending on the Fed to gauge how tight or how loose the labor market is right now. And when we look at that index, the current labor market is about 1 standard deviation weaker than it has been historically. That's been just a persistent weakness that's been evident in this alternative data set, just a broad swath of about a few dozen alternative indicators. And if the Fed is looking at that and is really nervous about how close they are to a neutral rate, then it makes sense that they could decide to stay on hold in December. They go, nothing has really changed materially. High frequency measures of layoffs are showing pretty close, 220 to 230, 235, 235,000 layoffs on a weekly basis when we look at the state level data. Not a material change to the best of our knowledge, but just this persistent drag, this persistent weakness. And again, Fed members are trying to remind folks that they are devoted to the 2% inflation target. When we expect inflation to remain pretty close to 3% out through 2026, they need to stay, pretty measured and pretty deliberate when they make rate cut decisions.
Right. If they stick to that 2% target, we're running at 3%, then inflation's still a problem. Stuart, sit tight for a second. Mike, last question to you, though, before we let you go, 30 seconds. So what is the next thing that you are kind of keeping a watch on that might be important for the Federal Reserve before that December meeting?
Well, we're going to be looking at the September jobs report tomorrow morning. It's old, but it is maybe the last jobs report that we get before the Fed meeting that has a complete set of data. So there will be some reason to look at that as Fed officials and economists try to impute what that means for the future. We're still waiting to see what happens with the inflation numbers, the CPI. That hasn't been announced yet. If they get that in before the Fed meeting, that would be great news for Fed officials. But then you have to look to the meeting itself. Remember, the blackout period, this is an earlier Fed meeting. The blackout period starts December 1st, and we do Thanksgiving week next week, and so there won't be a whole lot of Fed speak, so we're kind of getting down to it at this point.
Just around the corner. Yeah, that's interesting. Hey, Mike, thank you so much. Good to have Mike back with us. He's been on the road. We'll hear more about that in the days to come.
He didn't forget about us, did he?
No, I don't think he forgot about us.
All right.
All right, Michael McKee, Bloomberg News, international economics and policy correspondent there in D.C. Hey, Stu, before we wrap up, you know the Bloomberg New Economy Forum is underway. Lots of global leaders in government, business, and all that good stuff. You guys on the economics team came out with a special report called Scenarios for a World in Transition. You were kind enough to share it with us. Tell us about this and if there were some conclusions or narrative that you guys came away with.
It's really interesting that the forum and this entire conference is kicking off on an FOMC Minutes Day, and on a day we're actually hearing additional rhetoric from the president, adding pressure on the Fed to cut rates. We go to great lengths to really consider the effects in which changing policy is driving economics and driving economic decisions. In our special report, we go through a way of quantifying whether political rhetoric is supporting or creating some sort of deterioration in Fed independence, or is corrosive of Fed independence. And in our quantification, we found that the current rhetoric is about 20 times as bad as it has ever been, at least going back for about 30 years. So it's actually a really interesting quantification. When we think about what that could mean for rates, well, it looks like if the Fed were to be pressured into maintaining a focus on a maximum employment aspect of its dual mandate, inflation would stay close to 3%, not just through 2026, but those additional cuts as a consequence of political pressure would keep inflation around 3% through 2028. When we think about the cost of funding the national debt, when we think about the debt trajectory, it's real material consequences. These are all topics that are on discussion during this conference.
Which is fascinating to see Kevin Hassett talking with our own Anna Wong today, talking about the possibility for tariff rebate checks next year, which does create more liquidity in the system, but you do think about the government debt at the same time. Like, I just don't quite understand it.
Tariffs were offered as one of the ways to pay down the national debt, an additional 1 percentage point of GDP showing up as revenue coming from tariffs. If those end up just going right back out in the form of checks to lower income households, not only is it not paying down the national debt, but it's creating some of those inflation pressures that we saw as a consequence of stimulus during COVID.
Hey, before we let you go, we're going to be speaking to Mandeep Singh in just a minute about NVIDIA and the promise, of course, of productivity when it comes to this technology. How are you quantifying that?
Well,
do you have a little AI robot helping you at all?
We do. We, of course, have, the tools available on the terminal that are deploying large language models that are super helpful and encourage folks to dig into some of those available tools. But when we look broadly at the macroeconomic data, it's actually really difficult so far to find evidence of productivity gains. It looks like productivity gains from AI is just hovering around 10 basis points of additional growth per year. When we look at certain industries, however, there is a lot of evidence. So the IT industry, information, computer coding, real GDP in the information industry has increased about 25% since before the COVID period, but employment in the industry has increased just about 1%. So there are gains in productivity, but they seem to be pretty concentrated for now. The biggest macro indicator is, of course, NVIDIA earnings, so I'm looking forward to hearing what Mandeep has to say and looking forward to what's going on after the close.
He's passing the baton. I love it. Stu, thank you so much. Bloomberg Economics U.S. and Canada economist Stuart Paul. All right, as he said, NVIDIA definitely top of mind. The stock is up about 2.1% here ahead of earnings. It's the king of, I feel like, all the AI bellwethers that are out there, and their earnings do get released today later on.
So let's bring in Bloomberg Intelligence Global Head of Technology Research, Mandeep Singh. 4:20 p.m. Wall Street time is when we are expecting those numbers. The numbers, the expectations, those are certainly one thing. The commentary, though, what's important when it comes to the commentary?
I mean, look, what got NVIDIA here in terms of getting to a $200 billion data center business is it was a virtual monopoly when it comes to training of these LLMs. And even with inferencing, they had the majority of share. Even though AMD had a chip out there, Intel kept talking about GPUs, it was all along NVIDIA. Now, what changed yesterday was Google telling us they trained Gemini 3 entirely on TPUs. They are using TPUs, their own chips for inferencing. And so to my mind, it's now a duopoly in terms of at least enterprises having an option to use Google TPUs. And even OpenAI has a deal with AMD, 6 gigawatts, which is sizable. So what OpenAI is saying is there is a third option where you can run large language models on AMD. So from that perspective, I feel like there are 3 players now, but this market is also expanding. So it's not as if, you have to divvy up the same share across 3 players. The market is still growing 40% because the CapEx numbers are growing 40% plus next year.
Yeah, I was looking at our Markets Live blog earlier today, Mandeep, and they said in most recent quarters, NVIDIA earnings heralded broad price declines as traders took profits. But they said this time AI stocks have been sliding since the end of October, so the earnings announcement may even provoke buying. So if we just see even a tinge of optimism, could we possibly, I know you don't tout stocks or look at stocks, but if we have any more optimism coming from Jensen and team, could we see kind of everyone come back into that AI trade?
I mean, right now, the real big constraint is power. And every big company has validated that. And you want to optimize the power available to you with the best chips. And that's Jensen's pitch is we are pushing the
energy efficient,
most energy efficient chip. That's where the Blackwell shipments are really important because you want the print to say that Blackwell is what drove the beat and raise. And customers are looking to refresh their chips, even if it's a 2-year cycle and they have to take a hit on depreciation, they still want Blackwell because it's more power efficient and more performance per chip.
On the power side of this, we learned today the U.S. government plans to buy and own as many as 10 new large nuclear reactors that could be paid for using Japan's $550 billion funding pledge, part of a push to meet surging demand for electricity. These take so long to build, so long to get back online. Is it even on your radar when it comes to what you're doing in Excel right now?
I mean, look, they've told us that they want to add, OpenAI wants to add 26 gigawatt. Every hyperscaler who has $100 billion budget is looking to add at least 2 gigawatts of power. And I'm working with that equation. 1 gigawatt is like almost $50 billion in spend. And out of that, 25 to 30 billion right now is going to NVIDIA because that's the bulk of what goes inside a data center. But if you are using a TPU, a Google TPU, that 25 to 30 billion goes down to 15 to 20 billion because Google doesn't have to pay the NVIDIA chip premium, the 75% gross margins. So that's where, if you're looking to diversify, and look, that's what, when people are talking about circular financing, that's NVIDIA's way of lowering their price. They don't want to take a hit on their gross margin. They want to invest in Anthropic and OpenAI and say, look, guys, we want to give you a discount to remain part of our ecosystem, but instead of lowering our chip prices, we are investing this amount in you, so it sort of subsidizes, and I think that's their way of lowering the price and getting to that TPU sort of range where the arbitrage is very clear. Google TPUs are much cheaper when you are setting a 1 gigawatt data center.
So it makes sense, isn't worrisome.
I think so.
All right, thank you. Mandeep Singh, we know we'll be focusing on him, NVIDIA. This is...
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We've got the Dow Jones Industrial Average back in the red. Been a choppy day. The Dow now lower. S&P, NASDAQ higher ahead of NVIDIA earnings after the closing bell. Going to be all over those NVIDIA numbers as they break on Bloomberg Television and Radio. Bottom line here, stocks snapping back with the S&P up 0.2%. Higher by 11 right now with the S&P at 66.27. Dow Industrials, though, lower, down 57, drop there of 0.1%. The NASDAQ Composite Index up 73. That is a gain of 0.3%. And our Mag 7 Index higher now by 0.6%. 10-year. 4.10% with the 2-year, 3.57%. Spot gold up 0.2%, 4,075 the ounce. West Texas Intermediate crude down 2.1%, 59.47 a barrel. Bitcoin major sell-off again today with an 88,000 handle now on Bitcoin, 88,955. Bitcoin down by 3.8%. NVIDIA ahead of earnings up now by 2%. After earnings, Lowe's, the home improvement retailer, up 5.2%. Rival Home Depot down another 0.8%. So again, recapping, stocks edging higher. S&P up 0.1% ahead of NVIDIA after the bell. NVIDIA right now up by 2%. And for on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. Carol Massar along with Tim Stanovic live here on Bloomberg Business Week Daily here from Bloomberg headquarters in New York City. Hey, it was just about 1 month ago that investors spooked by the implosion of auto lender Tricolor Holdings and car part supplier First Brands Group got little reassurance from the head of the biggest U.S. bank. It is when J.P. Morgan Chase's CEO was on the earnings call with the analysts, that CEO, Jamie Dimon, said, this is a quote, "My antenna goes up when things like that happen. I probably shouldn't say this, but when you see one cockroach, there are probably more. Everyone should be forewarned on this one."
Just an editorial note, I always like when an executive says, I probably shouldn't say this, and then says it. That means it's definitely going to be.
It's our favorite moment.
Yeah, that's definitely going to be good. Diamond and other bank leaders offered warnings about potential troubles with lending or signs of economic weakness, despite their banks posting revenue that beat analyst estimates. Those in the private lending and credit space have counted Jamie Dimon's concerns, including Apollo CEO Mark Rowan. He spoke in a panel discussion earlier today at the Bloomberg New Economy Forum in Singapore. He downplayed recent concerns cited by Jamie Dimon that there are, quote, cockroaches in credit markets.
The size of the private credit market, as I see it, is some 41 trillion. Most of the market is investment grade. A fraction of it, some 2 trillion, is below investment grade levered lending. And so much of the focus is on this notion of levered lending and the Tricolors and the First Brands. And if you think about what's happened, the shock from tariffs has now adjusted into the economy. The shock from high rates has now adjusted into the economy. Credit stats are actually improving rather than declining. That does not mean we will not have late cycle banking behavior, because there are good banks and bad banks, and good insurance companies and bad insurance companies, and good asset managers and bad asset managers. But there's nothing that I see that is systemic.
All right, that again is Apollo CEO Mark Rowan speaking in a panel discussion earlier today at the Bloomberg New Economy Forum in Singapore. Hey, meantime today, and this is what really has got our attention as well, the investment management firm that focuses on private capital solutions like private credit, Blue Owl Capital, calling off a merger of 2 of its private credit funds after scrutiny over potential investor losses from the move sent its shares tumbling. Shares of Blue Owl, by the way, lower today. They've lost nearly 50% of their value since an all-time high in late January. So for the reasons why, what this is all about, and maybe the significance of Blue Owl as we continue to look at kind of the private credit and lending market, we bring in Sri Natarajan. He is Chief Wall Street Correspondent at Bloomberg News. He's right here in our studio. Also with us is Credit Sites Global Head of Strategy, Winnie Caesar. She's with us from Charlotte, North Carolina. Winnie, we'll get to you in a moment. Sri, we want to just ask you a couple of questions. Blue Owl, who are they? Where are they in the investment world, private markets, private credit world? And what's the significance of the news today?
So it's a good question. We talk a lot about Blue Owl, and Blue Owl loves to make a lot of headlines. So it is important to reorient our listeners as to what is Blue Owl and who are they. It was formed as a venture. It was a tie-up, a merger between Owl Rock and Dial. Owl Rock invested in a lot of middle market companies, say companies in the $50 to $200 million EBITDA range. They need loans. Regional banks were pulling back. They didn't necessarily have the capital easily available to them. So if there were people willing to step up and say, we're ready to do the due diligence, we're ready to do the credit work and lend to these companies, Owl Rock discovered there was a market for it. And Dial was a company that was investing in secondary stakes for a lot of these private capital firms. When you merged the two, you had the formation of Blue Owl, which in the last 4 years since the merger, has become sort of a proxy for the private credit market, because as the demand for such players has grown, as their capital has become far more important, and as they've been flexing their muscle, Blue Owl is certainly at the forefront of it. And the people behind Blue Owl, you have veterans from Goldman Sachs, Craig Packer, Lipschultz from KKR, you have Doug Ostrover from, erstwhile GSO/Blackstone. So these are really smart people. So when we think about the private credit market and try and get a sense of how it's doing, we look at players like Blue Owl. They have truly positioned themselves as the leaders in that space.
Well, speaking of mergers, that brings us to what happened earlier this week and why we saw shares decline. On Monday, there was set to be a merger between two of its private credit funds. Now it has called that merger off. Why in the first place would Blue Owl want to combine two of its private credit funds?
And look, it's just such a self-inflicted wound. And, truly, this isn't something extraordinary or something that never happens. A lot of their non-listed vehicles, this was a private vehicle for a lot of high net worth individuals to gain exposure into private credit markets. Eventually, as a means of getting liquidity, you either take that vehicle and take it public so that people can trade in and out of it, or over the life cycle of that fund, after its defined life ends, you just wind it down. You get the principal back. You've been paying out the interest as dividends to your shareholders. And when you get the principal back, you could wind down the fund. Now, Craig Packer was talking about it this morning as to when the idea was originally seeded. This private vehicle, OBDC2 that we're talking about, for high net worth individuals, and the public vehicle, the much larger public vehicle that does exist, OBDC,
right?
They had a lot of overlap. Pretty much these funds had almost identical holdings, something like 98% overlap. And when they initially thought about this merger, the public vehicle was actually trading very close to its book value. So it wouldn't have mattered a whole lot. The board would have easily approved it. The shareholders would have easily approved it. But the timing, the decision to announce this just a few weeks back couldn't have been worse, because you were suddenly telling investors in an unlisted vehicle who could trade in and out of that on a quarterly basis at book value, and Blue Owl had been honoring all those redemption requests all this time, that they now move into a publicly traded vehicle.
Which is discounted, right?
Which was trading at a 20% discount. So when the FT initially reported about this, they were absolutely right. On day one, you have a 20% paper loss, and no one's going to like that. And that was the problem. And it comes at a time, and we talked about the Jamie Dimon cockroach comments. Remember the loudest critic of Jamie Dimon right after that comment?
I forget, was it
Blue Owl. It was Lipschultz talking to our very own Danny Berger, and even without Danny mentioning Jamie Dimon, he took a swing at the big bang, saying that the next problems in private credit, next problems in the credit market are not going to be in the private credit firms. It is going to be at the banks. So with those headlines in the near past, and what's happened now, it's not a good look. It is a bit of a black eye.
All right, so interesting. Whitney, thank you for your patience, because we really wanted to lay this out because we feel like it's complicated. Come in on this, and Blue Owl is one thing, but the back and forth between the private credit guys saying, hey, everything's kind of okay, it seems like, and then you still have Jamie Dimon, who is, when you think about the financial system in the United States, when he says something, you stand up and listen. We've talked with this about you before. I mean, are you starting to see some concerns? Is anything growing in terms of momentum when it comes to maybe cracks, certainly in the private world, the private credit world?
Yeah, it's really interesting. We have oftentimes dubbed the relationship between private credit and public credit, so broadly syndicated loans, high yield, kind of banks in general, as the best of frenemies. There are definitely some frictions there, but then there are a lot of very complementary factors, not to the least the fact that a lot of the banks lend to these private credit firms. So, it's in the bank's best interest that private credit remains on a relatively stable footing as well, given that lending relationship. Now, when we zoom out a little bit and think about what has developed in private credit over the past, call it 3 to 5 years, there's been so much capital chasing not as many assets. And that oftentimes means that that competition for capital is going to result in some sort of erosion. It could be in terms of covenant quality. It could be in terms of lower pricing, which means that potential returns are a little bit lower. And I think that we're seeing some of the fallout or consequences from all of that capital inflow into private credit start to turn into some question marks about, what has actually occurred in this asset class. How many credit cockroaches are there? I think that anytime you're lending, there's going to be defaults. That's just a reality of credit as a whole. And it is also a reality that when you have a lot of capital that's flowing into one specific sector or type of asset class, you oftentimes see kind of a subsequent uptick in defaults just from that law of large numbers.
One of the criticisms of the entire private credit industry is that it's opaque, and the opacity concerns investors. They don't have the same regulatory environment that the big banks have. And I was struck what Mark Rowan of Apollo said earlier. We heard his comments there from the Bloomberg New Economy Forum in Singapore. The market's being $41 trillion. Most of the market is investment grade. He thinks a fraction of it, in his view, some $2 trillion, is below investment grade levered lending. Is that sort of if you look at the pie, would you agree with how that pie is sliced?
Yeah, I think that probably the pie slice is accurate, but I think that you can't underappreciate how important that below investment grade component is, because the growth has really resulted in a tremendous support or tailwind for public lev-fin markets like broadly syndicated loans, like high yield. When we've gone through periods of public market volatility, private credit has really stepped in to absorb some of the maturities of more stressed issuers or provide pretty big checks to help keep things moving forward. And if you have a coincident move where private credit is coming under pressure and you're seeing public market volatility, that could be a setup for a much larger streak of defaults than what we've seen in recent years.
One thing Shree, I want to bring you back here. As you guys report this out, keep an eye on what's going on in terms of credit markets, the health of the U.S. financial industry. Who are you talking to see, where there might be some cracks in the broader market, or broader credit market, I should say?
Look, when the cycle turns, and pretty much the universal belief is at some point the cycle will turn. I think what some of the more experienced executives want to point out that it is not going to be a question of this or that. It is not going to be a question of whether it's a private market that's terrible or whether it's the lending done at big banks. You will have some cracks in the market. But private credit or big banks, it's the same lending system. People who do good diligence and who do the legwork and who understand credit will come out looking good, and people who are tourists in the sector will end up with big losses. So when we talk about private credit concerns, you should be mindful of the fact that you necessarily won't see the biggest problems at the biggest players. You shouldn't expect the Apollos and the Blackstones and the KKRs to be at the forefront of any downturn. But there are many other smaller players, and especially those who are coming into this asset class because there is so much interest in this asset class. If you can raise money for a strategy and the interest from investors in the private credit strategy, it suddenly attracts a lot of new entrants. You have to worry about those players more than anything else.
Hey, Winnie, come on back in here. And I just want to hear from your view about exposure that traditional financial institutions have to this space. Big banks, they're often the ones who are lending money when it comes to these private credit firms. What's their exposure?
Yeah, so I think that a lot of people are trying to quantify that because there is this relationship between banks and non-bank lenders, with banks lending to the private credit industry. Now, I think in general, given how diversified big bank portfolios are, we can probably pretty safely say that this is not a kind of systemic risk looming, especially when we think of the leveraged finance component of private credit and that exposure on bank balance sheets. But within private credit, specifically, we do want to think about things like diversification of portfolios and outsized concentration risk, perhaps in lending relationships to sectors that might come under a little bit more stress in the near term. I think it's pretty well understood that there's a lot of healthcare in a lot of private credit portfolios. Car washes was another big one. And so thinking about that type of sector concentration and then zooming out that lens to kind of where the banking relationships lie, I think is going to be really important.
Just real quick, both of you, Winnie, let me start with you. Nothing systemic, though, yet.
No, we don't think that private credit is presenting, this existential systemic risk to the financial markets as of right now. We do think that perhaps private credit forward returns are going to look a little bit less attractive. And we do worry about some of that mismatch between kind of liquidity and what private credit structures actually look like. That could be also another kind of challenging angle. But from a broad-based financial systemic perspective, we still feel pretty from a bank's view.
Sri, the same question to you. The sources that you speak to in the banking industry and the private credit world, do they see this as being idiosyncratic or systemic?
I think it's more, they see it more as a reflection of market sentiment right now, because if you actually look at whether it's conversations or look at some of the numbers or look at some of the public commentary, right, which is banks keep talking about a resilient economy, still a resilient economy. They worry about storms gathering on the horizon, but right now they say the consumer is resilient, the broader economy is resilient. Similarly, if you talk to the big private credit players, they look at all the loans that they're making and they will come back to you and say, look, we're running far lower than historical default rates. We are not worried about that. I think the challenge that some of the private credit players are facing is the market sentiment and increased worry about the credit sector is coming at a time when the dividend yield on some of their products is also going down, largely because lending, making loans in a floating rate is a floating rate product. And when interest rates go down, your returns will naturally go down. So when you combine the two, it sort of scares away some of the investors, and that's what's being reflected in the markets.
All right, great discussion. So exactly what we were hoping to do. Sri, thank you so much. Chief Wall Street correspondent here at Bloomberg News, Natarajan, and CreditSight's Global Head of Strategy, Winnet Caesar, joining us out there from North Carolina.
Well, the U.S. Saudi Investment Forum 2025 is happening right now in Washington, D.C. Our own Anne-Marie Hordern is on location. She's moderating panels, conducting interviews on the sidelines of the forum. And right now, she's standing by with the Saudi Minister of Investment. Anne-Marie, take it away.
That's right. I'm here with the Saudi Minister of Investment, an individual who opened up the U.S. Saudi Investment Forum here in Washington, D.C., Khaled Al-Faleh. Thank you so much for joining me in Washington.
Good to be with you, Anne-Marie. Thank you.
So let's talk about some of these commitments we've heard from the president, from the Crown Prince. Yesterday I was in the Oval Office. The $600 billion quickly became $1 trillion, just in a matter of 60 seconds. And when you look through some of the deals that they're talking about, you hear the words commitments, MOUs. At what point do you think these deals will actually be inked, more solidified?
Well, this is actually a relationship that is quite reciprocal. Both countries benefit from co-investing with each other. There is no doubt that the American economy is the largest. The capital markets here are the deepest. I think something like 78% of the market cap of global capital markets is here in the U.S. And it's natural for an investment powerhouse like Saudi Arabia to be investing in the U.S. Also, we're modernizing, diversifying, and turbocharging our economy away, or in addition to, actually, our oil sector, which is going to continue to thrive, into new sectors where the U.S. happens to be the global leader, especially in tech and AI and healthcare and biotechnology. So I think it is natural. The capital in Saudi Arabia has been and continues to be abundant from our indigenous sources, government, PIF, companies like Aramco, which are growing their business, and they're generating from their revenue a lot of free cash flow that they need to deploy to grow and diversify their businesses. So it's natural for us to be looking at the U.S. for a majority of our future and current investment. And it's also equally compelling for U.S. investors to look at Saudi Arabia. We are one of the most dynamic and fastest growing economies in the G20, and we have many, many competitive strengths that actually make investing by American companies quite profitable and reasonably low risk, given them, the regulatory ecosystem in Saudi Arabia, the stability of the currency, which is pegged, the high credit rating, you name it. Saudi Arabia ticks all the boxes and then some. So the numbers that have been mentioned are natural, I think, given the scale of these two economies we're talking about. And they are mutually beneficial, hugely mutually beneficial.
When we first met, you were the Saudi energy minister. I used to follow you all over the world to ask you about the oil price. Where oil prices are trading right now, could Saudi continue to have that high level of investment with prices in the 60s?
Well, first of all, anybody who's been monitoring oil and oil markets like yourself would know that the market is highly cyclical. And after every downturn, there is a period of tightness because of demand being stimulated by extended long periods of low oil prices, and also by throttling the investment by some countries and companies. So I expect in the mid to long term, oil prices will be healthy, oil markets will continue to grow, and there will be plenty of investment. The other angle, I would say, is that investments in the kingdom are no longer correlated 100% with government spend, which is a function of short-term revenues from oil. That economy of Saudi Arabia has been superseded by Vision 2030, and we have, to a large degree, not fully, but we're on our way of decoupling the economy of Saudi Arabia from its strong correlation and interlock with oil prices. The private sector is the primary investor in Saudi Arabia, both domestic and international. As I said today in my opening remarks, FDI flows have quadrupled since Vision 2030 was launched in 2016, quadrupled. And as a result, our 80-year stock of FDI has doubled in the last 10 years. So in the last 10 years, we've generated more FDI stock than we had the previous 8 years. 90% of our FDI flows recently are not related to oil. It's in this, the sectors that are going to be driving the economy of Saudi Arabia tomorrow. Tourism is one example. Obviously, technology, cloud and AI, healthcare and biotech, education from the world's best universities are all coming to the kingdom and voting with their dollars and their money. So yes, oil markets will oscillate and prices will go up and down, but we don't invest on the basis of what oil prices are going to be next quarter or next year or the year after. The kingdom today is a magnet for global investment, and even Saudi investment is being reinvested at a very high place. And the kingdom, I would just end by saying, the kingdom has invested, all sectors of our economy has invested significantly, trillions of dollars abroad over the last 80, 90 years. And many investors are saying, we find the kingdom, Saudi investors, the best place to invest, and they're repatriating some of those stocks back to Saudi.
A lot of Saudi barrels, though, are going to Asia, namely China, but the dollars are coming to the United States. Do you think strategically today Saudi Arabia is closer to the U.S. than Beijing?
Well, we have actually quite a balanced global relationship economically, trade and investment. China remains to be predominantly our largest trade partner. The bilateral trade between Saudi and China is equivalent to the next 4 or 5 G7 countries. So it's quite significant, and that's going to only grow because of the complementarity between our two economies. China remains to be the world factory, and they manufacture at a low cost, and we realize they're also upgrading their technology capabilities, so they are good. And I'm happy to say, as a Minister of Investment, as excited as I am here in the U.S. about attracting American investment, I'm excited about attracting Chinese investment. We think, and we've seen a significant uptick FDI flows into Saudi. They're nowhere near where the U.S. has accumulated and continues to lead in investment in Saudi. But China is investing, and they will continue to invest. And we invest in China, too, for the reasons you mentioned. All of the barrels of hydrocarbons that go to China, we would rather process those in China in our own facility. So both SABIC and Aramco have been and continue to invest in that world #2 market, which is growing at a fast pace. And then we're seeing more investments in China and with China in areas where they are the global leader, especially in renewables. If you think of photovoltaics, wind energy, they're quite powerful country and economy in those sectors, and it makes a lot of sense for us to invest with them. Saudi Arabia continues to be guided by its own interests, and especially if they're aligned with countries who are like-minded and strategic partners to us. And I'm happy to say that we have that relationship both with the U.S. and China.
Khaled Al-Faleh, thank you so much for your time. That, of course, was with Khaled Al-Faleh, the Saudi investment minister here at the U.S. Saudi Investment Forum.
All right, Anne-Marie, thank you so much. Anne-Marie Hordern there in D.C. If you missed any of it, be sure to check out the interview at Bloomberg.com and on the Bloomberg terminal.
Hey, we are just about an hour and 12 minutes away from the close of U.S. equity trading on this Wednesday NVIDIA earnings day. Charlie Pellet has been watching everything happening very closely. Here he is for a business flash.
Thank you very much, Tim and Carol. A little change right now on the S&P 500 index. Down 6 now to 6610. Has been fluctuating, down 0.1%. The Dow swinging between gains and losses right now on the Dow, looking at a loss of 0.4%, down 186. NASDAQ higher, little changed ahead of NVIDIA, up 0.1%. Our Mag 7 index up 0.3%. And NVIDIA, the big story today, up now by 2% ahead of earnings. 10-year, 4.12%, with the 2-year, 3.59%. Gold up 0.1%, 4,073. West Texas Intermediate crude, 59.43 a barrel, down 2.2%. The slump in Bitcoin continues. 88,580 right now on Bitcoin, down 4.2%. Briefly, Adobe buying the marketing software company SEMrush Holdings for $1.9 billion. Adobe down 2.1%. SEMrush up 74.3%. Again, NVIDIA up 2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, gotcha, Charlie. Thank you so much. Yes, indeed, we're coming up on the last hour of trading, just about 12 minutes from now. But in the meantime, one group that we are keeping a watch on, so is Charlie, is retailers, which continue to report out their earnings. Target's lengthy slump persisted in the third quarter, underscoring the numerous obstacles that company and their incoming CEO faces, from intense competition to a weakening economy. I'm looking at Target shares down 3.6%. Tim, Lowe's really an outperformer today. It's up about 4.6%. That has its profit that topped expectations, helped by consumer spending on home renovations. And then my fave.
Also Scarlett's favorite.
TJX.
She has a credit card that is just a TJX credit card.
I used to. I got rid of it.
Oh, okay.
Yeah, but like
Scarlett loves TJX.
They'll always say when you're buying, because it's always like, big stuff, like it just adds up quickly. And they're just like, you really should open a credit card because you get like 10 or 15 or 20% off the first purchase.
Okay, well, the company posted sales last quarter above estimates and raised its outlook. Signaled that U.S. shoppers are turning to cheaper options as the economy shows signs of stress. With us right now, a Bloomberg News consumer reporter, Red Brown, and Bloomberg News specialty retail reporter, Lily Meyer. They both join us here in the Bloomberg Business Week studio. Red, I want to start with Lowe's because there was the Home Depot report yesterday that I think had a lot of people concerned. And the question was, okay, the lowering of guidance from Home Depot sent shares lower yesterday on concerns about consumer spending. Were we going to hear the same thing from Lowe's? We didn't.
That was kind of the expectation going in this morning, that we would you usually get copy-paste results from Lowe's. But it's interesting. I think with Lowe's, we kind of tend to forget it's a little bit of this turnaround story. So they've been really doing some of these initiatives to get their business back growing again. So they've really focused on things like their digital expansion. It seems to be gaining a lot of traction. They talked a lot about AI. I found this commentary really interesting about how it's already, their AI assistant kind of helps you shop. You ask what you're looking for. It's already getting 1 million queries a month. Wow. And they say it doubles the conversion rate. So it seems like they're making really good progress there. And another thing that they're doing to kind of copy Home Depot is expand their offerings to professional contractors. And that also seems to be really gaining traction. They had around $9 billion acquisition last quarter to kind of build out that business a little more. So it just seems like the divergence here with Lowe's and Home Depot is that just Lowe's is just making really steady progress on executing some of these strategies, borrowing a lot of Home Depot's businesses, but doing it maybe a little bit, at least the appearance is maybe doing it a little bit better than Home Depot at the moment.
I will say Lowe's is still down on the year, about 7% to the downside. Home Depot, though, is down about 14% so far here in 2025. Hey, Lily, I want to go to TJX because it did hit, I think, a 52-week high in today's session. It's up 21% year to date, but right now the stock's a little change, a little bit lower. A bit of a range, like more than a 4% range from peak to trough today. So what's going on at TJX? Although I should be able to tell everybody what's going on at TJX.
I mean, TJX is an interesting story today. You know, it really shows that consumers are looking for value. They want to get popular brands, they want to get designer brands, but they don't want to spend the premium that comes with a lot of other retailers.
And I also love like the whole TJ Maxx. I don't know how much you guys spend in TJ Maxx.
I've never been there.
On occasion.
I know. I don't know if it's a regional thing. Like I didn't have one where I was growing up. But
in California?
Well, where I'm from in California. I mean, it's a big state, but like, no, we had like we didn't have TJX. Maybe we do now.
Well, there's this like discovery factor,
from a small
right?
town.
Exactly. Like if you see something, like people always say, buy it because it won't be there next time around.
Why do people love TJX so much? Why is Scarlett talking about her credit card? Why is Mary Ross Gilbert from Bloomberg Intelligence? She said the same thing earlier on Bloomberg Intelligence Radio. She loves it too.
Yeah.
Why do people love it?
Well, I think people love the like thrill of the hunt experience of going into a TJ Maxx, not knowing what they're going to find, finding something from an expensive brand that maybe normally they wouldn't buy, or that's just much, much cheaper than they would find at another retailer. So I think it's a mix of the value, like you get really good deals and, you know, you have that experience of not knowing what you're going to get.
I forgot too that you do get a discount when you open, but you get coupons for when you spend. So like you have like a $5 coupon or a $10 coupon. So it's and they're like, yeah, but you're still paying for stuff. Let's go to Target. What do we see with Target here, Red?
Yeah, Target